10 million college graduates a year. Most countries don't provide that ecosystem in the world. We are an established consumer story, established technology story. The world thinks India is still it's not the easiest place to do business, but once you establish your ecosystem, it's a very robust place to do your business.
What does that mean in terms of returns?
In terms of, again, it all depends on benchmarks. I would say in the real estate business, India has been a top market for us for the last decade. We believe in this story a lot. India has been a top market overall for us compared to, but again, it's all dollars invested, and we love to invest a lot more, and hopefully maintain our returns and do even better.
We talked about all the stuff that's good and all the stuff that's exciting and gives you hope and reason to be optimistic. The few things that you believe are constraints and are holding back growth that require intervention.
I would say pace of deployment, both of government projects, private projects, capital deployment. I think that's something which we have to just make sure that everybody's motivated, because time is the biggest factor in terms of the same growth, if it happens over 3 years versus 1 year, has a very different meaning. So I think if we can just push the timing of our execution as a country, and all of us, not just the government or the agencies in the government, etc. The world is rooting for our success.
Yes, we hope that more and more will root for our success as well. But Ankur, before I let you go, so almost the middle half of 2026. How do you see this year closing? And more importantly, as far as the next year is concerned, because you did say very specifically that you believe this is an opportunity to press the pedal, what can we expect from Brookfield in India?
Part of being a long-term investor is actually being really bad at short-term. So if I were to guess what we'll be doing tomorrow, I'll probably be very, very wrong. But our target for doubling our business and making it more than $100 billion, I think the conviction today is bigger than ever before, and I'll just stick to that.
Well, all right, we wish you the very best of luck with that and look forward to having more conversations with you. Thanks very much for joining us here on The Record. Well, that is Brookfield continues to be as bullish on India as they were. In fact, perhaps even more is the message coming in from Ankur Gupta. $100 billion in assets under management, perhaps even earlier than the earlier estimate of 2030. That's the big headline coming in. From all of us here, for now, we'll take a break. There's a lot more coming up for you on CNBC TV 18. Stay tuned. We're back in a minute. Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The big stories that we're tracking for you this evening. The US terms the strikes on Iranian missile launch sites and boats as self-defense. Tehran calls the attacks a gross violation of the ceasefire as hopes of an imminent deal fade. Also pushes back against President Trump's claim that Washington was exploring options like third-party country transfers or supervised dilution of Iran's enriched uranium stockpile. The rupee snaps a 3-day winning streak, down 45 paise, closing at 95.68 against the dollar. Dalal Street erases early gains, ends lower. 12 of the 16 major sectors close in the red today. Tata Sons board reviews the performance of 5 key group companies, including Air India, at a crucial meeting at its Mumbai headquarters. The review gained significance months after Tata Trust chairman Noel Tata called for measurable milestones, capital clarity and greater discipline across group businesses. Vedanta chairman Anil Agarwal announces listing of 4 new demerged entities in June, remains bullish on copper, aluminum and oil and gas, projects a combined EBITDA of $10 billion in the coming years. That's an exclusive. India and Quad partners agree to mobilize up to $20 billion.
US President Donald Trump will convene a rare cabinet meeting as negotiations with Iran enter a critical phase. Meanwhile, Iran threatens to retaliate after the US carried out what it describes as self-defense strikes on Iranian missile launch sites and boats around the Strait of Hormuz. The IRGC also claimed that 25 vessels, including oil tankers, transited the Strait of Hormuz during the last day and night. US markets had a mixed session. A tech-driven rally lifted the S&P 500 and Nasdaq to record highs while the Dow Jones ended in the red. The Asian markets though continue their upward trajectory while the GIFT Nifty is indicating a slightly subdued start for our own markets. Oil prices edged lower after rising more than 3% in the previous session as negotiations between the US and Iran continue. Precious metals rise with gold hovering around the $45-50 an ounce mark. A confirmation of a CNBC TV 18 news break. The government will launch an offer for sale in Coal India to divest up to 2% equity. The floor price is 412 rupees a share. The OFS opens for non-retail investors today and for retail investors on Friday. We'll talk about all of that and a lot more right here on Power Breakfast. Good morning. You're watching the show right here on CNBC TV 18 in the Mumbai News Centre. I'm Hormas Fatakia. We move from one expiry to another. It was the Nifty monthly yesterday. It's the Sensex monthly in today's session. But we start off with how the Asian markets are trading this morning. And while some of the markets in the Asia Pacific are shut today on account of Eid, will be shut tomorrow, the markets that are open are doing fairly well for themselves. The Taiwanese index is up well over 2%. The Hang Seng is trading around the flat line, but the outperformer yet again in today's session is Kospi. 4.5% higher on the South Korean benchmark, and that is being led by SK Hynix, the other chip manufacturer, the rival of Samsung, which has hit $1 trillion in market cap this morning, just a week after Samsung had managed to achieve this feat as well. So both of these stocks are powering the Kospi higher, 4.5% on that index, and the Kospi is now up over 90% so far in 2026. Gains also coming in from the Nikkei, that's up 1.5%, and the Shanghai Composite is trading just below the flat line. So most of the markets are driven by AI. They are doing fairly well for themselves in today's session. But for our own markets, the GIFT Nifty, well, we had a pretty sluggish session yesterday, and the GIFT Nifty is also indicating a fairly sluggish start for today as well. The implied open suggesting a 100-point downtick as we speak. But let's set you up for today's trade. We'll tell you about the important cues that you need to watch out for, the stocks that should be on your radar, and of course the setup on the F&O side of things as well. Of course, there have been no overnight significant developments with regards to the negotiations between the US and Iran. Oil prices were higher, but they are still trading around about that $100 a barrel mark. The Brent it did cross 100 yesterday, but is yet again below those levels or hovering around those levels. So oil prices remain where they were yesterday, and that continues to remain the most important monitoring factor for our own markets as well, with what leads to a final agreement or whether there is one to begin with. Today, of course, is also the Sensex monthly expiry, and the fact that tomorrow is a market holiday. It will be interesting to see what kind of positioning do traders want to take, because the other markets will be open while we will be closed for a holiday. Of course, the fact that the broader markets are outperforming, that continues to remain another factor. The earnings reactions in the broader markets have been on the extremes on both ends. The Midcap index ending at a record high in yesterday's trading session. The only positive from yesterday, if you would want to call it that, is the fact that despite the market falling, the VIX was lower. The VIX was down around 3%, but if you are a pessimist, you would say that, oh, the VIX was down around 5.5-6% in early trading. It managed to claw back some of those losses and end 3.5% lower, still above the mark of 16. So to keep that on your radar as well. For the Nifty, well, it's a no-brainer. 24,000 remains the most important level. On the upside to watch. Then you go off to Tuesday's high of 24,088, and then to 24,250 on the downside. 23,800 remains the most important level to watch. For the Nifty Bank, though, the range remains the same, 55,000 to 54,500 on the downside. But for now, the GIFT Nifty is indicating a slightly subdued start for our own markets. We open most probably near that support zone of 23,800. Over to Upasna now, who would list out the stocks that should be on your radar today. Upasna, good morning.
Good morning, Hormas. Well, must say that a lot of stocks on our radar today as we enter the last leg of result season. First up, let me start with Siemens. Revenue growth at 14.6%, largely in line with the expectations, but it's a miss in terms of margins and profit. Net profit down 9%, margins at 10% versus 11% on year-on-year basis. Next up is IRCTC. The company beats its FY26 revenue guidance of 10% and even the margin guidance that is between 33 to 35%. If I talk about the Q4 PAT, that drops by 9% due to an exceptional item worth 46 crores in Q4 FY25. ONGC, overall it's been a soft quarter for the company. Net profit has taken a hit of 21%, revenue up 14%, while margins are also under pressure from 48% to 35% on quarter-on-quarter basis. Bayer Crop Science also in focus as net profit is up 13%, and overall if I talk about the numbers, they are largely in line, just a bit below the Kotak estimates. Revenue is up just about 1.2% and margins have increased from 16.3% to 18.4% on year-on-year basis. Next up is JK Tyre. Overall, it's been a good set for the company. In company's India domestic business has fared well this time around. Net profit up 80%, while the revenue has seen an uptick of 12%. Margins have also increased sharply from 9.7% to 12.7%. Next up is Gujarat Fluorochem. Net profit down 41%, revenue up 12%, and margins are under pressure by 200 basis points at 23% on year-on-year basis. And now coming to the Coal India, the CNBC news break has been confirmed regarding the OFS. Now, government to sell nearly 1% stake in Coal India via OFS. Government to also provide option to sell additional 1% stake in the company, and the floor price is set at 412 per share. And with this, the overall selling comes up to 61.6 million shares via OFS. So certainly a stock that will be on our radar today. And now coming to the April TRI-AI data, so certainly a lot of telcos will be in focus, especially when it comes to Vodafone Idea. It net adds nearly about 53,257 new users, and mind you, this is the third consecutive month that the company is adding. And lastly, coming to Satvik Green Energy, on the back of the order win, the company bags order worth 171 crore. So all in all, a lot of stocks on our radar. Will be keeping an eye out on all these in today's trading session.
There's a long list indeed. Upasana, thank you for those updates there. Lastly, Sudarshan joins in with cues from the FNO space. Well, Sudarshan, good morning. From one expiry to another today, what's the FNO data indicating at the start of the June series for NSE and the end of the May series for BSE?
Good morning, Ramas. So the month of May or the series of May is done, and historically in the June series, we have seen big moves. And let's see if this month also, or say the series of June 2026 also goes as the historical data suggests. But talking first about the yesterday's move, we did close in the red, but it was not a bad day of trade. If you go by the levels, Nifty managed to hold on to the levels, key levels, above key levels, though it closed below 24,000. It's the same picture for Nifty Bank. It remains above both 20 DMA and 50 DMA. Good parties. Nifty Bank too closed in the red, but it was not a broad-based selling. And broader market, if you see advanced decline ratio, it was almost same 1:1, and that's mainly because broader markets continue to see buying. Talking about the indicators, rupee, it did depreciate yesterday, but continues to hold on to the levels below 96. Similar picture for crude. It remains around 99 and remains below $100 per barrel. And India VIX remains at 3-month lows. Now talk about the June series. In the series of May, it was a flat. Nifty closed with a loss of 0.3%. In the June series, as I told you, historically we have seen big moves. So in June 2022, we were down 5%, 23 up 4%, 24 up 6.8%, 25 up almost 3%. And if you talk about the rollover also, it's at 70% versus 3-month average of 32.5%. So there also, it's not giving you the picture which indicates that we might see a big down move. Now, what about the trigger? So the major trigger that everyone knows about, the India-US deal, if there is any update, because everyone has been waiting and the commentary has been coming that it will happen next week, it will happen this week. So we'll have to see exactly when it happens. RBI policy on June 5, and there is an expectation that RBI may go for a rate hike. So we'll see for that also. FI action. Over the last few days, we have seen that FIs have been reducing short positions. Let's see if they return to Indian market. And lastly, monsoon update from the Met Department. That also will be watched very closely.
Lots of important triggers to watch even as the earnings season comes to an end. Sudarshan, thank you for setting that up for us. Well, of course, you earlier mentioned that oil prices are continuing to remain below the mark of $100 a barrel, but the same can't be said for a lot of other commodities. Manisha is here with all of those updates. Manisha, good morning. What's on your radar today?
Well, I'll start with the crude oil prices since you mentioned that. And yes, we continue to trade below $100 a barrel, and that's quite a sigh of relief. But yes, there's just so much uncertainty even now coming in from that area. The U.S. Secretary of State has said that it would take several days to complete, especially the unresolved issues like Tehran's frozen assets and unrestricted passage through Hormuz. In the meanwhile, it also is markets pricing in a 40% chance of a U.S. Fed rate hike in the month of December, and that is what is keeping the precious metals jittery as well. Having said that, it is off its lows and gold is holding above $4,500 an ounce, and silver is trading quite strongly at around $77 to $78 an ounce. But the major gains clearly have come in for the metal prices, with the Asian equities climbing to new highs, the tech-led rally that we've seen on Wall Street, and the renewed optimism surrounding AI and related technologies, which are going to use metals quite a bit, has led to gains herein. And then you have to watch China's industrial profits. That jumped up by 18% year on year between the months of January to April. That is supporting copper, aluminum, zinc, all of these metals trading in the positive in Asia right now.
Oh, yes, indeed. Aluminum prices, that is the key to watch in today's session. Manisha, thank you for all of that. Let's take a short break, get you all the updates from the US-Iran war on the other side. Steve. Welcome back. Getting you the latest on the US-Iran war developments. US President Donald Trump is set to hold a rare cabinet meeting as talks with Iran enter a critical phase. The meeting is aimed at securing a broader agreement with Tehran amidst a fragile ceasefire. Now, this comes after Iran threatened to retaliate after the US attack near the Strait of Hormuz. Meanwhile, Iran's Supreme Leader Ayatollah Mujtaba Khamenei, in his first public statement, said that the regional nations no longer serve as staging grounds for US military bases, adding that the US is moving further away from its former position with each passing day after the recent attack. Meanwhile, Israel continues its offensive in Lebanon. More than 120 airstrikes were launched in one of the heaviest days of bombing in weeks, as Israeli Prime Minister Benjamin Netanyahu said that his military was deepening its operations in the country. Now, here's some opinion from Amina Bakr, the head of Middle East and OPEC Plus Insights at Kepler, on how these tensions could impact the global energy markets.
Well, it all depends on the Strait of Hormuz. And what I'm seeing right now and the messaging out of Iran is that they are still going to be in control of the strait. They said that they're not going to be charging tolls, but they want to charge what is called a security fee or an environmental fee. And they also mentioned that it's going to be managed between them and Oman. We don't know what this framework looks like. We don't know what the tolls or, these payments, environmental payments entail. And even if we do get some kind of easing of the strait and the traffic, it would take maybe 2 months, optimistically, to kind of clear the backlog. These vessels need to unload and then go back again. And then you need this restart of supply to happen. In some countries, that could take, 4 to 5 months. So realistically speaking, we need a year of recovery to see the supply reach pre-war levels.
Let's now also listen to experts on the blockade of the Strait of Hormuz and developments in the negotiations between US and Iran.
He wants to try to get a deal done in time to tamp down the oil price and save the Republican Party in the Senate. And that's requiring him to do all kinds of compromises. But ultimately, he's going to have to revisit these things later because strategically they're suboptimal. Yes, I think you're right that they're framing it in a way that keeps the strikes contained within negotiations rather than allowing the markets and the world opinion to believe that the negotiation and the ceasefire are falling apart. And again, that plays to the president's concern about the election. But the key thing is that the president doesn't feel that he has enough leverage. The blockade is not providing him with an Iranian capitulation.
We see multiple changes in the marketplace going on at the moment. So I think if you just focus on the Middle East for a second, the first part is from a practical perspective, the Strait of Hormuz for container shipping remains closed. Vessels trapped. There's still over 100 ships sitting inside the upper Gulf that are unable so far to evacuate and get out of the upper Gulf. We have a land bridge supply chain which has been set up, but currently that's only able to transport around a third of the goods that would normally move in and out of the UAE, of the GCC area in the upper Gulf. And that means that all of the cargo that needs to go in cannot go in and get into Jebel Ali.
On to action from Wall Street then. The S&P 500 and Nasdaq closed at record highs, led by strength in the technology shares. The Nasdaq gained over 1%. The S&P 500 also was up 0.6%. The Dow Jones, however, was sulking a little, underperforming its peers. CNBC's Pippa Stevens gets us a wrap of all the action on Wall Street.
U.S. markets were mixed across the major indexes in Tuesday trading, with the Dow lower, but the S&P and Nasdaq closing at new all-time highs. The Dow dropped 118 points, the S&P gained 46, and the tech-heavy Nasdaq adding 312 points. SpaceX's Starlink has scored another win when it comes to in-flight Wi-Fi. American Airlines said it will install Starlink on more than 500 of its narrow-body aircraft starting early next year. SpaceX already has contracts with United Airlines, Southwest, and Alaska Airlines. Delta Airlines is planning to use Amazon's competing LEO service for in-flight Wi-Fi starting in 2028. And Ferrari shares fell after the company launched its first fully electric vehicle. The car is named Luce, and the Johnny Ive-designed car marks a departure from the aesthetic of past gas-driven Ferraris. The launch comes as other luxury car makers have scaled back on their EV plans due to weak demand. The car is priced at roughly $640,000, with deliveries expected to begin in the fourth quarter. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that, Pippa. Well, here's some opinion from Dan Greenhouse of Solace Alternative Asset Management on the corporate earnings and the U.S. consumer strength.
It's also important to note that even if you X out tech and comm services, the two big tech sectors, you're still growing in the mid-teens from an earnings growth standpoint. Margins are basically at record highs. Even if you X out tech and comm services, margins are doing quite good. So corporate America is doing phenomenally well now. And while justifiably we spend a lot of time talking about tech and how important it is to driving the overall market, I would also point out we've heard from a number of retailers in recent days, Walmart, BJ, Williams-Sonoma, et cetera, that have all basically said the same thing. Some version of, yeah, gas prices are up and people aren't happy about it, but they're more or less handling it pretty well, and we haven't really seen much of a behavioral change. So on top of the tech story, which continues unimpeded, you have a consumer that continues to do quite well.
Take a short break. All the cues from the world of AI on the other side. Stay tuned. Welcome back. All the updates from the world of AI. Mind you, there are plenty of them, and Rachna is here to summarize all of that for us. Rachna.
Well, we start with South Korea's memory chip giant SK Hynix crossing a historic threshold today, joining Micron and Samsung in the trillion-dollar club. The stock surged 11% on the back of explosive AI demand that we've seen in the past days. This is demand for high-bandwidth memory used in data centers. Shares have soared 250% this year alone, and now South Korea hosts two trillion-dollar companies. This is a first outside of the United States. Speaking of Micron, that crossed the same threshold yesterday. The stock surged 18% after UBS nearly tripled its price target to $16.25 a share, citing strong AI demand and long-term supply deals that lock in favorable pricing for years ahead. Then there's SpaceX, that we know that it's headed to public markets next month with an expected valuation nearly $1.7 trillion. Potentially the largest IPO in the history. But behind closed doors, Elon Musk and his team have been discussing a possible merger with Tesla. While antitrust concerns appear limited, shareholder dilution risks for Tesla holders are substantial here. Betting markets assign only 33% odds to merger by next May. But SpaceX AI growth story faces a credibility problem as well. Reuters has found that Elon Musk's Grok chatbot has barely gained traction with the US government, the world's largest potential customer of over 400 government AI deployments last year. Only 3 used Grok. By contrast, OpenAI technology powered 234 deployments. The gap raises questions about SpaceX's $1,750 billion valuation here. Meanwhile, the White House is reshaping its AI governance structure. Former Attorney General Pam Bondi has been appointed to head a new advisory panel on government industry coordination and national AI infrastructure. Bondi will facilitate cooperation between federal agencies and AI companies. This is a signal that Trump's team is moving away from heavy-handed regulation after its planned AI executive order stalled last week. Also, SoftBank is positioning itself at the heart of AI infrastructure build-out. The Japanese conglomerate is preparing IPOs for 2 spin-offs: SB Energy, its power and data center developer, and Rose, an autonomous robotics platform. SB Energy could raise $50 billion or more. Rose targets roughly $100 billion in valuation, reflecting investor appetite for the picks and shovels layer underpinning AI. Back in India, Microsoft says the country has reached an AI inflection point. 47% of Indian enterprises now run AI in production, faster than peers globally. India hosts the largest GitHub developer community at 27 million members. Microsoft's $17.5 billion India investment reflects the nation's strategic importance to sovereign AI build-out. That's what the CoreWave AI had to say about Microsoft. And finally, India is testing new infrastructure approaches. Red Balloon Aerospace, based in Andhra Pradesh, is launching a stratospheric super pressure balloon in Q2 designed to deliver telecommunications and imaging coverage to rural areas where traditional towers cannot reach. So we will look for more visuals, and we will present you more visuals from that launch, and we're also scheduled to speak to the founders shortly today.
So much to track. 50 billion, 100 billion, almost sounds like loose change now, all these valuation numbers. Rachna, thank you for that summary. Take your leave on this edition of Power Breakfast. From me and the team, thank you for watching. Bazaar Morning Call on the other side sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant with me, my colleagues Nigel and Rima. Guys, hi, morning.
Hi, morning.
Hi, morning. Well, there was no Trump post, right, on Iran overnight? Not yet, right? Well, that's good news. I guess that's status quo. But there's so much to talk about AI, and the gap between the AI haves and the have-nots just seem to be widening day by day.
Absolutely. Well, that's right, guys. So we get through today's trading session, go in for a bit of a break and come back on Friday. But
and it's the Sensex monthly expiry today. That got preponed from tomorrow to today.
Yeah, that's right. So it's going to be interesting with regard to the market share as well. But we had one expiry yesterday. Today, another expiry. Let's get straight to the action.
Absolutely. And I think it didn't go well. At least I think some amount of expiry action, expiry-related moves yesterday. The market selling off on the day's high. And we'll get to that in just a bit. So oil prices are still there, $99. I mean, just like a customary check on the prices as we start every day in the morning. I mean, you know, we are not very different. I mean, over the last 3 days, we've basically been around these levels, 97, 98, 99. Fox News basically saying that that President Trump is going to meet with his entire cabinet later today. So it was apparently supposed to happen at Camp David. Now it's happening at the White House. But apparently the full cabinet is going to be present. And they're going to take up the Iran issue. I'm not sure what to read, what to make of it, etc. But hopefully this is perhaps a pathway towards, you know, concessions will need to be made. I think that much is very, very clear from both sides. And whether that will require a broader sign-off, we don't know. We'll see. Now, U.S. equities rose to a high. They were, of course, shot on Monday. Yesterday, they traded, and it's a new all-time high. S&P 0.6 up. NASDAQ ending about 1.1% higher. And, you know, that's the NASDAQ composite. But the NASDAQ 100 hit 30,000 for the first time ever. So it's quite incredible. And I just went back and looked at the time when ChatGPT was launched. NASDAQ 100 was at 10,000. So it's basically 3x from the time that ChatGPT came through. You know, I've said this before. We use the word seminal too loosely to describe, I mean, everyday events. And, well, we say, well, that was seminal or that is. But I think this is it. This is one of those events which really is, at least it looks like 4 years from that launch, changed the world in more ways than one, in so many ways, so many different ways. By the way, the NASDAQ 100, and, you know, just take a look at this. Yesterday, when the NASDAQ 100 hit 30,000 for the first time, 50% of the stocks were in the red. So, again, I mean, within that bunch of stocks, which are all primed towards sort of, you know, servicing AI in one way or the other, even within that, it's a kind of sort of narrower set which is doing well. Anyway, the index is up 19% this year so far. That is the index, and it's the second best start to the year in 25 plus year. That's quite something. And just talking about that, Micron is the latest trillion-dollar company. It was up 19% yesterday after earnings and a couple of brokerage upgrades, etc. But $1 trillion in market capitalization. So memory has been the name of the game, at least for the last year and a half. And Micron very much at the heart of it, at the center of it. We've seen this, of course, with Samsung, you know, SK Hynix and others as well. Now, just some macro commentary. This is not very much. I don't think it moved the needle in that sense, but you know, a Fed voting member said that a prolonged Iran war could spur a series of U.S. rate hikes. You know, the 10-year was flattish. I mean, not very, I think about 2 basis points changed. The rupee pulled back. I mean, it had about 2 or 3 days of very strong gains. But yesterday, of course, ended weaker, 95.68 compared to 95.23, which was the close on Monday. So we'll see how we start this morning. But, you know, as we go into the holiday, once again, expectations are in the direction of perhaps progress towards some sort of an agreement, some sort of a deal being made. But how much do you trade anticipation? How much do you trade hope? And how aggressively can you do it? That's the question. Even last Friday, if you remember, as we were heading into the last weekend, the Nifty ended about 90, 100 odd points higher. It's basically on the back of hopes that, you know, something positive comes out. Some positive did come out, at least in terms of commentary. And Monday, the market followed on with more gains. But, you know, so we're in that general mood, general frame of mind even now that perhaps the direction of travel is towards de-escalation, etc. So tomorrow is a holiday. The resistance 24,300 and the support is 23,800 or so on the downside. That's a range. I mean, we've sort of bounced around up and down, below and above these levels so many times in the past. But those are pivots, at least in the very, very near term. Nigel has walked across to the wall with a quick sense of how the futures and options positioning is looking. Nigel, take it away.
Well, May was a flattish month, and yesterday's downtick will be attributed more towards the monthly expiry that played out. But June seasonality remains moderately conservative. And over the last 10 years, if you look at it, the Nifty has delivered positive returns in 60% of the June series, average return of close to around 1.5%. The bulls will hope for the same to continue. In terms of the rollover picture, the Nifty futures rollover stood at around 70%, more or less in line with what we've seen in the past, though the short rollovers continued. And there is some aggression on the short side as well. That was clearly evident, though in absolute terms, 70% is in line. Even if you look at the Nifty futures open interest, at the start of the series, June is similar to what we saw in the month of May. So no big change out there, as heavy, as light as what we've seen in the previous series. Well, the FI positioning of the future should come up for you on the screen. And they're a little less short, if you look at it, at the start of this series in compared to the May series. So they're short, but a little less short in absolute terms. Though on stock futures as well, they're a little less net long. So that mix continues with them being net long on stock futures as well as net short on index futures. Clients, in terms of the futures action, well, they remain net long, almost similar to what we saw at the start of the previous month. But on stock futures, their long positioning actually is a little bit higher than what we saw at the start of the last series. That's on the stock futures. So the broader market setup remains positive. Stock-specific opportunities likely to continue rotational leadership as well as likely to dominate market behavior. And this is going to continue to remain a very stock-specific market. In terms of levels, the recent low, that's on the 13th of May. That's going to be the first reference point on the downside, in terms of you don't want this level to get breached. But the first reference point will be the 50-day May. That comes in at around 23,680 or thereabouts. On the upside, I think the bears are positioned that they won't let this 24,250 to around 24,500 mark to get breached. And the Nifty Bank's role is going to be extremely crucial because 2 sessions back it went ahead and it conquered that 20 as well as 50 DMA. Yesterday it pulled back 250 points, but it continues to hold about those levels. So it's imperative that the Nifty Bank holds on to its own, get some support from Reliance Industries, and that's what could take this market to around the 24,500 odd mark. The odds at the start of the series are stacked towards maybe a bit of a positive bias. Cues to track, the monsoon is going to be important, the upcoming RBI meeting is going to be important, and the street is factoring in a more or less status quo out there. ECB as well, they're widely expected to hike interest rates out there. So those are the central bank action, RBI, Fed, as well as the ECB. Well, if you look at the weightage, on the MSCI Emerging Market Universe Index, the Taiwanese index clearly, as well as the Korean index, because of the AI play, there's been a big increase over the last few years. While India, well, the increase hasn't been that much. But keep in mind, in 2024, India's weightage went from around 8% all the way to around 20%. And, then, in fact, we have come back down to around this 11.2% or thereabouts. And if I plot the chart of the MSCI India versus the MSCI Emerging Market Index, it's now at the lower end of the rising channel that we have drawn all the way since 1996. In short, IFL had pointed this out in their overnight note, and it appears that the risk reward could turn favorable for India with this underperformance from the emerging market. So we'll have to see how that goes, but that's an interesting statistic that they put out there, IFL Alternative Desk. So we'll keep an eye on that.
All right, thank you very much for that. Taiwan overtaking India in market capitalization is a big story, and this is at a time when India's GDP is 4x that of Taiwanese market. A quick check on the GIFT Nifty before we proceed, suggesting, I think, a mildly lower start. Yesterday as well, the benchmark indices lost about 0.5%, but the good news is we held on to support levels and now 85 points lower on the GIFT Nifty. A check on Asia before we get things going. It was fresh highs on Wall Street, but it was all to do with AI. So it was names like Micron, 20%, Seagate, Broadcom, AMD, which is why this morning, again, you can see the gains coming through in the Taiwanese market. That's up 2.7%. Kospi is up nearly 5%. The Japanese market, too, is up nearly 1.5%. So that digital divide between the AI winners and losers seem to be widening. We'll talk more about it, but let's get in our first guest on the show. That's Candice Browning, Head of Global Research at BofA, joining in on the show. Thank you very much, Candice, and great to have you on CNBC TV 18. But first about the economy, and markets seem to be surprisingly resilient despite rising geopolitical uncertainty around US-Iran situation. It's been nearly 3 months now. Do you think, in a way, investors are underestimating the macro risk from a prolonged energy shock? Or is the market effectively betting that this remains a contained event? What's your own view?
Well, yes, I think, we just finished doing a global fund manager survey. So we actually surveyed more than 200 institutions that manage, over $500 billion in assets. And the results were quite interesting this month. Basically, about 54% of the respondents expect the Strait of Hormuz to be fully opened by the end of June. So investors are, effectively looking through the problems with the strait, and they think that it will be opened and that therefore oil prices will probably, decline and end the year somewhere around $85. So whether that's optimistic or too optimistic or not, I guess we will definitely find out. But this data point shows you clearly that investors are simply looking through this, and basically what's happened is rather than focus on the Iran war, they're focusing on the continuing proliferation of capex around AI infrastructure. So there's been a trade-off between those two.
All right, Candace, got that. Well, let's focus on another aspect then. One of the biggest debates globally right now is whether we're entering a stagflationary phase, which means high oil prices, sticky inflation, and slowing growth. How seriously is BofA thinking about that risk, especially for markets like the United States as well as the European economy?
I think it's definitely a risk. I think basically what's happened with this Iran situation is that it's what I would call a stagflation shock. And so, we have a somewhat different outlook about interest rates than we did at the beginning of the year. We definitely think there is more of a tilt towards tightening of monetary conditions rather than the looser conditions that existed at the beginning of the year. However, we think it's still a little bit too early to actually call for rate hikes. So while we're concerned about slower growth and higher inflation, we don't think that there are going to be any Fed hikes this year. We do expect that there will be hikes in Europe, about 50 basis points.
Got that, 50 basis points hikes in Europe. Candace, from an asset allocation perspective, at least up until now, capital is concentrating and moving towards U.S. equities, particularly AI trades. Will that continue, or are you beginning to see a broader rotation into other assets like commodities, other emerging markets, real assets? What's your view on asset allocation from here on in terms of risk reward?
Well, we still are quite bullish on the U.S., assuming that this situation in Iran does get solved over the next couple of weeks. While we see potential long-term opportunity in frontier and emerging markets, we don't really think that that's going to be realized until the situation in Iran is over. For example, as you know, India is very highly dependent on imported energy. So we continue to see that this energy problem is going to hurt some of the emerging markets and frontier markets. Whereas if you look at the US, yes, we do have higher, gas prices, but on the other hand, we're still benefiting from this AI boom. And you can really see that in corporate earnings, which, this most recent quarter were up strongly, double digits. So the earnings growth of the companies in the S&P 500 continues to be extremely robust.
Okay, got that. Candace, let's speak about the AI boom then. From Wall Street to Taiwan to South Korea, almost every major market rally seems tied to AI in some way or the other. Are we still in, early in the innings on this? Or are we running a little bit ahead of expectations? Is it getting into a little of, it's getting a little excessive? And what makes this AI cycle fundamentally different from past tech booms?
Well, I think, if you look back to the internet, the beginning of the internet, actually, a number of those companies were unprofitable, completely unprofitable. A lot of these companies are, in fact, very profitable. Now, you could look at the spending on AI in terms of CapEx right now and say, that's a lot of money and it's not generating, a lot of revenue right now. But the reality is that, this investment is going to continue for 12 to 18 months. We feel pretty strong about that. And obviously, the jury is still out in terms of what the revenue generation capability will be from these new technologies. So I think it's too early to call this a frothy or a bubble. I think the jury is frankly still out on it.
And Candice, what about India? We've seen an FI exodus. Global funds have pulled out nearly $22 billion out of Indian equities just this year alone. Is it purely a relative trade, money rotating away from India into Taiwan, Korea, chasing the AI premium, or is this a structural shift?
No, I think that India in particular has been hurt by its, dependence on importing energy. So any policy changes that relate to better energy security, I think, would really benefit India. And I think in some also, the losers of this, India so far has been one of the losers as a result of the Iran war in terms of, equity valuations. But, if the war ends and oil goes back down, I think India's got some great structural wins behind it. So I think that the losers of recent months could become the winners, by the end of the year. So we're quite sanguine on the Indian market over the long term. We think these problems are relatively short term.
Got it, Candice. Final question before we let you go. India has been the loser of this AI trade. But like you said, will the war ending and oil prices coming down alone fix these foreign outflow problem? Or what more is required to see the FIs return back to India?
Well, it's not going to 100% fix it, but it certainly is going to have a very, large impact. I think, India in terms of demographics has a lot going for it. And also, with positive policy changes and continued deregulation, I think India would have a lot of forces that would be beneficial.
Let's hope. Candice, great chatting with you. Thank you very much for speaking to CNBC TV 18. Look forward to the next one already. Let's get to the interactions lined up on the show today. So coming up, 8:35, the management of Yatharth Hospital will talk about Q4 earnings. 9 a.m. We'll be joined by ICICI Securities Probal Sen to talk about oil and gas space, ONGC numbers. 9:20. Deepika Mundra of M&G Investments will be our market master for the day. 9:30. We speak to Aren Keptian of UBS on markets and more. Following that, the management of EID Parry will chat with us. 9:40, 9:50, another earnings conversation with the management of Acres. Towards the end of the show, Lata will speak to 4 trade economists on whether the spate of FTAs can one day bridge our current account deficit. Stay tuned.
Time to slip into a quick break. We've got a lot of stock-specific action track for you when we come back on the other side. In our top 10 segment, we're looking at Siemens, IRCTC, JK Tyre, Corrado India, Senco Gold and Vodafone Idea. All of them will be reacting to positive news flow, while Coal India, ONGC, Transrail Lighting and Equus will be reacting to negative news flow. Take that break, come back, we get into further detail on all of those names.
Welcome back. You're watching Bazaar Morning Call. It's time to talk stocks. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. Nigel, you go first. Coal India OFS.
Well, that's right. Coal India OFS has been announced, and our news break here at CNBC TV 18, where my colleague Vivek had broken on May 7th. That's got confirmed. Let's tell you the details. The government will sell 1% stake in Coal India by the OFS route. They'll be looking to sell close to around 6.16 crore shares by the OFS route, and the option to sell an additional 1% stake. The government, remember, currently holds around 63.13% as of March 2026. So if they go the entire hog, then it'll come down by a couple of percentage points. But just looking at the floor price at around 412 rupees per share. And, at this floor price, the government can garner close to around 2,539 crores odd. But if they go for the green shoe option, then it'll be double of that, which will be more than 5,000 crores. And that is at, the floor price. I expect, the closing price actually will be a little bit higher than that floor price of around 412 because it's at such a sharp discount. In terms of when you can apply, today it will be for non-retail. We'll have to wait by for the cutoff price because that will be the reference point for retail when the OFS will open on Friday, which is the 29th of May. So the stock opens gap down. Yesterday, if you look at the intraday chart, the high of the day was around 475 rupees. It ended at the low of the day. The street had a bit of a sniff. Stock opens up in the red. And then I think we see a good amount of subscription coming in because the government has picked an opportune time to go ahead and sell the stake in Coal India. That said, let's focus on another PSU. Sudarshan joins us to tell us about ONGC. Sudarshan, morning.
Good morning, Nigel. So it was a soft quarter for ONGC, and the main culprit was a sharp drop in the production that we have seen for both crude and gas, and also because of higher OPEX and travel write-offs. This is a sharp drop we have seen for both EBITDA and margins. So talking about the headline numbers, revenue has seen an increase of 13.9%, but EBITDA has fallen by more than 17%, and there's a sharp drop in margin. It has come in at 35.3% versus 48.4% that company had reported last quarter. And if you talk about the production, crude production was at 4.95 million tons. That was down 6% YOY and 3% on a sequential basis. Gas production too has fallen 4% sequential basis. Brokerage though largely positive on the stock. Jefferies maintains buy call with a target price of rupees 360. But because of being a soft quarter, I'm going with red.
Thank you very much for that. Vinny, how did Siemens numbers look?
Not so great. Revenue, yes, came in line with expectations, around a 14.6% growth that we're seeing on a year-on-year basis. But the margins, that's where the miss came in, right? The EBITDA margins came in at just 9.62% versus 11.5% last year. Expectation was also of around 11.25%. So clear miss there. Why was the margin a miss? One, we had seen higher commodity costs, rupee depreciation. All of that overall impacted the profitability of the company as well. Now, when you look at the segment-wise performance as well, right, what you're seeing is smart infra and digital industry. Those margins also saw a drag, and that is what led to overall drag in the margins of the company. Order book and order inflow for Q4, that came in at 6,731 crores, which is up around 33%, which included orders from the parent company of around 1,800 crores, mainly in the mobility segment. Apart from that, order backlog for March 31st, March 2026, that stands at 45,000 crores approximately. But not a great set of numbers, missing the margin expectation. We could see a downtick coming in on the stock.
Thank you very much for that. Let's go across to Devyani now on IRCTC.
Well, a good set of numbers coming in from IRCTC. Now, the revenue growth has surpassed management's FY26 guidance of 10% revenue growth on a year-on-year perspective. Now, this is primarily as a result of the Q4 being good, with revenue growth of about 15% year-on-year, driven by strong catering performance of the company. Now, EBITDA increases by 6% this time around, but margins have been weak across the ticketing, catering, as well as the tourism business of the company. Now, PAT is down 9% on a year-on-year perspective, but that's primarily as a result of a 46 crore exceptional gain that was seen in Q4 of FY26. So all in all, a good set of numbers coming in from the company, going with the green on IRCTC in trade today.
All right. Thanks very much, Devani, for that. Well, JK Tyre and Carraro India are the next two names we want to focus on. Sud is here. Sud, morning.
Morning, Prashant. So it was a good set of numbers from both JK Tyre and Crowd India. So first talking about JK Tyre's India business continues to lead the growth, and this segment forms almost 90% of total revenue. So overall revenue has increased by 12%. EBITDA has seen a jump of 48%, and gross margin too has increased by 230 basis points YY. On a sequential basis though, it was a minor fall. Talk about the segments. India business revenue was up 15%. Margin here has increased by 300 basis points. And Mexico business, that forms around 10% of total revenue. Their revenue was down 16%, but margin here too has seen an increase of 120 basis points. Coming to Crowd India, it was a strong growth. Both the segments, domestic as well as exports, especially exports, that segment has seen a growth of almost 70%. And because of that, company has reported revenue increase of 37%, EBITDA has seen a jump of 45%, and margin has increased to 11.6% versus 10.9% in the same quarter last year. Two major segments, agri vehicles, for their revenue has increased by 37%, and construction vehicles revenue too has seen an increase of 36%. So I'm going with green for both JK Tyre and Carraro.
Thank you. For more earnings, Vinny is joining in.
All right, so first up, we'll talk about Transrail Lighting. Red expected here as well. Revenue declined by around 4% on a year-on-year basis. Margin have fallen by 90 basis points. Overall, weak numbers have just come in from the company. FY26, though, the management had given a guidance which they managed to hold on, but nothing exciting in terms of numbers. Their order inflow coming in at around 8,500 crores for the full year. An order book includes an L1 order of around 16,361 crores other L1 orders for the period of FY26. All in all, we'll see red here. Senco Gold, that's the next one. We are expecting it to open up in the green. They've seen a strong performance coming in Q4, 45% revenue growth. Margins have come in at 13.7% as well. There's a bit of an impact in Q1 that one could expect now of custom duty hike. Management commentary, they remain optimistic on FY27, expecting around a 20% revenue growth, and margin guidance of 7.5 to 7.8% for FY27 is what they've given. So some bit of green here as well. Equus, that's the company that we'll watch out for on the back of the numbers. Revenue was better than what the street was expecting, but here profitability was weaker than estimated. Consumer segment of theirs, the margin saw a sharp decline coming in. Revenue, the sharp rise in inventory impacted the overall cash flows of the company. So we are expecting red here, and the management expects revenue growth of 45 to 50% is what they've guided in their con call. So that will be key to watch out for. But as of now, nothing great in terms of numbers versus what the street was expecting. So red here as well.
Thank you very much for that. And a quick word on the telecom subscriber numbers for the month of April as released by the TRAI, Telecom Regulatory Authority of India. I think the key standout is Vodafone Idea, because Vodafone Idea has managed to add subscribers for the third consecutive month. So in April, they've added about 53,000. This compares with a 1 lakh addition in the month of March, and in February as well. It was the first positive month after a very long period of bleeding subscribers. So for Jio, largely steady, around 3 million. Bharti has seen a drop in April at 5 million, at 3 million versus 5 million. But March was particularly strong for Airtel. But as I said, the standout is Vodafone Idea, third consecutive month of positive subscriber addition, and the street will want to see this continuing. So let's do a quick recap then of the top stocks. Stocks with positive news flow are IRCTC, JK Tyre, Carraro India, Senco Gold, Vodafone Idea. Stocks with negative news flow are Siemens, Coal India, ONGC, Transrail Lighting, and Aegis. That's equities. What about commodities? What's happening here? Manisha is now joining in for a complete roundup. Manisha, good morning.
Morning, Nima. Thank you for that. Well, I'll start with the crude oil prices, where we continue to trade below $100 a barrel, even after some gains that we saw in the markets yesterday. Well, it really has to do with the U.S. Secretary of State statement saying that it could take several days to complete the peace negotiations therein. There are some unresolved issues like Tehran's frozen assets and unrestricted passage through Hormuz. In the meanwhile, you also have seen gold and silver prices kind of trade steady. Gold is back above 4,500, so is silver at around 77 to 78 $8 an ounce. Markets actually now pricing in a 40% chance of a U.S. Fed rate hike in the month of December. But the gainer in the segment clearly is the base metal prices. The dollar index has eased a bit. The Chinese data has come in on the positive side. The Asian equities are climbing to new record highs. And the tech-led rally on Wall Street does tell you that the AI and the related technologies are going to be using metals way more than what the earlier estimates were. So that is exactly where copper, aluminum, zinc seem to be getting their support from.
Okay, all right. Thanks a lot for that, Manisha. Well, time to slip into a short break. On the other side, the management of Tata Hospital will be waiting for us. Stay tuned.
Okay, welcome back. There's 30 minutes to go for the pre-open session. Yatharth Hospital is the first management on the program. The company's reported the highest ever revenues. It's also guided that newer hospital mix will elevate the group average revenue per occupied bed. Yatharth Tyagi is whole-time director at the company. He's with us now. Mr. Tyagi, great to have you with us here. Thanks for joining us. Could you just sort of, break this up for us? New hospitals, which is Faridabad Sector 20, New Delhi, Greater Faridabad, contributed about 22% of revenues in FY26. What was occupancy and what is EBITDA trajectory and break-even timelines here?
Good morning. Thanks for having me. So yes, the three new hospitals that we have started, as you mentioned, have been a major contributor to this 46% YOY, growth that we've seen in the quarter four growth that we've seen. These three hospitals specifically, if we talk about today, Faridabad Sector 88, which technically lies in Greater Faridabad, is a hospital we started around 15 months back. This hospital has today, broken even. In fact, for this financial year, this hospital is also PAT positive as far as P&L is concerned. The other two hospitals, the Model Town Hospital in New Delhi and the Sector 20 Faridabad, which combined together have a capacity of 700 beds, have been started in this financial year, and both are showing great occupancy. We feel that probably in the H2 of the new financial year, these two hospitals will also be break-even. As far as occupancy is concerned, both hospitals are showing a decent amount of ramp-up, both having upwards of a 30% occupancy as we speak today.
So Faridabad Sector 20 and the New Delhi Hospital, the new ones, break even in H2 of FY27. Now, there's a big gap between your consolidated margins, which stand at 21.9%, and the margins X of these new hospitals, which is 30%. Now, as we progress towards break even, what would consolidated margins look like, Mr. Tyagi, in FY27? Could you help us with a broad range or a number that you're targeting?
As far as margins is concerned, I think even for this quarter four, we are on track as far as our guidance is concerned. For the full financial year for 26, we mentioned we would be somewhere around 24-25%, and we are on that track. For the coming years also, we feel that the EBITDA margins would also be in this trajectory. However, we are quite confident that in the coming financial year, the EBITDA margin should show some upside. As I mentioned earlier, these two new hospitals would be break-even. So the EBITDA drag of these two hospitals will not be from the H2 of the new financial year. So we do see an upside in the margin for the coming years, somewhere between 24 to 25% would be a right guidance.
So you're maintaining your margin guidance of 24 to 25%, but you're saying it will be higher than FY26 margins of 24.2%. So you should end closer to 25%.
The reason for a higher margin than FY26 is, the EBITDA drag for these two new hospitals. And it's also important to note the new Agra hospital that have, just been operationalized this Q4 is already, a EBITDA positive hospital since we started it. It was already a running hospital. We acquired a running asset, and in Q4 it has shown a margin of somewhere around 16%. So that will also contribute significantly going.
What about the revenue guidance, Mr. Tyagi? Last year you did about 36%. This year, what are you looking at?
We have a lot of, room as far as the revenue growth is concerned. The major reason is the growth in the RPOP. Another reason is the ramp up of the new facilities. We have added around 1,000 beds as far as financial 26 is concerned. So in the coming years, the huge ramp up of these new beds will be seen. I think we're quite sure the 36% YOY growth that we have shown this year, we should be surpassing that growth.
Right. Bottom line, you've put out a number. Mr. Tyagi, what is the guidance?
Yeah, I think the company has shown tremendous growth as far as the CAGR for the last 3 years is concerned. I think for the coming 3 years also, as far as bottom lines and other numbers, we should be maintaining that trajectory.
Okay. And you said you want to get to 5,000 beds, right?
Yeah, so currently with the 3 new hospitals operationalized this year, we are 2,600 beds. The announced capacity is 3,200 beds, which includes the new acquisition of Gurugram that we recently done, which will be operationalized from the first quarter of FY 28, as well as the Agra and the Model Town Hospital. There's a brownfield expansion also being planned for the Greater Noida and Noida extension. So announced capacity today stands at 3,200 beds. We do target 5,000 beds in the next 3 years, but I think we should be able to achieve it much earlier.
Sorry, operational beds are how many? 2,600?
The total bed capacity today of the group stands at 2,600 beds.
And you have given a guidance for another 900 beds?
Yes, yes.
And so you have visibility in terms of how you're adding these 900 beds right now. So that's...
These are done deals. So these are on track. They just need to be operationalized here.
And the next 1,500 beds after that?
Would be coming in, as I mentioned, would be a mixture of acquisitions as well as brownfield and greenfield. These would be primarily in the areas of North India, primarily in Delhi NCR. That's where we have presence. In the past, we have shown and we have followed a cluster-based approach. So, today we have 3 hospitals in Noida, 2 hospitals in Faridabad. We have started a new cluster in Gurugram. So we believe in being the largest players in the cities we operate. So we would follow the cluster-based approach to reach this guidance of 5,000 beds.
By when, Mr. Tyagi? 5,000?
See, the guidance is for the next 3 years, but we are quite sure the company should be achieving it much earlier.
So this is 27, by end of 28, you should be 5,000 beds?
I think before 29, that's the target.
Calendar 29?
Yeah.
Okay. Your debtor days also improved. It stands at 112 versus 125 days. Could you tell us what helped in the improvement? Was it the payer mix shift, collections improved? And when do you get to 100 in terms of debtor days?
There's a mix of all the 3 things that you've mentioned. Yes, there were improvement in the payment cycles as far as certain government schemes are concerned. Also, we did see a shift as far as the bigger pie of private insurance, international patients, and self-pay patients increase in our revenue. Debtor days did come down because of that also. Going forward, we are sure of bringing these debtor days somewhere close to 75, after 2 financial years are concerned.
Okay, so 75 is the target, but after 2 years. Thank you. Thank you, Mr. Tyagi, for joining in and wish you all the very best.
Thank you.
All right, let's get into a short break. On the other side, we'll connect with Deven Choksi of DR Choksi FinServe. Stay tuned.
Welcome back. Hope you're having a good morning. We start off a new series. That's a June series. And history suggests it's been more positive than negative over the last few years. Though for starters, we're likely to pull back close to around 80 to around 90 points or thereabouts. But let's go across to Hormuz. He joins us to tell us about all those big movers yesterday. And Hormuz, some backed and some not backed by delivery. Go ahead.
Morning, Nigel. And Adani Group stocks have been doing fairly okay for themselves over the last couple of days. And Adani Total Gas is one of them. It was among the top Nifty 500 gainers on Tuesday, with a fourth straight day of gains for the stock, the biggest single day gain in 3 months. The volumes were the highest in almost 2 months as well. Close to 3 crore shares were traded on Tuesday. It was well over 6x its 20-day average. 15% of those were marked for delivery and around 43 lakh shares for delivery. The 20-day average is around 7.5 lakh shares. It was the fourth most traded stock on the Nifty 500 on Tuesday. And of course, from the March 30 lows, the stock is up over 40% as of closing yesterday. Concor is the other one. It was an earnings reaction, a negative one at that. The stock was the second worst performer on the Nifty 500, down over 7%. The biggest single day fall since June of 2024 for the stock. On the put option side, the premiums were up almost 130% on Tuesday. Volumes were the highest since November of 2025. Over 90 lakh shares were traded on Concor yesterday. The 20-day average is just over 12 lakh shares, and 36% of those were marked for delivery. So around 33 lakh shares for delivery. The 20-day average is just over 6 lakh shares, and the stock over the last 12 months is down over 20% and nearing its 52-week low, which is at 421. And lastly, Bliss GVS Pharma, a news flow driven name. The stock was up around 5% on Monday, but yesterday's session the stock was in an upper circuit of 20%, the biggest single day gain since July of 2015 for the stock. It was the fifth straight day of gains, and in these 5 days the stock is up 35%. Volumes were the highest since the start of the year. Over 1.5 crore shares were traded, well over 5x its 20-day average, and a third of those were marked for delivery, so close to 50 lakh shares for delivery. 20-day average is around 10 lakh shares, and the stock also with that 20% upper circuit ended at a 52-week high.
Thank you very much for that. Deven Choksi is now joining in as promised. Deven, good morning. Thank you for joining in. Any view on the Adani Group stocks? All of them have been doing very well, whether it's Adani Enterprises, Total Gas, Green, Adani Power. Stocks have seen some solid upward momentum.
Yes, Seema. Good morning. Well, I think fundamentally, none of these companies were ever in doubt, despite of, I think, whatever the selling situation on the global front, particularly on the SEC, DOJ front that they were having. I believe that I think having cleared the all embargoes, particularly from SEC and DOJ, and also from the foreign accounting practices. So from that asset practices, from that particular point of view, I think that 2 or 3 possibilities are emerging. A, the company, particularly Adani Enterprise, going for demerger of the businesses, including the road first and thereafter the airports. They should be fairly attracting the capital both on equity side as well as on the debt side. The other assets also, I think, equally importantly, the power assets. I think the renewable power, the green power as well. I think they are also going to be attracting larger amount of fund flows. This was up till now a little bit circumspect because of the fact of the embargo that was there. Now with this embargo going in, probably you are seeing the possibility of higher amount of equity, of course, and repricing of the debt. And that's where probably the market is justified in taking the stock prices to the higher levels. We believe that the fundamental story remains intact with the EBITDA compounding at the rate of 20% at the group level, which is, I think, sounding quite reassuring because the cash generation is happening very systematically and very high at this point of time, and giving promises for higher amount of capacity build-up going forward.
Okay, got it. Hi, Deven. Good morning and good to see you. Deven, I wanted to ask you about a couple of these other names, particularly the PSUs. We've been talking about this in the past. Coal India as well as ONGC, they could be candidates that the government comes in to sell because of the tailwinds that you're seeing temporarily. And they've gone ahead and they've bite the bullet. In fact, my colleague Vivek had given us a heads up close to around 20 days or so ago when he said that they could do an OFS. Now the OFS announced, and the good news is it's at a sharp discount, 412 rupees. Would you advise investors to go ahead and apply in this OFS when it opens for them on Friday?
Well, I guess I think the business-wise, Coal India particularly is doing very well. I believe I think the higher amount of the production is also giving a good amount of visibility on the volume rate growth for the company as well. And around 400 levels, practically the downside will be limited. So in a way, I think that will be a buy opportunity. However, the larger challenge remains, I think, how many green funds globally would be participating into this asset. I think that remains to be seen. But locally, I believe that I think the issue is priced attractively at close to around 400 levels. So I think certainly one should go for it from investment perspective.
I see. Got that. So that is the Devin, hi, morning. Hitachi and GE Vernova, do you have a view?
So both the Hitachi Energy particularly, I think, saw the numbers and probably very impressive numbers, of course. And nothing that has completely surprised me because I think they have always been carrying a good amount of order book, which they continue to show the visibility for next 2 years easily. So from a perspective of looking at, I think this entire business is both GE T&D or GE Vernova and the Hitachi Energy, including, I think, companies like Siemens Energy. I think we believe that they are probably heading for one of the best times going forward in the next 5 years because the way in which power infrastructure, power utility infrastructure is getting built into the country. Some of these companies are getting the best of the times, I think, as far as their order book position and their execution is concerned. So we remain structurally bullish about them. Maybe the valuation-wise, one is arguing that, yes, I think they are adequately priced or fairly priced. But if one is looking at, I think, 5 years from now and execution thereon, I believe that I think some of these companies may offer opportunity at lower levels during the market ups and downs.
David, what about Bliss GVS Pharma? The open offer price by Anupam Rasayan is $299. The stock today is at $381. In fact, since the deal is announced, on Monday it was at 300 rupees, and in 3 days it's rallied to 381. 2 days now. Today would be the third day. So what's the play here now? Does it make sense to buy Bliss GVS when it's trading well above the open offer?
I guess I think the Anupam is getting properly integrated with this formulation company, which is having the presence in other parts of the world. So certainly, I think that's an advantage that one is getting. And in my viewpoint, I think that's a strategically important advantage that the company is talking about, Anupam is talking about. So from that perspective, I think Bliss Pharma definitely remains an important play going forward as well for Anupam. Though I think the numbers probably at this point of time not very easy to come across, but we believe that I think the deep integration is in offering, and that is where probably we like the company from a perspective of long-term investment. Maybe currently things are adequately priced, so one may not immediately jump into it. Correction in the stock price could be better opportunity.
Yeah, yeah. You know, the Tata board meeting yesterday, right, Devin? So sources tell us that there were presentations made by Air India, by Tata Digital, Tata Electronics, but also Tejas Networks. Now, Tejas Networks is listed. We reported on it yesterday morning before the board meet started. Tejas was up about 5-6% yesterday. You know, the thing, of course, with Tejas has been the long wait for the next BSNL tender, that order. But it's a strong company with IPs and technology base in that sense. But it's not done well. From the lows, it's come up quite a bit from 300 to 500. Any thoughts here, Devin?
Yes, Prashant. I guess I think all these companies which are driven on the data center theme actually, Tejas, HFCL, and for that matter, even Sterlite Technologies, each one of them probably up till now have been sluggish and moving upward because of I think the customers not placing enough orders. But given the fact that in the next 5 years, the amount of data center capacity which is coming up in the globe, and these companies are well positioned themselves into applying all the solution, including the networking and the complex solution therein, I think they are favorably placed. I'm not too sure as of now as to how exactly the numbers will unfold for all these companies, but really they remain promising. I've never seen this kind of strong order book for companies like Sterlite Technology or for that matter even HFCL. And so is situation with Tejas. So I would like to believe that I think things are shaping up well. Maybe once a number comes, we'll probably have more comfort in putting across on the commodity.
Okay, all right. I want to ask you, Devin, about the real estate pack. Suntech Realty, I was looking at an advertisement that they put out in the papers today. They have launched that long-awaited project near Nariman Point, which will be coastal facing. I recall the promoter entity put in money at more than 400 rupees. The stock is closer to around 300 rupees. What's your view on the real estate pack, and if any view on a company like Suntech Realty?
I think in general, we remain extremely bullish about the prospects of real estate company, and particularly the companies which are into luxury and ultra-luxury segment. Because what we are observing that affordable in the premium segment, wherein I think the masses are getting into, they have the challenging form of selling at times because I think higher amount of inventory. But the luxury and ultra-luxury segment is attracting fairly good amount of demand from majority of the high net worth consumers, I think, that we are experiencing. And in my viewpoint, I think some of the companies like Oberoi, or for that matter, even Sri Lotus, which is typically, I think, predominantly positioned in Mumbai market at this point of time, but generating a significantly large amount of per square foot realization, which we observed in case of Lotus. They collected about 69,000 rupees per square feet realization, which is highest in the industry. So such kind of companies, they remain distinctly favorable as far as the portfolio addition is concerned. And we like them from the long-term investment perspective.
Got that. Devin, yesterday we got the Vahan data for the auto pack, the Vahan registration numbers for May so far, and very strong numbers. Sudarshan, I remember saying that this month could be the best, May 2026 could be the best since May 2018. So in the last 6 years, and we could see double-digit growth across the various segments. So passenger vehicles in particular could be a 20% plus kind of growth. Any view on auto names from here on? So at least it seems like the volume momentum that picked up post GST is sustaining even in the month of May.
Yes, yes, Rima, absolutely. I think 20-23% kind of a growth by TVS, Bajaj, even Hero. And even I think Ola has gained some part of the market share, I think, in this particular month. So I'd like to believe that I think there are two different things that are happening. One important thing, the new buyer is moving towards the electric vehicle. That's where probably I think you are seeing the larger amount of growth numbers coming in as well. Your players like Bajaj, I think the numbers are also coming in from the three-wheeler which they have launched, the electric three-wheeler which they have launched, which has possibly given them maximum amount of profitability advantage in this particular situation. So we believe that I think this two-wheeler as well as four-wheeler, and particularly electric vehicle theme, is going to unfold big time in coming years. And that is where probably we would like to stay with some of the stronger companies who have got the best of their abilities in manufacturing and product launches, and at the same time distribution. So that's where I think our focus remains with companies like Bajaj and TVS for that matter.
All right. Devin, we leave it there. Thank you very much for joining us. Good speaking with you. It's a pleasure. Well, we'll take a quick commercial break here. We'll come back with a pre-open. We'll have ICICI Securities' Prabal Sain join us in the oil and gas space. Mitesh and Sudarshan will be with us as always with the technical view. Stay tuned. Okay, well, 16 minutes to go for the market open, 2 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they'd want you to do as we begin this new session. Gentlemen, good morning. Great to have both of you here. Sudarshan, maybe a bit of, you can blame a part of yesterday's move to expiry, but what do you do? I mean, we seem to be in this 23,800, 24,300 kind of band.
Yeah, good morning. Well, yesterday was a disappointment. The market broke out above 24,000, stayed above 24,000, and then 24,100, and then retreated. Now I can also comfort myself by saying it was expiry, as you said, or X or Y or Z. But that doesn't change the fact that the breakout failed after being almost decisive. That's very, that creates a setback for the analysis. As of now, if you have long positions, close them out if you still have them, and just step aside.
All right, step aside. Mitesh, were you also a little disappointed? The fact that we gave up yesterday, we couldn't quite consolidate on the gains with an upward bias. What's the call for the day?
Good morning. I was, in fact, we have been struggling to get past 23,850 on the Nifty, and then when we broke out, kind of immediately retreated. So we are still above this 23,850, 800 zones. So there's still some hope for me. What I would look for closely is the movement of the bank Nifty. On the banking names, on the charts, many of them are looking quite strong and showing some reversals on the hourly, 2 hourly, 3 hourly chart. So I think there is a good chance that if the banking stocks could recover fast after a mild cap down decline as the GIFT Nifty is indicating, then I think we might have some thing positive to look forward to. The bank Nifty has got good support around 54,500, 600 zones. So in case we drop about 300-400 points from here and then recover, I think I'll be aggressively going long, especially on the financial names.
And stocks, Mitesh?
I have more of buy calls today. Canara Bank, and I was talking about banks. Canara Bank is one stock which can be bought with a stop below 129.5 for targets of 140. Also a buy on Interglobe Aviation with a stop below 44.25. Here I would look for targets of 4,600. Then buy on CDSL if it starts getting past 1230, 1231. It's just closed about 4 or 5 points below that. So about 1231, buy with a stop at 1209 for targets of 1275. And one sell call, that's Aurobindo Pharma. Looks to be some kind of a profit booking pullback going on over here. So in the short term, sell with a stop at 1485 for targets of 1420.
All right. Sudarshan, what stocks would you go with?
I have a mix. I have Eternal as a buy, a much better chart than it was earlier. Buy with a stop under 245. NMDC is a buying opportunity. Again, a decent swing and position trading chart. Buy with a stop under 90. MCX is a short with a stop above 33.80, and Nykaa is a short above 270. The short selling is only because they are looking at a correction. So the correction will end sometime. Be swift if you short to take profits.
All right, gentlemen, we'll come back to you for more calls at 9:10. For now, let's put the spotlight on the oil and gas space. Probal Sen, analyst at ICICI Securities, is now joining in. Probal, let's begin with your view on ONGC. What's the read?
I think the results, that have just come out, the analyst meet is still, going to be at 11 o'clock. So, but on the headline, I think the increase in the OPEX was a bit of a negative surprise. Therefore, the results did come in a bit below our estimates, at least for the quarter. Having said that, I think the main thing to look at it really is, what happens going forward. They have recently expanded the technical service arrangement with BP to cover the entirety of the Western Offshore, which suggests that the results from the Mumbai Offshore technical service arrangement are going, in line or ahead of what they were looking at, which is something that's definitely a positive from a sustainable production perspective. The Daman Offshore project should ramp up steadily over the next year, and most remaining hiccups in terms of infrastructure or any other remaining issues with respect to the KG Basin development seem to have been completed as per the management. So even that ramp up should actually start to show up in the overall production numbers. So while the production remains moderate or muted even for FY26, we are fairly optimistic about production prospects for 27 and 28. The second thing, of course, is that as of now, realizations, at least for Q1, do seem extremely, extremely strong. We have not really seen any measures by the government to, cap realizations in any way. And with the royalty changes also coming through, I think the earnings prospects for ONGC are something that will continue to get stronger. This was one quarter result. Year end, there could have been adjustments that could have been made in OPEX. There could have been higher exploration and depreciation costs and so on. So, I don't think one should read too much into the numbers for the quarter.
Prabal, of course, where if oil stays high, they'll earn more. But in terms of producing more, that's where the government thrust and all this energy security talk, etc., comes through, right? So, can we see a dramatic shift in some way that ONGC operates, which gets them to explore more, have more success, and that kind of thing? I mean, that's the question. How much they're able to produce. Price, of course, will move up and down.
I think those are the points that I was referring to, the kind of technical service arrangements that they've now done with BP on the Western Offshore, which is pretty much the largest producing area for ONGC, but also one of the oldest assets that they have, and has been seeing a fairly steady decline over the last 5 to 7 years. And what we understand from the management is that at least on the Mumbai offshore assets, the decline has already been stemmed to a certain extent with the initiatives that BP has taken. And if that extends to the entire Western Offshore region, then at least the overall decline rates for existing assets itself can actually see some improvement. That's number one. Number two, as I said, with the offshore assets of Daman and KG starting to ramp up this year, I think that is something that will also provide some incentive to production. With respect to what government is doing, I think the Samudra Manthan initiative that is there, I think Oil India spoke about it in some detail, with respect to sponsoring some of the deep water and ultra deep water wells. And in addition to that, the changes that have been done in the royalty regime, specifically for new exploration or, fields that have basically been awarded, under different bidding schemes, but which are brought aggressively back into production. There are now more incentives as far as royalty deferment and lower rates that the government is doing. So I think from a government and regulatory standpoint, the environment is being made much more enabling for upstream companies. Of course, it will depend on execution skills and the intent by the management. And I think that's something that will be a key monitorable going forward for the next 1 to 2 years.
So in, say, FY, what is oil production growth for ONGC? Like, what does it average and what are you expecting? Are you expecting that number to move up?
As per our last published numbers, we were building in about 2 to 3% production growth on an annualized basis over both 27 and 28. As I said, we're going to have to sort of wait for whether there's any change in the official guidance in the call that's happening at 11 o'clock today. But that was our published number. So that is the kind of growth that we're building.
All this holds true for Oil India as well? I mean, the same kind of thesis?
I think Oil India, the numbers could actually be slightly better, primarily because, they do have assets that are capable of producing, specifically as far as natural gas is concerned. They do have assets that are capable of producing a bigger number for a very long time.
Sorry. Okay. What about on oil marketing companies? We've had about 7.5 rupees of hikes so far. Do you think more is coming?
I don't know. I don't think that, one can speculate on whether more is coming. All I can tell you is that there is another 6 to 7 rupees of increase that is needed as of prices to basically get to gross margin break even. Having said that, these price increases that have happened from 15th to 25th, that alone has actually reduced the potential annualized losses by more than 1 trillion for petrol and diesel. So it is a significant move in terms of, sort of helping the OMCs manage the losses. Whether they will actually go ahead and do the increases to completely eliminate the losses, or maybe there could be a wait and watch, given that there are some signs and there are some reports that the conflict in the Gulf may be getting into some sort of a resolution, at least over the next couple of weeks. So, that's something that the OMCs and the government look at. I have no clue.
Got that. Just one quick bit, Prabal. Do you have? You don't look at Coal India, right? Or you have?
No. Coal India is looked at by Mohit Kumar, who's the power at.
I see. Fair enough. We'll leave it there. Prabal, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. Well, let's just move on to I think the pre-open session has come to an end. So maybe just look at the Nifty, and it's down about 33 points. Tomorrow is a market holiday, so that's the other thing. If you are taking positions, so you got to account for that. Act accordingly. So probably at the margin, it does take away from how much risk people want to carry overnight. In any case, I think a lot of people who are trading just want to go day to day, unless, of course, you have a positional view, which is also worked out sometimes. But, more often than not, headlines kind of stop you out as you begin the new session. Sudarshan and Mitesh are back with us with their 9-10 calls, hitting them a little earlier today. Sudarshan, what do you have?
It's Eternal. Buy Eternal with a stop under 245.
Eternal. And Mitesh, what about you?
I'll go with a long on Canara Bank with a stop below 129.5 and a target of 140.
Canara Bank. Mitesh, IFB went up, he's not done anything, but was up a lot yesterday, and then, of course, ended 11% higher off the highs. But any thoughts here?
So, I'm not been tracking the stock, but personally look at the charts, tell me that the stock peaked around levels of 1230 first in February 26 and then again in May 26, and yesterday hit a high of 1280. So I think around 1220, 1230 there's a supply pivot, but once it starts getting past that, the stock will really get into a strong uptrend.
Got that. Thanks very much, Mitesh and Sudarshan, for those trades and that perspective as well. 5 minutes to go for market open. The big question, the dollar rupee is open, by the way. We should put that up. And we'll just take a quick look at where we are starting. It's kind of flattish, nothing very much. 0.05% change in the dollar rupee. But it's a talk of the town, right? The BOP is going to be negative, big negative, and where all will it show up? So here's a mix, a set of opinion from some of the really top fixed income CIOs describing the current situation that we find ourselves in, because the BOP, the big negative, is showing up in rate transmission in a significant way, something that we've discussed quite a bit. And of course, here's some advice from practitioners in the fixed income market on what the RBI needs to do. Suyash Chaudhary of Bandhan and Amit Tripathi of Nippon. Listen in.
Where we are now, and not really from a credit deterioration standpoint, but the right pricing of credit, we are in essence in the midst of a funding shock, which is coming from a sustained period of balance of payment deficit. So the country level lack of dollar funding is percolating into liability side, funding, I would say, stresses in terms of availability and cost of capital across the board. And on the other side, you are seeing probably a once in a decadal, if not more shock from, the commodity cycle suddenly flaring up, the lack of the India-US deal probably pressuring the SME, MSME sector. So not so much of the credits that we as mutual funds get exposed to, because, most of what we are talking about may not be issuers in the market. But I was just caution, that things are different for different people now, and there is a generalized, need to right price. Because if you're the holder of capital, you are, basically the setter of the narrative right now.
While the balance sheets are good, we are today, as an economy, struggling to fund a 13% credit growth, which means that somewhere the market infrastructure is becoming an issue. This is a macro structure issue. And the second macro structure issue which we need to address is this complete breakdown in terms of transmission, at least as far as debt capital markets are concerned, vis-a-vis the policy rates. Today, banks are borrowing 3-month money at 225 basis points over repo. The last time that happened was in a crisis period. So somewhere I think we need to manage the macro level issues properly at this point in time, so as to ensure that the liquidity issue does not convert into a credit issue in the near term.
Average inflation forecasts have to invariably move up, and RBI is first and foremost an inflation targeter. They should start the rate hike cycle going, but at the same time ensure that they don't unanchor markets' rate expectations. So you don't need a fresh pressure point coming from mixed commentary from the RBI. So you start the rate hike cycle going just to, continue to be credible as a conventional inflation targeter. But it won't solve much for the time being. What you could potentially hope for is a benign confluence of events. And I am not operating via perfect wisdom. I'm sure there's a big piece I'm missing here. But what we can think as a benign confluence of events is some sort of a dollar bond strategy to whatever extent jumpstart it with a $30-40 billion flow. The cessation of war that takes commodities, so let's say oil back to 85-90. And then at some juncture, if the shock to the US economy, because that's also a K-shaped economy, starts to show in their labor market and Fed rate expectations were to turn again, then you could potentially get a window where dollar depreciates. In 2025, dollar depreciated, we didn't benefit. A lot of other EMs did. But hopefully this time around, because we are cheap enough, that could potentially show with us. And so you need that jump start to happen, and from there you can build that narrative.
Okay, a bunch of sort of interesting opinion coming through. As they say, fixed income markets sends things first up in terms of, and of course, equities perhaps a little later. Typically, bond markets do sense stresses in the system, smell them far away. So advice from some top fixed income managers. We've got market open, it's absolutely flat, so not very much at all. Almost unchanged, 23,900 and 55,90 on the Nifty and the Nifty Bank. Sensex is also absolutely flat, not changed. The small cap index is up a quarter. The mid-cap index, I think, is also starting maybe slightly higher. Yeah, 0.16, but there are small changes. 900 up, 500 lower. That's the advanced decline out of the gates. We will see how things settle in about 30-40 minutes. The Nifty heat map will give you a quick sense of how the 50 stocks are opening. You've got Hindalco, Sun, Eternal, NTPC, Tata Consumer, which are coming up with the top gains. On the other side, coal, ONGC and ITC are starting in the negative. It's about, 30-31 stocks in the green and about 19 names which are down in the red. Rima.
Well, Coal India is the big loser today on expected line. 6% lower for Coal India at open, 431. The floor price for the 1% offer for sale is 412. So currently it's trading about 20 rupees higher than that offer for sale. ONGC is the other big loser with the fall today. It's dropped below the 50-day moving average. Numbers disappointing. Stock has fallen nearly 3%. Then you've got cuts in ITC, HDFC banks. These two heavyweights are dragging the Nifty by nearly 2%. Infosys too has opened up on the flatter side, but with a negative bias. On the way up then, you've got strength in commodity names. So Hindalco, JSW Steel up and about. Pharma names like Dr. Reddy's, Cipla seeing buying. It's a mixed picture across banks. So you've got an HDFC bank in the red, but an Axis Bank is higher in trade. Eternal is seeing buying, and that's a stock which has moved up 4.5% this week itself. So third consecutive day of gains for that. And Adani Ports too, hitting fresh 52-week highs with the up move. Ultratech Cement, Bajaj Finance, Jio Financial, Tata Consumer are some of the other names with gains of over 0.5%. But very, very quiet. But good to see the mid-caps are outperforming today, up nearly 0.5%.
Well, that's right, Riman. That's what I said at the beginning as well of the series. We could be in a bit of a range on the headline index, but going by the stock futures, both FIs as well as clients, they're aggressively net long. So stock-specific action should continue. A few stocks, though, are having bombastic moves. Let's pull a few of them up. Finolex Industries, stock up 10% in reaction to its numbers. Massive move is what we're seeing out there. PNG, normally a low liquidity stock, well, that's bursting away. That's up close to around 8.5%. So big move is what we're seeing out there. Carraro India, that stock is up close to around 7%. Big move is what we're seeing out there as well. JK Tyre, stock is bursting away, up 6.5% as we speak. I think Delta Corp as well is opening up with a gain of close to around 5%. I think there is a hearing that is scheduled with regard to that on that gaming case. So I guess that's why the stock has moved up. Remember, it's a fourth of what it was at its peak. And various other names that are doing quite well. Jindal Worldwide, another stock that's up and about in today's trading session. I think they're all reacting to their numbers. Even Gandhar Oil, I recall the stock seeing a bit of a spurt of late on very, very large volumes. and that one has moved up yet again. So pull up that stock. Gandhar is up close to around 5%. If I pull up the last 1 month chart, you'll see that the stock has rallied close to around 20% approximately. And Red Tape Limited, the street is buzzing with excitement that something's going to give out there. Well, that one's up close to 3.5%. Yesterday it was up more than 10%. I recall halfway through the trading session, it did spike up. And Nalco holding with gains of around 2%. This aluminium cycle is looking very, very good. I'll tell you what, Mr. Agarwal was sounding extremely optimistic. He'll want to list Vedanta Aluminium as soon as possible. He says in the next 1 month or so, the sooner he does it, the better, because global aluminium prices have spiked up. Vedanta Limited, that's a listed entity, that holds stake only in Hindustan Zinc. Otherwise, doesn't have much relation to Vedanta Aluminium itself. But that one as well, holding up and about. And as we did that market check, the market that was expected to open up with a cut of around 50 points, it opened up with a cut, but after yesterday's expiry-related fall of 100 points and today's 50-point downtick, that's got lapped into, the markets have moved into the green.
All right. It's 23,930 odd on the Nifty at this point in time, and the Nifty Bank will come up quickly, and we'll just look at where the indices are at. So this is flat right now, holding pattern, not very much up or down, but individual names, of course, there's been plenty of action. So no doubt of that. Deepika Mundra is with us. She is Director of Equity Research India at M&G Investments. Deepika, good morning. Great to have you with us here. Appreciate your time. Prashant this side. Deepika, so I was reading some of what you've written, which is the fact that while there's been so much hand-wringing and anxiety about why India is missing out on this big global AI capex super cycle, and other markets are overtaking it, and I mean, in both in absolute and relative terms, India has underperformed, and that's just a fact. You are not disheartened. You are finding opportunities here in the, as you call it, picks and shovels. So just run us through, and let's dive straight into that topic. How are you doing it here in India? Which are those picks and shovels, and where are the opportunities?
Well, good morning and thanks for having me. The regional trade, of course, AI has been the most dominant factor. The playbook, in fact, Prashant, has been very well established, right? The market is focused on bottlenecks, and every bottleneck from GPUs to CPUs gets repriced. India, while we don't have any meaningful play on hardware, we're going to be one of the largest users of AI and AI compute, and for which we're likely to see the development of data centers. So as of now, we have just over 1 gigawatt of data centers operational. There is a pipeline of 5 to 10 gigawatt to come through in the next 5 to 10 years. This will require a lot of capex from, and particularly in the electrical equipment space. So this is what we call the picks and shovels. We prefer the shorter cycle plays here, being able to reprice commodities quite quickly. So you have electrical equipment, gensets, cables and wires. You have a whole bunch of plays that can play out on the data center story. What we do have to be mindful of is that the correlations, just like we've seen in the region, are very high in India as well. Almost all of these stocks are up more than 100% over the past 12 months. So we have to we are being conscious on valuation and thinking more bottoms up than just then from a top-down data center theme perspective.
And valuations here are, these are well-discovered stories, right? Even before this data center and the AI thing burst into the scene, these were growth was high, but so were valuations here.
Yes, I think they are well discovered. What we're seeing, though, is consistent build-up in order books. The focus, though, is going to remain on execution. And as we've seen in the recent past, the two key issues, which is commodity prices and supply chain bottlenecks. These are the two things mainly to solve for. And the companies that are being able to work around these better are likely to be the longer-term winners in this space.
Deepika, but these are all mid-caps, right? These genset, transformers, cables, etc. It's great for mutual funds in India for bottom-up ideas. But these aren't large enough companies to attract foreign capital back into India. What would be the total market capitalization, for instance, of India's differentiated AI play, if you want to put it like that?
Well, there are at least, I could say, 16 to 20 companies in this space. I would not be able to tell you the total market cap offhand, but it is fairly substantial. I mean, we're looking at companies easily within the $10 billion plus market cap range in each of these names. So it is fairly substantial. I think there is enough liquidity as well. What we are being more conscious of course, like I mentioned earlier, is on the valuation front. I think we're finding enough liquidity in these names.
So if these are structural plays and it's going to play out, say, to 2030. Now, this argument has been made for Micron globally. Initially, it was seen as a cyclical commodity play, but now it's seen as a structural play. And therefore, you need to relook at the kind of valuation multiple. Should the same logic be applied to these companies, these 16, 20 companies? And yes, they're already trading at higher valuation multiples than they were in the prior cycles. But should one be willing to pay higher because there is growth visibility? I mean, how do you wrap yourself around the valuation argument for these companies when there is growth?
Right. So see, we want to be able to reflect the AI and the industrials theme overall in the portfolio. At the same time, we don't want to run a risk of this being the dominant driver of returns. So I think it would be a mistake not to be present at all, but be more mindful of what we are doing within these themes, which is why I mentioned shorter cycle, ability to pass on commodity costs, and not single product companies. So I think what we're looking for is companies with much wider portfolios rather than being single product, where, let's say, if the capacity build up is there and the cycle peaks, then you're left with idle capacity 2 to 3 years down the line. So slightly more, and I think we have some of these names available in India.
You've also added upstream oil and gas companies. Do you want to tell us a little bit more about that?
So since the Iran conflict broke out, we have had to rebalance the portfolio to some extent, while some of our calls have been very medium term in nature. So for instance, we have been underweight IT services for the last 2 years. We have been underweight on consumer staples for the last 2 years, mainly on valuation and low growth. We have taken some tactical measures to rebalance the portfolio post the conflict. So for instance, we are short or rather underweight certain names, like for instance, in the airline space, we have reduced our holdings considerably and at the same time rebalanced to reflect that versus higher exposure to commodities.
So that's a tactical play, the upstream. And so the increased weightage is a tactical play just till the Iran conflict is ongoing, or do you think we are going to see policy measures which help increase production?
Well, that is clearly what has been in the headlines over the last few days, right? The focus on increasing production. Also, the current oil price is not reflected in these names. If we look at oil futures, not just the current spot prices, they too have moved higher quite considerably.
Yeah. So, I mean, M&G invests globally, right? Deepika?
Yes, most definitely.
Yeah. So where is India relative? I mean, so, there's this, the weight is now, I think Taiwan is in MSCI EM, for example. I don't know which benchmark you guys use, but, we were, I think, 17, 18%. Now we've fallen quite a bit. I mean, just a function of how market caps have moved. But what is your sense? How are you placed the market itself?
Right. So we have different strategies, and then different strategies will end up having different benchmarks. From an India perspective, we remain fully deployed. So we have no cash in our India portfolios. But our name count, for instance, is much lower than what it used to be. So we're a lot more concentrated in our holdings today than we were, let's say, in 2024. So from that perspective, we remain constructive on India. It's not that we are not, but our name count is much lower than what it used to be.
And is it so how many names are we talking about, Deepika?
So on average, we would have about 50 to 60 names in the portfolio.
I see. And what's the AUM here in India?
Sorry, I will not be able to disclose all those details. That you'll have to speak to my comms team for that. But
sure. No problem.
Yeah, a lot of that is public information on the M&G side.
Okay, all right. Hi, Deepika. Good to see you in. This is Nigel on this side. The other burning debate is whether or not it's time for the FIs to come back into India. A couple of points out, yeah? India's weight on the emerging markets, well, it went from 8% in 2020 all the way to 21% in 2024, and we're back down to around 11-12% or thereabouts. So, the flows have been actually eluded us. There is this argument that valuations weren't very, very cheap. In fact, expensive, but maybe a little bit too expensive in comparison to us peers. Give and take everything, given that we're hopefully at the end of this war, hopefully crude oil prices don't spike up from here on, and earnings momentum should pick up in India. Do you think there's a good argument that FI flows could return back to India? Their selling actually has reduced in the last few months.
Well, I think you made the argument for me, so I needn't add much more. But I'd just draw back to the where we started the conversation, right? AI as a trade is been very dominant. The correlation across markets is very high, and so is the concentration. So while we're aware of the very long-term opportunity of the AI beneficiaries as well as the enablers, we think that there is space for India under the sun as well. And like you rightly pointed out, the earnings have been reasonably good. The the main problem I think that we need to solve for is the currency.
And do you have strong views on what perhaps is needed? We had a bunch of fixed income CIOs yesterday, and there was varied opinion. But any thoughts there?
Well, I am no fixed income expert, but stabilization in the rupee would be much helpful for FII flows to come back to India.
Yeah, no, that's a given. But okay, so but yeah, fair enough. Deepika, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. So that's Deepika with the MNG Investments with some perspective. Well, I think markets are holding, but just about 15 odd points lower. So it's been flat. The indicative open was kind of flattish, and we are not very different at this point in time. Let's just look at where else is. Coal India perhaps comes up, but these are all sort of, news related here and there with that offer for sale.
Good recovery from the lows, actually.
Down 6 now, down about 4% or so from the lows.
Yeah, I think the market actually was a little bit net short on that one, waiting for this to take place. Remember, the flow price is 412 rupees, but actually what the price at which you get demand could be much higher than that. It could be much higher than 412 rupees, and there are various arguments that work in favor of Coal India. In a bit, we'll tell you why, the government could probably have found an opportune time to go ahead and do this take. We'll get to that in just a bit from now.
Yeah. Any other stocks, guys? Moving around, and we'll have Vinny in just a bit to talk about.
I think the aluminium stocks, the listed ones, they are taking heart from that. And I'm sure you guys remember, and I'm sure, most of our viewers as well, they keep writing to us. But in December, I think December 5th or 7th of 2025, we had put out this piece about why aluminium will be in a bit of a deficit for this year. And that's why it could be the commodity to track in 2026. I'm sure that, most of us will remember that. And this Middle East crisis has put that gap actually a little bit wider. And that's why you're seeing aluminium prices that have gone one way. The last 6 months, these stocks have gone, up in a drastic manner. Nalco, remember, they don't get the benefit of high alumina prices, but yet the stock is rallying. You have Hindalco that's seen a big rally as well. 60% rally in the last 6 months or so. Big move, and Vedanta Aluminium is waiting to get listed. Earlier, people were expecting 420, 430, 440 rupees or thereabouts. Going by the current prices of aluminium, when Vedanta Aluminium, not Vedanta Limited, when Vedanta Aluminium gets listed, it could see a big spurt up. Vedanta Limited has nothing to do with Vedanta Aluminium as of now. It's just the holding company of Hindustan Zinc.
All right, that's on the aluminium plays. Carraro India is a big mover. Sudarshan was telling us about the strong numbers, 25% revenue growth, 48% profit growth, and that stock is surging. Along with that, JK Tyre. And you also have strength coming through in landmark cars. Again, not a number we've spoken about, but the profit here has gone up to 15 crore versus 1.4 crore. And stock is seeing buying. Along with that, Gandhar Oil. Again, the stock here has, the profits have gone up to 40 crore versus 12 crores. So some of these stocks are making big moves. Along with that, you've got Transrail Lighting. So let's put the spotlight on that. Vinny joins in with more.
Hi, so Transrail Lighting, they've reported a weak set of numbers, right? Revenue has seen a decline of around 4.25% on a year-on-year basis versus the previous quarters, which then managed to do well. But do not forget, Q4 FY25 was a very high base for them. Now, margins also have fallen for the company, 90 basis point decline that we've seen coming in. For the full year FY26, the management has given a guidance of around a 30% revenue growth that they would manage to do, 29 to 30%, which they managed to do for the full year. But all in all, there was a miss that came in for Q4 FY26, revenue decline that came in after a couple of quarters of growth, and that is why the street is not happy with that. They have an order inflow of around 520 crores for FY26, of which 37% accounts to international. They do have some exposure to the GCC region as well as the West Asia side as well. So that will be something important to watch out for if there was any major impact that came in because of that as well.
All right, thank you very much for that. Let's move on now to our next guest. It's Arun Captain. I hope I'm pronouncing it right. He's the Global Head of Economics and Strategy Research at UBS. He joins us from the UBS Asian Investment Conference 2026. Thank you very much for joining in. How was day one, Arun? What were the key takeaways? What were your learnings from it? And what are you looking forward to today? I think you're in mute. If you could hear me, I request you to kindly unmute. All right, seems to be a little bit of an audio glitch. So here's what we'll do. We'll get into a short break. We'll come back and reconnect with him. Welcome back. We managed to connect with Arun Captain, Global Head of Economic Strategy Research at UBS. He joins in from Hong Kong from their Asian Investment Conference. Arun, great to have you. Looks like we've connected. We were just trying to understand how was day one. And before going into the conference, you had compiled some of the difficult questions that you received from investors. For example, can the incoming Fed chief deliver on rate cuts? What's more important to the global economy? AI energy? Is AI inflationary or disinflationary? So tell us, have you got the answers to all these questions? What's the key takeaway?
So, and actually, that's the focus of the conference. So there's a heavy dose of AI and why are markets going up when we have all these energy risks. And then, of course, there's the themes around is China reflating and what's the Fed going to do? So we answered all the questions in a note yesterday. So we're discussing the same thing here today at the conference.
Do you want to tell us quickly your views?
So I think the remarkable thing is that so 60% of the index performance year to date in equity markets is driven by tech. And so on the equity side, you've seen that really neutralize all the energy related weakness. But that's even true economically. So if you look at the countries that are part of the AI supply chain, it's over 50% of GDP. And they have basically had, in terms of trade gain, that is significantly larger than the oil price increase. So memory prices are up about 8 times as much as oil prices. And so that seems to be neutralizing, at least at these oil levels, I think the negative impact. And hence we've seen actually very little movement in the global hard data. We've seen a lot of weakness in the surveys, not a lot of weakness yet in the hard data. So that's basically good news and a little bit unexpected.
Korea and Taiwan, I mean, just to, I think the AI export boom is so strong. I mean, I think they're probably wondering what is 100, right? Give us 120. I mean, it's just crazy, right? The surplus as a percentage of GDP is 10-15% now for these countries, Aaron.
Yeah, so if you look at Korea, I mean, it depends what you annualize the last month, but it looks like it could be running at something like 22% of GDP annualized. Coming into the year, we thought it would be 6, so now it's partly a big price effect, right? So memory prices are up about 455%, so that has a big impact, but it's also the volume. And I think really the way to think about it is if the US hyperscaler companies are going to basically invest $1 trillion and you put that money into an economy that is 16 times smaller in the case of Korea, or 30 times smaller in the case of Taiwan, you're going to get enormous impacts, I think, on those economies and on the equity market. Like just for Taiwan, for example, we think you've got something like a 10 percentage point of GDP contribution just from the net exports, right? And that's basically the flip side of all the spending that's happening in the U.S.
This thing, right? There are only 3 stocks in Asia right now, maybe 4. Just exaggerating to make a point, right? There's Samsung, there's SK Hynix, there is Micron, there is TSMC. Is it getting? So Taiwan, for example, yesterday there were these headlines that it's overtaken India in terms of market cap, but their market cap is now 5 times its GDP. How does this play out in your opinion? When does it become too much?
Well, so right now it looks like the supply of chips is running way below the demand for chips. And so, I mean, what that's actually doing, I think it's hopefully creating a smoother path for Taiwan. If they basically were to ramp up the production to meet, I think, what the U.S. is asking for, then you basically get a boom-bust cycle where, the memory prices would ultimately come very, very sharply. And then all the positive things you see happening now would turn into basically negative drag. And so partly by keeping the market undersupplied or basically the chips and the memory not being able to ramp up so rapidly, this will probably extend, I think, the sort of the tech cycle or the AI cycle. Now, eventually, I think there's a lot of uncertainty about, where this CapEx cycle is going and how long it has to run. But certainly, I think for the next year and a half, it looks like we're just going to get more of the same. And as you say, it is very concentrated here in just a few economies. It's basically Korea, Taiwan, and maybe Malaysia, but beyond that, and China, but beyond that, not too much else.
Arend, hi, good to see you, Win. Hopefully we get the visual back. I wanted your view on India. India's market capitalization, as a percentage of the globe has come down to around 3%. That's the level from where, because of the recent underperformance, from 4% it's come to around 3%. Even if you look at our weightage on the MSCI Emerging Market Index, that as well has come down. Post this period of underperformance, how do you see India fit into the scheme of things, in your scheme of things, and where would it come in the pecking order?
Yeah, so I think there's 2 perception problems. So one is obviously India, like many other countries in Asia, is very sensitive here to this energy disruption, right? So there's an immediate sort of widening of the current account deficit, creates currency vulnerability, and once the currency is perceived to be vulnerable, it becomes very hard to invest in local currency assets because you're basically facing that currency risk. That's problem number 1. Problem number 2 is that it is not perceived to be part of the AI play that applies to a lot of the rest of Asia. And right now, that is really the predominant thing that I think investors want to invest in. And then the third thing is that while the currency has cheapened somewhat, it's still not really perceived to be cheap. The equity market, while underperforming, is still not perceived to be cheap either. And so that, I think, currently creates sort of a complicated set of circumstances where, the route of least resistance is to buy the things that have momentum, which is basically the AI plays outside of India. Now, that could very quickly reverse. I mean, if there's a resolution particularly on the energy side, if there's a resolution in the Middle East, then I think we'll get a knee-jerk reaction that the most vulnerable countries to those higher energy prices will come rallying back. I think to take some pressure off the currency. will then also make it easier to start thinking again about retaking that local currency exposure and equity. But the structural headwind, I think, is that India is not perceived to be a play on AI.
But it's still growing at about 7%. We've got a demographic dividend, and it's no longer very expensive compared to its own relative standards. So if the war comes to an end and that headwind is out of the way, do you see interest in India? I mean, does India even come up in the conversations that you're having in the conference right now?
It does come up because I think there's a desire not to have all the eggs in one basket, right? I think a lot of the basically, it's really, there are 4 countries, or roughly, it's China, Korea, Taiwan, and US that are sort of big AI plays. I think right now that is the sort of the route of least resistance where investors feel comfortable. But, having that level of concentration and risk ultimately is not very desirable. So I think there is a lot of clients are actually praying that, this energy crisis goes away so that they can start to think more idiosyncratically about what are the other things, that you could invest in that are not sensitive to some sort of global, beta effect on energy price. And then I think people will try to come back to India and some of the large, it is a large country. So I think there is a desire to start to look at those things again. Right now, though, the market is just super one-dimensional, just focused really on energy risk and AI. And I think we really need, the energy risk to go away, take the currency pressure off, and then we have a dollar INR forecast of 96 by the end of the fiscal year. If that's if we stay in those type of ranges and the market shows that things are sort of stable, then I do think investors will come back.
Yeah, a fair point there. So, Aaron, this is a question which I think I'm sure gets discussed. What you think something will pop this entire big AI thing trade? I'm not saying it's real and here to stay, etc. But maybe something changes technology-wise, for example, all this reporting that it's become too expensive. AI budgets are being blown up in 3 months. What was supposed to last for a year? This is an industry built for scarcity, right? So when this kind of a thing happens, then if suddenly you start to realize, well, is that what's going to be the tell that this is now becoming too large and problematic?
So I think the risk here is, I think this is a multi-year capex cycle. Clearly, there are 3 companies basically funding it, right? It's Meta, Google, and Amazon that are driving 90% of the capex. They have exhausted their cash flow largely. So we're now projecting, I think, $250 billion in borrowing for these tech companies. So that's becoming a constraint. There's to some extent a funding constraint to sort of sustaining this cycle. And I think, the funding is there as long as there's a perception that the earnings are going to be there. And so I think the risk is ultimately that there's an entrant into, particularly from China, an entrant into the sector that is able to produce at much lower cost, much lower energy costs. And then I think people might have a rethink about, what is sustainability of these sky-high profit margins that these companies have. And then you could see, a repricing of that portion of the tech sector. But that's just on the hyperscaler capex side. And of course, the other part of it is that now there's a diffusion of the technology into basically the rest of the equity market. And there, I think it's just much more unpredictable where things are going. So while sort of tech more broadly defined is now, lifting all boats, I think actually investors have very little clarity about who the winners and losers are going to be. So right now, it's still, I think it is sort of very focused on these, on basically, NVIDIA and the hyperscalers, and the capex cycle probably has another couple of years to run. I think the valuations based on the current earnings, I think are defendable. The question is whether those earnings are correct or not, right? And I think we'll have to wait and see. I'm not the equity analyst in those companies, so I won't comment. But I think there is sort of a general level of nervousness out there about that.
As an economist, is AI inflationary or deflationary based on what you've seen right now? And what's your own view on what the Fed is going to do? It's, his predecessor faced a lot of political pressure.
Yeah. So it's inflationary right now. So we have an estimate in the note you mentioned earlier that in the US, if you look at PCE prices, we have about 40 basis points of AI effect, and that's coming through various channels. So one is just the memory channels. So as I mentioned, memory prices are up a lot, but also through the stock market. So when you have an enormous increase in the stock market, you get a financial services effect that's worth about 20 basis points. So So in the near term, actually, AI is inflationary, right? So that's for this year. You already have tariffs, you have the energy, and then you have 40 basis points of an AI add-on to the PCE data, not so much the CPI data. Now, in the medium long run, I think it's disinflationary, right? So if it's associated with a lot of labor shedding, then clearly that would be disinflationary. Even if there's no labor shedding and productivity goes up, then that's likely also disinflationary. But that still has to happen. I think the productivity numbers that we're currently seeing, in my mind, aren't really AI productivity. They have much more to do with a shift away from labor-intensive production to capital-intensive production. So you generate a lot of GDP with a couple of companies doing a lot of capex. You don't hire anybody. That looks like productivity, but it's not really productivity in the sense of us knowing what to do with the technology and becoming more productive. I think that's still to come. So what it is doing, though, and that's in some sense becoming disinflationary, I think the AI fear is having a chilling effect on labor markets. So if you look at the Challenger data in the US, a quarter of all the layoffs are now said to be attributed to AI. If you look at wage growth, that is already running below what our models would have predicted. So I think there's already sort of a perception that the bargaining power that people have and labor has is going to go down as the technology gets rolled out. Now, we're not able to measure that yet, but I think that's something for next year and the year beyond, where I do think we're going to go from inflationary to potentially disinflationary. And that, I think, is the argument that Kevin Warsh is going to try to make, right? That this is sort of a 1990s Greenspan-like sort of analogy where you basically want to accelerate the destination point to get to that productivity, because then it solves all the problems. You basically solve your inflation problem. Eventually, of course, then the notion is you solve your employment problem as well. And why not cut to get there more quickly? I think right now that's not possible. I think the data is just not giving him the cover to sort of make that argument. And so I think that is much more next year's story than this year's story.
All right. We'll leave it there. Thank you very much for joining us. Fascinating conversation. And glad you could sort of join us today, and hope we're able to chat more outside of the conference as well. Thank you for being here. So that is perspective coming in through the UBS conference there. Well, I think markets are down 24, so not very much happening. Let's get to EID Parry. Nigel.
Well, that's right. That's the next management on the show. The sugar and biofuel division saw better profitability due to better realization and cost optimization measures. Mr. Muthu Murugapan, the CEO and whole-time director of EID Parry, joins us on the show. Hi, sir. Good morning. Good to see you. And as always, what kind of growth guidance are you looking at for this year? I'm looking at last year. I think for the company on the whole, it was a 20% growth with margins improving around 40 to 50 basis points. How do you see FY27 pan out?
Hi, Nigel. Good morning, and thank you for having me on the show. So I think FY27 looks a challenging year. I think we had a good crush last year, and as you mentioned, good realization as well in the sugar and biofuels business. However, looking ahead, I think there are some challenges that lie on the road ahead. I think from a sugar perspective, we are seeing prices being largely range-bound and not moving up too much. We're also seeing a very likely deficit monsoon. This could impact the crop yield as well, and this could impact the cost line going forward. Beyond this, there are pressures on input costs, given the West Asia crisis, particularly on processed chemicals, fuel costs, as well as other material costs. So there could be some stress, going into FY27.
Okay, got it. All right, some stress going ahead, but you wouldn't want to put a guidance to it? High single digit, mid-teens, something on those lines?
No, Nigel, so we don't really give guidance. I think we'll have to really hunker down and watch the situation. There are a lot of moving parts currently.
Let's focus on ethanol sales then. What was the total volume that you did in the past year, and this year, what is it likely to be, and how are input costs panning out there?
Sure. The distillery segment has also been challenging in F26. Our alcohol volumes are just over 16 crore liters, much the same as F25. As you know, on the ethanol side, there is a significant amount of overcapacity. We're at a 20% blend right now that needs about 1,300 crore liters of capacity. The installed capacity in India is close to 2,400 crore liters. So allocations have not sort of enabled us to utilize our capacity. Given the overcapacity situation, we've also seen ENA prices coming down. That's our other product line in the distillery segment. And in this sense, margins have dipped. We're down to EBITDA margins of 4% on this business. It was 8% in F25, and perhaps prior to that, it was closer to 20%. So we do see this as a challenge. Ethanol prices also haven't gone up for 3 years. So here again, I think we have to really manage for cost and efficiency going forward.
What is the peak capacity? You said you did 11 crore liters last year, right? What kind of capacity?
In terms of our total alcohol volumes in F26, we've done about 16 odd crore liters.
Yes.
We did much the same last year. Our capacity is closer to 19 crore liters.
19 crore liters. Okay.
Mr. Murugapan, Rima here. Can you talk to us about your decision to exit Parry Sugars in the refinery business? Will the total hit be closer to 1,000 crore rupees? Because there's an impairment loss of 400 and the provision towards a financial guarantee obligation of nearly 600 crore rupees. What would be the amount that you will be able to recover, maybe on account of land, plant, equipment sales, etc.?
So, Rima, this has been a challenging business for EID Parry for a better part of the last 2 decades. So, I think a call was taken to exit really because of operational unviability, high leverage and also lower spreads. Yes, the impairment, I think, as you've articulated, is about 400 odd crores on account of the investment in the asset, 591 crores on account of the liabilities. Now we are working to see what best we can recover. The recovery would largely be from the infrastructure that's available at the plant. And the sale of the infrastructure. And I think this process has started.
Any range, how much you will be able to recover? Because it's a sizable amount that's getting hit on account of the obligations and impairment, as we said, nearly 1,000 crore.
Yeah, so Rima, it'll be nowhere near the impairment levels. I wouldn't like to comment on the exact number. I think those are deliberations which are ongoing right now. But this, I think the exit of the refinery was really part of a meticulous plan which we put together.
Even the consumer business has had a tough FY26. Revenues of 600 crore versus 884 crore. At the EBIT level, segment EBIT level, it's been a little worse off than what it was in the prior year. What's the plan here? Are you seeing any signs of a recovery, and what led to the weakness?
So, Rima, the consumer business was really a purposeful recalibration of the business model. I think we looked at the market credit piece to start with. We also looked at the product portfolio. We made some changes there, as well as on our pricing strategy. So I think all of this has led to the contraction of the business. I think going forward, we really want to put a stronger business model in place, a business model with more value-added products and a model with more products of margin-accretive products going forward. So that's the plan. I think you will see that pan out in F27. We really want to put a stronger model in place to enable growth in this business.
Final question, sir, before we let you go. What's the plan with Coromandel, the shares that EID has? Possible that investors could look at you paring down stake a little bit. You still have more than 56%. So some kind of give back in a challenging year, some inflow into the business will be good.
So, Nigel, no such discussion at this point in time.
Sometime during the fiscal, would that be a targeted holding that you have in the company? You could still bring it down to 51% at some point of time and still hold maximum stake?
No, as I said, Nigel, no real discussion at this point in time on the core stake.
We appreciate you joining in, sir. All the very best for the coming fiscal. As you said, some challenges, but you appear prepared with some of those verticals and the business strategy as well. We'll chat up during the course of the year.
Thank you.
All right. Thanks very much for that. So that is EID Parry in focus there. No change with regards to markets. We're still down about 20 odd points or so. Acus is the next company on our radar. It's a fairly recent listing still. And they are in the hot aerospace segment. And of course, consumer electronics as well. Now, revenues for the fourth quarter went up, but margins, absolute EBITDA and EBITDA margins contracted. For the full year, numbers look pretty strong. So we'll, of course, map out what happened in Q4, but of course, get a sense of F527 as well. Aravind Melagiri is Executive Chairman and CEO at Acus. Mr. Melagiri, good morning. Great to have you back on the program. Thanks for joining in. The fourth quarter contraction is, as I understand it, due to the full ramp up of the consumer electronics business. And so let's just start there. What happened and by when will this business turn around, break even, and start to scale?
Yeah. If you really look at it, Q3 is when we had first commercial production and we had a capitalization stopped, and Q4 complete all the costs showed up in the Q4 for us in the consumer electronics side, and that basically led to the actual full capex in the books showing up, and also the operation cost showing up, and utilization has moved up a little bit, but not to the level where fully can be absorbed. So that's what has happened, and so we see we have guided towards Q4 27 to be the EBITDA break even for the consumer business, whereas our aerospace continues to thrive well and continue to grow and continue to improve the margins what we have seen.
So, Mr. Meligari, by when will the consumer electronics business break even?
Q4 27 is what we have guided towards EBITDA break even.
EBITDA break even by Q4 of this year, this financial year.
Yes.
Got that. Now, what should we expect for the full year, FY27? You saw a 43% EBITDA jump in 26 over 25. What can we expect?
We're expecting to double our EBITDA in the coming year, FY27, and 100% growth.
Oh wow! So, you'd go to what? 300 crores?
Yeah.
300 crores in EBITDA this year. And what about margins, sir?
Yeah, I mean, aerospace will continue to maintain about 20% operating EBITDA margin. And as I said, consumer will get towards the tail end, a Q4 level, EBITDA break even.
Okay.
That's what you see.
Yeah, sorry, at a net level, if you can give us a sense?
At a net level, we are, in terms of your talking PAT level.
Yeah, PAT level.
Pretty much we should be able to, we will take a PAT positive only in the H1 of 28 at this stage where we are guiding.
I see. So do you have a sense of where the net number will look like for full year FY28 then? I mean, the market's already pricing stocks on FY28 earnings. So might as well ask you that.
I cannot guide at this stage, So because there are a lot of moving elements, just to give you, we are adding additional capex on the consumer side this year, close to 500 crore. And that will, when that comes on full online, and that also has a factor in there. That's the reason what we are guiding as a percentage. We may not be able to position right now, but as a overall, we have an internal target to get to the PAT positive in the H1 of 28.
And the split between the businesses by that time, H1 28 will be on a EBITDA level, will be aerospace and consumer electronics will be what, sir?
The revenue basis, we are, currently we are, our goal is to get towards more like a 20, currently we'll end up at 22% level of aerospace at that point in time.
Sorry, that's a revenue.
Consumer side.
Yeah. Revenue makes 22 consumer electronics, basically. Is by FY 28.
27 end, right? That's what it is.
Okay.
And currently it's about 15%. So it goes up from 15 to... So just to quickly recap all the guidance that you've shared with us, on a consolidated basis, EBITDA doubles in FY27. For the consumer business, EBITDA break even by Q4 FY27, PAT positive by H1 FY28. And the top line growth will be?
Top line growth, where aerospace, we're planning for 25 to 30% for the FY27. And, and consumer, we're basically going between 125 to 150% on the consumer side, consumer side overall. And overall, we'll double 50% growth year on year on the revenue.
So on the consumer side, the focus this year is going to be on EBITDA break even. But thereafter that, because there is capacity which you're adding, there is capex that you've planned. What is the trajectory of the consumer business as you see it in terms of the EBITDA? So margins for aerospace are high, above 30%. How will the consumer margins look like? What is your long-term plan?
Our long-term consumer margins are going to be about 20% EBITDA. That's what I have always, communicated, and we expect it to happen that way. It's a function of utilization, Rima, and its utilization continues to improve. As the utilization improves, and then we'll pretty much get there.
Okay. I believe your operating cash flow was negative last year, and you've got a very large capex that you've lined up of nearly 660 crore in FY27. How are you planning to fund that? What is the net debt level?
So currently net debt is about 100 crore right now, and we'll end up about net debt about 800 crore by end of the year, including the working capital increase and the capex what we'll be doing. And we feel good about where we are with that stage.
Up increase in your net debt, sir. Would you at some point look at equity fundraise? Or are you comfortable with the net debt jumping 7x, 8x?
At this stage, we feel comfortable. And if we need, from organic side of it, we are fine. If there is anything else needs to happen, we'll look at it. We're open.
And what's the cost of this debt, Mr. Meleguri?
Somewhere around 9% level. It could be, anywhere between 6 to 9%, depending on whether it's a PCFC versus, dollar borrowing versus rupee borrowing.
So average is 9, you're saying 9%?
So we take it internally 9% as borrowing cost.
So that's about 100 crores a year in terms of interest payments.
Yeah.
Yeah. So, but you obviously don't want to stay here, right? At these levels of...
Look, manufacturing cannot be grown without, if you're growing at a certain rate, 10, 20%, you can do through internal accrual. You need debt to come in. And that's the reason we look at EBITDA as the growth measure at this stage of high growth stage of the business. So we need to leverage the debt to scale this business. And this opportunity we have as India, as a country, we have two unique situations: one, aerospace growth, and also same time consumer electronics, manufacturing moving into the country. And we're in a sweet spot on both the verticals. So we, ideally given, we can get all the assets getting sweated and then we invest further. All that can happen, but customers won't wait.
Yeah, no, I completely agree. And of course, I mean, we at CNBC have visited the facility, etc., and what you've built. So it's quite fantastic. Let me just push just one last number. You said EBITDA will grow 100% in 27 over 26. 28 over 27. You have visibility. I mean, these are orders which are, unless somebody drops off, you have a solid order book and you know how much you can execute. So in 28 over 27, what should we expect? From 300, what will EBITDA go to? Yeah.
Yeah, looking at a capex level, what we are doing this year, they're all coming on board, and we should be able to see similar level of growth in FY28.
So 100% EBITDA growth in 27, 100% EBITDA growth in FY28.
I didn't say that in that range, I said.
Okay, in that range. Okay. All right. Well, we wish you all the best of luck. We need, aerospace champions out of the country, and we wish you the best of luck. Thank you very much for joining us.
Thank you.
Okay, well, I think the markets now, it's like a traffic light. 5 points up, 5 points down. 23,922 is where we're at. The F&O data in terms of what's happening on the BSE. Mangalam is here with exactly that. Mangalam, take it away.
Well, it's been fairly volatile ever since the market gave up from highs yesterday ahead of the monthly expiry on the NSE. The BSE expiry is today, and ahead of that, the Sensex has actually given up important levels as well. 76,000 is an important mark. So sticking around this would be extremely crucial. Tomorrow is a holiday, which is why, remember, all the BSE options expire today on Wednesday. That's the 27th. 76,173 is the 20-day moving average, and 76,36, where the Sensex right now is the 50-day moving average. So the next 100 points, 200 points on the Sensex, extremely crucial when it comes to resistances, and those are marks which are important to cross. Were that to not happen, then 76,000 as a mark will see a lot of resistance. Why do I say that? Because the 76,000 call writers are extremely active. The highest number of open interest build up, and the recent change in open interest has been on the 76,000 call premium over 120 rupees order. Tells you that between 76,150 to 76,170, closer to the 20-day moving average, we will continue to see support. However, at lower levels, we will find some sort of demand come by as well. 75,800 put writers are fairly active. Currently, the highest change in open interest is what we've seen as 75,800 put, telling you support comes in around 75,600 to 75,700. And the maximum open interest is at the 75,500 put. So you put all of these data points together, you get a range, a decent 500-600 point range on the Sensex for today's expiry, which is between 75,600 to about 76,170, 76,200 thereabouts. So that's the level, that's the range that everyone will be tracking on the Sensex ahead of expiry tomorrow. Remember, tomorrow's ahead of expiry today. Tomorrow's a holiday, so the BSE options, weekly options, expire today.
Thank you very much for that update. We will slip into a short break. On the other side, we'll talk commodities with Manisha Gupta. Stay tuned. Welcome back. As promised, let's talk commodities. Manisha's joining in and she's got her eye on base metals. Manisha.
Thank you for that. Well, yes, as the other markets continue to consolidate, the base metal prices have continued to gain even in the trading day today. That is because the US dollar index has eased a bit. And when you look at the Chinese data, well, the last couple of them have come in on the positive side. The industrial profits jumped up by 18% on an year-on-year basis from January to April 2026. And that clearly has been a supportive factor. It also has to do with the equity markets. The tech-heavy index in US surged quite a bit. In the Asian markets as well, the equities have seen new record highs. So whether it is about the Japanese market, South Korea, all of that seems to be doing quite well. And we've seen records being hit onto those one as well. The other thing really is about the structural deficits that you have seen in most metals, whether it comes in from mining or smelting, have been supportive as well. It also is about the renewed optimism that we are looking at various industries, especially AI and technology-led, where most of these metals are used. And because the markets are looking at supply constraints and concerns here, you have seen a support factor come in because of that as well. So take a look at the US tariff hoardings. US is stockpiling a lot of raw materials. This is a front loading that we've seen in sense of fearing import tariffs. That has been supportive. US and Iran could strike a peace deal. And if that happens, you could look at the metal prices and metal demand come back into the markets quite strongly. The speculative buying has been on the stronger side as well. So whether it has been about institutions, macro funds, they seem to be rotating money in hard assets, tangible assets, and metals seem to be doing quite well because of that as well. Various reports will tell you on how metals perhaps could be the best play in this year going forward. If you look at the copper prices, then we have seen strength there because there is a production concern there. Mines in Panama, Chile and Peru have seen ore grades go down. The cost efficiency seem to be declining. And with the kind of shutdowns that we are seeing around this has supported copper. Aluminum is another story. There are 3 or 4 major factors which have led to support. To begin with, it is China enforcing nearly 45 million tons of domestic production cap to manage the carbon emissions. This is the second straight year this is happening, and the Chinese mills already have hit 45 million tons in the previous year itself. And then the TRC charges also are trading at record lows. You also are looking at the West Asia conflict, which seems to have impacted 8 to 10% in sense of global aluminum trade flows supporting markets. The inventories should come in on your screens, and that would give you an exact picture, really. These are LME inventories globally. So when you look at copper, for 2026, we've seen copper inventories almost double on LME inventories in warehouses. But that picture, let it not fool you, because much of those inventories are lying in US, not being used and not available to the rest of the world, is where we are getting support from. Aluminum, the picture is quite clear with the kind of numbers we're looking at. Half of what we were in sense of inventories in comparison to last year. It has been nearly 37% of a decline in inventories, and that is what is bothering the street. And then it is zinc. Strong structural story here as well. Half of what we were in the last year, so 47% of decline in inventories here as well. And when you look at the prices, finally, the best of gains clearly seem to be coming in case of aluminum there, 23% up in this year till time.
Okay, all right, Manisha, thank you very much for that. Well, I think we'll take a quick commercial break here. Markets are holding about 18 points up at this point in time. Indianomics with Lata. She's going to be speaking with 4 trade economists on whether the spate of FTAs can one day bridge our current account deficit. So stay tuned. That's the panel you'll see in just a bit.
Welcome to Indianomics. What's puzzling about the rupee fall in the past 15 months is that it is happening at a time of modest current account deficit. Current account deficit, or CAD, is the extent to which current outflows like imports, interest payments on loans are higher than inflows like exports and remittances. Historically, over the past 30 years, India has run a CAD of just 2 to 2.5% of GDP, and we have had enough capital flows to fund it. In 2013, CAD went up to 5% of GDP, and we had a rupee problem. But in FY25, India's CAD was only 0.6% of GDP, and we still had a problem. Likewise, in FY26, CAD, or current account deficit, is only about 1.3% of GDP. We still have a falling rupee because capital flows are not enough. The problem is, historically, we always had enough capital flows, that is FDI and FPI inflows, to bridge the current account deficit. But in the past 2 years, we are not able to get capital flows even to fill smaller current account deficits. But then we can't do much about capital flows if investors are chasing AI stocks or commodity markets. What we can control is our exports and imports. Hence, the Indian government has signed a host of FTAs to boost India's trade. India signed 9 free trade agreements in the past 5 years, and 11 more are in the pipeline. The question we are asking today is, will more FTAs help us to bridge the current account deficit? Will they increase capital inflows in the form of FDI? Will they give us more services exports? Joining me are 4 experts: Arpita Mukherjee of ICRIER, Amita Batra of JNU, Rupa Chand, formerly of IIM Bangalore, and Professor Pralok Gupta of the IIFT, Indian Institute of Foreign Trade. Gentlemen and ladies and Mr. Gupta, thank you very much indeed for your time. Well, let me start with Arpita Mukherjee. Ms. Mukherjee, you know, I was looking at the data from UAE and Australia. Those are the two countries with which we first signed FTAs. They become effective in 2022, I believe. But if I looked at it, 22, 23, 24, 25, 26, it is not as if exports have grown a great deal. I mean, they've grown in some years, but, you know, to Australia, for instance, exports have grown by just 3% in FY26, 3.96%. It's not as if the FTAs have done wonders. Are the FTAs taking time to generate exports? How should we look at what to expect from the free trade agreements?
See, basically, the exports happen from the free trade agreement based on tariff phasing period. So you have to wait for 3 to 5 years to see a change. Having said that, the two countries that you selected are actually a very low tariff country. So they any which way had very low tariff. And the FTA that you selected with Australia is actually a mini deal. It's not a very comprehensive FTA covering wide range of products on both sides. To taking that into account, yes, these were deals where the market, the other side is already a low tariff country, and you cannot just look at tariff to look at the benefit of the trade agreement. And secondly, that after the trade agreement is concluded and signed, it takes time for the implementation, and based on the phasing out, you see the benefits. So if you are entering a zero duty immediately on signing of the agreement, that will show something, or else you are going for like 5-7 years phasing out, then you will see the growth in exports slowly.
Professor Batra, is my whole premise to look at FTAs as a solution to current account deficit all wrong?
Not at all. Yes, exports are expected to be pushed up because of an FTA. But as has been said already, there has to be a distinctive, higher preferential margin that we must be able to access the other market with. In case of Australia as well as EFTA, you see the tariffs on the other side are low, preferential margin is low, the incentive for our exporters is low. Plus, there is also another aspect, you see, which is that when we look at competition in these markets, you know, particularly when we're talking about Australia, there have been some gains, as you mentioned, in the textiles and clothing sector. But these are far smaller than the rate at which you see a competing nation like Vietnam gaining in Australia. So these are, you know, Vietnam is a country that's already present in these markets. It dominates these markets. And so there is existing first mover advantage for certain other countries that you have as competition. So export competitiveness, building that up for us as a prior to export and FTA benefits is very important. The second aspect that you mentioned in terms of the capital account bit of the overall balance of payments, I'd like to touch upon that too, because an FTA is not just supposed to be, I say supposed to be, just export push through the preferential access, but also the linkages that it provides any country in terms of integrating with global value chains. Now, the Australia rightly said it's a mini trade deal. A comprehensive was supposed to be completed by the end of 2025. We are nowhere near that. I don't know if we've started the comprehensive negotiations towards the comprehensive trade agreement, but we haven't reached the conclusion of that. There is no investment component in that. EFTA has an investment promise from the other side, but the commitment is another aspect. And so are the UK and the, the coming in EU, European Union FTAs, you know. With all these, what we need is an additional component which ensures investment is part of the trade deal or as a separately negotiated parallel agreement. And that will come in when we have our own template, that is the bilateral investment treaty model of 2015. worked upon, that was promised in the budget of 2025, but we've yet to see the outcome of that.
Professor Gupta, as has already been said, I am prematurely looking at the goods data alone. We have to look at investments and services. Can you enlighten us? If we are not able to narrow our current account deficit, will the FTAs at least bring in enough capital flows to bridge that deficit?
Yeah, thank you, Lata. Just 2 points. One, before coming to your question with respect to, because you started your show with linking FTA journey with the current account deficit.
That's right.
So it is very important to note that our renewed journey for FTA, it started in 2020. So at that time, we were not facing any pressure on the rupee. So it's more a part of that. Exports are part of our more growth strategy when we are talking about the 5 trillion economy. So export-led growth. So that is that CAD and helping CAD through export, that is definitely a part. But essentially, what I'm trying to say is that it's not that because CAD is high, so we are focusing on FTA. We have started FTA journey much ahead, and we have negotiated this FTA with significant of India's interest protected in number of sectors, whether these are goods or services or other issues that have India's interest have been captured. Now, coming specifically to your question on the services and investment, yes, on the services sector, there are significant commitments from our FTA partner countries. So from like European Union, we have around 144 subsectors that have been committed by European Union out of the around 160 subsectors in the services side. The same is true for UK also. So more than 135 subsectors they have committed. And one thing which is very important to note in the services, that there is a commitment, there is a liberalization or commitment on a foreign direct investment in the services sector, which is in the trade parlance called Mode 3 or commercial presence. So India has made commitments on Mode 3. That means India has committed to allow foreign direct investment from these countries. So there is an expectation that significant FDI in the services sector will flow. And I would remind you one very important data in that context, that out of total FDI that is coming to India, around 2/3 is in the services sector.
Got it.
So with these commitments, we expect more and more FDI will come into play.
Yeah.
Second, on the 100 billion in the EFTA agreement that you talk about, the Switzerland, Iceland, Norway, and Liechtenstein, there is a provision that these countries will make 100 billion investment in coming 5 years. And if there is a shortfall, then the balance that have been achieved in the FTA, that could be recalibrated. So it's a more like incentive or facilitative element that these countries, the private sector, are more promoted to make investment in the country. So I would say that these FTAs are geared towards having a multi-pronged effect on the economy in terms of investment, in terms of increasing exports, in terms of increasing imports to ensure the raw materials for India. For example, in the Australia deal, we have good provisions for the raw materials like cotton, chemicals, and different kind of raw materials, so that supply chains are completed. And also, there is a mutual recognition agreement, like with Australia. You mentioned some data on the Australia. So last year only we signed a mutual recognition agreement on the organic foods. And so India's testing, India's standard that would be accepted in India.
Fair enough.
Now, see, where is the market for organic food?
Yes.
The market is in the developed countries.
Yes.
Now, if these kind of things are happening in the FTA, they will give benefit in different to the country.
I take your point, sir. If it has only happened last year, then I'm counting my chickens too quickly. We will have to give it time. Professor Rupa Chadha, thank you for your patience. You also specialize in services, Professor Chanda. So can you tell us if the FTAs are geared towards having more GCCs and other kinds of services? Is there evidence already, for instance, from the EFTA? Should we expect more from the UK? I would assume these are the countries who want to invest in GCCs in India.
First of all, the whole perspective of looking at an FTA in terms of its benefits is not about reducing deficits. And as previous speakers have said, it is much wider than that. It is about promoting exports, but it's also about increasing inputs and having, supply chain diversification, getting access to critical inputs, reducing manufacturing costs. So there's a range of things that you actually want from the FTAs. They're geopolitical, of course, as well. And second thing is that having a deficit bilaterally is per se also not bad. It could be because you're actually getting access to better quality inputs, and that feeds into better quality exports. You could be increasing your bilateral deficit, but actually increasing your exports to third markets. So therefore, the whole way in which FTAs are often looked at in terms of whether they are benefiting us or not is not really the right perspective. Having said that, the real gain comes from having much more comprehensive, broad-based, and integrated sort of approaches. So whether we look at trade and goods, investment inflows or outflows as well, which can promote your exports, and services. Now here, coming to the services question that you specifically asked, yes, of course, we've seen that our surplus is there in services. We are seen to be competitive in services, however, not a sufficiently broad range of services. So we tend to focus on IT-enabled and professional services. But I would look at services much more broadly than, again, just professional services and IT services. And I would look at imports of services as well through Mode 3, which can enhance our overall economy-wide competitiveness. So what do I mean? I mean, for instance, logistics. That's a very important sector. Many of these sectors are actually open to FDI. Telecommunications. So what I'm getting at is that look at the service sector both as an enabler for exports in other areas, as well as our exports, which we already have, which we are doing very well at in areas like DPCs and IT services professionals.
Professor Chanda, please hold that thought. I'm running into a commercial break. We have to take this break. For Bazaar viewers, it will be Chartbusters thereafter. But do join us after market hours. You will get to hear these experts on the entire issue of FTAs and whether they can bridge India's current account deficit.
Coal India is the top index loser, down over 2% as the government announces an offer for sale up to 2% stake at a floor price of 412 rupees a share.
ONGC 2 trades under pressure. It's down 3% following a weak fourth quarter where margin and profits contract. Oil and gas production also declines. Brokerage Jeffrey says that the fourth quarter EBITDA numbers were 20% below its estimate.
Aluminum prices continue to rally on supply concerns. Prices are up 3% this week, 23% up this month so far. Hindalco top gainer on the Nifty. Nalco also up 5%.
Transrail lighting slips around 5% as the fourth quarter revenue declines 5% while margins contract as well. The management joins us in a short while for now to detail the past quarter's numbers.
Some other corporate earnings that are in focus. P&G Health up 8% on the numbers. JK Tyre up 5.5% on numbers. Good performance coming in from Finolex Industries as well. And then we have Siemens, which too is higher by 3% post its earnings.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. Yesterday we had a bit of a down day, but that was more monthly expiry related. Today we started off on the back foot, and now as we speak, the Nifty's at the high point of the day. The breadth of the market has improved, and a lot of stocks out there doing a thing of their own. Hey, Mangalam.
Hi, Nigel. The market looks good, and we do have a bunch of earnings to contend with as well. The broader market's looking a lot better than the frontline indices. Dips being bought into, that will make bulls feel very happy. Brent contained around sub $98 per barrel. Let's focus on Transrail lighting. A weak fourth quarter with revenue and margins, both of them under pressure on a high base, even as the company maintains and meets their full year performance as far as the guidance was concerned. We do have with us the MD and CEO Randeep Narang, who joins in. Randeep, I reckon that you had taken into account this sort of high base when providing a guidance for the full year, which is why you've managed to meet the full year guidance despite there being a decline in the fourth quarter. The question is, what are you expecting in FY27 when it comes to revenue and margin guidance? And also a large part of your unexecuted order book is international. Are there any execution issues out there because of the geopolitical crisis?
So firstly, thank you for having me over. We have maintained and bettered our guidance. We had said we'll do 25% growth. We've actually done 30% revenue growth. We've also looked at the various ways to look at the disruption in the market with all the Middle East crisis impacts, whether it's LPG or logistics or other elements of the backward supply chain. So we are very happy with the overall results. Our EBITDA and our PAT is very strong. So therefore, that's a very good start to the year. Now looking at 27, we are looking at a 20 to 22% growth on revenue, which is very important. We have an order book of 16,300 odd crores. So we are well placed. Our international book is around 40% and domestic is 60%. Therefore, we are comfortable that we will meet our revenue and the guidance going forward for 27.
Got it. All right, Mr. Narang, we appreciate you giving us those details. So 20 to 20% growth, we'll work with that. As you said, international business is around 40%. Give us some clarity with regard to how much comes in from the West Asia region, which is currently, having a conflict that's ongoing over there. Point number one. Point number two, what about margins? What is the range we should work with for this year?
Yeah. So the Middle East, West Asia, we have two jobs, not very big, 1,000 crores out of 16,000, and they are all in a startup phase. So there is no crisis for us in terms of these jobs, and we are hopeful that things will ease out in the next few months. So we are not in any way troubled. Our margin guidance, as I was mentioning last year, was 11.5 to 12%. We have achieved for the full year 11.9%, which is well within the guidance given. And for this year, with the disruptions in the cost, the way the inflation on energy is happening, the way we're looking at cost escalations, we've looked at a very prudent and practical guidance of 11%, which is, of course, can be better if things stabilize. But principally, this is still one of the best in the industry. And we believe that with all the caution, we will achieve these numbers.
All right, so margin guidance pruned from 11.5 to 12.5% to about 11%, largely because of the current geopolitical uncertainties with a room for upside out there as well. So you have an unexecuted order book. You are fairly confident of FY27, going into FY27, executing these orders. The question is, what about order inflows? You know, how has the order activity been around the world right now and in India in particular? What segments are doing well and what's the kind of inflow number that you're targeting this year?
So as you know, we are predominantly T&D, which is around 85 to 90%. So we feel there's a huge potential in India, almost 80 to 1 lakh crores of opportunity. As you know, the government is very bullish about the energy infrastructure. Internationally, we see 50 to 60,000 odd crores of orders. So our take would be a 25% growth on our last year's order book of 8,500. We are looking at 10 to 11,000 crores of new orders coming in this year.
Okay, all right. Give us some numbers in terms of your debt. You know, that's reduced in the last couple of years. I think the net debt number used to be around 500 crores. That's come down to around 270 crores. Now you have some capex plan, I think, of around 200 crores or thereabouts, the additional capex plan out there.
Yes.
So what is the capex plan you'll be announcing for this year? And what does that do to your net debt number?
So these are from internal accruals, and this is also going to be in a staggered manner. We're looking at 200 odd crores, and this is basically for some plant equipment upgradation and tools and plan for execution of the various projects we have under our order book. So this will be staggered over. I don't see much difference. We will be in the range of 225 to 50 crores, and this is going to be stable. A lot of good work has happened in terms of reducing the net debt. So the cash flow from operations has improved dramatically. So overall, we are very happy with the manner in which the operations have executed the jobs.
All right, debt remains stable between 225 to 250 crores. Just final question from my end, Mr. Narang, that your working capital days, they improved by about 10 days, still at 81, which is understandable in a business like yours. But given the sort of uncertainty that we're facing right now and the execution challenges that one may see as the conflict goes on, raw material availability, etc., do you see that as an issue for your working capital? What are you targeting for the entire year?
Actually, we have started a very clear momentum and a rhythm on managing our working capital versus each of our business verticals and each of our teams. We also have very marquee clients, and all international jobs are multilateral funded. Domestic jobs are marquee clients, which are private and central utility. So we are very comfortable that whatever is the current plan, we will maintain and better it. And we're looking at sub 80 days on working capital.
All right, sub 80 days on working capital, 20 to 22% revenue growth, margins at around 11%. 25% growth in the order book, between 10,000 to 11,000 crores is what you foresee in FY27, with Middle East accounting for just about 1,000 crores of your unexecuted works, which you believe will resume and are currently underway as well.
I'd like to say one more thing just before we close. I mean, this is the best ever year for Transrail in terms of the growth. We are looking at consistent growth. We're looking at another level of 22% growth going forward. And for all our stakeholders, we believe that our guidance has been fair since we got listed, and we will continue to do so and beat our guidance going forward.
All right, we take that point. You know, the last 12 months, it's been fairly choppy. The stock is down about 20% after having seen levels of over 800 rupees, now down to around 500 rupees, recovered from lows as well. But as we speak, down about 4.5%. There has been some amelioration from lows on the back of management commentary, but obviously walking the talk here and continuing to beat the guidance is something that the street will be looking at from Translail writing. With that, we'll take a short break. On the other side, we have another management joining us, Black Box. They join in to discuss their fourth quarter performance. Stay with us. Welcome back. You're watching us here on Chartbusters on CNBC TV 18. It is earnings thick and fast. The other stock is Black Box on our radar. The stock has surged over 70% in the last 1 month alone. They reported their fourth quarter numbers yesterday. Revenue grew about 9%. Order inflow too spiked. We do have Sanjeev Verma, who's the CEO at the company, joining us in the studios for the quarter gone by. It's a big jump that we've seen, 9.5% year on year. Just wanted to understand a couple of things. You know, your EBITDA margins quarter on quarter saw an improvement to around 9.3%. And you did mention the last time you joined us that a lot of your orders moved into FY27 because of the geopolitical tensions that we're facing. Do those tensions still, the tensions still continue? Do those delays still continue, or have you gotten those orders?
Yeah, so two aspects. One, of course, the delays were largely because of some supply chain constraints, which is the raw materials like fiber and others, which has caught the cycle right now. And of course, more recently, of course, some geopolitical tension. But I believe we are over the cycle from a supply chain perspective. For the geopolitical tension continues to be there, but we're not affected by that as much as our North America business is concerned. So basically, we are over it at this time from a supply chain perspective.
What's your FY27 revenue growth guidance? Your exit quarter was about 9.5%.
Yes, I think we have gone public saying we are current operating margin guidance is about 10%. So we surely are focusing on getting there in our fiscal 27. We are not guided quantitative guidance yet, but I think if you look at the order book at this time, coming at the highest of $800 million opening backlog, we booked about $1 billion, expected to dramatically grow booking this year. We can expect a significant revenue growth in the coming year.
What would significant be, sir? Because you've got some inorganic growth as well. I remember the Brazilian company that you went ahead and picked up, and you're guiding that close to 500 crores will be accounted from there.
Correct.
You know, and there'll be some organic growth as well. So ballpark, should we be working with a mid-teen growth, including this 500 crores, or will it be even better than that? Should it be high teen?
It should be high teens.
High teens.
Be high teens.
Could it be 20%?
It should be 20%, yes.
20% could be the revenue growth with margins holding around 10%.
10%.
Got it. And you mentioned about the order inflows. There were a couple of data center opportunities, I think, that you were talking about. When do we see the light of day, finalization of these orders?
So we have, for this year, as I said, we have a very robust order book of $1 billion. Opening backlog very, very strong. We also have cracked into a new hyperscaler. We expect our quarter one momentum to continue. So we'll see some coming in quarter one and some coming through the course of the year. We expect our order book for the year 2027 to be significantly higher than what we did in fiscal 26.
Define significant again, because, we want to quantify the adjectives.
50% or more.
50% or more. Okay. All right. You also mentioned about a strategic breakthrough with a new global hyperscaler. Yeah. Could you give us an inkling of who that hyperscaler would be? And given the sort of infrastructure race that is taking place for digital, do you foresee that coming more into your order book as the years progress?
Yeah, I think I called out about 50% or more from order book perspective. There are only 4 or 5 hyperscalers. We serve all of them, but I think we are substantially gaining ground with one largely in the healthcare space out there. So we'll announce it when we get there. So I think net.
Can we hear that?
Next quarter.
Okay.
Okay, all right. What about any other challenges for the business? The globe is in a bit of a flux right now. Challenges you are observing on the supply side or any other challenges?
I think the issue has been infrastructure. The issue has been more fiber, networks, power. I think in some markets, it will continue to have some. I think the projects are delayed in Europe for that matter. In many countries don't have power.
Right.
So I think cyclically from our perspective, presence in 35 countries. So when we have North America, we are currently working for something in Europe. We are focused on India as well, which has just announced some mega projects. So I think we are hedged intrinsically because we're present across 5 continents. Primarily, of course, North America, where we're not seeing challenge, but of course, we're seeing some good momentum in Europe and Asia Pacific as well going forward. So that gives us a strong confidence with respect to what growth we see from booking and revenue coming up in 27.
Right. I'm looking at your cash from operations in March 2025. It's negative. And a large part of the cash balancing act has been done using cash flow from financing activity. So what explains that, and what's the kind of cash generation that we can see going forward?
So I think we can see a decent cash generation going forward. If you look at from our timing perspective, the last quarter specifically, some projects getting delayed. So we had a heavy quarter with respect to our March, and you see that in our AR being high at this time. We also did a very large deal from our partnership of Wind River. So we expect as we get into fiscal 27, our cash flow to ease out because the collections will start to happen, and the operating cash by the company would be significantly higher than what you see now.
What should typically the EBITDA to CFO ratio be, according to you? Because right now, as I speak, your reported EBITDA is roughly 75 to 80% higher over the last few years as an average as compared to your cash flow from operations.
Yes, so I think going forward, a large part of EBITDA will drop down into our PAT, right? So therefore, about 80-90%, we don't expect all our fixed costs to remain. So therefore, the conversion of EBITDA to PAT in fiscal 27 would be...
What we're talking about is cash flow to EBITDA. How much of that will flow down? As of now, there is a gap out there. The EBITDA number is growing up well, but the cash flow is not going up at the same pace. That's the point.
Yes, we'd expect at least 70-80% of that to flow down going forward.
All right. And the promoter stake, that has been coming down over the last few quarters, understandably to accommodate some of the funds, etc. as well. Now, just shy of 70%. Last quarter was 70.11%. The quarter before that was 70.24%. So every quarter there's been a 0.2, 0.3% sort of dilution by the promoters. Is that likely to continue?
I think it's on the contrary. The promoters participated in the pref that we did for 386 crores. They brought in 200 crores, and I think that caused a little bit of a 0.1% of dilution that happened. The promoters are highly invested in the business. Everybody subscribed to our warrants for the pref issue that we did for 386 crores, with promoters bringing in 200 crores, right? So I don't see that going forward. I think the confidence of promoters is extremely high. That shows back in their investment of 200 crores that happened a couple of months back. Right, so.
Okay, all right. Since things are looking so good, have you seen a lot of institutional interest? Actually, there's one mutual fund, which is Quant. They're the big ones in there. Well, have you received a lot more requests from domestic and foreign institutions?
I think we continue to meet them at this time. We're also heading towards our capital day on 1st June that we have put through across, meeting a lot of investors. And I believe a lot of investors' confidence is being shown up now at this time. We expect that to improve as we go forward. From a management perspective, execute well, execute well, and execute well.
Execute well, execute well, execute well. I'm just looking at some of the numbers that you're speaking about execution. Assuming mid-teen sort of growth taking place next year, you get to about 7,500 crores on the top line with 10% margins close to 750 crores, roughly 70% of that flowing down to your EBITDA as well. That takes you to about a 500 crore PAT. Market cap of close to around 18,000 crores. You're, not particularly cheap, still at around 35, 36 times.
Yeah, I think I would not want to speculate on short-term stuff.
I'm speaking purely from a
perspective of, I think we are a direct beneficiary of the AI-led infrastructure growth. I think we are at the cusp of that. We are among very few companies globally who can deliver this large-scale AI infrastructure. The market bakes in what the market bakes in, and from that perspective, but highly positive for fiscal 27.
We appreciate you coming down to the studio and giving us all of those details. Wishing you, as well as your team, all the very best, and all the best for that Investor Day. Maybe there's a fresh update. We look forward to having you back on the show.
Thank you, Nigel.
Okay, all right.
Thank you so much.
Okay, time to slip into that break. Come back. We'll continue to focus on markets and on stocks that are moving around. Welcome back. Well, markets are doing well. The Nifty is holding with good gains, but take a look at the broader markets. You have a lot of stocks out there. Delta Corp, today there's a court hearing with regard to their gaming business. So the stock is up close to around 10%. Keep in mind it's down drastically from the top, but let's see whether or not there is any relief in store. A couple of other names that are moving very, very well. Coffee Day, time for a coffee. Stock up close to around 17%. So big move is what we're seeing out there. HFCL continues its good run, and Nalco has perked up close to around 4.5%. Remember, the numbers were disappointing, but the stock is now moving higher as we speak. So good move on Nalco as well.
Yes, a bunch of stocks spiking as we speak. Exide is the other one which has surged as well, along with the Adani Group stocks, Adani Energy Solutions, Adani Total Gas, both of them up between 6 to 8%. Broader market is doing a lot better. Let's get you some ideas for profit then from our colleagues at Money Control Pro. And today we have Anubhav Sahu joining with the stock.
Well, talking about Balaji Amines, which is a strong import substitution play and among the two key amine derivatives manufacturer. Now, in the quarter gone by, company posted strong sequential improvement in spite of Middle East headwinds, which impacted raw material sourcing. We are particularly enthused about fiscal 27 for the company, wherein the management expects 10 to 15% volume growth, largely led by standalone business. Now here, key project to watch is the traction for dimethyl ether, which is an alternative for LPG in industrial applications and the aerosol market. Interesting to note that BIS has recently published a new IS code stating that dimethyl ether can be blended with LPG up to 8%. Now, company has recently commissioned 1 lakh ton capacity and awaits few regulatory approvals. Balaji also expects ramp up in electronic grade battery chemicals such as dimethyl carbonate to be used as electrolyte. Now, along with that, there is a heavy capex outlay for the specialty business targeting ethylene diamine and sodium cyanide derivative products. While this is well supported by balance sheet, project delays remains a key risk for the company. That said, we continue to like the company for its import substitution initiatives and see it as a key beneficiary of China anti-involution policy. So even after a strong run recently, valuations are reasonable in our view.
All right, with that, what we do is take your leave on this edition of Chartbusters with the news that it is an all-green screen. Midcap index doing well, broader markets looking good as well. The only red is the good red that we like, which is one on my tie, and the second part is the India VIX, which is down by about 5.5%. What we'll do is take your leave, come back. On the other side, we have the team of Trading Hour, which includes me, Ritu and Hormas, for the next part of the show. Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Hormaz Vatakia and Ritu Singh, looking good for the market. 50 points higher for the Nifty. The last hour yesterday was a dramatic sell-off, and thereafter today we saw a recovery from the lows, but still below that 24,000 mark. Buying on dips is taking place today as we kickstart a new series. Add to that, we have the market breadth firmly in favor of advances. The India VIX is lower. And across the board, there is some sort of optimism given the sort of weakness that we are seeing from highs on crude as well. So not looking particularly bad. And add to all of this, Ritu, tomorrow's a trading holiday.
Yes, tomorrow it's a truncated week. So let's hope we close this trading day better. You were talking about your red tie and the India VIX being down. The IT pack is also joining that party. It's it's slipped into the red now as we speak. So a bit of a issue there. We'll have to see how that goes, but the market breadth still looking all right. With where we're at, the Sensex has gotten back into the green, away from that red, up about 132 points. The Nifty also up still shy of that 24,000 marker. What's also doing good, better in trade today is the metal pack, relatively better compared to some of the others. Names like Hindalco, Tata Steel, all of those up and about. What's dragging the market slightly lower is, big names like HDFC Bank. That's been a key drag on the frontline index. ITC, ONGC also doing relatively worse. What's helping, though, on the flip side is ICICI Bank and Tata Steel, as well as Axis Bank, Hindalco, pulling their weight there. But Hormaz, as always, is walked by to the wall to give us the list of the top movers and shakers in trade.
It's a start that will be, pleasing for the bulls, if you could say that, because from the red, the Nifty has now moved into the green. The recovery that has come in from the lows, the dip has gotten bought into, and now we are at the highest point of the day, or at least close to that. So, but of course, the 24,000 mark continues to remain the most important one. As Mangalam was highlighting, the bulls will like the fact that the Nifty Bank, the India VIX is continuing to remain in the red, was down around 3.5% yesterday, is down another 6% in today's session as well. The banks continue to remain a little wobbly, but the one segment that is not wobbly is the metal space. The metals index is at a record high in today's session, 4.5% higher for Nalco, Hindalco as well at 52-week highs, 4% in today's session as well. Welspun Corp, APL Apollo seeing good gains in today's session. Positive result reactions as we wind down this quarter's earnings season. PNG Health is now up 12%, so extending its gains from the morning. Phenolics Cables is significantly off the highs of the day. At one point was up around 7-8%, so now down to 2.5%. Gandhar Oil also, and JK Tyre has extended gains. The stock is now up 5% in today's session. Now take a look at the negative reactions. ONGC, after its results, the earnings miss that you saw on the operational front, 4% lower there. Brainbees Solutions is now down 50% from its issue price of 465. Transrail Writing is looking to recover from the lows, and Techno Electric was down around 12-13% in yesterday's session, down another 7% in today's trade as well. Take a look at the newsmakers. Coal India is recovering from the lows as well, was down around 6-7% at the start, now down only 2.5%, so buying emerging at lower levels. Zen Technologies, after a new suite that it deployed earlier in the day, 4% higher here. MV Photovoltaic, of course, these solar names continuing to do well ahead of the June 1 deadline for the ALMM. And Granules India, after a block deal that took place earlier in the day, 3% higher here as well. And lastly, AI Engineering, as another day that the stock is at a 52-week high. HFCL continues to move higher, now 169 on the stock. CG Power as well, one of those names that are at a 52-week high in today's session.
All right, Hormaz, thanks very much for running us through that list. Let's focus away from the equities for a bit more on the macros, because amid what's happening with the geopolitical uncertainty around the Iran war, is India entering a new oil shock macro regime? And where is India standing in terms of stability on the macros? To answer all of that, we're joined by Devang Shah of Axis AMC. Devang, thanks very much for your time. Yeah, of course, the big talking point these last few weeks is what's happening with oil prices, and as a result, what's reflecting in the weakness in the rupee. A bit of a stability, over the course of the last few days since the weekend when talks of this sort of truce began. But, it's very fragile. One day we see strikes, one day peace talks. How much of the rupee weakness do you associate to purely what's happening on the oil prices, and how much of this is really structural weakness on account of what's happening in the flows? And do you think we've already seen the bottom, or is there more to go?
Yeah, first of all, as you rightly highlighted, I think India being a big importer for oil, we all understand that the India macro story weakens a bit with oil prices seeing significant shocks. And oil prices have actually increased from a low of $60 to now, and we have seen it above $100 for more than 3 months. So that is leading to, I think, the impact on current account deficit and balance of payment positions for India, which is weakening. And hence, we are seeing all the impact on currency. I would say over the last 15, 18 months, we have seen actually a 15% rupee depreciation. It was partially because of the tariff deal which got announced, and then probably around 5 to 7%, which has happened on account of this crude volatility. Is it done? It actually all depends on when this entire scenario on the Middle East conflict settles across, and how do we see the crude prices settling over the near term. Our view is that somewhere down the line for the year, crude prices will probably hover around this $80, $90. And that's generally it weakens the Goldilocks period, which India was going through, of lower inflation, lower current account deficit, and significantly stronger growth. So perspective, if you'll ask me, definitely the macro story has weakened a bit. Completely is the rupee weakness done? I would say if this crude problem continues beyond a quarter more, or if the crude dollar prices continues to over 100 for beyond June, personally, I believe that rupee can see some near-term pressure, and probably we can see some more weakness.
Right. Devang, the RBI policy outcome is on June 5. If you were in the MPC, what would your suggestions be? What should the street anticipate this time around? I mean, everyone's talking about calibrated price hikes, but are there any other tools that the RBI has to, fix the problem that we're currently facing with regards to inflation without hampering growth?
Right. So see, first of all, if you'll ask me, I think last week there was a lot of fear among bond markets that somewhere down the line, can there be another intermeeting hike? And we've actually seen the entire bond markets now started aggressively pricing in rate hikes, from where we were probably 3-4 months back, where we all assumed that for the year we'll not see any rate hikes and this would be a year of stable interest rate regime. I think thanks to all the oil volatility, we're all started pricing in the swap curves, which are a very, very good indicator of where the bond markets are, what kind of rate hikes the bond markets are pricing in. We're pricing in close to 100 basis of hike. Personally, if you'll ask me, I think rate hike is not the only solution which can actually take care of the entire macro scenario in which we are currently. Let's look at the comparison, because generally comparison is with 2013 or 2022 scenario. Our belief is that the market macro environment for India is completely different. The current account deficit is genuinely a problem, yes, but it is not like a dire shock in India as it was in 2013, where our current account deficit was upwards of 4%. Today, after all the oil mayhem, we probably go up from 1% of current account deficit of GDP to 2%. So yes, we need some calibrated approach on rate hikes, but I think there is no requirement of a panic, significant, massive rate hike environment today. Bond markets are actually pricing in aggressive rate hikes. And if I look across the curve, 3-year corporate bonds today are trading at around 8%. 30-year GSEC is trading around 760, 65. So these are levels where the operative rate in India was closer to 6.5. So what we believe is that tactically, yes, if I was from in the MPC, I'll probably use measures like attracting dollar flows as well as calibrated rate hike over the next 6 months, and keep the financial conditions easy so that the impact on growth is minimal.
Devang, since you mentioned calibrated rate hikes over the next 6 months, is the bond market or maybe even the currency pricing in the fact that the interest rates will remain higher for longer across the globe, not just in India, but or adding to the fact that whether there is a rate hike this policy or not, but the fact that the rate cut cycle is out of the window for now, at least till the situation normalizes, and it's not normalizing anytime soon.
No, so completely agree with you. So first of all, I think we all need to understand the fact that, and we have been talking about this now for 6-8 months, that the rate cut cycle is over, and it's over everywhere because inflation is back. But is it a scenario where bond markets should price aggressive rate hikes? Our view is no. Secondly, I think the economy will get fractured if somewhere down the line we keep financial conditions too tight, because we will enter a vicious cycle. Let's think across that. Let's think across a way where a lot of debate about let's use aggressive rate hikes again and probably that would stem the currency depreciation. But the impact can be that if you tighten financial conditions significantly, the credit growth will slow, and somewhere down the line, such high rates will probably lead to weaker growth in the Indian economy. At this point of time, relative better growth will probably attract more dollars. If we get into this vicious cycle of higher inflation, lower growth, I think currency depreciation will continue. So our view is, yes, monetary policy rate cuts are over. Completely agree. Rates are going to go up, definitely. But the measure or the pace of rate hikes should be slow and gradual. And secondly, I think the problem in the hand at this point of time would be to attract some dollars, because we are seeing FI outflows, as Ritu was highlighting. We are actually seeing current account deficit widening. So if we can attract dollar flows and somewhere down the line do a measured rate hike response, I think that's the best solution for macro as per us.
Yes, measured rate hike is what the market is also pricing, and it's only the question of when. Thanks, Devang, very much for joining in. Never second-guess the RBI. Last year, they shocked everyone with that stance change to neutral. So we'll have to see what they do in this June policy. But time for a break. Up next, we're going to be joined by Naveen Killa of UBS Investment Bank to discuss the quick commerce space in just a bit.
Welcome back. Shifting focus to the bond markets, as always, Manisha Gupta is here with the latest. Manisha.
Thank you so much for that. Well, it's a day which is slightly jittery when you look at the Indian rupee, which is off its recent highs yet again. Some slipping coming back in for the Indian currency. The crude oil prices have been quite volatile. At one point in time, yesterday in the New York session, we did see $100 per barrel come back yet again. It was nearly 3.5% of gains, but currently trading yet again below that $100 a barrel mark. In the meanwhile, Iran has warned off retaliation against US strikes, and that is something that the markets will watch out for. Interestingly, when you look at the Indian yields, we've seen that trade below 7%. This is the first time in 2 weeks that we've seen that happen. But much of that support seems to be coming in from the US yields as well, where we saw some decline in the overnight markets therein. Also, the street will watch out for is the RBI government bond sales on Friday. There's an enlisting of 170 billion of 6.68% 2040 paper, and there is also 110 billion of 7.43% of the 2076 bond. This is what the street will keep an eye on. And yesterday, CNBC TV 18 had a fixed income summit. We had SEBI representation there, and a lot was talked about bonds, which I want to slightly put over here. So one is the SEBI said that corporate bonds are not risk-free. Having said that the market regulator is planning major reforms to deepen the India's debt market. There also is a plan to explore a pilot project for tokenization of corporate bonds using blockchain-based technology. Also, tokenization to improve settlement, efficiency, transparency and accessibility is what the SEBI as a regulator said. SEBI and RBI also seem to be working together with the market to strengthen the market-making mechanisms and improve secondary market liquidity. The regulator also said to our event that considering separate regulatory framework when it comes to debt brokers therein. Also, they're looking to conduct more and more outreach programs. This is being done to encourage companies and SMEs as well to raise funds through the bond markets therein. And then they're also renewing or reviewing the municipal bonds framework to increase retail participation and help finance urban infrastructure projects as well. So a lot has been said, and we have seen in the recent days as well that bond seems to be on top of mind when it comes to the regulator, and we've seen similar statements coming in. Also, finally, when you look at the outstanding corporate bonds, that number clearly has increased quite a bit. So you are looking at interest coming into the markets. In 2015, it was 17 lakh crores, and FY26 stands at a tall 59 lakh crores as on your screens.
All right, Manisha, thanks a lot for that. So that's the bond market update coming in. Let's shift focus then to the quick commerce space. That is a sharp detour that we're taking right now. That's because UBS is holding its Asian Investment Conference 2026 in Hong Kong. And from the sidelines, we do have with us Naveen Killa, who's the head of APAC Telecom and Media along with Internet. UBS Investment Bank obviously joining us right now. They've paired their estimates on the quick commerce space. They do believe that, discounts are, the worst of discounts are perhaps behind, even as there is a fair amount of competitive intensity and expansion of the space that goes ahead. They have actually, maintained their buy rating on both Eternal as well as Swiggy. So we'll get into the rationale and the space at large in general in just a bit. But thank you so much for joining in. I just wanted to ask you, Naveen, you mentioned that 1,200 to 1,500 dark stores are possible over the next 12 to 18 months. We're closer to around 5,000 to 6,000 dark stores already. Taking this number to about 7,500, 8,000, does India even have the demand depth to, absorb that sort of infrastructure, even as in the tier 1 areas, there is a fair amount of density already?
So I would say, look, there are two drivers of growth still. And I think you need to kind of think of this as a scatter chart where, on one axis, you have a growth driver, which is more spend from existing customers. And then the second one is obviously new customers coming into the ecosystem. And then along the y-axis, we are talking about assortment. So I would say, and one of the platforms recently actually reported in their financial statements that they have close to 80,000 SKUs in Delhi NCR region, close to 50,000 SKUs in the next 7 to 8 cities, and only about 20,000 SKUs in the towns beyond that. So when you look at that, I think there's an opportunity both in terms of geographical expansion into new towns, new customer acquisition, which is where the discounting element comes, which is what you talked about. And then the second growth is more spend from existing customers, which is driven by assortment expansion. And that's the second part of the growth we're talking about.
Naveen, in your report, interestingly, you're talking about these big players with their deep pockets that had sort of been sleeping so far in this space coming back, looking to set up more dark stores, your Amazons and Flipkarts of the world. But you also say over time, you expect them to increase the total addressable market. So now, while near term, to what extent do you think they will hurt these, current players in the market like Swiggy, Instamart, Blinkit, etc.? And over time, do you think it'll be a net-net positive, given that they will end up expanding the market as well?
I mean, that has already happened, right? So if you look at, while optically the year-on-year growth rates for the industry look like they have gone down, if you look at the incremental customers that the sector is adding every quarter, the incremental value of the NOV, net order value, that is being created in the quarter, actually that's still very similar to the levels that we saw 3-4 quarters ago. So what it means is that the market is expanding faster. Now, coming specific to the larger platforms entering into the market, obviously there will be a point where I think you will start to see some consolidation, some restructuring of the industry landscape. But right now, if you look at the 2 or 3 larger platforms, their growth rates are still pretty strong. And I would say, we are not yet looking at one hurting the other market. The other thing I would also add is, as the larger platforms, which have traditionally focused on 1 day, 2 day, 3 deliveries, start doing quick commerce, there is a little bit of an internal cannibalization. So what that means is that the customers are shifting their spending from 1 day, 2 day deliveries into quick commerce, which is also expanding the quick commerce TAM. So as of now, I think there is obviously space for growth for the entire ecosystem.
So, Naveen, is it fair to assume that the quick commerce space has not yet reached the fittest will survive stage? And part 2 is the fact that with Zepto doing the kind of discounting aggression, is it gaining incremental market share to justify that kind of discounting aggression that they're doing?
So, I think discounting is a strategy that all platforms use on a selective basis. I think this is linked to one of the earlier questions, right? So you grow the business in 2 different ways, by acquiring new customers or by increasing the spend of the existing customers. The first driver of growth will be driven by discounting, because the initial customers, have to go through the hesitance of using quick commerce the first time. Are they gaining market share? I mean, if you look at some of the data points around MAUs and MTUs and all, they probably are. But obviously, as I said before, the other platforms are also growing. If you look at the MTU additions of the 2 listed larger companies, they also had pretty robust growth in the last 3 quarters. Then I said the second part, which is your growth is from existing customers. That is obviously driven more by quality of service, increasing assortment, expanding your average order value. And that's what obviously the 2 larger platforms are probably currently focusing on.
Right, Naveen, a lot to ask, out of time right now. So we request you to join us outside of the conference as well at times, that in your compliance, and probably have a conversation with us at more regular intervals, give us insights and data points on what's taking place in the quick commerce space, and thereby, making it public to everyone. The views on both Swiggy and Eternal for now as they're listed, and then perhaps some more IPOs in this space as well. Take a short break, come back, getting more of the markets and a lot of stock-specific action.
23,970 is where the index currently stands at, but a lot of activity in the broader markets. JSW Energy, after announcing the closure of its QIP, where a lot of marquee funds were issued shares, 4.5% higher on that stock now, among the top gainers on the Nifty 500 now at the highest point of the day is JSW Energy. What also continues to do well is GE Vernova. Of course, after the move seen in Hitachi Energy today, GE Vernova is putting in a move of its own. And Vedanta was higher yesterday, higher today as well, 2.5% or close to 3% higher now on Vedanta. And the stock is up almost, 30% this month itself. And this is turning out to be the best month that the stock has had since April of 2024 on last check. So good going for Vedanta. Of course, this one accounts for the demerger adjustment. So the graph doesn't show the adjusted values. But a lot of on the flip side though, Poly Medicure continues to drop. It was on a 2-day losing streak after its results, was down around 7% in yesterday's session, is extending those losses. Another 5% knocked off in today's session as well. So not good going for Poly Medicure. But now we take a short break. On the other side, we'll continue our corporate conversations. The management of Carraro India joins in to discuss the road ahead. Stay tuned. Welcome back. Continuing our corporate conversations on the earnings season. Carraro India is the management joining us on the show now. A strong fourth quarter, robust growth in revenue, margins and profitability driven both by the domestic as well as the export business. Let's discuss the road ahead of the company with its managing director Balaji Gopalan, who is joining us on the show. Mr. Gopalan, good morning. Thank you for taking out time. You had your FY26 revenue growth at 25%. Do you believe that this sustains going into FY27 as well? And if so, what gives you that confidence that it will sustain despite all the uncertainties that you are currently witnessing across the globe?
Yes, thank you very much for giving me this opportunity. We closed the past year with a lot of challenges, but we were determined to reach the guidance that we had been sharing with the market. So we closed with a higher revenue of 25%. Not only that, we moved the EBITDA up by 33% and PAT by 48%. Now, this shows how structurally our business model is robust. Now, coming to the current year and the future, I'm sure all of us are aware that there is uncertainty and we are evaluating how the situation is emerging. On the long term, medium long term, we are very sure that we can recover, we can recoup, and we will get back to the traction that we have built. So our exit traction momentum of last year is now getting a little bit disrupted. Nonetheless, it is a short term, probably a quarter or 2 quarters, but Carraro with its model and the market acceptance of our products and technology, we are confident that we will not be slipping down, but certainly we will not be able to have a growth as high as last year. We would be a little bit cautious while looking at the future. We will want things to emerge a little bit about the Middle East situation, and then we will have our strategies in plan to recover and reach a reasonably good result for the coming year as well.
Okay, so growth in this year would probably not be as good as the previous year, and you do expect a quarter or two of disruption on account of what's happening. But particularly on exports, Mr. Gopalan, one on construction equipment exports, particularly you have TBH, BHL, which have been good growth drivers. Can that continue with the disruption that you're talking about? And secondly, the higher HP tractor export market, which you said is gradually recovering. How large a segment could it be over, say, the medium term?
See, the export market for high horsepower is just an indication of global market accepting products from India and the Indian OEMs. Okay, so that is giving a positioning advantage to OEMs in India who want to export. Till now, India did not have the technology and the capability to look at more than 100 horsepower, 120 horsepower for export because we didn't have it within India itself in our portfolios. Now, with the support that is coming from companies like Carraro, Indian OEMs are in a better footing with a product, reliable product available for export. So this will emerge, this will ramp up. So you will not have big revenues coming out of it, particularly when you look at the scale in which Carraro is operating at around 2,250 crore, 2,500 crore. This high horsepower will not make a significant difference, but it is a journey that will begin, and over the next 3 to 5 years, it will have a significant positioning in that. Coming to the global market in construction equipment, like I said, sometimes the war economy, once the war is over, there is reconstruction, and we are in that sweet zone where equipment and machineries will be required for reconstruction. So logically speaking, I would say that we are looking at something very good after all these issues and uncertainties are resolved. So construction equipment, although the market is a little bit down now, we expect it to pick up in the next coming months. Coming to tractors in exports, we have to look at Turkey, US, and EU. Now, coming to Turkey, Turkey had a market of roughly peak 60,000-70,000 tractors in a year. It dropped down to 25 couple of months back. Now it has reversed to 35,000 tractors. So we benefited last year with the Turkey market. But now again, it is plateauing at 35,000 and not growing. But their peak volumes are at 70,000. So that is a gray area, a potential that can open up. US market went down during the tariff confusion. When tariffs were normalized, it started picking up. But now with the Iran war situation, again, wait and watch. So we are not very clear when that market will open. EU has been very stable. In fact, there is a slight uptick as well in the EU market. So overall, I would say today is not a situation where we would like to comment something in a very clear terms. There is uncertainty, but we have watchtowers as Kararo Group. We have watchtowers in all regions. Every day the watchtowers exchanges data, information, and we put our action plan in place, mitigation plan. And that is the reason, in spite of disruptions, we will be able to maneuver and take some hit, obviously, during this period. But in the medium to long term, we have enough strategies to recover whatever disruption we have had in the next couple of months till everything settles down.
Right. Balaji, I just had a two-part question, one in near term and one in the medium to long term, like you spoke about. In the near term, you said that FY27 will not be as high as FY26, and it is understandable given the sort of uncertainties, and you explained that fairly well. But do you have a rough estimate of how much worse can it be in the very near term before it starts to get better? What should the street pencil in? A double-digit growth should still be on the cards, right? And how much of a hit on your margins will you be able to take before you have to pass it on?
Yeah. See, when it comes to this situation, one is near term. Near term is 1 or 2 months, and that will take a hit. There is no doubt about it. There will be pressures on supplies, so there will be pressure on volumes. There is raw material shortage. There is manpower shortage with suppliers. So the entire supply chain is suffering as much as 25 to 35% currently. That has to improve. So that will have a cascading effect. When raw material is not available, revenue drops, there is pressure on the cost of raw material and the margins get affected. We are approaching all OEMs and they are supporting us to recover any of these extraordinary costs that we are incurring now. Plus, in our contract with all OEMs, any material cost fluctuation is indexed and it is recovered. So we are saying that this quarter could be a disruption for us. It could not probably meet what we would want to achieve. But surely after the next quarter, in the remaining 6 months, if things have stabilized, we have sufficient time to recover whatever we went through in this next quarter. So to answer your question, double-digit growth is too optimistic. It is probably a wish list. But I look at it not even in the mid numbers, 3%, 5%, 6% is something I feel we should look at it realistically and work around those numbers and wait for the market to open up and then grow. But structurally, we are beating the market because we are growing beyond the market in this segment we are present. So we are relatively in a better position in medium long term.
Right, that candor is very rare, Thank you so much for joining in. 3 to 5% as against the 25% growth that you did last year, and this is largely because of the current uncertainty that we're in right now. But you are confident of navigating through this as things open up, and we all hope that they do open up. And maybe, which is exactly why the street is also is respecting your guidance, and we haven't seen a big gash on the stock after that as well. It's marginally holding in the green. Take a short break. Come back. We have another management joining us. That of Pine Labs, to discuss their fourth quarter performance, where profitability continues for them. Putting around that 23,950 mark for the frontline index, the Nifty, that is the Nifty Bank, still lower. Is there any concern with regards to the macros? Well, what's on that list? We do have with us Ritu back again. Ritu, what about the macro signal?
Mangalam, what else but the AI trade? That's all we've been talking about these last few weeks. Because, what the recent trigger really is, you have this country with a population smaller than Delhi that has leapfrogged India to become the world's 5th largest equity market. We're talking about Taiwan, of course. The total market cap hitting $4.95 trillion this week, nudging past India's $4.92 trillion. And what's really remarkable is the context. I mean, if you look at Taiwan's entire economy worth, it's just $977 billion, which is roughly a quarter of India's $4.15 trillion GDP. So clearly what the markets are pricing is not really the size of the economy, but the exposure to what we're calling the biggest investment theme of the decade. And that, of course, is artificial intelligence. And the key driver here, it is just one stock. It is TSMC, Taiwan Semiconductor Manufacturing, which again manufactures the advanced chips that power NVIDIA, Apple, and pretty much all of the global AI ecosystem. And it now accounts for roughly 42% of Taiwan's benchmark index, which is a level of concentration that is pretty extraordinary even by global standards. Its first quarter revenue has already hit a record $35.6 billion. They're already projecting a full year growth of above 30% because demand continues to outpace supply. India, meanwhile, is discovering pretty sharply the cost of missing on this AI wave. Our markets have limited representation in semiconductors, in AI infrastructure, in advanced manufacturing, and that's showing in the flows as well. We've been talking here about the foreign investors pulling out, now nearly $24 billion from Indian equities just this year, increasing allocations towards Taiwan and South Korea. India's weight in the MSCI Emerging Markets Index, that's also nearly halved over the past 2 years, while Taiwan and Korea, they've been gaining market share. And that really matters because passive global EM money automatically follows benchmark weights, meaning higher index weights attract more structural inflows. And now, at the same time, you also have South Korea, which is rapidly climbing the global market cap rankings, again, on the back of AI, semiconductor trade. Kospi has been among Asia's strongest performing major indices this year. That, again, is driven by memory chip makers, exporters, and corporate reform optimism. Pretty much at the center of that rally, again, is that one stock, SK Hynix, one of the world's most important AI memory chip supplier. That company, again, has crossed $1 trillion in market cap. Together, Samsung Electronics and SK Hynix, they are pretty much turning South Korea into another key AI supply chain market for global investors. Now, that has pushed South Korea's total market cap to roughly $4.3 trillion. Again, narrowing the gap with India. Remember, India only recently overtook Hong Kong about 2 years ago to become, among the world's top 4 equity markets. But this AI-driven reshuffle is, again, challenging our position. So the bigger macro signal from all of this, clearly you're seeing the global markets reward AI concentration more than the consumption story India has been talking about, more than diversification. Yes, India is one of the fastest growing major economies. Yes, we have strong domestic SIP inflows. We have healthier corporate balance sheets than we saw a decade ago. But that still does not, the fact that we still don't have a globally scaled listed AI or semiconductor champion integrated into global supply chain. And until that changes, or until perhaps we see this AI trade cool off, the rankings, the flows, and the valuation premium risk moving further away from India.
Macro signal that is coming in from Ritu there. Of course, the AI trade continues to dominate headlines and the discourse as well. The index continues to struggle around that 24,000 mark, although it continues to remain in the green. We'll take a short break. We're back with the management of Pine Labs on the other side. Stay tuned.
Let's shift focus to Pine Labs. They reported a strong performance, improving profitability and cash flows, even as the company continues to drive through AI-led efficiencies. Let's get in, Samir Kama, the CFO of the company, for more on the outlook. Samir, firstly, first full year of profitability finally for Pine Labs, a 50% or more growth in your gross transaction values for the year. Can you sustain and repeat this performance, maintain profitability? And if yes, what will be the drivers this year?
Thanks, Sidhu. Look, when we went into the IPO, we were obviously at a 145 crore loss. And the clear direction that the firm was leading was to build a high-quality, globally relevant fintech platform. And we were building out a lot of initiatives and we were investing early in time. And I think we had a clear direction that this full year, we are going to see a very strong performance kicking. And I'm glad to report back to the street that we delivered almost about 113 crores of PAT, which was almost 145 crores of loss last year. There's a big swing, and that's come directionally through a great operating performance. We have grown our top line. Our adjusted EBITDA has moved up actually by about 55%. We reported an adjusted EBITDA of about 560 crores, which is a significant swing of about 60% over last year and a strong top line growth. More importantly, I think one of the questions that Street always asks is it a cash flow accretive business? I'm glad to also report that for the full year basis, we are able to translate that into strong operating cash flows, about 400 crores. So all round, I think this is right way in the direction that we were planning to reach, and I'm glad the results kind of bore fruit to that extent.
All right, we see that, and the results are showing. What stood out for me was working capital days reducing sharply from 60 to 45 days. Is there more room for growth out there? And additionally, I wanted to know from a growth driver standpoint, the affordability and EMI infra business, where the penetration is still sub 10%. How big can both of them be?
Yeah, let me answer the first question on working capital. I think, look, we go through a quarterly cyclicality of working capital, but if you see on a steady state annualized basis, our working capital cycle is pretty strong and we do generate free cash flows. With the rise of EBITDA, I think the translation of free cash flows to EBITDA is almost as high as 70% now. So I think that's a clear directional shift, and I'm very, very confident about the pace at which we are going to be delivering these numbers on a sustainable basis as far as operating cash flow is concerned. With regard to areas of growth, look, I think the way we have built our business is we have laid down the rails. We are largely present in the enterprise mid-market segment where there is a lot of complexity with commerce. We work very closely with some of the large enterprises, largest banks and brands in digitizing commerce and fueling GTV, so to say. Now, speaking within that, the affordability business is a strong value driver for us. We've been able to create a strong moat for our business by bringing together close to about 400 brands and about 42 credit institutions. And I think we've been able to drive a GTV growth of close to about 30% over the last few years. And that's a very strong, profitable segment for us. In terms of the headroom, we believe there is enough headroom to go because today, as we speak, as you rightly said, the penetration of total affordability within the GTV of consumer durables, IT, and even non-consumer segments is only about 25% paper finance plus digital finance put together. And we believe there's a significant headway for growth there. I think a lot of effort is growing in penetrating within the existing merchants in terms of awareness, adoption, and at the same time, adding new categories, including beyond the traditional consumer durable segment, mobile segment, which is where we believe the growth levers are going to come for the future.
Well, Samir, you're anticipating 21 to 23.5% revenue growth this year. What will lead that? And do you believe that this is the kind of growth rate that you are going to be working with, say, for the next 2 to 3 years as well?
You see, I think over the last 4 years, we have been able to deliver a strong 19% growth rate and a 45% EBITDA growth rate. That was on the back of a lot of investments we are doing. So if you see, a lot of those investments have grown fruit. For example, our international business today has grown at about 44%. It contributes to about 15% of our top line. And we have been able to win large client mandates across geographies. We have a very large presence in Southeast Asia, Australia, Middle East, made early entrance into the US market. And I believe that the platform we have created for scale in India has global relevance. And we're going to see a lot of incremental growth coming from these geographies as well. Also, within our existing business, the online or the payment gateway business has seen stellar growth of about 60%. I think these growth initiatives are going to bear fruit. Our existing online and the in-store business is also seeing strong growth. So across segments where we have been investing are bearing fruit. And we believe that the growth trajectory we have guided for is sustainable in the medium to long term.
Samir, pleasure having you today. Thank you so much for sparing time and joining us today. Wish you good luck for FY27 as well. The markets are off the highs of the day though. The Nifty is still at around 23,950, still holding on to some of those gains. They're looking for support around important levels. But take a leave on this edition of Trading Hour from Ritu Mangalam and me. Thank you for watching. Halftime Report takes the action forward on the other side.
Stocks trade in a narrow band as uncertainty over the US-Iran deal continues. Utilities and metals are big gainers, while healthcare and energy drag.
The government is offering up to 2% equity in Coal India via an offer for sale with a floor price of 412 per share. The timely move can mop up over 5,000 crore rupees for the government to cope with the West Asia pressures.
Aluminium prices gain as China enforces production caps to control emission, and LME inventories shrink amid West Asia supply disruption. Stocks of Hindalco and Nalco perk up.
ONGC declines after reporting a dip in oil output in Q4. Margins too come under pressure as operating expenses climb. Well write-offs also weigh down on performance. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vinny Motiwala. Vinny, good afternoon. Well, we have BSE monthly expiry today as well. Yesterday it was Nifty, so that way it's a fresh new series that we are talking about. It's been quite volatile from the word go. Yesterday, 23,900. After a lot of volatility, we could close above that level. We continue to be above that level even now. So 23,933 on the Nifty as we speak. Bank Nifty continues to be an underperformer. We are seeing some selling come by from the highs of the day, so we'll keep tracking that. For now, the Midcaps doing well, 0.2% higher on that one. Metals are rallying. We'll of course discuss that in greater detail. Autos, consumption, all these names are doing well in trade today. While we do have some pressure coming in majorly from banking index, oil and gas also not doing so well, but very close to the end of earnings season. And also, it's a holiday tomorrow.
Absolutely close to the end of earnings season. It's a holiday tomorrow, a truncated week. But yes, a lot of movers that are coming in on the broader end of the market as well, right? Look at Siemens Energy, that's up again in trade. We have Adani Total Gas, that's buzzing away. Jayaprakash Power, we have AIA Engineering, Zen Technologies, Z Entertainment, some of these movers on the broader end of the market. But let's talk about what's on the show for you all today. We have a very exciting lineup. First up, we'll have a management for the Q4 numbers. That's going to be Transportation Corporation of India to discuss the outlook of the company going forward as well. Moving on, we'll also bring on board the Movers and Shakers segment, and we'll put the spotlight on ONGC, Hindalco, Coal India, and more big movers in trade, as well as in our Crypto Corner segment today. We'll focus on the latest development in the crypto space as well. But let's start on time for our Movers and Shakers segment, where we focus on those individual stock names. And first up, we'll go across to Nigel, who's here to tell us everything about Coal India. Nigel, afternoon.
Well, afternoon. Yeah, that's right. Coal India is the company in focus. The few reasons that we're looking at it is because they're going to be doing an OFS. And remember, this was our news break in the first week of May itself, that they're likely to do an OFS. What are the details? The government is likely to sell close to around 1% stake in Coal India by the OFS route. That equates to around 6.16 crore shares. And they have an option to sell another 1% stake on. So in total, they have an option to do close to around 2%. The government holds around 63% stake in Coal India as of the last reported number. The floor price that they had fixed was around 412 rupees per share. And, if they just go ahead with the 1% stake, they'll raise close to around 2,500 crores. If they go the entire haul, then it'll be close to around 5,000 crores odd. In terms of dates, today is the date for the non-retail holders to go ahead and apply. While on Friday, since tomorrow is a holiday, that's where the retail audience gets their opportunity. Remember, today's cutoff price will be tracked. That will come post-market hours. And on that base, there will be demand for the retail audience as well. I think it's an opportune time for the government to go ahead and do this OFS. Let me give you four broad reasons. One is that the European natural gas prices have surged up. That's why globally people are searching for alternates to gas, and that's why coal prices have spiked. In fact, the international thermal coal prices have moved up from around $95 to around $115 per ton over the last 1 year or so. It spiked up by close to around 18% since the start of this war. The third factor is Coal India volume should pick up. Remember, the last few years have been absolutely dismal. Between FY21 and FY24, the volume growth on a compounded basis was 10%. FY25 was only 1%, and last year there was a degrowth. So on that low base, the street is factoring in mid-single-digit growth, and it's a dividend machine. Last year as well, it gave close to around 26 rupees 50 paise per share, which is very, very good. Jeffrey says valuations are attractive at around 9 times on a PE basis and 6% dividend yield. So OFS in the works, there appears to be rather strong demand, and the government has picked a perfect time to go ahead with this OFS.
Okay, I take that point. Thank you so much, Nigel, for bringing us all these details. The stock that I'm tracking today is ONGC. The company reported numbers last evening, and it was a weak set. Now, remember, Oil India, which is the immediate peer, did do well in the quarter gone by, but ONGC did not, so that has come in as a surprise. Their overall revenues were up 13.9%, but EBITDA was down 17% this time. Margins declined by almost 1,300 basis points, and profits declined 20.6% for the company as well. Their crude production was down down 6% on a YY basis, 3% on a sequential basis. Even the gas production was lower, 3% on a YY basis, 4% on a sequential basis. It was a soft quarter, which was led by higher OPEX. There was dry well write-offs as well, and that is what Jeffrey says in their note as well, that it was a soft quarter versus what they had anticipated. They have a buy call with a target price of 360 rupees a share. The company just did a conference call and they indicated that they have produced as much as they sold. So basically the production was not less than the demand that they saw. However, going forward, they will look at better production, more drilling and more gas wells as well. So we'll keep tracking that for you, but the stock hasn't recovered from that commentary. The stock is still lower, 4% in trade today. And this is coming at a time when oil prices are higher, so they expect it to continue, but ONGC lower in trade. But we do have Hindalco in focus. Nigel is back with us. Nigel, tell us.
Well, that's right. Aluminium stocks, they are in focus today as the LME prices have hit the highest levels we've seen in the past 4 years. Let's run you through the key reasons that is driving these aluminium stocks higher. First, the fears around Guinea. Ministers in Guinea, well, they have indicated a desire to curb the bauxite exports to support prices. Remember, Guinea is the largest bauxite producer with an output of around 183 million tons in 2025, and exports is a large proportion of this production. Remember, most of the exports go to China. So if China doesn't get its desired quantity of bauxite, then it could possibly disrupt the aluminium production. What's the concern, though, of Guinea authorities? Well, the problem is that bauxite prices have nearly halved in the past year. From around $120 per ton, it's come down to around $60 on a per ton basis. For Indian companies, Hindalco as well as Nalco, well, they're largely backward integrated on the bauxite aspect, while Vedanta, they're partially integrated with regard to bauxite. The second factor is the concerns over output cuts in China have suddenly come back on the table. China's daily aluminium output recently touched the highest levels we have seen in the past month itself. But with the country's annual production, it's already capped at around 45 million tons. The utilization levels are in excess of around 97-98% or thereabouts. So that raises fear of a possible supply side restriction, in addition to the production cuts that we've already seen in Middle East, which has got impacted. Remember, GCC nations plus Iran put it together, they account for around 7 million tons odd. That's roughly 9 to 10% of the global aluminium output. So continuing disruptions in the region are also adding to supply concerns. Finally, there are structural demand drivers when you talk about AI, data centers, electrification, as well as global energy transition. Well, that's what could support aluminium demand. In turn, it's supporting aluminium prices. And there is this fear, if bauxite supplies out of Guinea, well, they are restricted, then that will put aluminium production in a further crunch. So put all this together, aluminium LME prices are up and stocks participating as well. Nalco and Hindalco in focus.
Absolutely, Nalco and Hindalco both buzzing away in trade. Thanks so much for that, Nigel. But Sonal, back to you. Aquis, that's the one, a fairly recent listing, reported its numbers. Nothing great coming in there.
Nothing great, and that's why that big fall in the stock price is what we are seeing today. The company is a vertically integrated precision manufacturer, which basically serves the aerospace and consumer segments. If we talk about the numbers, it was an improvement in terms of revenues, 47% on a YY basis, but EBITDA was a decline, a sharp one at that, 23%. Is what the company reported. EBITDA margins declined 795 basis points. And this time around, there was a big loss, 54 crore of loss versus a profit last year that's at around 9 crore rupees. It said it is because of commencement of commercial operations in consumer electronics in Q3, because of which the costs were higher for the company this time around. FY26 versus FY25, yes, the numbers look better overall. And the net loss, however, has expanded to 113 crores versus 102 crores rupees. In terms of the aerospace order book, that stands at 889 million or 89 crore rupees in Q4 versus Q3. So there is an improvement. The aerospace business has actually done well. 27% revenue growth. They have seen a 76% EBITDA growth as well. But the consumer business is where they are seeing some pressure. 84% revenue growth, but an EBITDA loss of 78 crore rupees. The company did indicate in a conversation with us today that it will turn PAT positive next year, but their working capital days have increased as well. So the balance sheet looks stretched, and that is the other reason why the street is not so happy with the commentary on profitability. So 151 days, so balance sheet and P&L weak this time around, and that's why that big fall in the stock price.
Absolutely, a big fall, down almost more than 8.5% as of now as well. But let's move on and talk about some of these other movers in trade as well. And to take us through all those stocks, we have Hormuz at the wall to take us through all of that. Good afternoon.
Good afternoon, and plenty of movers in the broader markets in today's session. And the metals index itself, you just heard Nigel as to why these stocks are doing very well. The metals index is at a record high today. Nalco is the top gainer in today's trade, 4.5% higher on the stock. And a similar move seen in Vedanta as well. It's not just today's session, but the entire month of May, the stock has done very well. The first full month after the stock has traded, adjusted for its demerger, 30% higher this month now for Vedanta. Another 3% added in today's session. But some of the earnings reactions, the sell-off is continuing in names like Poly Medicure, is down another 5% in today's session. So that makes it a 15% drop that the stock has seen ever since it reported its results earlier in the week. The other mover today is Z Entertainment, and an announcement came in last night that the company is in talks with FIFA to stream the Football World Cup matches later this year. 8.5% higher on that stock as well. Another positive earnings reaction is Procter & Gamble Health. Among the best earnings reactions that we have seen today on the positive side, 10.5% higher on the stock for this MNC company. On the flip side, the stock that has not seen a very good result reaction is Brainbees Solutions, the parent company of FirstCry, after its results. Another 5.5% gone in today's session, and the stock is now down over 50% from its issue price, which was at 465. Hitachi Energy, the stock didn't do very well today. Yesterday, it was very choppy, but today's session, 3.5% higher. Jefferies increased its target to 43,145, and that is the highest target on the street for the stock.
Okay, thank you so much for that, Urmas. But on that note, let's just slip into a very short break. We'll come back after the break, connect with the management of Transport Corp to discuss their Q4 FY26 numbers and the way forward. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Nifty still holding on to 23,900 levels. But let's put the spotlight on the first management for today. We have Transport Corporation who reported their numbers, a decent set of numbers that came in Q4 FY26. When you look at it for the quarter, they've managed to see a 12.3% growth. Business has seen a bit of a pickup coming in Q4. Though FY26, they'd given a guidance of 10 to 12% for revenue growth. Slight miss there, right? FY26 numbers have come in at 9.5% in terms of revenue growth. Seaway margins, that has done well for the company. But to talk to us about the outlook of the company going forward, let's bring on board Vineet Agarwal, Managing Director at Transport Corporation of India, to discuss that. Vineet, good afternoon. Thank you so much for joining us on the show. I want to start by talking about that FY26 guidance. You've spoken about a 10 to 12% range where you would come in. Just a slight miss there, but I want to know for FY27, given what we are seeing in terms of the current geopolitical tensions, the current scenario, what is the FY26 outlook that you have?
So FY27, you're right, and it's a pleasure to be there, be here with you guys. The unexpected part was the Gulf War. So that happened, I think, on February 28th. So March is typically the best month for us in the year. And the business that could have happened that month did not happen. So we missed it by a bit, and we were quite confident to get there. Notwithstanding, I think the divisions have all done relatively well, and we've started to see some pickup there. All our businesses performed very well. On the margin side, also, we saw good growth, and the guidance for that was about 10-12%, and we happened to achieve that. Now, going forward for the FY27, the most obvious thing is, there is going to be an inflationary impact because of fuel pricing increases and just general cost increases across the system. So, which essentially means that would add to some revenue increase. We would have some volume increase, but we are also anticipating some demand pullback towards the end of the year, or rather the second half of the year. So, which would mean that net looking at about, again, the same 10-12% kind of top line increase.
Okay, 10 to 12% top line increase. Vineet, as you said, there are a lot of things happening, right? So while 10 to 12% is what would happen on the revenues, what's happening with costs right now? Because fuel prices have increased. On the commercial side, it is higher. We're seeing retail price hikes as well. Commodity costs in general have increased. Is that impacting some sort of demand? Is that impacting some sort of the functioning of the business overall?
Well, not directly in impact, because we have contracts where we pass on all these cost increases, whether it is fuel price hikes. On diesel side, we've had a 7.5 rupee kind of increase, which we have contracts for back-to-back pass on. Also, in terms of, you've also seen that manpower costs have gone up in some places where minimum wages, some states have increased that. So that has an impact on our warehousing business, and we again pass them on to our customers. So from our side, we are well protected. But what really happens is that this kind of inflation impact is going to possibly eat up some demand in going forward. Already in the South, we are hearing about some slowdown in terms of consumer durable offtake. Because price hikes have happened either due to raw material or just general inflation. So if there's some demand erosion that happens, that can start affecting the overall economy. But for us, we are relatively well protected with these pass-throughs.
Mm-hmm. Okay, Vineet, I want to talk about two specific segments as well. One is the freight segment and the CVA segment. Now, when you look at the freight segment EBIT margins, they have come off slight bit, right? While in terms of the CVA margins, they managed to see an improvement. So for FY27, or the outlook that you could give for the next couple of quarters, if possible, what is it that you're keeping an eye out on in terms of margins over there? What should we watch out for?
Well, on the freight side, clearly there is some competitive pressure and other areas of impact. And as I said, sometimes the pass-through doesn't happen all the time right away. There's sometimes a lag. Notwithstanding, I think freight should do relatively better this year. The focus towards LTL is increasing, and that will continue. On the Seaways side, the margin, we do not expect any margin expansion to happen because we have a fixed capacity there, and our ships are depreciated. And although the bunker prices have gone up by 100%, we've been able to pass on a lot of that. What's going to happen towards the second half of the year, that is on Q3, end of Q3 and start of Q4, is addition of 2 new ships that are coming in. We've ordered these ships in China, and they should start coming in, and hence we would have some increase in revenue, but also some initial costs of startup, etc., will go up. So I think for the full year, we would have possibly a moderated Seaways margin, but net impact is that it's still going to be positive.
That means, would it be in that Seaway margin of 28-29% is what your target is? Would it be in that range or still plus 30 somewhere around that?
I think that 25 to 30% is a reasonable aspect. Also, typically when monsoon starts, some Seaways business tends to come off because ships don't operate that efficiently. But because you operate only on the domestic sector. So some of that might happen. So moderate between 25 to 30%.
Vineet, you're saying that you are able to pass on the hikes that you're seeing to customers. It is a pass-through model. Is there any case that you will not be able to do that because demand would get impacted and ultimately it would impact your margins? Is that a risk that your business is factoring in, considering that there is still a lot of uncertainty and inflation continues to be a worry?
Sometimes there is a lag with this. The hikes have happened in the middle of the month, and we have to pass on this. Usually, we'll pass it on towards the end of the month. So there is some give and take in this. So not something to worry about. The trend, however, that is very keenly we are observing is that because of these fuel price hikes on the road side, railways becomes an important element of actually switchover. So we have a rail business and we are seeing very good growth there. So a multimodal business and the shift that strategically that we've done in the last decade is really helping us. Across the board, if there's some volume that comes off on the road side, we should be able to capture some of that on the rail side or even on the sea side.
Take that point, Vineet. Thank you so much for joining us today and letting us know the kind of business that you saw in the quarter gone by. Most importantly, what the outlook could be like, considering that we are seeing a lot of uncertainty because of West Asia war. That's the word coming in from Transport Corp. The stock absolutely flat with some positive bias. Time for a break now. Dharmesh Shah of ICICI Securities will join in with some trading strategies on the other side. Stay tuned. Welcome back. The Nifty continues to be above that 23,900 mark, though we have come up from the highs. But what's the F&O setup looking like at noon? Mangalam Malu is joining us with that update. Mangalam.
Well, the market is, fairly volatile. It's day one of June series. The Nifty off highs, off lows as well. But as we speak, it's marginally in the green. The Nifty Bank is the one which is slightly under a wee bit of pressure right now, but no real worries out there as well. The broader markets have a lot better stuff going on for them in terms of an outperformance. The important part, however, is the sector of the day is Nifty metals. If there was one playlist which was going around today, it would be heavy metals. But the important part is that the Nifty today's low coincides perfectly with the 20-day moving average. Today's low on the Nifty is 23,868. Guess where the 20-day moving average is? 23,867, which will give bulls some happiness that the fact that we are seeing support at lower levels. And even the Nifty Bank, which is, fairly above both the 20 and the 50-day moving averages, will continue to find support out there because this is a congestion zone that the Nifty Bank crossed after a fair amount of time. So any sort of, underperformance of the Nifty Bank, bulls will not be very worried about that, which is why exactly the market is poised between a narrow range. 23,900 put writers are fairly active, telling you there is strong support around 23,750, 23,800. And we've seen some call writing at 24,000, telling you still that above 24,100, 24,200, these are options that expire next Tuesday, will continue to see some supply. So the range of the market, which before this up move was between 23,300 to 23,800, has now moved to 23,800 to 24,200. So it's a 500-point up move that we've seen on the range itself. Amidst the stocks which are buzzing around, a lot of long positions are added on Exide, which is outperforming today. Shorts are caught on the wrong side on Swiggy, so we'll watch out for how Swiggy performs from here on because it's seeing an element of short covering. And ONGC, we've been speaking about the results of the company and the con-call commentary. There are a lot of short positions added on ONGC, which is an underperformer in today's trading session. But as we kickstart June series, the most important triggers to track throughout the month of June will be one, US-Iran developments, impact on commodities, because 8 out of last 11 June series have seen a positive up move. Let's see whether there is a surprise coming in out here as well or not. We have the RBI policy outcome on June 5. How they navigate through the current situation that we're in when it comes to macroeconomics is something that we'll be tracking. Demand impact of fuel inflation. We've heard corporates speak about early signs of that. Could that derail the course or not? And finally, it's June, so we keep an eye on the sky. Monsoon advancement is something that we will be tracking too.
Okay, Mangalam will keep an eye out on those three important points for the month of June as well, and key levels also is something that you all should watch out for. But on that note, also bring on board Dharmesha, Assistant Vice President, ICICI Securities, joining us to talk about his trading strategies. Dharmesh, good afternoon. Thank you so much for joining us on the show as always. Like you heard Mangalam as well, right? Important to note for the June series in terms of three triggers. But what are you keeping an eye out on in terms of levels? Nifty today obviously continues to be a bit more volatile, though still managing to hold on to 23,900 as of now.
Yeah, so good afternoon, Vinny. Yes, thank you for inviting me on the show. Absolutely, I think so. If you look at the market, I think so for last few trading sessions, we managed to surpass the major resistance of around 23,800, and post such resistance getting reach on the higher side, we see a more of a trading range happening for the market. Going forward, what we believe, I think, so the way the structure seems to be building up on Nifty 50 constituents, it looks like the market seems to be finding the support as 20-day exponential moving average. If you look at the today's low of Nifty, right, it exactly coincides with the 20-day exponential moving average. So going forward, we expect Nifty to see a strong support in this range of 23,600 to 23,800. 23,800 was the previous breakout level, previous resistance level also. So we expect this to hold in this current corrective phase. And eventually, I think so Nifty should be looking for a target of around 24,400 in the month of June. So buy the dip should be the strategy, and if dip towards 23,600, 800 should be look as a buying opportunity for a target of around 24,400.
Okay, all right. Take that point, Dharmesh. What about individual names? Anything that you have on your radar?
So if you look at the market, I think so the way the things are panning out in terms of sectors, power as an index seems to be clearly outperforming even in this current corrective phase. So power as an index to talk for, I think so the 10 months of long consolidation breakout has been witnessed in the power index itself, indicating, I think so the acceleration likely to continue on the higher side. So we believe the inside the power space, Tata Power remains to be at top pick in the current market price. So if you look at the chart from the Tata Power from the weekly perspective, the stock has witnessed a falling trend line breakout, retesting the previous breakout level, which was placed at 415. Post results, we expect Tata Power to see clearly outperformance going forward, keeping a short target of 470 and a stop loss of around 392. So Tata Power remains to be a topic inside the power space. Apart from Tata Power, Power Grid is something one. Post results, we have seen some bit of a profit booking happening for Power Grid, but strong support seems to be placed in the level of 285, 289. And again, the same story of falling trendline breakout indicating the end of the corrective phase for Power Grid. Expecting the Power Grid to head towards 352, keeping a stop loss of 289. So Tata Power and Power Grid remains to be a top pick at the current market price.
Okay, take that point. In fact, Dharmesh, we do have some queries that we would like to take up with you. Let's get to the first one. Tina Kapoor is writing to us from New Delhi. She holds 150 shares of Eternal at 230 rupees a share. She asks if she can book her profits right now. She bought it at a lower level, 230 rupees. So making some profit here. What do you suggest?
I would suggest you to hold on to the stock. I think so. The stock seems to be on the verge of a breakout. I think so. 253, 54 is likely to see a breakout and should be looking for target of around 265 to 268. So internal, I think so. One should hold and book around 265 to 268 is a good level to book profit.
Okay. Dharmesh, one more query. This is actually on Ashok Leyland. Utkarsh is writing to us from Mumbai. He wants to know if Ashok Leyland is a good bet that comes in on the auto ang side if he wants to play that side of the story. But for a short term, would that be advisable?
Yeah, if you do, I think so. The whole of the auto space, I think the strong sets of numbers from the monthly perspective. But yeah, definitely crude oil is something one which was impacting some bit of a pressure on the auto space as a whole. But we believe, I think so, crude should see a cool off going forward. Looks for target of around 1992. So can be a positive for across auto space. Coming to Ashok Leyland, again, I would say that the stock has seen a good correction from 210 to almost 145. Strong support is placed at around 138, 142. We expect Ashok Leyland to head towards 174 to 175 in the month of June. So buy the dip should be the strategy for Ashok Leyland. And if one is holding, I think so one should hold on for a target of around 174.
Take that point, Dharmesh. Thank you so much for joining us with your thoughts on individual names. By the way, the markets have come off sharply from the highs. We are in the red as we speak. The midcaps too have taken a dip. As we speak, we do have a lot of stocks at the day's low. HDFC Life, SBI Life, two of them there. There's also HUL, HDFC Bank, ITC, Tech Mahindra, some of these big names and big weights on the index which have come up from the highs of the day. Look at that. Some of these insurers not doing so well. We do have ITC, HUL, Tech Mahindra, Wipro, all these stocks not doing so well. Reliance Industries has also come off from the highs. So continues to be a volatile day, but we have come off from the highs. So we'll keep tracking that for you, but it's time for a short break now. On the other side, in our Crypto Corner segment, Manisha Gupta will focus on the latest developments in the space. Stay tuned for that.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome to Crypto Corner, and let's start with the regulatory and legislative shifts that we have seen into the international markets. And the top of the list clearly is Clarity Act, where there is uncertainty on legislative passage. Odds have dropped to nearly 50% from 75% in the previous week, and we've seen more and more concerns coming in for this one. The second important news over the week has been the European regulatory crackdown, where we did see the Spain government block decentralized prediction markets, including Polymarket and Kalshi as well. And this is being done to ensure, because it is illegal and the gambling, especially within games, is not allowed. But there is a positive within the news as well. This is about the global stablecoin adoption, where you have National Bank of Georgia now partnering with Tether to launch a CBDC initiative. When you look at the overall money rotation within the crypto markets, well, we actually have seen outflows, especially from the Bitcoin ETFs. But there also has been inflows, especially when it comes to the technology. The Bitmine Emergent Tech has accumulated 111,000 Ether in the past 1 week. The Bitcoin spot ETFs have lost nearly 1 billion over the same time. This is as the capital seems to be now rotating towards the altcoins. Alternative assets like Hyperliquid, Solana and XRP actually have seen more inflows and money coming in for them. Solana's ecosystem actually is slated to join Russell's 3000 index, and that's a big news for Solana, keeping those markets and market cap on the higher side. And when you look at the overall banks and brokerages getting in on-chain to crypto, that clearly is now started to include bigger names. For example, you have JP Morgan, which is now operating through its blockchain division, Canexus Digital Assets, and JP Morgan now has launched JPM On-Chain Liquidity Token and Money Market Fund and My On-Chain Net Yield. So we have seen JP Morgan, it already had one existing, it seems to have added one more. There is also an addition coming in from Goldman Sachs and BNY, which are looking to launch an institutional tokenized money market fund solution. There is also UBS, which is now operating UBS tokens, on-chain repurchase transactions. There is DBS Bank and SBI coming together for a digital markets build on-chain legal framework for digital fixed rate notes and variable capital as well. So big names now coming in on-chain for giving services to their participants, their clients, and of course, getting in more people as well. And continuing, of course, with the crypto as a market, we are now joined by Nishal Shetty. He is founder at WazirX and joins us now. Nishal, hi, thank you so much for joining. And just so much happening in the international markets therein. What is your sense on clarity and the way we see markets moving with big bank names now coming in on-chain?
Thanks for having me here, Manisha. I think if you specifically look at the US, there's definitely a lot of regulatory clarity emerging. I think in the past they came up with the stablecoin related act, and that I think pushed the whole payments ecosystem around the US and globally towards I would say a really greater adoption cycle. Now, if you look at a lot of these traditional payment processes all around the US, they're now supporting stablecoins. And it's becoming sort of like a default method for almost every payment provider in the US, where if they are accepting credit cards and debit cards and fiat, they're also now accepting, I think they're starting with stablecoins, so USDT, but I think over time they'll start accepting other digital assets as well, depending on the regulatory frameworks as it evolves. So I think for stable coins at least, that adoption has really skyrocketed in the US, and what that's doing is it's allowing the US USDT and USDC, all these stable coins, to I would say merge into your traditional commerce online, and now the next act that they're trying to push for, I think that will bring more clarity on the regulatory aspect for exchanges and any crypto related services in the US. So at least from a US point of view, I think the regulatory frameworks are getting solidified. In Europe, we've seen MiCA, and that's Europe is sort of already established, and US getting established. I think two of the largest economies globally would have really built a proper framework for crypto. And in Asia, we've seen multiple countries, Hong Kong, Singapore, and quite a few other countries in Southeast Asia coming up with regulatory frameworks.
Oh, yes.
India, we have to see. I think we are in that path. Just a few days back, we had the standing committee, meeting and asking questions to different crypto exchanges. WazirX was one of them. So I think we are still on that path. Probably might take longer than some of the other geographies, but India has its own unique challenges on, what's the right way and right approach to regulate this sector. So we'll have to wait and watch. Let's see how that goes.
Oh, yes, yes. Nischal, also, WazirX is now launching WazirX Zero and the futures as well. What is the plan on that one? But even before we get to that, how is it, after that Lazarus 2024 incident, what is it that is happening with that? How have you updated your security and multi-party compatibility? And of course, what is the timeline and sense of restructuring strategy of making the affected users whole?
I think for us, the cyber attack that happened, it was more on the infrastructure where our cold wallets were held. So what we've done is we've gone with BitGo, which is one of the largest custody providers. So majority of our assets are now with BitGo in their cold wallets, and they're one of the largest in the world. They're also a company that has IPO'd in the US. So that's one of the stronger points. We've also gone with another infrastructure provider called Fireblocks, which is the second largest, or probably they're on par. But these are the two big names in the custody industry or the infrastructure for securing your digital assets, BitGo and Fireblocks, and we've made sure that we use them now. In terms of restructuring, we were able to distribute 85% of the value, and now for the remaining 15%, we have like a 3-year roadmap, which all our creditors, they approved that. So the idea is that in the next 3 years, we build up our business, create revenues, and distribute the profits so that we can make the users, the 100% of the funds we can give back. So that's this 3-year journey now. We are on that rebuilding phase. The question is, how do you rebuild, after this? I don't think any company's been able to come back from these kind of attacks. Usually it's, you wrap up, you go home. But we believe that we have a responsibility where we need to build this up again and be able to give back, whatever we can make from this journey to our creditors. And that's what we are doing. In that, we've been trying to innovate. Now, if you look at the regulatory landscape, with spot trading and all, with TDS and all, it's much more harder. But in the whole future space in crypto, that's been taking off really well in the last 2 to 3 years. And the reason, there are multiple reasons for that. We can discuss that. But futures is sort of, I would say, the top revenue generator for all of the exchanges in India. But even globally, futures has really grown in size the last 2-3 years. So it's not just the fact that TDS came into spot exchanges in India that everyone moved to futures. There's also this maturing audience in crypto. Like they all started with spot. Spot is a very simple to understand, easy to use sort of a financial instrument. But futures requires you to learn and get better at it. And what's happening is, it's a journey for everyone who entered crypto in 2017, 2018, where they spent 4-5 years understanding, money markets, how financial industries operate. And now they're graduating towards becoming, proficient in futures.
Yeah.
And that is not just in India, but you're seeing that globally in the crypto ecosystem, which is why all these futures ecosystems have grown. Now the largest decentralized exchanges are also futures exchanges globally. And if you look at the volumes for any of the centralized exchanges in any part of the world, futures plays a major role. So that was one of the reasons why we are also getting into futures. We want to make sure that all of our customers can trade effectively on a futures market. But we are taking a cautious approach. For example, we want to make sure that people understand before they trade. So we have sort of a questionnaire where you need to answer questions, which helps you also understand that this market, what futures is, what leverage is, and you know the risks involved, and then you get it. And I think it's going to be a journey. You learn, you try, we have lower leverage right now, like on crypto, for example. On some of the larger tokens like Bitcoin, you usually see a leverage of 100x to 150x, unheard of, but in traditional markets, but that's like a common thing. But we started with 10x because we want people to learn, and gradually we'll increase the leverage. So we are taking steps to go hand in hand with how our customers mature. We'll also mature the platform.
Absolutely.
And offer the right kind of trading options for them.
As you said, next 3 years are going to be important for you in sense of roadmap and, of course, getting that participation, trust, and those volumes as well going. But thank you so much, Nishal, for joining us today.
Okay, Nishal and Manisha, thank you so much for taking us through that conversation. With that, we'll slip into a break. When we come back, we'll focus on Transrail lighting in our Inside Edge segment. Stay tuned for that. Welcome back. You're still tuned into Halftime Report. The markets have recovered yet again from the lows, so it continues to be a very volatile market. But if we talk about the broader markets, which are outperforming, we do have some stocks which are not doing so well. Techno Electric is one of them, which is down around 10% in trade. We spoke about Equus earlier. That is lower in trade. But the other stocks include the likes of GE Shipping, which is down around 6.5%. There's also Spark, which is not doing so well, so down 5% on that one. Carraro India is the other one, which is sitting with cuts of around 5%. So a lot of earnings reactions that we are tracking and news flow as well. Kernex is the other one which is in focus, 5.5% higher right now. They have bagged Kavach order worth 475 crore rupees. Misho is the other one which is not doing so well. So a lot of stocks which are reacting to news updates and earnings as well. Well, it's time for our Inside Edge segment. We'll focus on Transrail Lighting. Reported a weak Q4. Revenue margins were under pressure. Winnie, tell us more. We spoke to the management as well.
Hi, absolutely. So when you talk about Transrail Lighting, not a great set of numbers. During the first three quarters of FY26, they managed to see very strong growth. Q4 FY25 was also a high base. So yes, because of that, we've seen a lower number coming in, but a decline was something that the street was not expecting. So decline in revenue of 4%. Margins fell 90 basis points in Q4 as well. FY26, that given a guidance. Now, the company was in that range of guidance. Revenue is actually better than the range that guided for of 26-27%. Margins also came in the range of what they had guided. But what is the outlook of the company, right? Unexecuted order book stands at around 16,300 crores for the company. Most of it is obviously domestic order is around 60%, 60+%, and the remaining is international is 30+% around that level. The management said that they're looking at a 20 to 22% growth in FY27. West Asia accounts to 1,000 crores of the 16,000 crore total order book, which they have. And margins, they see it at around 11%, given the geopolitical uncertainties that are going on as well. 25% growth in terms of order book expectation, and new orders are also expected during the year. So that could be in the range of around 10,000 to 11,000 crores. They also made some new capex plan announcement yesterday. So that would come in through internal accruals that will be funded through that as well. But let's, on that note, listen into what the management had to say. Stock is still down 4.5% in the trading session.
Now, looking at 27, we are looking at a 20 to 22% growth on revenue, which is very important. We have an order book of 16,300 odd crores. So we are well placed. Our international book is around 40% and domestic is 60%. Therefore, we are comfortable that we will meet our revenue and the guidance going forward for 27. West Asia, we have two jobs, not very big, 1,000 crores out of 16,000, and they are all in a startup phase. So there is no crisis for us in terms of these jobs, and we're hopeful that things will ease out in the next few months. Government is very bullish about the energy infrastructure. Internationally, we see 50 to 60,000 odd crores of orders. So our take would be a 25% growth on our last year's order book of 8,500. We are looking at 10 to 11,000 crores of new orders coming in this year.
All right, that's the word coming in from Transrail Lighting. With that, it's a wrap in this edition of Halftime Report. Do stay tuned. Business Lunch will take all the action ahead.
Stocks trade in a narrow band as uncertainty over the US-Iran deal continues. Utilities and metals are big gainers while healthcare and energy drag.
The government is offering up to 2% equity in Coal India through an offer for sale. The floor price of 412 rupees a share is an almost 10% discount to yesterday's close. The timely move can mop up over 5,000 crore rupees for the government to cope with the West Asia pressures.
Aluminium prices gain as China enforces production caps to control emissions, and LME inventories shrink amid West Asia supply disruptions. Stocks of Hindalco and Nalco perk up.
ONGC declines after reporting a dip in oil output in the fourth quarter. Margins also come under pressure as operating expenses climb. Well write-offs also weigh down performance.
Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always is Hormaz Patakia. Hormaz, good afternoon. You know, the market's coming off the highs that they had managed to gain a little bit in the morning. Narrow range of trade, but, you know, the Nifty now in the red, the banks underperforming.
It's been a very dull session after all the action that we have witnessed over the last few days. The very narrow range that the index has been trading both yesterday and today. And it doesn't come as a surprise, more so because of the fact that yesterday was an expiry, today is an expiry as well. So, and more importantly, tomorrow being a market holiday, the traders would also be positioning themselves accordingly, especially considering the situations that are developing in West Asia at the moment. Oil prices have not gone anywhere. Brent continues to remain around that $97, $98 a barrel mark. It is the Nifty Bank that took the Nifty down yesterday. Today is no different. And the only difference is the fact that the Nifty Bank yesterday managed to hold on to 55,000. It is not managing to do that as of now. But that level of 55,000 will be the most important for the Nifty Bank. And of course, for the Nifty, the 24,000 level on the upside continues to remain a barrier. And of course, the first hurdle to crack and then to sustain above it before we start looking at higher levels. But for now, the index meandering in a very narrow range. The broader markets, stock-specific activity is aplenty.
Absolutely. And if you take a look at the sectors, right, the media pack is rallying. That index is higher by 3%. And we've got stocks like Z Entertainment, which is up 10%. We've got Sun TV, which is up 5% in trade. So those names doing really well. As we pointed out, that metal pack also doing well. Nalco soaring over 4% in trade. We've got Hindalco that's up 4%. And we've got Tata Steel that is gaining about 2% in trade. On the downside, we've got those FMCG names that are in the red. We've got ITC that's down over 3% in trade. We've got HUL and Britannia, both of those stocks nearly 1% in the red. So that's how the markets are looking up today. But moving on, the top stock focus today is Coal India, as the government is offering up to 2% equity in the company via an offer for sale. Nigel D'Souza joins us now with all of those details. Nigel?
Well, that's right. Coal India is the stock in focus, and it's a little bit lower, but just take a look at the big recovery we have seen from the lows of the day, because the interest seems to be quite high in this particular OFS. To give you the brief details, the government is looking to sell close to around 1% stake in Coal India by the OFS route. They have an option to sell another percent. So if they sell this 1% at the floor price that they spoke about of around 412 rupees odd, then they'll garner close to around 2,500 crores. Obviously, if they go the entire hog and they sell the additional 1%, then in total they'll raise close to around 5,000 crores approximately. The government of India, remember, they hold close to around 63% stake in Coal India. So this is, a step in the right direction for them. They get some money off the table, and the timing is very, very good. To give you another detail in terms of subscription, it opens for non-retail audience today. And in the coming days, that is on Friday, that's when the retail audience gets a chance to participate as well. The timing is very, very good for the government's perspective. Let me give you some few reasons. One is European gas prices have surged. So globally, consumers are looking for the alternate sources of fuel. And that's why coal is in demand. Now, if you look at it from the time this Middle East crisis has broken out, coal prices internationally are up by around 18 to 20%. Now, that's good news for Coal India's e-auction volumes. Why do I say that? Because the pricing has been a little bit subdued. If international prices are moving up, the e-auction prices can catch up, and that's key to its profitability as well. So that's point number two. Point number three is production numbers in the last few years have been absolutely dismal. They did very well between 2021 and 2024. However, in 2025, the growth was only 2%, and last year was a degrowth. So now the street is optimistic that we'll see growth coming back, maybe mid-single digits is what we're looking at. And then finally, Coal India has been a dividend machine. Even last year, they declared close to around 26 rupees and 50 paise. And in terms of valuations, it trades at around 8 to 9 times PE with good dividend yield and an EV upon EBITDA basis around 5 times out. Put everything together, opportune time from the government of India. It appears it's giving a fairly decent entry for investors as well. And this issue in all probability should get lapped up. Back to you.
Nigel, thank you for that update there on Coal India. It'll be interesting to see the subscription figures towards the close of trade. The stock recovering from the lows of the day, still around about 3% lower as we speak. But the other sector that Arundhati was just highlighting is the fact that the metal stocks are doing very well for themselves. The metals index is at a record high, and that's because global aluminum prices have surged to their highest level in nearly 4 years. And that's amidst concerns over a possible production cut in China and continuing supply disruptions due to the West Asia war. Now, the Nifty Metals Index, as we speak, is trading with gains of around 1.5%. All of the constituents are in the green. Hindalco and Nalco are the top gainers, and Hindalco too is trading at 52-week highs in today's session.
In fact, in an exclusive conversation, Vedanta's group chairman Anil Agarwal told CNBC TV 18 that he is very bullish on copper, aluminium, oil and gas. Take a look.
I'm very bullish on aluminium, copper, oil and gas. All three critical metal, very, very important. And fourth is, we can be the largest producer of arm and ammunition. The kind of factory we have, massive, if they can be modernized and privatized, we will be the largest producer of today's digital technology given. But we have to be, Parliament has to be together. Everybody has to be together, one way, one goal, to make sure that we will produce arm and ammunition here. And we run our, whatever strength we have, we leverage that 100%. All the share will be in the process of issuing. By next month, all these 4 companies will trade by themselves. It will have a very strong management. And this will be company which is what we require in natural resources in India. $20 billion we spend. Fund will never come on the way. Government is with us, and this all will be India. And by this, I'm looking forward at least 5,000 downstream industry to come in with our product.
Another stock that's doing very well in today's session is Vedanta. In fact, it's done very well all through the month. Let's also put the focus on the macro fallout from the West Asia conflict. Rising oil prices and a weaker currency have raised concerns over heightened inflation and the current account deficit. We spoke to some top fixed income CEOs to understand the implications and the possible impact on the macros.
You know, where we are now, and, you know, not really from a credit deterioration standpoint, but the right pricing of credit, we are in essence in the midst of a funding shock, which is coming from a sustained period of balance of payment deficit. And, you know, so the country level lack of dollar funding is percolating into liability side, you know, funding, I would say, stresses in terms of availability and cost of capital across the board. And on the other side, you are seeing probably a once in a decadal, if not more, shock from, you know, the commodity cycle suddenly flaring up, you know, the lack of the India-US deal probably pressuring the SME, MSME sector. So not so much of the credits that we as mutual funds get exposed to, because, you know, most of what we are talking about may not be issuers in the market. But I was just caution, you know, that things are different for different people now, and there is a generalized, you know, need to right price. Because if you're the holder of capital, you are, you know, basically the setter of the narrative right now.
While the balance sheets are good, we are today as an economy struggling to fund a 13% credit growth, which means that somewhere the market infrastructure is becoming an issue. This is a macro structure issue. And the second macro structure issue which we need to address is this complete you know, breakdown in terms of transmission, at least as far as debt capital markets are concerned, vis-a-vis the policy rates. Today banks are borrowing 3-month money at 225 basis points over repo. The last time that happened was in a crisis period. So somewhere I think we need to manage the macro level issues properly at this point in time so as to ensure that the liquidity issue does not convert into a credit issue in the near term.
Average inflation forecasts have to invariably move up, and RBI is first and foremost an inflation targeter. They should start the rate hike cycle going, but at the same time ensure that they don't unanchor markets' rate expectations. So you don't need a fresh pressure point coming from mixed commentary from the RBI. So you start the rate hike cycle going just to, continue to be credible as a conventional inflation targeter. But it won't solve much for the time being. What you could potentially hope for is a benign confluence of events. And I am not operating via perfect wisdom. I'm sure there's a big piece I'm missing here. But what we can think as a benign confluence of events is some sort of a dollar bond strategy to whatever extent jumpstart it with a $30-40 billion flow. The cessation of war that takes commodities, so let's say oil back to 85-90. And then at some juncture, if the shock to the US economy, because that's also a K-shaped economy, starts to show in their labor market and Fed rate expectations were to turn again, then you could potentially get a window where dollar depreciates. In 2025, dollar depreciated, we didn't benefit. A lot of other EMs did. But hopefully this time around, because we are cheap enough, that could potentially show with us. And so you need that jump start to happen, and from there you can build that narrative.
On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned.
Welcome back. Let's get to the latest of the US-Iran war developments. US President Donald Trump is set to host a rare cabinet meeting as talks with Iran enter a critical phase. The meeting is aimed at securing a broader agreement with Tehran amidst a fragile ceasefire. This comes after Iran threatened to retaliate after the US attack near the Strait of Hormuz. Meanwhile, Iran's supreme leader Ayatollah Mujtaba Khamenei, in his first public statement, said that the regional nations no longer serve as staging grounds for US military bases, adding that the US is moving further away from its former position with each passing day after the recent attacks. Meanwhile, Israel continued its offensive in Lebanon. More than 120 airstrikes were carried out in one of the heaviest days of bombing in weeks, as Israeli Prime Minister Benjamin Netanyahu said that his military was deepening its operations in the country.
And on the trade front, United States Trade Representative Jameson Greer said that he expects to meet Commerce Minister Piyush Goyal soon to finalize the India-US framework deal that has been under discussion since early this year. Speaking at the Council of Foreign Relations conference, he said that both the countries have had meaningful conversations and the US team will visit India next week to discuss trade framework agreement. Greer's comments come as the US is expected to come out with a new tariff architecture next month to replace reciprocal tariffs.
Back home, hearing in the case over the SIR in Bihar, the Supreme Court has ruled that the decision to conduct the exercise was within the statutory mandate. Ashmit is now joining in with more details on this. Ashmit.
Well, this was the SIR exercise, the first of its kind when it happened in Bihar. And importantly, the Supreme Court has held that this is legally tenable, has shown the green flag to the Election Commission. The Supreme Court went on to say that this was consistent with the constitutional provisions. This was consistent with the Representation of People Act, going on to say that there are enough and more procedural safeguards and that this was a proportionate action that was taken by the Election Commission to ensure the integrity of the electoral rolls and to ensure that there's a free and fair electoral process. And with that, importantly, saying that there are enough procedural safeguards in place to ensure that even people who are disenfranchised, they have remedies available to them. So broadly, what we understand is that the Supreme Court has upheld the SIR exercise. What this does is that it paves the way for the SIR exercise across states to continue post-Bihar. We saw that in states of Tamil Nadu. We saw that in poll-bound states of West Bengal. That exercise now will continue with the Election Commission on the SIR. One important clarification, however, that the court has issued is that exclusion from the electoral roll does not mean that a citizen is divested of citizenship. That is an important clarification. The Election Commission, the Supreme Court clarified, is only performing a function for the sanctity of the electoral rolls. It is not deciding on the citizenship of the persons concerned. And to that end, the Supreme Court has directed for Election Commission to ensure that the excluded names are sent to the centre for necessary adjudication for decision on whether or not their citizenship is valid. And if their citizenship is found to be valid, they will have to be put back on the electoral roll. So broadly, a green flag being waved, the Supreme Court saying that the SIR exercise as conducted by the Election Commission is kosher, is good, is constitutionally valid.
All right, Ashmit, many thanks for taking us through those details. Now, moving on, the World Health Organization has termed the latest Ebola outbreak in the Democratic Republic of Congo to be a public health emergency. The country has reported over 900 cases and 220 deaths so far, and there is danger of contagion to other countries. So far, there is no specific treatment or vaccine, but some development is underway. Sonal Butra is here with all of those details. Sonal?
Well, yes, the Democratic Republic of the Congo is facing one of its most serious Ebola outbreaks in years. According to the WHO, more than 900 suspected cases and over 220 suspected deaths linked to the rare Bundibugyo strain of Ebola have now been reported. On May 17th, the World Health Organization, or WHO, declared the outbreak a public health emergency of international concern. The current outbreak is caused by the Bundibugyo strain of Ebola, which is considered less lethal than the Zaire strain. Fatality rates for this particular strain are estimated between 30% and 50%. However, the bigger concern is that there are currently no approved vaccines or specific treatments available for this strain. Symptoms typically begin with fever, fatigue, and body aches. Infected individuals are not contagious until symptoms appear, and the incubation period ranges from 2 to 21 days. This is only the third recorded outbreak caused by this particular strain of the virus. The disease spreads through direct contact contact with bodily fluids of infected individuals and is not airborne. The outbreak has already triggered alerts beyond Africa. In Italy, 2 humanitarian workers returning from Uganda were hospitalized in isolation after developing symptoms, though tests later returned negative for Ebola. Closer home, India also recorded an Ebola-related scare after a traveller returning from Uganda was isolated in Bengaluru. Reports indicate the tests were negative and India has not reported any confirmed Ebola case. Health authorities say surveillance and screening measures have been intensified in line with the WHO guidance. There is, however, movement on the vaccine front. Researchers at the University of Oxford, working with global partners including Serum Institute of India, are working on a vaccine for the latest Ebola strain. A clinical-grade vaccine doses could be ready within 2 to 3 months. Experts warn the outbreak could spread more rapidly in regions marked by weak healthcare infrastructure and high population. The absence of approved vaccines and therapies for this strain could make containment significantly more difficult.
Sonal, thank you for summarizing that for us. Take a short break, get you all the updates from the world of AI on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. Now getting you the latest updates from the world of tech in our segment, the AI Pulse. Rachna Dhanrajani joins us now with all of those details. Rachna?
South Korea's memory chip giant SK Hynix crossed into the $1 trillion club, joining Samsung. Shares jumped 11%, lifting the company's market cap above $1 trillion. The stock has soared about 250% this year, fueled by surging demand for high-bandwidth memory chips used in AI servers. Now, SK Hynix is a key supplier to NVIDIA, so it cements its position at the center of the global AI supply chain. South Korea now hosts 2 trillion-dollar companies, and this is a first outside of the United States. Then there's American chipmaker Micron that also joined the $1 trillion club after shares surged about 14%. The stock jump came after UBS tripled the price target to $1,625 a share, the highest on Wall Street. UBS argued that AI has permanently changed the memory chip business, pointing to long-term supply deals that hyperscalers like Amazon, Microsoft, Google, and Meta have signed, locking in favorable pricing for years ahead. Micron shares are now up nearly 200% year to date. Then there's SpaceX that, as we know, is headed to public markets next month with an expected valuation of near about $1.75 trillion, potentially the largest IPO in the history. But behind closed doors, Elon Musk and his team have been discussing a possible merger with Tesla. While antitrust concerns appear limited, shareholder dilution risks for Tesla holders are substantial. The betting markets assign only 33% odds to a merger by next May between the two Elon Musk-led companies. But SpaceX AI growth story is now currently facing a credibility problem. Reuters found that Elon Musk's Grok chatbot has barely gained any traction with the US government, the world's largest potential customer. Of over 400 AI deployments last year, only 30 used Grok. By contrast, OpenAI powered 234 deployments. And then, as you can see, there's also Anthropic in the mix, which is despite the supply chain risk tag. Now, the gap raises questions about SpaceX $1.75 trillion valuation. So we'll have to see how that one goes about in just about a month.
Well, the biggest IPO in the history of IPOs is on the way. We keep an eye out on that. Rachna, thank you for that update there. Now, India is also testing a new connectivity infrastructure approach. Andhra Pradesh-based Red Balloon Aerospace has launched a stratospheric super pressure balloon designed to deliver telecommunications and imaging coverage to rural areas where traditional towers cannot reach. The balloon can remain airborne for 100 days and is being looked at as a cost-effective alternative to satellites. Some flashes at the bottom of your screen, sources telling CNBC TV 18 with regards to HDFC Bank, and that's in response to possibly the Indian Express story earlier this morning. The HDFC Bank's the parking differential interest under marketing as an industry-wide practice. These flashes coming in from Furqan, and sources have also told CNBC TV 18 that the RBI may look into the quantum of the differential interest rates, and the fact that the HDFC Bank's investigation into the MSRDC case started on the 2nd of April and closed on the 17th of April, and the HDFC Bank Vigilance Committee viewed this case as a case of hyper-competitiveness. And in a statement, the bank has told CNBC TV 18, and I quote, that the bank has robust internal oversight, audit and control processes and systems. All issues are dealt with in accordance with the bank's established norms, and full process is always followed before final determination post any internal review. And we strongly reject any assumptions of wrongdoing or culpability based on selective material, end of quote. And that's what HDFC Bank has told CNBC TV 18, and the flashes at the bottom of your screens with regards to the case investigation into MSRDC started on the 2nd of April, closed on the 17th, and the parking differential interest rate is an industry-wide practice, but the RBI, according to sources, may look into the quantum of differential interest rates. We'll get you more on this as the show goes by, but for now, the stock at the lowest point of the day, 2.5% lower, and that's keeping the Nifty in check as well. We take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Mangalam Malu. Mangalam, good afternoon. We are below the 23,900 mark. It's been quite volatile from the word go. It's a fresh new series, so we've started on a volatile note. We'll see which way things go. But for now, midcaps are outperforming while the benchmarks, they continue to suffer.
Benchmarks continue to suffer. The midcaps are outperforming, but just by a smidge. They too are off their highs. And the story of the day will be told by the crisscross lines, who've now come closer with the green one just marginally above the red one. But as we speak, let's tell you all the top stories that we're tracking this afternoon. Markets trade near the flat line, just below it actually as we speak. Uncertainty over the US-Iran deal continues. Utilities, metals and autos are the big gainers, while IT and financials drag. It's the broader market which marginally outperforms.
Auto component maker Crude dips to the day's low despite strong Q4 results. Domestic business delivers 25% growth while exports shoot up nearly 70%.
Aegis slips more than 9% after the company's fourth quarter EBITDA margin contracts. Management tells us that consumer electronics business will break even by the fourth quarter of this financial year. Adds that they are eyeing the aerospace business to grow between 25 to 30% in FY27.
And a number of stocks buzzing on the back of fourth quarter numbers. Finolex Industries surges as strong realizations boost fourth quarter numbers. JK Tyre also higher as it reports margin expansion in the fourth quarter. Okay, all right. Those are the top headlines that we are tracking. Some of those stocks we'll discuss in greater details. But for now, as Mangalam pointed out, midcaps are outperforming, but they've come off from the highs of the day. HDFC Bank, of course, continues to be on our radar. That stock at the day's low. A lot happening around the investigation into MSRDC case. It closed on April 17th, and we are getting some source-based flashes as well. So keep an eye out on that one. There is a lot of update that is coming by. This is something which is putting the Nifty lower as well.
Yes, and a bunch of midcaps, however, are buzzing around, some on numbers and some beyond that as well. Dredging Corp for one. Well, a lot of volumes picking up on that counter, so that stock's up around 4.5%. Gillette reported its numbers, has been doing extremely well for the last, many quarters when it comes to performance. So that stock has moved higher as well. And alongside that, as we speak, we're seeing some traction in names like LIC Housing Finance, which from the broader markets are actually spiking as well, has moved to the high point of trade. Let's get you some more movers. Then Upasna joins us to take us through all the midcaps that are moving around in trade. Upasna.
Well, if we talk about the Nifty Midcap 100 index, that's up nearly about 0.3% as we speak right now. So first, let us focus on some of the top gainers in today's trading session. First up is Delta Corp. The volumes are 10 times higher than the daily average, up nearly about 12% as we speak, followed by HFCL up nearly about 8% on the back of that 163 crore order that the company received from Railtel. CG Power also in focus, up nearly about 4%. The stock is at its 52-week high. Next up is AIA Engineering. One of the key volume buzzers for today. The volumes are higher by 11x times its daily average volumes. And lastly, coming to Zentech, up nearly about 5% on the launch of its next generation border security ecosystem. Also, certain cookware and appliances makers also in focus. They are gaining in trade. For the likes of Stovecraft, the rally continues today as well, up nearly about 7%, followed by TTK Prestige, seeing a dash of green there as well, up nearly about 3%. Now, let us look at some of the key stocks in focus on the back of result reaction. Camlin Fine Sciences, up nearly about 6%. Finolex Industries reported a good set of numbers, up nearly about 7%. Ram Ratan Wires has cooled off a bit in tandem with the market. AstraZeneca and also Senco Gold seeing some deep cuts out there. Now, on the flip side, let us look at some of the top losers in today's trading session. Easy Trip down about 6%. It's off its 52-week high. Brain-B Solution and followed by Misho seeing a cut of nearly about 3 to 4%.
Right, we take that point. Pasna, thanks a lot for that. Let's welcome Rajesh Palvia from Axis Securities on a quick technical check in the market. Rajesh, we have been fairly volatile in today's trading session, but suffice to say that the range in which the Nifty was consolidating, that itself has moved higher by a couple of 100 points.
Yeah, hi, good afternoon, Mangalam. Yeah, definitely. So Nifty range has moved up higher as the put-based concentration is clearly visible at 23,800, 23,700 strikes. So these levels are likely to act as a major support area for any kind of volatility if we see in the near-term perspective. Though still 24,000 call writers are still confident, as throughout the May series also we have seen most of the activity was at 24,000 level. This is very first day of June series. And looking at the rollover data also, Nifty rollover was slightly lower compared to 3 month, 6 month average. So I think 24,000, 24,050 is the challenging level at this moment. Once we able to take out this level, then we could see benchmark indices to move further higher, and possible extension of rally towards 24,200, 300 we could see in the near term perspective. So overall structure is bullish. Buy on dip should be your strategy. 23,800 needs to keep as a stop loss. Bank Nifty is still not able to take out 55,400, 500 zone, which is major challenging level, stiff resistance based on the call concentration. So I think that level needs to take out to support more on the Nifty. So 55,500 to 54,600 would be the range for next couple of days. But sector specific, mid-cap space is showing good traction. Lot many sectors are still continuing their upward trajectory. Metal, pharma, capital goods, even automobile, all these even capital market themes, all these sectors spaces are showing good traction. So I think there are a lot many opportunity on the stocks front, so one can focus on stocks till the Nifty not able to take out this breakout level.
So what in case of individual names? You did indicate maybe not so many opportunities, but do you have anything on your radar?
So I think one stock from the Swiggy is looking attractive. Very strong reversal after multiple supply zone breakout is already taken out. So looking at the reversal on the Swiggy daily chart, stock is now comfortably holding about 20-day moving average. Strong buying action visible on Swiggy. So looking at the breakout on near-term chart, we expect Swiggy can extend further more gain. Stock has reversed from the oversold trajectory. Possible up move towards 285 to 290 we could see in the near term. So buy and accumulate strategy. On the downside, 264 needs to keep as a stop loss. Another stock where we are focusing is from the pharma space, that is Glenmark Pharma. Stock has shown a very strong reversal from its 20-day moving average support area. And looking at the near-term, short-term structure, we believe that once a stock take out 2380 level, we could see a target of 2450 to 2480. So Glenmark Pharma is also looking attractive with stop loss of 2320.
Okay, take that point. Thank you so much for joining us. Glenmark Pharma at the day's high as we speak. We'll slip into a short break. When we come back, we'll connect with the management of RateGain to discuss their Q4 numbers and the road ahead. Stay tuned. Welcome back. You're still tuned into Midcap Radar. It was a solid showing for rate gain in the March quarter. Top line more than doubled to 700 crore rupees. Going forward, the company sets eyes on that $1 billion revenue target by FY 2031 and aims to be debt-free by FY 28. Let's put these numbers into perspective and discuss the quarter gone by with the founder and MD of the company, Bhanu Chopra. Mr. Chopra, good afternoon. Thank you so much for joining in. You have given targets for FY 31 in terms of your revenues, also on your debt reduction. But if we talk about FY 27, your EBITDA guidance is coming at 21.5% to 22.5%, which compares with Q4 margins at 23.5% on an adjusted basis. Why are you expecting that downtick to come by versus Q4? Also, in terms of organic growth, you're looking at 12 to 15% combined, which compares with 19% growth that you saw in Q4. What are you penciling in terms of fundamentals for FY 27?
Yeah, so thanks for having me. So to address your question on both the growth and margins. So as you've seen, we've had like a pretty fantastic Q4 in the year FY 27. We grew about 70%. And we are targeting similar sort of growth in FY 27 as well. And we're expecting to grow to about 3,000 to 3,100 crores. The Q4 numbers were, quite a lot better than the first 9 months. Our margins up until December for 9 months were trending towards 16-17%, and also the growth was single digit. So there was some deferment of some revenue from Q3 into Q4, which we had guided for, and as a result of which the the revenue, if you look on a consolidated basis, has normalized. So we are very, very comfortable at this scale to grow at 12 to 15%, closing in at 3,000 crores. If you recall, a few quarters ago, I've been on your channel and I talked about in FY 24 going from 1,000 crores to 2,000 crores by FY 27. So we are beating that number by almost 1,000 crores now. And we should be over 3,000 crores in FY 27.
Incredible. So that's your outlook for FY 27. And remember the conversation that we had earlier as well when you spoke about 2,000 crores. But I just wanted to know a couple of things. One is the Middle East impact. About 4% of your revenue you get from Middle East. How's that business coming along? Is there any, slowdown expected out there because of geopolitical uncertainty? And second part is on, the debt. Before Sojourn acquisition, you were debt-free, and now you have almost $100 million of debt. So what's the repayment position there?
Yeah. So to address your first question on the Middle East, yes, that business is certainly impacted. Although we are seeing some growth come back in terms of local travel in GCC countries, and also, the kind of incentives and promotions the hotels are running. And as you're aware, we work quite extensively with all the tourism boards in Middle East, including Visit Dubai, Abu Dhabi, and Qatar. And what we've been told is as soon as the war is over, there is a massive requirement and need to ensure that they bring back the traffic back into the Middle East. So although we've taken a dent, we do expect that there will be massive activity in terms of creating momentum, doing digital advertising, which is what we would be the beneficiaries of. So the impact is continues on. It is getting better. But as you're aware of the situation in Middle East, as soon as the war is over, we do expect that, it would be very, very similar to the COVID times. There would be revenge travel and revenge spend by these tourism boards that we should be beneficiaries of. To your question on the debt repayment plan, we are actually ahead on the debt repayment plan. So at the time of the acquisition, we raised about 125 million in debt. And within 6 months, we've already paid back 32 million. So the net debt situation is net debt that we need to pay now is 93 million. And the way we are generating cash, we do expect to pay it off completely by FY 28.
Okay. Your growth target, $1 billion revenues by FY31. You have 3,000 to 3,100 crore guidance for FY27. That basically means 2 to 2.5 times growth by FY31. Will it be a mix of organic plus inorganic? Do you think this growth could come by in a totally organic way?
So as you have seen the track record since we've gone public, we are an acquisitive company. We build the platform, the structure, the go-to-market teams, and we are in a very, very solid position with some of the world's marquee brands. We work with all the top hotel chains, the top 400 hotel chains, the top destination management companies that I talked about, similar to the ones in Middle East. We work with the top car rental companies. So our thesis or playbook is quite simple, that we want to continue to expand the relationships that we have with all these marquee brands and become a one-stop shop for anything digital or tech. So one-stop tech shop for all their needs. So we will continue to be acquisitive and acquire additional capabilities to build in deeper relationships and leverage the relationships that we have with some of the world's largest brands. We work with 13,000 customers. So my sense is, a lot of this growth will be in an organic, and we've established a track record on how we do these integrations, and we do them well. Sojourn was a big integration. As I pointed out in earlier quarterly calls, also we're running ahead in that integration plan, both from cost synergies that we wanted to drive, as well as consolidating the platform. It's much faster than what we have done in the past. Given the fact that it was such a large acquisition, I'm very pleased to say that we are running ahead, and we will continue to look at opportunities. And even in terms of the market perception now, we've established ourselves as an acquirer, as a platform that can enable entrepreneurs to scale through our platform to get access to these multitude of marquee customers.
All right, Bhanu, thanks a lot for joining in and giving us an outlook on the business. Fourth quarter was unusually strong. You expect growth of around 12 to 15% in the next year, with margins between 21.5% to 22% odd. That's about rate gain. Meanwhile, just before we take that short break, a couple of stocks now hitting lows of trade. From the Midcap end, you have Coforge, which is lower. The last few days have been decent for Midcap IT in particular, but now as we speak, it's coming in for some bit of selling. Escorts, Kubota and TVS Motors from the auto space as well are currently lower at the lower end of today's trading range so far. We take a short break, come back, getting more on the markets. A lot of stocks which are buzzing around, including the one which has strong numbers, Finolex Industries. Stay with us. Amidst the volatility in the market, Finolex Industries is trading higher on the back of their fourth quarter numbers, a strong growth in profits. Upasana joins in with the number crunching. Upasana.
Well, if I talk about the fourth quarter, the revenue growth has come in at 12% despite the flat volume growth that the company has seen. This is on the back of better realization that the company has seen. Now, if I talk about the volumes, they stand nearly flat, down about 0.5%. And the lower material cost and various cost control measures and even better realization has led to a margin improvement that the company has seen. Speaking about gross margins, they stand at 47.8% versus 34.5%. EBITDA margins are also seen a sharp jump up from 14.5% to 25.3%. PAT has overall seen an uptick of nearly about 58% at 261 crore. Now, if I talk about other line and items of the P&L, the other expenses as a percentage of sales has also come down from 18% to 15%, certainly making the better OPEX cost. Now, if I compare Finolex Industries versus its peers, that is Supreme Industries and Astral, the revenue growth has come in lower and even the volume growth stands lower as compared to these two majors. But in terms of margin expansion, it stands the highest at 1070 bips. So certainly we can see the stock surging on the back of that. And if I compare the full year numbers, the FY26 revenue growth stands down 1% on year-on-year basis, while the company had guided for double-digit growth few quarters back, and volume growth stands down 4% on year-on-year basis. So all in all, that's the key highlight of the result.
Okay, all right. So that's Finolex Industries up 8% in trade today. Well, with that, let's quickly take a look at the Nifty. It was below 23,900 when we started the show. That has reversed. So we are above that mark, but continue to be in the red as we speak. So we'll take a leave on this edition of Midcap Radar, but do stay tuned your stocks when we return to answer all your individual stock queries.
Hello, good afternoon. You have tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, so glad to have you back and have some company during the show as well.
Absolutely. It was a great vacation, but it's nice to be back as well. But, you know, the market's looking quite range-bound today.
Absolutely, a bit range-bound, flip-flopping between the red and the green. Nonetheless, today they're still managing to hold on to 23,900 levels. Hope that level continues through the end of the day as well. What is doing well today is the broader end of the market. When you look at it, that's a slight bit better, right? Midcap is just slightly better. It's not something wow or something extra good, but 0.3% of gain is what we're seeing the Nifty Midcap hold on to. In terms of sectors, metals is doing well, realty is doing well, energy is managing to hold on to gains, while on the flip side, your banks and financial services, which are seeing the downtick in today's trading session, Arundhati.
Absolutely. And, you know, one of those sectors that's also underperforming is the Nifty Bank, right? That's about 0.3% in the red. And that's because of HDFC Bank. If we can bring that chart up for you, it's about 2.5% lower in trade today after the news came out as well. And if you look at the sectors, the stocks that are doing well, we've got that metal pack. That index is gaining, you know, nearly 1% in trade. And we've got Hindalco that's doing really well. We've got Nalco that's doing well. We've also got the media pack that's doing really well. Sun TV is soaring in trade as well today. And on the downside, we have got those FMCG names. ITC is one of those stocks that is the top loser, but that's also because it went ex-dividend. So that stock is about 3% lower. We've got ONGC as well. That's not doing too well today. And that's the top losing stock on the Nifty today. That's about 4% in the red as we speak. But moving on, joining us today is Sneha Podar, the Vice President, Research Wealth Management at Motilal Oswal Financial Services, and Somil Mehta, the Head of Retail Research at Mirae Asset Sharekhan, to answer all of your stock queries. Now, let's go across to our first query. Kunal writes to us from Nagpur. He holds 45 shares of Belri's Industries at 210 rupees, and he is making a slight bit of a profit right now. He wants to know if he should continue to hold and also wants to know the short-term outlook on the stock. So, Sneha, let me come to you first. You know, take us through what you make of the stock, and should he hold the stock right now?
Hi, good afternoon to all the viewers. So fundamentally, Belrise is a very deep-rooted auto and company which is into safety critical systems and advanced classical chassis components. Basically, this company is benefiting from the premiumization which is being witnessed in the two-wheeler OEMs, and this is the dominant category in their overall revenue. Now, if we look at the Q4 numbers, even they were very robust numbers, wherein we saw a 40% jump in the Q4, while the overall jump in FY26 was robust around 20%. What they've done is they've rationalized their debt, and they are now, recently in December, they announced their entry into the defense and the aerospace. So they're trying to move away from the cyclical industry to a more structural play. So definitely, Belrise can be held on from the both short-term as well as long-term perspective. The entry level seems to be quite decent.
Okay, we'll keep an eye out on those levels over there for entry level for Belrise Industries. But more on that, Somil, what is your thought on this one? 45 shares at 210. What should they do?
Good afternoon to everyone. I agree. Short term looks great to me. Long term looks great to me. It has been holding on to a very crucial trend line, long term trend line, holding above 20-40 daily moving average. Every time it dips down, it will take support at the lower end of the Bollinger Band and the 40 daily moving average, and then again start a new move up. At the moment, it has been consolidating around the averages, but I think after this consolidation, the next move will start on the upside. The supports would be around 200 and the next support is around 192 levels. So these are very crucial levels to watch out for in the very short term, but my view is positive in the short term, medium term, long term, all three.
Okay. Positive on the medium term, short term, long term story. That's the word on the technicals for Belrise Industries. Let's move on then to the next query. We have Vaman, who's writing to us from Hyderabad. This is an investment query. Wants to know if it's the right time to enter JSW Cement and JSW Energy for a 2-year time period. Sneha, on the fundamentals, how is both these JSW stocks looking to you?
Okay, among JSW Cement and JSW Energy, I would prefer JSW Energy. Instead of JSW Cement, he can look at Ultratech. Now, the reason being, like JSW Cement Q4 numbers were very good, and they are expanding their capacity, pan India. To capture the growth. But the concern point over here is that the debt levels are pretty high and the expansion plans will keep them elevated. So we don't really see, though the revenue growth will be pretty good for them, but then somehow because of the higher interest burden, the PAT growth would be muted over next 2 to 3 years. So JSW Cement from that angle is avoidable. In case of JSW Energy, we are quite positive. They are transitioning from to more towards the renewable energy. So there the proportion, the overall contribution to revenue is rising in case of the renewable energy, and it is across solar, hydro, and wind power. And moreover, along with this transitioning, their plant utilization is further improving, which would support the overall operating performance. Plus, their thermal assets, they continue to be cash cows for the company, so that will help them to cater to all the capex requirements. So we are expecting very robust growth of about 60% PAT growth over the next 2 to 3 years. So one can really look at this counter from 2 year perspective. My suggestion would be after the recent run up that we've seen, one can do a staggered buying in the stock, probably 50% at this level and 50% at the lower levels.
All right, so staggered buying in the stock. Somil, if I can come to you, JSW Cement and JSW Energy, and the viewers looking to invest for a period of 2 years. Is this the right time to invest and enter these stocks, and any levels to watch out for?
Even I'll go with JSW Energy. Energy stocks, power stocks look really very good from here for a medium to long term outlook. JSW Energy looks really well, at a very good price level at this point of time. It has broken out of quarterly swing highs, taken support at crucial levels. The entire consolidation which we saw in last one and a half year has broken on the upside. So JSW Energy looks good to me. For a target, at least 700 I'm looking for in the medium term outlook. But JSW Cement, I'll still avoid. Only if it goes above 143, 145, then I'll probably revisit the stock again.
All right, so both of you are positive on JSW Energy. Moving on to our next query, Anurag Tiwari writes to us from Bhopal. He holds 400 shares of Everready Industries at 409 rupees with a medium-term view. He wants to know if he should continue to hold or sell at current levels. He is making a loss on the stock. So, Sneha, from a fundamental perspective, should he continue to hold this stock or should he sell at these current levels?
Since he's ready to hold on from medium-term perspective, my suggestion would be actually the company has been struggling with the stagnation at the revenue level, and this is largely because the volume pickup has not really happened at the battery level, which was anticipated. But what I believe is that given the recent announcements by the Delhi government and the Orissa government in order to push the usage of EV vehicles, probably this will help to push the battery volumes. And since his time frame is medium term, we can give it some time and see if the volume push happens or not. If it picks up from here, then definitely this company can benefit because they have a strong brand equity and the valuation levels are really comfortable. So let's wait for 1 or 2 more months and monitor the stock, and then probably we can take the call.
Okay, wait for 1 or 2 months and then maybe we can take the call on the fundamental front. But Somal, on the technicals, how is Everready Industries looking at, right? Right now, I'm just looking at the stock move. You know, every time it's somewhere around that 450, 480, then it starts seeing a fall. Again, it touches that, then again sees a fall. They bought it at 409. So what should they be doing? Medium-term, long-term outlook they want, but nonetheless.
Everready has been taking support at 270, 260 for multiple times, and it has been happening since 2021. Now, since 2021, multiple times it has gone up till 430 and 490, 460 levels. So it has been trading in a broad range. It's a very big range, but in the chart since 2021, it's like a broad range. Now this time again it has taken support around 270, 260, and again started a move up. So I'll be positive here in the medium term, in the short to medium term, but I would suggest a very strict stop loss around 295. That will be my stop loss, and my targets on the upside would be around 390. I'm not looking for anything above 390 at this point of time.
All right, Somil and Sneha, just stay with us. We have to take a quick break, but we'll answer more stock queries on the other side. Stay tuned. Welcome back to Your Stocks on CNBC TV 18. Still with us, Sneha Poddar of Motilal Oswal Financial Services and Somil Mehta of Mirae Asset Sharekhan to answer all of your stock queries. Now, the next query is coming in from Shiva, and he writes to us from Hyderabad. He holds 275 shares of Bajaj Housing Finance at 100 rupees and 120 shares of Ashok Leyland at 160 rupees. He wants to know the outlook on both the stocks for the next 6 months. So he's making a loss on Bajaj Housing Finance and he's making profits on Ashok Leyland. Sneha, let me come to you first. What do you make of both of these stocks and what's your view in the long term?
So in Bajaj Housing Finance, so it's a strong name in the housing finance domain, and it's well supported by diversifying into the higher yielding non-home loan segments. Plus, it is also expanding into the affordable housing. But the concern over here is that the competitive intensity is rising from the banks and the largely from the banks, and so the near-term pressure on the margins could be seen because of this elevated competitive intensity. So that makes us a little neutral on this stock. I mean, my suggestion would be to exit near the cost price. I mean, no need to panic and sell at this moment. But then sell on rise can be adopted in this counter. In case of Ashok Leyland, we are quite positive. The CV cycle has revived, and the company is also diversifying into the non-truck segments. It is overall improving its market share in the HCV segment, and the overall capex cycle is very disciplined, and the cash flow positions is well maintained because of this disciplined capex cycle. Plus, they are continuously launching new products, which are more of a premium products that they're launching. So we are positive on the company given the prudent capex that they follow and the healthy cash flows. And with the CV cycle being supportive, there's a good hold at the current levels. Probably he can look for a target of 180 to 190 levels.
Okay. We'll keep an eye out on that for Bajaj Housing and Ashok Leyland on the fundamentals. On the technicals, Saumil, what's your view for Bajaj Housing Finance? Last 6 months, the stock has actually seen a decline. Even last 1 year, it's down 30%. They bought it at 100 rupees. They're making a loss on this one. Well, Ashok Leyland is around their buy price right now. But both these for the short term, what is the 6-month target that they want for these? What would you tell them?
Ashok Leyland definitely a great stock to be in for short term, in medium term and long term. No doubts about it. My targets would be close to around 180, 190 levels for Ashok Leyland and above in the long term. So hold on. And in fact, you can buy at current levels as well for Ashok Leyland if somebody wants to buy on the portfolio. Bajaj Housing Finance, the stock has been going down, struggling to go above the averages as well. It has not, since the time it has listed, it has not closed above 200 daily moving average, which is not a very good sign. At this point of time, it has bounced from the lows of around 70, and it has been consolidating around the averages, around 20 and 40 daily moving average. So in the very short term, yes, there could be a spike till 95 and 96 levels, where the 200 daily moving averages. So that is, that is the only target I have. I would not look beyond that because it is in the downtrend.
Okay, that's about coming in on the technical front over there. Just a quick word in terms of, you had seen some numbers flashing at the bottom of your screens. Ramco Industries was the one that reported its numbers. A sharp spike up that has come and posted its numbers. It's up 11% as of now. We've seen some margin expansion that seems to be playing out as well. So that is why the stock has seen a run up. That was just report Ramco Industries. Yes, that's on the screen for y'all. It's up 13%. As of now, you can see just after reporting its numbers. So that's about Q4 earnings. But let's keep it going with the stock-related queries. You have Sriram, who's writing to us from Chennai, who's holding 150 shares of Apollo Microsystems. This is at a price of 32 rupees per share. He wants to know the short-term and the 2-year view on the stock. Apollo Microsystems, what's your view coming in on this one, Sneha? Fundamentally, the long-term story for this one, how do you see it playing out on the defense side?
See, Apollo Microsystem currently has an all-time high order book of almost 1,500 crores. And in FY27, actually, what is, their 2 large orders are expected to, move towards the execution stage. So high revenue visibility is there for next 2 years. And moreover, they are moving up the value chain into more premium defense electronics space. My take would be this is a long-term story, and one should keep riding this because structurally the defense electronics space is booming, especially with India becoming an export hub for defense, and with government laying so much emphasis on the indigenization in this segment. Definitely, no need to book profits in hurry. Probably partial profit booking can be done, but better to ride on from the next 2 to 3 years perspective.
So better to keep the stock from the next 2 to 3 year perspective, and it's a good stock to hold. Saumil, if I can come to you, he has 150 shares of Apollo Microsystems at 32 rupees. That stock has seen a stellar rally in the last 1 month alone. It's rallied 40%, right? So what's your view? Should he keep the stock, book some profits? What should he do?
If you have traded for short term and medium term, then definitely book some profits. But if you are holding on for a long term in your portfolio, then definitely stay on because I think it is in a good uptrend, and I'll be looking for much higher targets from here. It may see a small correction till probably 380, 340 levels, but that would be a buying opportunity. I would be a buyer here. On the upside, I'll be expecting a target of at least 500 plus for the stock.
All right, so keep the stock is what you're saying. Moving on, the next query coming in from Utpal Singh, who writes to us from Chennai. He holds some shares of PI Industries at 2,300 rupees. He wants to know the prospects of his investment. So we don't know how many stocks he's got at this point, but he made the investment at 2,300 rupees. The stock is currently at 2,843. Sneha, if I can come to you first, what's the long-term view on the stock?
So PI Industries is largely into the custom synthesis manufacturing led agrochemical segment along with the pharma CDMO space. They have a strong competitive positioning, but a recent few quarters they have been witnessing a lot of pressure on the earnings front. But stepping into FY27, we expect this year to be a recovery year for the company, and this should be largely driven by the new molecule launches and the ramp up across the CSM pipeline. So my suggestion would be, since he's ready to wait for long term, the recovery should be seen in FY27, and thus the stock price should again come back into momentum. His buying price is at very comfortable levels. So wait and watch kind of approach can be taken here.
Okay, that's a word there. On the fundamentals, on the technical, what's your view coming in for PI Industries, Somil?
My view for PI Industries is negative. In the short term, medium term, it doesn't look good. It has been struggling to go above 20 and 40 daily moving average. I'll be expecting a target of at least 2,550 in the short to medium term outlook. So my view would be to stay away.
Okay, we would be to stay away from this one. Trans-rail lighting, that's the next query that we have on, and this is from Rajiv, who's writing to us from New Delhi. Wants a 6-month view on Trans-rail lighting. Now, Trans-rail lighting reported their numbers also last evening. It was not a great set of numbers. The management has given some commentary in terms of outlook of the company, maintaining and going above with that growth of 20-22% growth in FY27 is what they're talking about. But a short-term target is what they're looking at, and wants to know for a 6-month short-term time period. So, Somil, I'm going to come to you for this one. Trans-rail lighting, does it merit entering the stock?
Not right now. I'll be bearish on the stock. Not much of a data, but I'll stay away from the stock because it has been forming low tops, low bottom, trading below averages. And my next target on the stock would be 450, below 450 actually. So stay away.
Okay, stay away from the stock. You have the numbers of Cummins flashing at the bottom of your screens for you all. At least on the first look, seems like profit is, above what we were expecting at CNBC TV 18. We'll wait out for more details coming in on this one. But yes, versus yesterday, what Siemens was reported in terms of numbers, today seems like Cummins is faring fairly better. Revenues also above estimates as well. So that right now, you can see the stock has seen a spike up also coming in post the numbers. ABB, Siemens, all of them didn't do that well the day the numbers were reported. Seems like this one is actually beating the trend, and we're seeing a sharp uptick coming in. We'll come back with more details on this one, but Aru, as of now, the stock is buzzing in trade.
Absolutely, the stock is up over 5% after those numbers came out. But Sneha and Somil, thank you so much for taking time out and being here with us on the show and answering all of our viewer queries. But with that, that's all we have on the show for you. But do remember to email us your queries and we will address them with our experts. But stay tuned for Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The markets that are open are doing fairly well for themselves. The Taiwanese index is up well over 2%.
So oil prices are still there, $99. I mean, just like a customary check on the prices.
The government will sell 1% stake in Coal India by the OFS route.
And RBI is first and foremost an inflation targeter. They should start the rate hike cycle going.
We've got market open. It's absolutely flat, so not very much at all. Almost unchanged.
We remain constructive on India. It's not that we are not, but our name count is much lower than what it used to be.
The last hour yesterday was a dramatic sell-off, and thereafter today we saw a recovery from the lows.
The rate cut cycle is over, and it's over everywhere because inflation is back.
If we're talking about Taiwan, of course, the total market cap hitting $4.95 trillion this week.
We are below the 23,900 mark. It's been quite volatile from the word go.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Rima, and in a short while from now, we'll have Prashant as well, who'll be joining in. Well, for the markets, we've faced some resistance at around the 24,000 odd mark, and that's why we've come off close to around 100 points from the highs of the day. The Midcap index is well still in the green, but that advanced decline ratio has narrowed off a little bit. And the rupee, well, it's more or less stable. It showed some weakness initially, but that's stabilized as well. So we'll keep an eye out on that front. But keep an eye out on the bottom of the screen. We have numbers that are coming in there, and my colleague Vinny is going to be slicing and dicing those numbers very, very shortly. I think we had Cummins numbers that were up for you on the screen, and the stock went for a bazooka move. It's up, I think, 5.5% as we speak. So let's get that one, up for you. Yeah, it's up 7.5%. Let's pull up the numbers as well. It appeared it was a bit of a beat. I think Siemens as well came out with a set of numbers. Numbers were pretty okay, but I think what the street likes is the order book visibility, and some of these stocks, they're just flying away. The cap goods space is clearly getting a lot of attention, and Siemens was up. Cummins says, let's join the party, post its numbers. So that one as well is up, but Vinny is going to be joining us, I think, in 5 minutes or so from here on, and she'll give us a breakdown of that. Hey, guys.
Hi, crude prices have also fallen meaningfully. So when we started trade, it was about 99 for Brent crude prices against the dollar. Right now, it's down to 96. So there has been a seminal fall in crude prices. So that's positive, which is why ONGC has taken a leg down. So it opened lower, 3% down on the back of numbers, but now it's down close to about 4.5%. A couple of the other big losers include HDFC Bank. That's down about 2.5%. It's putting pressure on the Nifty Bank, which is lower by nearly 250 odd points. ITC is down 3.5%, and then you've got cuts in Coal India, offer for sale there. Infosys, Wipro under pressure. BEL also down more than 0.5%. On the way up, you've got commodity names. Hindalco, Tata Steel, Eternal is doing pretty well. It's rallied 6.5% so far this week. Power Grid, Interglobe Aviation ahead of numbers later this week. Interglobe Aviation, that decline in crude prices has provided flight to that aviation stock. Hi, Prashant.
I was just looking at the Cummins numbers, Rima. We were just talking about the AI story. And this is also AI story, Cummins? Gensets, data centers? Yeah? Look, I mean, I think
Draw the connection.
We'll have to check out, and Winnie will join us in a bit to talk to us about that. But I think this is that. And maybe, we'll probably have some commentary from the management. The con call typically happens the next day. So I guess this will be Friday now, and that's when they kind of sort of give out more details, etc. I don't think they put out a guidance anymore on that call, but 8% jump on Cummins at this point. Actually, as you guys said, the market at the index level is not doing very much, but this is, lots of stuff happening as far as single stocks are concerned. So absolutely no complaints with everything which is going on. Well, how should you position yourself in the last hour? That's the question. Mitesh is with us to answer that. Mitesh, good afternoon. Good to have you with us here. What's the trade?
Good afternoon, Prashant. Well, I think, the idea was that we will possibly maintain a positive stance in Nifty unless we break 2858. We haven't done this, but we are still dangerously close to that. So kind of wait and watch your trading stock specific bias. I have one buy and one sell call right now. So ONGC, if you look at the chart, that's kind of given breakdowns. ONGC will sell with a stop about 80 to 85, look for targets of around 62. And Siemens I think that's on the buying side, buy the stop below 3,800 for targets of around 4,020.
Got it. Okay. All right. Thanks a lot for that, Mitesh. By the way, keep an eye out on the broader markets. A few stocks actually are spiking up as we speak. HCC, the stock was up, I think, close to around 2 or 3%. It's got an additional spurt out there. I'm not sure whether there was some news flow out there. So that stock is bursting away. Hind Rectifier, that stock is spiked up close to around 10% as we speak. So big uptick is what you're seeing on that name. And Pine Labs, we had the management earlier today on the channel. And, there was a large trade as well. If I'm not mistaken, around 3%, got cleared out in terms of a large trade that was there. And after that, in fact, the stock, just take a look at it around 12 noon. Yes, that's when the management as well joined it. From there, the stock has seen a big move. I think close to around $10 move from the lows. But the metal that's been twinkling all around, and 2026 belongs to it, is aluminium stocks. And in fact, aluminium stocks itself, they're in focus today. LME prices have hit the highest levels we've seen in the last 4 years. Let's run you through the key reasons for this rally. First, fears around Guinea. Ministers in Guinea, well, they have indicated a desire to curb the bauxite exports to support prices. Remember, Guinea, that's the largest bauxite producer. It has an estimated production of around 180 million tons in 2025. Most of it with exports, and a large proportion of those exports go to China. Now, if China doesn't get its desired quantity of bauxite, it could disrupt the aluminium production. The concern for Guinea authorities is there's been a sharp correction in bauxite prices, which have come down from around $120 per ton to around $60 per ton. For Indian companies, you'll be asking, what about them? Well, they are backward integrated. Hindalco, Nalco, they get all their bauxite requirement from their own backyard, so they are okay. Vedanta, they are partially backward integrated, and they're gradually moving towards getting fully integrated as well in the next couple of years. But some part of the bauxite availability could impact them, or prices spike up, it could impact them a little bit. But the ways aluminium prices have moved, it will offset any kind of this issue with regard to input costs. Second concern is output cuts in China. China's daily aluminium output hit the highest levels we've seen the last month. And to give you a number, the production capacity that is capped in China for aluminium is around 45 million tons. They're already at around 97% utilization levels. So there's fear on the supply side as well, because remember, the Middle East has already got hit. GCC plus Iran put it together, that's 7 million tons, 9 to 10% of the global aluminium output. So continuing disruptions in the region, as well as some kind of cuts in China, could probably keep aluminium prices higher for longer. And then we'll be talking about the structural, tailwinds. As we were mentioning, various AI, data centers, electrification, those are themes, right? They'll all require aluminium. So that's what's keeping aluminium prices in good stead. So put everything together, there's a bit of a supply concern with regard to bauxite. There could be some concern with regard to China as well if they pull back production a little bit. And we already have the Middle East mess that's taken out some kind of capacity that will keep aluminium out of the market for at least 6 to around 9 months. So explains why stocks are doing well. Well, I think we have Gurmeet Chadha who joins us. We're going to be getting Gurmeet Chadha in just a bit. Mitesh, let me ask you about these stocks though. The way these stocks have rallied, Nalco as well as Hindalco. And I'm sure Mr. Agarwal and team will be working on filing those papers and trying to get Vedanta Aluminium listed as soon as possible, because things are looking very, very good. From an India perspective, these companies, they'll get the benefit of the weaker dollar, weaker rupee in comparison to the dollar, the elevated aluminium prices as well, and cost 100 rupees. So lottery, how are they looking on the charts, Hindalco and Nalco, since both of them are listed?
Very clearly, I like Hindalco was a buy call a few days back. Nalco, I think, if you look at the last few days, it did a good range of about 410, 412 to roughly about 393, and it's broken on the upside. The all-time highs, the previous all-time highs was around 440, 442 here. So that's the first trading target. But once we clear that, I think good chance that we are looking at a 485 kind of a target of the stock. It's so bullish on all these stocks, and they remain good.
Okay, all right. Thanks very much, Mitesh, for that. Well, those are some trades coming through. Cummins' numbers, of course, we were just talking about that. Winnie's taken a closer look. Winnie, take it away.
Hi, so overall, numbers, great set of numbers that have come in versus what we were expecting at CNBC, or the street was also expecting themselves. Now, first, in terms of the revenue growth, 22% revenue growth. We were expecting the revenue to come in at about 2,800 crores. This is much about that, 3,000 crores. What's leading the growth? The engine segment of the company, that's done very well for them. That's seen a good growth. Now, margins of the company, we were expecting a bit of a decline. We're seeing an expansion coming in terms of margins. Largely flattish, but still an expansion versus a decline that we were expecting. 21.34% is what the EBITDA margin came in at versus 21.12%. Profits of the company, that has also seen an improvement. There is one small impact that is there of that one-time labor cost, but despite that, you're seeing a good number coming in terms of the margins. So all in all, they managed to see good numbers across both their segments that they have. You do not have commentary that comes in as of now, but the power generator side, that's expected to do well for the company. We were already expecting a good growth. Now seems like that's done better than what the street was expecting. So that is something in terms of details we'll wait out for, as well as what the order book lies is something we'll wait out for in terms of the commentary that comes in from the management as well. But as of now, good numbers versus what we saw coming in from ABB and Siemens. They've done much better than that. And Prashant, you were talking about AI, data center, all of that. That does work out for these players as well, because they do support them in some way or another. So obviously, if that works out, then this also, they see some increased orders. And they've also mentioned about data center being a story for them as well.
Yeah, thanks very much for that. Siemens, Vinny, you want to just sort of run us through that as well?
So Siemens, like we spoke about in the morning, right? The numbers were not anything great in terms of revenues, profits of the company or the margins of the company. They were a miss that came in. But what was exciting was in terms of the order book. That seems like that is something the street got excited about, because apart from that, nothing was good in the numbers. So order book for the company stood strong for the next year. Backlog stands at 45,000 crores. That is a strong order book jump that we've seen versus last year, 10% jump there as well. Mobility segment, smart infra segment, their revenue growth, that was consistent, but margin was a miss coming in, which was a bit of a worry. So when you see in the morning, we saw the stock did see a decline of around 4-5%, and then that recovery has come in. Seems like on the back of the order book is where we are seeing the run-up, or some buying that again came in the stock as well. Again, the con call for this one is also going to be tomorrow, so we'll wait out for more details again for this on Friday as well. But as of now, most of these capital good names are buzzing in trade, even before Cummins numbers. If you'd seen any of these other names also, like ABB, AI, and AI Engineering, all of them were up and away in trade, including Hitachi Energy.
Thank you very much for that. You know, Vinny, I was just checking Cummins India's Q3 numbers just to get a sense of the data center contribution and what the company said. So there are 4 segments for the company. There's domestic power generation, distribution, domestic industrial, and exports. So domestic power generation is about 35% of the overall revenues. And in that, the management in the conference call said, on an average, data centers is 25% of that particular. So we're talking about 8-9% in terms of a direct revenue impact. But the management did say that it's very lumpy, but the order book in the pipeline seems to be pretty strong. But strong numbers, and the stock is on a tear. Gurmeet Chadha is now here with us on the show. Gurmeet, any view on Cummins and the numbers?
It's been a very good run, for most capital goods, especially more in the power equipment space. So we've been, we don't have Cummins in the portfolio, but we have been adding, more full stack energy plays like Wari, for example, which has a full stack play in terms of from, let's say, polysilicon right up to the module. And I think you will probably see more policy measures also. In fact, there is some news of Semicon 2.0 expanding the scope on, in terms of covering, the energy a bit as well coming. So that's something we've added. We are also looking at some more names like Azad Engineering, or if there's any correction, which is both an energy play in terms of turbine parts as well as now getting into aerospace and defense. So that's something we've added in the portfolio.
Yeah, 100%. Actually, that's the theme which is doing well. I was looking at a broad swath of names. The Adani Total Gas, Power, Adani's Energy Solutions, Hitachi, GE Vernova, CG Power, Siemens, JSW Energy, NetWeb, Cummins India. And these are, by the way, some of the largest volume-led gainers across the board in the market. So it is that kind of broad space which is where bulk of the activity is very much. as we speak. Just a quick word, Gurmeet, if you will, on how HNI sentiment has been through this phase. Your client set, what they're doing in terms of putting more money to work, putting less. What's been happening?
Prashant, it's a bit of a selective, family office to defense. So, for example, Maruti as a treasury was pretty active when markets made February lows. A lot of allocation happened towards ETF. A lot of family offices are getting into, precision engineering, manufacturing, IP-driven kind of a bets. I think there's a bit of a disappointment with the legacy top Nifty names, whether those are frontline banks and let's say the ITCs and the IT services of the world. And I think that's where there has been a bit of a shift happening, in large family offices and HNIs. And that's why you probably see the breadth of the market has been pretty encouraging. Even today, if you see, Brent at almost 96, overall things better. But I think the frontline stocks struggle because the earning growth is single digit and there is FI pressure in terms of those names. Even if you look at the FI number, they've also expanded from top 900 to 1200 stocks with sizable reduction in the frontline stocks and increasing. So I think it's a market which is now probably getting a little maybe overvalued in some of the electrification, energy names, IP-driven defense names, and getting very undervalued in the frontline names. So it's a bit of a mixed sentiment. And in some family offices, Prashant, it's more wait and watch. I think the broader belief is that let things settle. We can enter maybe 4-5% higher. That's perfectly fine.
All right.
Sorry, you were saying that the FI selling was now in 1,200 stocks versus 900 earlier? I missed that point.
No, I said from top 900 names, they have expanded to 1,200. So they've added 300 more names, which means they are all seeing the beyond. And if you see the reduction, there's, I think, a very good report by ICICI Securities in terms of the percentage reduction. I think the highest is HDFC, followed by Infosys, then it is Kotak, and then it is ITC. There's almost like a 9-10% reduction. And that weightage has gone largely beyond the top 100. And that's why even the FI action on a while we always look at net numbers, the FI action also has shifted slightly beyond the top 100 stocks, if you see the percentage holdings.
Got it. Okay. All right, Gurmeet, good chat. Thanks a lot for joining and giving us your view on all of those stocks. By the way, keep an eye out on Coal India. I'd mentioned this earlier today. The timing is perfect from the government of India. There are a lot of tailwinds for the company, and that's why we had said that we expect it to get lapped off. Now, this is an issue that's coming at a 10% discount to yesterday's price. Take a look at that stock. What a big recovery we're seeing. It's moved into the green where you have the base price at around 412. And I was looking at the subscription data. It's already subscribed. That is the offering of around 6 crore. And 12 crore as well in terms of bids have already come in. Now, the government has to go ahead and decide whether or not they want to exercise this option. Today, the non-retail price cutoff will be tracked because that becomes the base for Friday, when retailers need to go in there and see whether they want to participate in the issue. Big recovery from the day's low, close to around 8% higher. Well, time to slip into a short break. On the other side, we have Gautam Chowchari of UBS. He's waiting for us to tell us how he is feeling about the markets. He'll be on the sidelines of the Asian Investment Conference 2026.
Okay, welcome back. Markets, of course, are looking down about 40, 45 odd points. This even as oil prices from the time that we started this morning are down about 3.5. Of course, speaking with a series of representatives from UBS over the last 2 days. Gautam, good to have you on the program. Thanks very much for joining us. Is there an uptick in interest? Are you pitching hard? Is it being received well? What's happening?
Good afternoon from Hong Kong. I think it's been a long time since I saw this kind of lower interest in India. So the interest remains quite low among the global investor base. We have seen them being sellers for the last few months, but even the interest level is quite low as we speak. Select investors are looking at bottom-up ideas, and we've had a few corporates from India talking to these investors. We've had a session around macro, but the interest is obviously clearly biased and focused towards what's happening in tech, in Korea, Taiwan, Japan, rather than looking at India right now.
I was looking at what is going on, for example, just today, as an example. It's not, you almost get a sense that while there's a lot of hand-wringing about why FIs are not here and all that, but because SIP flows have been so strong and local investors have to put money to work, there is, it's not as if the market's been bombed out or anything, right? With no foreign money and oil at these prices. There's enough and more activity, action. If you look at if you run a screen on 500 companies year to date, I mean, it's not a bad-looking screen at all, Gautam.
Absolutely. So if you try to marry the level of interest specifically from global investors, some of the narrative we see around the Middle East and oil prices, etc., was in pockets. We do have a bull market going on, as you rightly said. There are those pockets very clearly.
So what type of questions are you fielding about India? And you also spoke about some select bottom-up ideas. Do you want to tell us a little bit more? What's catching the interest?
Absolutely. Absolutely. So the debate around India, again, this is an Asia conference. We have investors from across the world, including from Asia, and looking at companies across APAC, as I said, Taiwan, Japan, Korea, China, obviously. So in that context, the big debate in India is around how India responds to the oil shock in the near term, and more medium term, how does the AI theme play out? Because if on one hand, they're clearly positive and looking at opportunities around the AI theme in markets like these, the Korea, Taiwan, Japan. On the other hand is India. So that's the big picture debate happening around India. In terms of companies and stock bottom-up ideas, like even the corporates we had, from financials to healthcare to consumers, even energy, when I speak to the investors, the debates are more around, can individual companies can somehow manage to grow materially higher than what the macro supports for, again, market share gains, new products, or specific parts of the cycle where they are very, very well positioned, for example, energy. So that's the kind of opportunities investors are looking at in India. Clearly, the macro view is for the investor set overseas, not supportive.
Do foreign investors find India still expensive, even after this period of time consolidation that we've gone through? And two, are foreign investors also worried about the concentration risks because they are holding so much of just select few AI stocks? At some point, it's going to be too much as a part of their portfolio.
So in terms of valuation, that's the bigger issue for India, for global investors, because with all the macro news flow narrative not being positive, markets having seen a time correction, global investors having sold off, are lightly positioned in India, it would be a tempting time to jump into Indian stocks. But the thing holding them back is the valuation. So there are only pockets like financials where they find valuations attractive. But again, the growth rates in financials in general compared to 10 years back is definitely lower. So pockets, yes, but broadly valuations is what is holding them back. In terms of in India versus the rest of the region, again, the same. The growth valuation matrix is not supportive of India for now.
Hi, Gautam. Good to see you in. Gautam, so there's still any signs of AI fatigue? Valuations or too much of interest? No fatigue yet? people are still interested. And also, we say India doesn't have a core AI play, but we have various ancillaries, right, on the energy side of things and other ways of playing this entire AI theme. Are people interested in them?
Let me answer the second one first. The second one, clearly, yes. And that's where we are seeing kind of a mini bull market, including some of the global investors having participated in that, because that's that theme of the AI ancillary supply chain or the entire value chain is a theme globally, not just in India. So when you say talk about power or the power equipment around that, that theme has been working very well globally, not just in India. And there is a mini bull market in that space, including in India. The AI fatigue part is very interesting because that's one of the first things we picked up when we started this conference, a debating point among these regional investors or global investors. But over the course, at least today is the day two, and we'll have more tomorrow also, multiple thematic sessions around AI and tech, whether the memory super cycle lasts or not. But again, the common theme coming out from whether it's experts, whether it's macroeconomists looking at the cycle, whether it's the global tech companies or experts looking at the elements of this AI cycle, leads us to believe that the fundamentals don't support any immediate AI fatigue. Because look, on a headline basis, these sectors and companies globally or in Asia are nowhere near rich. They're still attractively valued. The debate is, will there be a turn at some stage where the earnings don't show up? But again, whatever we have heard till now from all the experts doesn't seem to suggest. And that's the same sense we get from investors also, that they're not really looking at to get out of that trade in a hurry. Look, there will be some investors, for example, who will have constraint, like the typical one, they can hold only 10% of the fund in one stock, and therefore, even if the stock is the key driver of markets or the indices, they are capped. So that can happen, forcing them to sell. But otherwise, there is absolutely no AI fatigue.
There is no AI fatigue. Point taken. Any questions around the rupee and macros here?
Yeah, rupee is a big part of the macro debate, very clearly, and that's clearly not helped. But again, we did hear comments from some investors that a lot of the things which could go wrong for the rupee have all happened together. And how does that play out if oil prices stabilize? So there is some discussion around that, but yeah, the broader consensus view around rupee is it remains weak or gets weaker.
But that's not keeping people away, or that is keeping people away. I mean, that's not the real. The margin may be, right? Doesn't help with an argument.
At the margin, again, that's part of the broader macro narrative around India. But I think if I distill it out, I think the key is still the valuations, especially the relative valuations.
Yeah. So any ideas, single stocks you're pitching hard, Gautam?
So again, we like a lot of the single stock ideas. Again, India is always a stock pickers market. And even in this environment, there are companies which have a good growth outlook for the next 2-3 years based on their own, like in the financial space, in small finance banks or non-bank financials, a couple of consumer names which found interest, and even utilities and energy, clearly seeing opportunities there.
Yeah. Name a few from the published list. What is part of the what is part of the mix? What is part of the conversation?
I can't. I'm not allowed. But yeah.
Yeah, no, we have some of that stuff running on graphics here. Cummins is up 10% now. I mean, it's limit up on Cummins India. Super strong numbers. Stocks I think was up about 3% when the numbers came through. And almost all of the gains. Actually, no, it's over 10% higher. So about almost $66,000 right now, Cummins. Absolutely stellar moves. So that's what we are looking at this point in time. Gautam, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate you joining us, and have a good conference. Speak to you when you're back. All right, we'll take a quick commercial break here. We come back with, more market coverage and, some trading ideas coming through as well. Stay tuned.
Welcome back. Well, as promised, let's get in Mitesh Thakkar. He's joining to give us his trades at around 3 p.m. Mitesh?
So very clearly, guys, I think, market hasn't rebounded yet, but it's not breaking down also. The Nifty is somehow keeping its head about 23,800, 850 level. So we'll still wait it out, I think, on the index. Sometimes the waiting part can be frustrating, but it's important, till you get a directional bias. That's the time when you want to take positions on the index. And on the stock side, BT, ST on Power India, it's a big stock, 37,000 plus rupee stock. So keep a stop at 37,400. Look for targets of around 38,000. And Premier Energies, I think, that's a stock which has done well. It's just on the verge of breaking about the 1,040, 42 pivot. So it's a BTS in the sense that you buy about 1,045, take a stop at about 1,030, look for targets of 1,070.
Thank you very much for that. We'll come back to you for more. For now, let's talk about Zee Entertainment. Stock is surging as the company has officially entered talks with FIFA to stream and broadcast 2026 World Cup in India. Devyani joins in to get us the details that we know so far. Devyani.
Well, that's absolutely right. Now, Zee Entertainment has entered talks with FIFA to stream and broadcast the 2026 World Cup in India. Now, as per Reuters, Zee has made an entry amidst little headway in FIFA and Reliance Disney negotiations. Now, FIFA wanted roughly around 100 million for the 2026 and 2030 rights, but has revised that ask to roughly around the $60 million mark. Reliance Disney may have given an offer of roughly around $20 million for it. Well, so the FIFA opportunity, that's what's important. The FIFA World Cup is one of the most watched sports events all over the world. FIFA World Cup has a worldwide viewership of roughly around 5 billion. And for the 2022 World Cup, India was among the top 10 markets worldwide. The total engagement was nearly roughly around 745 million, while the digital and linear TV viewership was roughly around 85 million each. Now, reports say that the past two FIFA World Cups may have drawn in roughly around 200 to 300 crores in ad revenue. Now, why this time is different though? FIFA World Cup in 2026 has their matches in US versus what was in Qatar in 2022. So the late night schedule of the matches may impact viewership and ad spends this time around.
Well, indeed, it is in the night this time. So the assessment is that the viewership is going to be less, though the interest is very high. But how many people will be able to watch the entire match? That's the question, which is why the bidding has been on the lower side. Thank you, Devyani, for that. Zee Entertainment, though, clearly is excited. Let's see whether their bid is accepted. Let's talk about some more stocks which are in the news right now. Upasana joins in, and these are on the back of their Q4 earnings.
Well, first up, let me start with Finolex Industries, certainly the stock of the day. Now, the revenue has seen an uptick of 12% on year-on-year. Despite reporting a flat volume growth, this is because of the better realization that the company logged in this time around. Now, lower material cost and better realization along with the cost control measures taken by the company has led to a margin expansion this time around. Gross margins stand at 47.8% versus 34.5%. EBITDA margin has also seen a sharp increase from 14.6 to 25.3%. PAT on the back of the lower OPEX has seen an uptick of nearly about 58% at 261 crore. Other expenses as a percentage of sales has also come down from 18% to 15%. Now, if I compare Finolex Industries to two of its peers, that is Supreme and Astral, the revenue and volume growth is down, but the margin expansion stands highest in terms of Finolex Industries. So certainly we can see the surge on that one. Next up is Gillette. Net profit is up 21%, revenue up 3.2%, and margins have also increased from 29.4% to 35%. Aegis also remained in focus on the back of its weak numbers. Revenue saw an uptick of 47%, but margins down nearly about 795 basis points. The company has reported a loss this time around, mainly led by the company's consumer electronics segment, which was a key drag, versus a profit of 9 crore. Now, management joined us today morning and they've guided that the consumer electronic business will break even by Q4 FY27. And it is also eyeing its aerospace business, which is nearly 90% of their revenue, a top line growth of nearly 25 to 30% in FY27. Next up is JK Tyres. Overall, a good set of numbers. The India business is where the growth came from. Now, if I talk about the India business performance, the revenue has seen an uptick of 15%. Margins have also seen an uptick of 3%. 300 basis points. Now, overall, talking about the Q4 revenue, it logged a double-digit growth of 12%. EBITDA was up 48%. Margins also expanded by 300 basis points. And also, gross margin saw an uptick of 230 basis points. Now, some of the stocks in focus on the back of news. Zentek, also in focus, it has launched its integrated smart border suite, that is ISBS, a next generation border security ecosystem is what the company has highlighted. And lastly, coming to HFCL, it has bagged 135 crore order from RailTel, so hence we could see that surge on that as well.
Okay, well, thanks very much for that. Well, that's the single stock list, which is making the moves 22 points lower on the Nifty, not very much going on. I think maybe sort of focus on the macros for a little bit. This is from the Fixed Income Summit yesterday, and we spoke with top fixed income CIOs to understand the situation on liquidity here. I mean, generally the well understood the consensus is that liquidity is ample. There is no problem. But some of the fixed income managers we spoke to said otherwise, and of course suggested measures to remedy the situation as well. Listen in.
Where we are now, and not really from a credit deterioration standpoint, but the right pricing of credit, we are in a sense in the midst of a funding shock, which is coming from a sustained period of balance of payment deficit. So the country level lack of dollar funding is percolating into liability side, funding, I would say, stresses in terms of availability and cost of capital across the board. And on the other side, you are seeing probably a once in a decadal, if not more shock from, the commodity cycle suddenly flaring up, the lack of the India-US deal probably pressuring the SME, MSME sector. So not so much of the credits that we as mutual funds get exposed to, because most of what we are talking about may not be issuers in the market. But I was just caution, that things are different for different people now, and there is a generalized, need to right price. Because if you're the holder of capital, you are, basically the setter of the narrative right now.
While the balance sheets are good, we are today as an economy struggling to fund a 13% credit growth, which means that somewhere the market infrastructure is becoming an issue. This is a macro structure issue. And the second macro structure issue which we need to address is this complete breakdown in terms of transmission, at least as far as debt capital markets are concerned, vis-a-vis the policy rates. Today, banks are borrowing 3-month money at 225 basis points over repo. The last time that happened was in a crisis period. So somewhere I think we need to manage the macro level issues properly at this point in time so as to ensure that the liquidity issue does not convert into a credit issue in the near term.
Average inflation forecasts have to invariably move up, and RBI is first and foremost an inflation targeter. They should start the rate hike cycle going, but at the same time ensure that they don't unanchor markets' rate expectations. So you don't need a fresh pressure point coming from mixed commentary from the RBI. So you start the rate hike cycle going just to, continue to be credible as a conventional inflation targeter. But it won't solve much for the time being. What you could potentially hope for is a benign confluence of events. And I am not operating via perfect wisdom. I'm sure there's a big piece I'm missing here. But what we can think as a benign confluence of events is some sort of a dollar bond strategy to whatever extent jumpstart it with a $30-40 billion flow. The cessation of war that takes commodities, so let's say oil back to 85-90. And then at some juncture, if the shock to the US economy, because that's also a K-shaped economy, starts to show in their labor market and Fed rate expectations were to turn again, then you could potentially get a window where dollar depreciates. In 2025, dollar depreciated, we didn't benefit. A lot of other EMs did. But hopefully this time around, because we are cheap enough, that could potentially show with us. And so you need that jump start to happen, and from there you can build that narrative.
Okay, all right. Keep an eye out on the broader markets. And one stock I want to bring your attention to is LIC. They had announced the bonus. It goes X on Friday, which effectively means that if you want to be part of that bonus, then today is the last day to buy. So explains why that stock, in fact, has perked up in the last few minutes. Now moving a little bit higher, cutting its losses, still down 2.5%. Well, let's look at the F&O action. The Nifty has been down. It was down 40-50 points as well. But the India VIX is cooling off. And I think this is a big trigger. If the India VIX can move below that 15% odd mark, that's going to be very, very good news from a bullish standpoint. Remember, we're talking about the index that at the highs had almost moved to around 30. So it's come down substantially. On the day that the markets are not rising, still the VIX is cooling off, telling you that the bulls believe the best is yet to come. And, there is some confidence coming back even with regard to the headline index. The PCR ratio is close to around 1.98 the last time I checked. Going to individual strikes, though, the bears, they will look to defend this 24,250 mark. I say that because the premium out there, is a little bit lower in a market that, even when it was up 5-10 points or thereabouts, so you got the direction right, but yet the premium is coming down. That's telling you that, in fact, there is writing at that level. Even if you look at the 23,900 call as well, the premium out there, I think it was down close to around 19%. Yes, it's still down, 170 rupees or thereabouts. So we are seeing signs of writing at those levels. However, I expect that 50 as well as the 20 DMA to get protected. The reason I say that is the 50 DMA first. That's because the 23,900 put, well, the premium out there has come down. There is aggressive writing that we're seeing at that particular strike. Just pull up the chart, it'll tell you the picture in terms of the support levels. Tata Motors PV, there's a short covering bounce playing out on that stock. On X side, there is fresh buying that we're seeing. And on Info Edge, that's another stock that's seen a sharp correction from the top. That as well has come in for a bit of a short covering bounce in today's trading session. But keep an eye out on Coal India as well. That's the other stock in there. Beautiful move by the government, actually, going ahead and announcing an OFS when there are tailwinds for the sector on the whole, and valuations, as always, have been very, very, supportive for the stock. Yesterday's high was 475. It ended yesterday at around 455 approximately. Today, it opened up, gap down 8% lower, and now all of that has got bought into because demand reportedly has been very, very high. But let's get some opinion we got earlier today. We spoke to Deepika Mundra, the Director of Equity Research India at M&G Investments, to discuss the AI trade. She told us that India will be one of the largest users of AI, but that valuations still remain a bit of a concern. Let's hear her out.
India, while we don't have any meaningful play on hardware, we're going to be one of the largest users of AI and AI compute, and for which we're likely to see the development of data centers. So as of now, we have just over 1 gigawatt of data centers operational. There is a pipeline of 5 to 10 gigawatt to come through in the next 5 to 10 years. This will require a lot of capex from, and particularly in the electrical equipment space. So this is what we call the picks and shovels. We prefer the shorter cycle plays here, being able to reprice commodities quite quickly. So you have electrical equipment, gensets, cables and wires. What we do have to be mindful of is that the correlations, just like we've seen in the region, are very high in India as well. Almost all of these stocks are up more than 100% over the past 12 months. So we have to we are being conscious on valuation and thinking more bottoms up than just then from a top-down data center theme perspective. I think they are well discovered. What we're seeing, though, is consistent build-up in order books. The focus, though, is going to remain on execution. And as we've seen in the recent past, the two key issues, which is commodity prices and supply chain bottlenecks. These are the two things mainly to solve for, and the companies that are being able to work around these better are likely to be the longer-term winners in this space. Since the Iran conflict broke out, we have had to rebalance the portfolio to some extent, while some of our calls have been very medium term in nature. So for instance, we have been underweight IT services for the last 2 years. We have been underweight on consumer staples for the last 2 years, mainly on valuation and low growth. We have taken some tactical measures to rebalance the portfolio post the conflict. So for instance, we are or rather underweight certain names, like for instance, in the airline space, we have reduced our holdings considerably.
Well, that's the tactical call coming in from MG Investments, going long on upstream stocks, reduce their investments in airline companies. Mayuresh Joshi is now joining in on the show for the last leg. Mayuresh, stock of the afternoon is clearly Cummins India, very strong numbers. Revenues up 23%. There is margin expansion versus fears of contraction. Delivered a 25% bottom line growth. What's your view?
No, I think solid set of numbers by Cummins India. And I think the entire pack, if you probably look at that, I think Siemens as well, to a large extent, Thermax. I think the entire pack has probably done well. And I think the entire rationale, I think the logic behind that is the expectation in terms of the product mix that all these companies have in the right place. Second, I think in expectations of both the data center demand growth expected to come through. I think there is huge opportunities coming in from new streams of businesses as we speak. And third, I think in terms of the expectations of free cash flows and the ROEs that might get reported, I think that can be significantly higher. So I think valuations on one side and momentum on the other. I think a lot of tailwinds still to play out for these stocks and the entire sector as well.
More stock means you'd be a buyer here? Or I mean, tailwinds are there, sure, but would you pay the price here?
No. So I think it's a little bit expensive. And again, I think as we break out a stock in 4 stages, I think this stock has probably reached stage 4 and beyond that, which means from a positioning perspective, I think it is fairly valued above mean and average standard deviations from a valuation perspective. And even from a earnings perspective in terms of what is probably getting gestated in. So there might be steam. So what I'm trying to say, Prashant, is there might be steam in all these stocks, but whether to have fresh buys, not at this juncture.
Okay, all right. Hi, Mayuresh. Good afternoon. Good to see you in Coal India. Just take a look at the stock. You know, those that were short, they'll be running for cover right now. You know, if they've not covered their short positions, because the stock from doing a low, I think around 425, 428, it's seen a big jump up. It's now in the green. In fact, it's up 1%. What's your view on the stock? Valuations have always been supportive. The problem is when they make statements like power demand is going up, our input costs are going up, but we want to serve power. We may not increase prices. Investors get spooked on that. Otherwise, the setup is good, right? Coal prices internationally have moved up. E-auction prices in India have been depressed, which gives you reason to believe that prices will move up. How would you approach the stock at 460?
Nigel, I think so. As a theme, I think we do like all the miners probably in India, whether you're talking about Coal India or NMDC to a large extent. And yes, I think there have always been these challenges in terms of the arbitrage. Prices have always been lowered in terms of import parity compared to where global prices are. And therefore, I think pricing obviously needs to be far more consistent for not just Coal India, for the other miner NMDC as well. They just recently increased their lumps and fines prices as well. But it has to be far more consistent in terms of how the globe is positioned. And the second aspect for both these players is obviously execution. What is expected to probably happen in terms of evacuation is extremely important in the case of Coal India. How much of inventory is probably held in their pit heads, as well as the power plants. And again, I think a large part of the expectation in terms of expansion of both thermal and renewable as it goes. Thermal will have a decent share of expansion over the next 2 years as well, which means the e-auction part of the business is also almost 20% in terms of the EBIT contribution as well. I think that will provide more consistent growth going forward. Valuations have always been supportive. It's a good dividend yield paying stock, more than 5.5%. I think these two challenges, if they're able to overcome that more consistently in reported numbers, I think a re-rating is something which is bound for these stocks. Now, how and when that will happen in terms of consistency is what time will tell. But at this juncture, it probably looks like it's a good structural story to probably hold on.
Okay, all right. You know, and I'll tell you what, the stock has moved up as well, Mayuresh. And this evening, we'll be tracking the non-retail bid cutoff price, because that becomes the reference point for retail on Friday. So that's going to be rather important as well. We'll keep an eye on that one. By the way, a couple of stocks in the broader markets have spiked up. Ola is up closer on 4% on large volumes. Suzlon is another stock that spiked up. Remember, both these two have seen a sharp correction from the top, but there appears to be a bit of a spike up. Even Suzlon, actually, the management joined us a couple of days ago, and they were saying that execution will be around 3 gigawatt approximately. You know, 30% of what the industry will do. Stock is now up close on 6%. Not sure if there's news flow, but that one spiked up. Mayuresh, stay with us for the time being. Take that break, come back. We'll come back, we'll discuss a few stocks, and we'll wind down the markets.
Welcome back. Absolutely flat on the Nifty. It's 23,900 on the Nifty. Sensex down 70 odd points. Midcaps outperform, though the advanced decline ratio split right down the middle. The Nifty Bank is slightly under pressure. Mayuresh, Z Entertainment stock is reacting to the possibility that they may win the bid for FIFA. At least they're in talks, official talks. So the street is excited. How meaningful can it be? And if it does come through, at the bid they're talking about $35 million, how much upside could there be potentially for Z Entertainment?
Not really sure, Rima, on this one, because I think there is a lot of spate of news action that probably comes through. But how much is that as a sustainability factor is something to be watched out for. So largely, I think the stock is not in our coverage list as we speak. But I think there are too many ifs and buts related to the stock itself.
All right, Mayuresh, what about Welspun Corp? Drill, baby, drill was the theme earlier. When Mr. Trump started talking about, higher amount of focus on oil and gas, and they have 20-25% of the pipe market share in the United States. And even with regard to tariffs, they were a beneficiary because they had their unit in USA. I recall discussing the stock with you, 750 rupees, 850 rupees. Today, it made a fresh high. I think it's around 1,300 rupees, if I saw it correctly. Time up? Or do you think it has more to go? Do you think this is a structural story that's gradually playing out because of the exposure to the United States, the Middle East, and the India vertical as well?
You're bang on, Nigel. I think the tailwinds probably exist for the stock as a whole. And therefore, I think once the resolution happens in terms of the West Asian crisis, I think the pipeline development can be pretty, the orders for the pipeline development in the entire region can be pretty large and they will be time-bound. And therefore, I think Welspun might benefit incrementally as we speak. You're absolutely right about the US operations. I think the US operations are full to the hilt as far as FY27 exit is concerned. And therefore, I think as more orders come their way, both these regions with decent stability of margin performance can probably prop up earnings to a large extent. And the Indian business obviously hits it well. In my opinion, again, I think the management, when they put out their guidance in their presentation of a 20% top line and EBITDA growth, are being a little bit too conservative, in my opinion. And therefore, I think last year was challenging in bits and pieces. But this year, again, I think if you probably leave out the first quarter itself, I think the second half can see significant amount of growth. And in my personal opinion, I think 20% can very well get exceeded. Similar to what Cummins and Siemens are performing, I think there are tailwinds, but do you go out and buy it right now in the stock? I don't think so. But with a clear bias, I think we continue holding the stocks in our portfolios.
Okay, that's a call on Cummins. By any chance, do you look at Carraro India? Stock started strong, reacting to numbers, and now has slipped nearly 10%. When we chatted with the management, they did indicate that FY27 is not going to be as strong as FY26, which had a top-line growth of 25%. And there are some concerns on the export front. But any view here? Sharp decline.
I think it belongs to a very strong global parent, Rima. Then the Italian parent is doing extremely well on the global front. As far as their core business is concerned, I think the construction equipment part of the business, and specifically the export part, held up very well for FY26. What really transpired is the GST cuts. And therefore, I think the 4WD axle system that Carraro probably has large leadership in, the pricing has now become far reasonable and at par with the 2WD gear system, which was pre-GST. And therefore, pricing in terms of better technology and in terms of better usage of the product probably will ensure that the pricing mix and the product mix remains in the right place. However, I think in terms of headwinds, what probably entails in terms of the monsoon distribution is going to be extremely critical in terms of tractors and tractor sales per se. And that will have a significant count in terms of their core tractor business product mix. The construction business will keep on doing well, and the export piece might come back very, very strongly in the second half. So completely agree. I think FY26, I think the numbers might not come through. And therefore, I think the kind of reaction is
complete OFS, from what I remember. The parent basically sold diluted, and so that was the Carraro listing, recent listing. The other one is Acres. We had the management with us earlier. I think the stock limit down 10% actually, but it's done well, very well recently. From 100 levels went up to about 200 or so. Past 200, and I think closes at about 190 today. Well, so that's the market for you. The Nifty ending how it started with nothing on it, 6-7 point change. Bank Nifty ending down about 0.5% or so. Mid-cap index down about 0.5. Small-cap index also ending, I think flattish to slightly higher, 0.19. So broader market is doing better. Energy, metal, and autos are the three spaces which saw gains, if you want to pick this out sectorally. And as far as large caps are concerned, Tata Motors Passenger Vehicle, Hindalco, Power Grid, Eternal, Indigo, and NTPC are some of the top gainers as far as the Nifty are concerned. ONGC lost, ITC was ex-dividend, and HDFC Bank was the other loser as well. In the broader space, it's the power names: Hitachi, Cummins, CG Power, GE, Siemens, JSW Energy, ABB, Apar Industries. Long list of exactly that theme, the power theme, which participated on the upside. That's it from all of us here on the Closing Bell team. Thanks for staying with us. Markets forward. We'll pick up on the action in just a bit.
Markets end mixed in today's trade with benchmark indices closing marginally lower. Broader markets outperformed. The Sensex slipped 142 points to 75,867 and the Nifty ended at 23,907 even as midcap stocks extended gains.
Aluminium prices hit a 4-year high as China enforces production caps to control emissions and LME inventory shrink amidst the West Asia supply disruptions. The stocks of Hindalco and Narco along with other metal names perk up.
Coal India comes under pressure after the government announced an offer for sale to offload up to 2% stake at a floor price of 412 rupees per share. The move could help the government mop up over 5,000 crore rupees amid mounting pressures from the West Asia crisis.
You're with us here on Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. In today's context, that's Friday. I'm Hormuz Fatakia. With me is Sonal Bhutra. Well, we're heading into a holiday tomorrow, Sonal. So, yeah, that's the bigger takeaway. But of course, with the typical expiry session, the market's going absolutely nowhere. So the bulls will at least be happy for the fact that even if we didn't go higher, we didn't go lower either.
We did not, but it was a very volatile session, you have to say. Midcaps for the most part of the day, they were outperforming, but the advance decline ratio, if you look at those lines, they were converging. They almost converged by the end of the trading session. Overall, a very, very flat market for you. 6 points lower on the Nifty. We stayed above the 23,900 mark that happened yesterday as well. We did see some recovery towards the last hour of trade. Midcaps outperformed 0.4% higher on that one. Bank Nifty was a laggard today, so 0.4% lower on that one. That continues to be the case. So a whole host of stocks which were in focus on the back of news updates. And of course, we are towards the fag end of the earnings season as well. So we'll get you updated on all of that. But let's tell you what we have in our lineup and what do we have in store for you today. We start with the top movers and shakers of the day. Hindalco, Coal India and Z Entertainment, these stocks were in focus today. So we'll decode what's driving the action in these stocks. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. Let's get started then and take a look at the top movers and shakers of the day. Hormuz is here at the big wall with that list.
Well, as we mentioned, right, it was a very choppy day, the index going nowhere, but stock-specific activity was aplenty, and particularly so in the metal names. They did well yesterday, they continue to do well in today's session as well, and it is a record high for the metals index. Hindalco himself is at a 52-week high. Nalco, Vedanta, Tata Steel, all of them doing very well for themselves, gains of anywhere between 2% to 4% in today's session. You look at the earnings reactions, a lot of them came in just before market close, and Cummins India was the standout in these results. 11% higher on the stock after the results, beating estimates, and of course higher on a year-on-year basis as well. Gillette's numbers were good, 5% higher on the stock. TVS Sri Chakra went up almost 17% after the results announcement, ended with gains of 12%, and ONGC was possibly the disappointment of the day among the Nifty 50 names, 4.5% lower on the stock. You look at Coal India among the newsmakers, the stock at the start of trade was down 7%, recovered all of those losses and ended with gains of 1%, and a very strong response to its non-retail portion of the offer for sale. Carraro India, a complete reverse. The stock started higher 10%, reversed all of those gains, and then ended with losses of around 9%. We'll tell you more during the course of the day. Z Entertainment, of course, ending 10% higher with that FIFA conversation, and Zen Technologies too, after a new product launch, doing well for itself. There were more order wins in today's session. HFCL continues to move higher after in 2026. Kernex Micro won an order, spiked 5%, gave up most of those gains by close, and Jupiter Wagons too announced an order win. And lastly, stocks at 52-week highs. Adani Total Gas, 5th straight day of gains for the stock now, almost 50% in these 5 sessions. Phenolex Cables, AIA Engineering, and Honasa Consumer too doing well for themselves, all of them at 52-week highs, Sonal.
Okay, all right. Neat list of all the stocks which were on our radar today, buzzing on the back of earnings and news updates. Let's get stock specific now. Shares of Hindalco surged after aluminium prices hit a 4-year high. Morgan Stanley initiated coverage with an overweight call, also supported the stock. Nigel is joining us now. Nigel, tell us what's happening here.
Well, that's right. Aluminium stocks, they are in focus today as the LME prices have hit the highest levels we have seen in the past 4 years. Let's run you through the key reasons that is driving these aluminium stocks higher. First, the fears around Guinea. Ministers in Guinea, well, they have indicated a desire to curb the bauxite exports to support prices. Remember, Guinea is the largest bauxite producer with an output of around 183 million tons in 2025, and exports is a large proportion of this production. Remember, most of the exports go to China. So if China doesn't get its desired quantity of bauxite, then it could possibly disrupt the aluminium production. What's the concern, though, of Guinea authorities? Well, the problem is that bauxite prices have nearly halved in the past year. From around $120 per ton, it's come down to around $60 on a per ton basis. For Indian companies, Hindalco as well as Nalco, well, they're largely backward integrated on the bauxite aspect, while Vedanta, they're partially integrated with regard to bauxite. The second factor is the concerns over output cuts in China have suddenly come back on the table. China's daily aluminium output recently touched the highest levels we have seen in the past month itself. But with the country's annual production, it's already capped at around 45 million tons. The utilization levels are in excess of around 97-98% or thereabouts. So that raises fear of a possible supply side restriction, in addition to the production cuts that we've already seen in Middle East, which has got impacted. Remember, GCC nations plus Iran put it together, they account for around 7 million tons odd. That's roughly 9 to 10% of the global aluminium output. So continuing disruptions in the region are also adding to supply concerns. Finally, there are structural demand drivers when you talk about AI, data centers, electrification, as well as global energy transition. Well, that's what could support aluminium demand. In turn, it's supporting aluminium prices. And there is this fear, if bauxite supplies out of Guinea, well, they are restricted, then that will put aluminium production in a further crunch. So put all this together, aluminium LME prices are up and stocks participating as well. Nalco and Hindalco in focus.
Nigel, thank you for that update there. Good going for all of these metal names. To take this conversation forward, we are now being joined by Mayuresh Joshi from Markets Meet India and Shrikant Chauhan from Kotak Securities. Gentlemen, good afternoon. Thank you for joining in. Well, Shrikant, I'm assuming the setup on the Nifty does not change much considering today's price action. But what are the important levels that you're watching out for on the index now?
Yeah. Afternoon, Harmaz. Afternoon, everyone. So while looking at the setup of the market, yes, it is like the market has managed to sustain above the mark of 23,800, which is positive because below that the market has spent a lot of time, nearly 7-8 days. And after crossing these levels, now the market is sustaining above the same, which is positive. So based on that, I am expecting market to remain within the broader range of 24,500, best case on the higher side, and 23,800 or 700 on the downside. So it should not break the level of 23,700 on a closing basis. Till then, we can expect upward activity or maybe stock-specific activity in this market. The Bank Nifty has also managed to survive between this 55,000, 54,500 sort of levels. So from here again, the Bank Nifty can move towards the levels of maybe 55,500 or 56,000 in the best case scenario. Because unless and until we get support from Bank Nifty, I don't think that the market can manage to surpass or maybe to reach the levels of 24,500. So in both the indices today, we saw some fear because of holiday of tomorrow. But otherwise, I am of the view that the market can again rebound to the next level of 24,000.
Next level of 24,000. The 23,900 mark continues to be a support so far. Let's see which way things go. Mayuresh, we'll come to you in just a bit. We have to discuss a stock first. Shares of Cummins India rallied over 10% after it reported an all-round beat in the fourth quarter. They have announced a dividend as well, which is the highest ever. Vinny is joining us with the report card now. Vinny?
Hi, absolutely. When you look at the numbers for Cummins India, Q4 FY26, a strong beat that's come in all round for the company. Revenue, profits, margin of the company, everything was above expectation, above cnbc TV 18's poll. Now, just in terms of revenue breakdown, 22.6% uptick, 3,000 crores approximately what the revenue stands at. Margins came in at 21.3% as well. We were expecting a contraction in terms of margins. So that came in as a positive surprise, right? An expansion in terms of margins. Slight bit of an expansion versus last year, but nonetheless an expansion. Apart from that, profits of the company, that's also seen a growth of 25%. Now, the press release came in. We have 2 points that come in the press release. The domestic sales. So domestic sales for Q4 FY26, that's seen a growth of 30%. So domestic demand, that seems to be steady, that seems to be resilient as well, while exports. Q3 also the management highlighted that exports was a bit muted and seems like that's the story playing out in Q4 as well because export sales for Q4, that was lower by 6%. It came in at 450 crores. For the full year, FY26, domestic sales and export sales both have seen a growth. Domestic sales are up 19%, export sales are up 12%. The management has given a commentary as well, future outlook. They say that they're closely watching obviously the rising crude oil prices, commodity prices and the geopolitical tensions, how that shapes up. They're closely watching that. The export environment that also could face some near-term pressure again is what something they've highlighted. So that will be key to understand where are we going to face that problem from, as well as domestic demand. They said remains steady. That we've seen in terms of the domestic sales numbers as well. But all in all, good set of numbers that have come in from the company and nothing to complain on that front. That's why the stock was passing in trade.
11.5% higher on Cummins India. Vinny, thank you for summarizing that for us. Mayuresh, well, not just Cummins, but this entire capital goods space, a lot of these stocks have already gone up 50, 60, 70%, and Hitachi Energy is up even 100%. Not so much for Cummins. The stock hadn't done much before today's move. Where within this space does your preference lie? Do you prefer these private players, the MNCs, or do you prefer a PSU name like BHEL?
Afternoon, Hormaz. So I think the preference is towards the private guys. And obviously, I think as Vinny was explaining, the expectation in terms of incremental demand expected to be significantly higher, at least on the domestic front, is propping up earnings for all these players. I think the entire space itself, whether it's Cummins India, Siemens India, ABB, Thermax, GE Vernova, as you say, I think extremely strong incremental domestic demand and further levers in terms of data center growth expected to prop up demand even more over the next few quarters. Having said that, I think the expectation in terms of order wins and the margins at which these orders are coming and the execution thereof and how the placement of these stocks are, I think a large part of the universe is stage 4 and above, which we feel is a little risky as per our own metrics in Marketsmith India. And our own belief is that this might be signaling that they're penciling in the best to come in the next 1 to 2 years. So there might be tailwinds, which I completely agree upon, and there might be further momentum on all these stocks or a combination of these stocks put together. But whether you go out there and have a fresh buy at this juncture, I probably don't think so.
Okay, all right. So that's your take on Cummins, the entire cap goods space. Let's go to the next stock now, Coal India. That was under pressure, but it recovered sharply from the lows of the day, ended 1% higher. The government announced an offer for sale to offload up to 2% equity in the company. The floor price is set with 412 rupees per share. Nigel is back with us with all the details. Nigel.
Well, that's right. Coal India is the stock in focus, and it's a little bit lower, but just take a look at the big recovery we have seen from the lows of the day, because the interest seems to be quite high in this particular OFS. To give you the brief details, the government is looking to sell close to around 1% stake in Coal India by the OFS route. They have an option to sell another percent. So if they sell this 1% at the floor price that they spoke about of around 412 rupees odd, then they'll garner close to around 2,500 crores. Obviously, if they go the entire hog and they sell the additional 1%, then in total they'll raise close to around 5,000 crores approximately. The government of India, remember, they hold close to around 63% stake in Coal India. So this is, a step in the right direction for them. They get some money off the table, and the timing is very, very good. To give you another detail in terms of subscription, it opens for non-retail audience today, and in the coming days, that is on Friday, that's when the retail audience gets a chance to participate as well. The timing is very, very good for the government's perspective. Let me give you some few reasons. One is the Middle East crisis has, broken out. Coal prices internationally are up by around 18 to 20%. Now, that's good news for Coal India's e-auction volumes. Why do I say that? Because the pricing has been a little bit subdued. If international prices are moving up, the e-auction prices can catch up, and that's key to its profitability as well. So that's point number 2. Point number 3 is production numbers in the last few years have been absolutely dismal. They did very well between 2021 and 2024. However, in 2025, the growth was only 2% and last year was a degrowth. So now the street is optimistic that we'll see growth coming back, maybe mid-single digits is what we're looking at. And then finally, Coal India has been a dividend machine. Even last year, they declared close to around 26 rupees and 50 paise. And in terms of valuations, it trades at around 8 to 9 times PE with good dividend yield and an EV upon EBITDA basis around 5 times out. Put everything together, opportune time from the government of India. It appears it's giving a fairly decent entry for investors as well. And this issue in all probability should get lapped up. Back to you.
A sharp recovery for Coal India indeed. Nigel, thank you for summarizing that for us. We'll get a quick chart check from Shrikant. But before that, the race for the FIFA World Cup broadcast rights has heated up, with Zee Entertainment now entering talks to stream the 2026 tournament in India. Devyani is now joining in with more details on this. Devyani.
Zee Entertainment has officially entered talks with FIFA to stream and broadcast the 2026 FIFA World Cup in India. Now, as per Reuters, Zee's entry comes amidst little headway in FIFA and Reliance Disney negotiations. FIFA wanted $100 million for the 2026 and 2030 rights, but has revised this ask to the $60 million mark. Reliance Disney may have offered the a $20 million bid for it though. Now the FIFA opportunity, that's what's huge. FIFA World Cup is one of the most watched sporting events in the world, with the worldwide viewership seen at roughly around the 5 billion mark in 2022. For the 2022 World Cup though, India was amongst the top 10 markets worldwide. The total engagement of nearly 745 million and digital and linear TV viewership of 85 million each was clocked during that time by Indian viewers. Reports say that the past two FIFA World Cups may have drawn 200 to 300 crores in ad revenues for Indian companies. But why is this particular event different? In 2026, the matches are going to be played in the US versus in Qatar, which means that for Indian viewers, they will be streamed late at night, which might impact the viewership and, as a result, ad revenues for companies. That said, a good opportunity, and the sentiment boost is what Z got in trade today.
All right, Z Entertainment higher in trade today. Shrikant, let me come to you for these two stocks. One is, of course, Coal India, which saw recovery, and the other one is Z Entertainment. Technically, what do you make of these?
See, both these stocks did exceptionally well today. It was like completely unexpected that the stock can rebound back to the levels of 460 despite opening at 430. But one thing was very clear, that the response which was like expected was as per the expectations, and because of that, Coal India managed to surpass its previous closing of 460. If we consider the overall long-term pattern for the stock, then consistently since last 1.5 years, the stock is forming higher top, higher bottom series, which is positive. And based on that, I'm expecting stock is moving towards the levels of 500 at least in the near future. So certainly it's a hold at current levels. Even if there is a view of buying more, then one should definitely look for adding in or participate in the OFS. For Z Entertainment, after a very long time, the stock is forming some inverse head and shoulder sort of bullish formation on daily charts. Based on that, I'm expecting on immediate basis, the stock can move towards the levels of 100. And on the crossing of that, the stock can move towards 125 or maybe 130. So both these stocks having solid potential from current levels. It's a buy at current levels and more on dips.
Mayuresh, would you be brave and look for Z Entertainment? Because at one point a Nifty constituent, but then the multiple issues that plagued the company, it's been nothing but a value destroyer all this while.
No, you're absolutely right, Hormaz. And therefore, I think lots of ifs and buts, to put it very simply in Z's case, which makes it very, very difficult in terms of an analyst to probably assume and forecast what might come through, both in terms of the core business and the issues surrounding that. But coming to the point in terms of Z winning the FIFA World Rights, historically, I think what has been seen during global events like these and major sporting events like these is, and when it comes probably to nighttime in terms of Indian viewership, QSR, same sales store growth, goes exponentially higher. So I think that is one space to watch out.
Okay, all right. Thank you so much, Mayuresh and Shrikant, for joining us today and taking us through your thoughts on individual names and the outlook going forward. With that, it's time for a short break. We'll get to the top corporate voices along with the key market events to watch out for on the other side. Welcome back. Let's talk about the top corporate voices of the day. Pine Labs management said that the 145 crore rupee loss earlier was largely due to investment-led decisions and not reflective of underlying business performance. Speaking to the channel, they also highlighted strong operating cash flows of nearly 400 crore rupees and improving free cash flow generation.
Carraro India was one stock in today's session, opened higher, was up around 10%, then fell 10% as well. And that's because the management told us that the company does not expect growth in FY27 to be as high as the 25% it reported in FY26. They flagged geopolitical tensions as a key concern over the next 1 to 2 quarters and warned of near-term supply pressures as well. The stock ended losses of almost 8%, reversing all those 10% gains.
RateGain has guided for revenue of nearly 3,000 crore rupees in FY27. Speaking to CNBC TV 18, company's management said that its West Asia business has seen some impact, but they expect sharp recovery in travel traffic once the conflict eases.
And before we call time on the show, here are some key events to watch out for. Upasana is here with all of that. Upasana.
Well, first up, let us look at some of the important results that are scheduled for tomorrow. Companies like Ashok Leyland, Apar Industries, Bharat Dynamics, Deepak Fertilizers, Praj Industries, Schneider Electric, all these counters will be reporting their Q4 FY26 numbers tomorrow. Now, high-tech pipes will also be in focus as the board meeting is scheduled for tomorrow to consider fundraising, and also Wellspun Corp, there is an investor meet tomorrow scheduled. Now, on the flip side, let us look at some of the important global economic cues for tomorrow. US Q1 GDP, initial jobless claims and crude oil inventories data will be out. Next up is Europe in business and consumer confidence data will be out tomorrow, and even the ECB president's speech is scheduled. And lastly, coming to IEA, it is to publish its annual World Energy Investment Report. And lastly, Europe foreign minister to hold an informal meeting of foreign affair talks, which will go on till 28th of May, that is tomorrow. So all in all, these are the events scheduled for tomorrow.
Upasana, thank you for that update there. With that, we take a leave on this edition of Markets Forward from Sonal and me. Thank you for watching. We'll be back with more news and updates on the other side. Stay tuned.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty end flat after a range-bound session. Midcaps outperformed. The rupee remains above the 95 mark against the dollar. Iran condemns the latest US attacks as a definitive violation of the ceasefire, but Tehran does not pull out of the talks under joint mediation of Pakistan and Qatar. President Trump calls for a rare cabinet meeting at Camp David. Crude oil prices pull back from recent highs. US Trade Representative Jameson Greer expects to meet Commerce Minister Piyush Goyal to finalize the framework for a trade deal. Greer says a team of negotiators from the US will visit India next week. Air India cuts nearly 20% of domestic flights and 27% international flights, citing high fuel costs. Indigo also cuts frequency on domestic routes due to a drop in demand and disruptions on account of the war in West Asia. SpiceJet and Akasa also trim capacity. The Supreme Court upholds a 28% GST on online gaming, says the tax levy is constitutionally valid. The tax demand from companies could soar to over 2.3 lakh crore rupees. Relief for Amazon. The Supreme Court quashes a 200 crore rupee penalty imposed by the Competition Commission. The penalty was imposed for allegedly suppressing material information while seeking the approval for investing into Future Group in 2019. Baiju Ravindran sentenced to 6 months prison by a Singapore court in a contempt case linked to alleged non-compliance over asset disclosures. The court orders him to surrender and pay 90,000 Singapore dollars in legal costs. Ravindran claims no wrongdoing, adds he has not been actively contesting court proceedings as settlement talks with lenders are underway. Prime Minister Modi urges citizens to take precautions as the sweltering heat wave continues to singe large parts of India. The cabinet seeks a report from all ministries on actions taken to deal with the heat wave. The cabinet approves more than 25,500 crore rupees for the Sarthak public distribution scheme over the next 5 years. The scheme will cover assistance to states for the movement of food grains and modernization of the public distribution system. The Supreme Court upholds a controversial special intensive revision of electoral rolls by the Election Commission, says the exercise is intended to secure free and fair elections. Sam Altman and Dario Amodei back the pedal on previous statements warning of a jobs apocalypse due to AI. Altman says he was pretty wrong about the economic impact. Amodei hopes AI will be a multiplier of output and not a destroyer of jobs. Both OpenAI and Anthropic are planning to go public this year. While a range-bound day of trade saw the markets ending the day mixed, the Nifty and the Sensex closing marginally lower today, with the Nifty holding above the 23,900 mark. Banking stocks underperformed today. The Sensex down 140, the Nifty Bank down by about 240 points. The Midcap index closing in the green. So once again, we've seen the Midcap story picking up pace. But the big story that we continue to track: negotiations between US and Iran continue, and this despite US military strikes on Iranian targets. Here are the latest developments. Iran has said a renewed war with the US is unlikely because, and I quote, of the enemy's weakness, end of quote. But the country's Revolutionary Guard said Tehran stands ready to repel any attack. Iranian defense forces have released footage showing the interception of US's Reaper drone. Tehran also said it tracked an F-35 fighter jet which withdrew after missiles were fired. Iran also announced the end of a record 88-day internet shutdown overnight. The continuation of talks despite the US's attacks have helped oil prices soften. Meanwhile, Iran has claimed that 25 ships have transited through the Strait of Hormuz in the past 24 hours. In fact, a tanker carrying LNG from Abu Dhabi National Oil Company has exited the Strait of Hormuz. This comes a day after an LNG ship crossed the strait to reach India for the first time since the waterway's effective closure. President Trump said he and his cabinet convene at the White House. The meeting was supposed to take place at Camp David. In a post on social media, Trump said the trip was scrapped because of the possibility of bad weather conditions. A White House official told the New York Post the president and his top officials were poised to discuss both foreign and domestic issues. In Lebanon, Israeli airstrikes have killed 31 people, injured 40 others in the southern part of the country. UN officials say Israel is responsible for 91 airspace violations yesterday, the highest number since both countries agreed to post the ceasefire. Israel's Prime Minister Netanyahu has said that he has ordered Israeli defense forces to deepen the operation in Lebanon.
Under my direction and that of the Minister of Defense, together with the Chief of Staff, we are deepening our operation in Lebanon. The IDF is operating with large forces on the ground and is seizing controlled areas. We are fortifying the security zone to protect the northern communities.
It is imperative to avoid any escalation of a conflict that has already exacted a devastating toll on civilians and that risks making the search for peace even more distant, prolonging the suffering of people. The Secretary General added that this takes place as Israel has announced an escalation of its operations in Lebanon. We witness constant violations of the ceasefire in Gaza, and the result of negotiations between the United States and Iran to enter the conflict in the Gulf remains unpredictable.
Well, that's the latest there in the US-Iran conflict. We told you first it is now official. Shares of Coal India down 6% today, recovered midday. This after the government said it will sell 1% stake in the company via an offer for sale. This accounts for roughly 62 million shares. The centre will also provide an option to sell an additional 1% stake via the Green True option. The floor price is at a 10% discount from Coal India's closing price on Tuesday, so the stock closing lower today. Global aluminium prices continue to soar. They've now touched their highest levels in nearly 4 years. This is fears about production cuts in China added to supply concerns on the back of the ongoing tensions in West Asia. Remember, West Asia is an aluminum powerhouse and accounts for about 10% of global output. Bloomberg reports that China may tighten controls on energy-intensive industries to curb excess production. China has been running smelters at near full capacity to ease global supply shortages. Shares of Hindalco, Vedanta, National Aluminium Company, rose in trade today. Now, airlines are cutting their domestic and international flights amidst a drop in demand and rising jet fuel prices. Sources say that Air India plans to cut around 22% of its domestic flights, but Air India is not the only one. Madiha joins us now to take us through what's going on with Indian aviation. Madiha, airlines across the board cutting capacity, both international as well as domestic. Take us through what consumers should expect.
Right, so India anyway has just 5 major airlines, so passengers already don't have many choices, and now they are quietly pulling seats off their schedules, and this is across the country. Fewer flights are being operated. The West Asia crisis, remember, is the main reason behind this reduction. So starting with Air India, where the cuts are big. So domestic network cut by 15 to 20%, and on international routes, the reduction has been even sharper, 27% in their overall international network. In its official statement, Air India attributed these cuts to rising jet fuel prices that have made operations unviable for Air India. Coming to Indigo now, India's largest carrier by market share. It is reducing flight frequency on domestic routes, and sources inside Indigo cite 2 pressures simultaneously: a dip in demand during the current lean travel season and the overhang of the West Asia tension. So it is more of a demand side squeeze, not a cost story like Air India. Among smaller players, Akasa Air has also pulled back on its West Asia operations by 15%. This is what Vinay Dubey, the CEO of Akasa Air, has publicly mentioned. While they've kept their domestic network largely untouched, we are still to hear from them what their current domestic changes are. Regional tensions are the stated reason for Akasa Air's West Asia reduction as well. Now, coming to SpiceJet, which has been navigating financial turbulence for some time now, it is also reducing domestic flights by 8 to 10% is what we understand. They are hit by a combination of high operating costs and softening demand for SpiceJet. This is not a new challenge, but it adds to the pressure on a carrier still working to stabilize. On Air India Express, the low-cost arm of Air India Group, we are still awaiting their official details, but what we understand is their capacity cut on domestic routes is of 10%. The airline has shared its position with us, and we will update their stance shortly. Taken together, this is a sector-wide signal. Fuel costs are biting demand. Fuel costs are biting and demand is cooling, and airlines are responding by doing what airlines do. They are cutting capacity to protect their margins. And what does this mean for the traveling public, as you asked? It means fewer options, potentially higher fares on the routes, and that remain and the period of uncertainty ahead for Indian aviation.
Well, it is going to get tougher, not just for airlines, but for consumers as airlines cut back on capacity, as Madiha was pointing out. And we will have to wait to see how much of this is going to pass through in terms of prices. Now, U.S. Trade Representative Jameson Greer has said that a team from Washington is set to visit New Delhi next week. Speaking at a conference, Greer said that he hopes both India and the U.S. finalize their trade agreement soon. This comes after Commerce Secretary Rajesh Agarwal said that talks with U.S., Canada and the EU are moving ahead, and that the government hopes the agreement with the U.S. is reached soon.
We've had many meaningful discussions. We have a framework agreement done with the Indians. I have a team going there next week. I expect to meet with my counterpart soon as well. I would really like to be in a position to finalize our agreement with them as well on the basis of the joint framework we agreed to. It would be historic for the U.S. and India. I mean, just think, with the U.S. and the EU, we tried to have a trade agreement with them, didn't work out. EU and India, we've tried several times, didn't work out. So we're trying to do things that have never been done. They're not going to be comprehensive trade agreements because, as we have found, that takes years and can never find full traction.
Well, that is the U.S. Trade Representative Jameson Greer saying that a U.S. trade team will visit India next week, and he hopes to meet with his counterpart, that's Commerce Minister Piyush Goyal, to finalize the India-U.S. trade agreement. Now, the Supreme Court has set aside a 200 crore rupee penalty imposed on Amazon in the Future Coupons deal case. The competition watchdog, the CCI, had imposed the penalty for allegedly suppressing information while seeking approval to invest in the Future Group. The court maintained that any amount deposited or recovered from Amazon should be refunded within 8 weeks. In another legal setback, this time for Bajaj Ravindran coming in from a Singapore court, it has sentenced him to 6 months in jail for contempt of court over alleged non-compliance with disclosure orders. Ritu joins us now to take us through the ruling. Ritu, a 6-month sentence there for Bajaj Ravindran. What does the Singapore court have to say?
Bajaj Ravindran has been sentenced to 6 months in prison by a Singapore court in a contempt case where the court found that he had failed to comply with multiple orders linked to the disclosure of his assets. Now, as part of the ruling, he has been asked to surrender before the authorities, pay legal costs of 90,000 Singapore dollars, and also submit ownership documents linked to BR Investco, which is a corporate entity that held shares in a related company. The case is being pursued by Qatar Investment Authority, or QIA, in the Singapore court, and it is linked to a $150 million loan that Baiju's Singapore arm had taken from them. Now, the ruling adds to the mounting pressure on Bajaj Ravindran, who is already facing legal battles across multiple jurisdictions. In the United States, for instance, lenders are trying to recover losses tied to a $1.2 billion loan. Now, Bajaj Ravindran has also hit back strongly. In a statement today, he said lenders and stakeholders are already in settlement discussions with the founders, and that a settlement has been agreed to in principle with just a few minor issues that are still unresolved. He called the case an unnecessary pressure tactic by QIA and claimed there was no wrongdoing by the founders, accusing the proceedings of creating a misleading impression at a sensitive stage of negotiations. He also added that neither him nor any of the founders have personally received any portion of the disputed funds, and that the funds were only used for legitimate business purposes.
Ritu, many thanks. The Cabinet has approved the Sarthak public distribution scheme to strengthen the public distribution system. The scheme will have an outlay of 25,500 crore rupees over 5 years. The program is intended to assist state agencies in interstate transportation of food, grains, and introduce technology-driven reforms. So that's a decision being cleared by the Cabinet this afternoon. Prime Minister Modi urging citizens to take precautions as the sweltering heat wave continues to singe large parts of India. In a post on social media, the Prime Minister urged people to stay hydrated and help others cope with the extreme weather conditions, advising citizens to carry water while stepping outdoors and extend help to others whenever possible. The Cabinet has sought a report from all ministries on actions taken to deal with the current heat wave. And staying with weather updates, the Met Department has delayed the expected onset of the southwest monsoon over Kerala from the 26th of May to now between the 28th of May and the 3rd of June. The Weather Department has also predicted that the monsoon is expected to reach Mumbai between the 5th and the 10th of June, while Delhi is likely to receive rainfall around the 27th of June. We'll head into a break, but up next, the Supreme Court upholds a 28% GST on online gaming, says the tax levy is constitutionally valid. That and more when we return. The Supreme Court has upheld the 1 lakh crore rupee GST show cause notices to online gaming companies. That is the top story. The top court has also ruled that tax on actionable claims arising out of online gaming are constitutionally valid. Ashmit joins us now with the details. Ashmit, this brings to closure a long pending matter, massive amounts involved here, big win for the Revenue Department. Take us through what the Supreme Court has said.
Significant decision, a decision that could impact possibly, potentially one of the largest tax disputes ever in the country. We understand that the apex court, the Supreme Court, has upheld the GST show cause notices that was issued against as many as 71 gaming companies. Now, just the numbers, those show cause notices add up to about 1.12 lakh crore rupees. Legal experts say that accounting for the penalty and the interest component, that figure could soar to even higher than 2.3 lakh crore rupees. So again, potentially one of the largest ever tax cases here in the country. The Supreme Court saying that the show cause notices are valid. The authorities can proceed under those show cause notices. The companies are free to respond to those show cause notices, to respond with their concerns, but that the GST authorities shall proceed as under law with processing these GST notices. Now, bear in mind, the whole issue came to light with the August 2023 amendment that was brought to the GST framework. This amendment, essentially what it did is that it provided for a 28% levy. The question then arose is that will this 28% levy apply prospectively, or can it also apply for the period before the amendment, pre-August 2023? And that is the question that seems to have been decided by the apex court. For now, the court saying the show cause notices that were issued even for the pre-amendment period, they are valid, they can go ahead, the authorities can press forward with that. But just a caveat here for the benefit of our viewers, this is a show cause notice. This should not be read as a final decision on the total demand that is to be paid by gaming companies. This is a show cause. GST authorities asking companies to show cause why that tax should not be levied. So now, of course, that stage will begin. The Supreme Court allowing for these companies to now go ahead and to respond to these GST notices that they're looking at.
Well, many thanks, Ashmit. Of course, recovery is a whole different matter. Many of these companies are shut. Many have pivoted. Their cumulative revenues will also not amount to the kind of demands the tax department has raised. But that is another matter altogether. HDFC Bank has refuted allegations that it flouted banking regulations by camouflaging higher interest rates offered to Maharashtra State Road Development Corporation on deposits as marketing expenses. But cnbc TV 18 learns that HDFC Bank is not the only bank to follow such a practice. Remember, HDFC Bank's shares had come under pressure through Wednesday following an Indian Express report that highlighted differential interest rates offered to the state-run entity. Furkan joins us now with more. Furkan, what is the bank's stance and where could this lead us? Is the RBI looking into the matter?
So in a nutshell, the bank has rejected allegations that there was any wrongdoing on its part or that there are any irregularities in its internal audit and governance processes. But CNBC TV 18 learns that this practice of offering certain entities an interest rate that is higher than one offered to the general public is an industry-wide practice. Industry sources also tell us that in many instances, this differential rate of interest is couched under other accounting heads so that it does not set a precedent and the bank is not pressured to offer other customers a higher rate. But let me quickly take you through what has happened. The allegations are that HDFC Bank offered the Maharashtra State Road Development Corporation or the MSRDC an interest on deposits at an effective rate of over 6%, when the prevailing rate it offered to others on the similar deposits was 3.5%, so a difference of over 250 basis points. The report also suggested that the differential interest amount was not paid as an interest but couched as a marketing expense. Now, we learned that in practice, this money, which is classified as marketing expense, also includes the distributor's commission. But this does not mean that RBI may not scrutinize the bank's practice because the 250 basis points difference is quite large and works out to a substantial amount given MSRDC's deposit. It's also being said that the bank's internal governance and audit committees had already taken note of this practice. Sources say that audit committee of the board under the chairmanship of former Infosys CFO MD Ranganath had ordered a formal internal vigilance investigation into this practice, and a probe had begun on 2nd of April this year. The probe was completed by the Vigilance Department under Prasoon Singh on 17th of April. The investigation report has been sent to the nomination and the remuneration committee of the bank. And my sources tell me that the investigation has flagged instances of hyper-competitiveness by the bank. This could lead to some penal action. However, the bank has responded to our queries on the matter, saying that, and I quote, the bank has a robust internal oversight, audit and control processes and systems. All issues are dealt with in accordance to bank's established norms, and full process is always followed before final determination post any internal review. We strongly reject the assumptions of wrongdoing or culpability based on selective material, unquote. We are still awaiting responses from the Reserve Bank of India on this development. Back to you.
Furkan, many thanks for joining us. Ethical hacker Nisarg Adhikari has disputed the CBSE's clarification that no production data had been compromised in its on-screen marking system. He asserts that he accessed non-test user data and had visual proof, including screen recordings, to back his allegations. Archana joins us now to help us understand what the on-screen marking portal is all about and why it has caused such a fracas. Archana.
Well, Shireen, India's education system is in the headlines yet again for all the wrong reasons. After NEET, CBSE is facing one of its biggest result controversies in recent years. Remember, this is the largest education system or board of high school board in India. So what exactly is happening? Well, it all started after this year's Class 12 board results were declared. Now, across subjects, many students said that their marks were shockingly lower than what they had expected, even compared to their own school assessments and pre-board results. Then some students began questioning the CBSE's brand new digital evaluation system called on-screen marking, or OSM. Now, what is OSM? Let's go back in February this year. So on February 9th, CBSE notified that it was moving the evaluation of Class 12 board exam answer scripts to the digital system called OSM. Now, under this system, physical answer sheets are scanned at designated centers and uploaded to a portal where examiners log in and mark them on screen. But after that, what happened? Two students, Vedant and Sanjana, and then many others like them, claimed that the scanned answer sheets shown to them during the revaluation process did not even match their handwriting. In simple words, they alleged that they may have received someone else's answer sheets. It did not end there. According to a Hindustan Times report, CBSE may have ignored suggestions from its own governing body members to first conduct wider pilot projects before rolling this out across the country. The report says several teachers involved in this testing process had advised CBSE not to proceed so quickly. Now, citing the need for better training and more preparation. Meanwhile, this is another important development. According to the Internet Freedom Foundation Executive Director Apar Gupta, a teenage cybersecurity researcher that you also mentioned, Nisarg Adhikari, he claimed to have found serious vulnerabilities in this portal months ago. He flagged them, but no action was taken. Now the IFF has written to the Ministry of Education demanding a time-bound probe and review the contract with the vendor. However, CBSE has rejected that any breach like this has not happened. Now, the controversy has also taken political colors. Now, Leader of Opposition Rahul Gandhi has questioned why the company which is handling this OSM system, which is COEMPT, was awarded the contract when it had similar experience or similar, obstacles in Telangana. It was previously named Globe Arena, and it was linked to similar controversies in Telangana in 2019. Now, he has also demanded a judicial inquiry into this. Back to them.
All right, Archana, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV. And stay tuned. We're back in a minute with more. Welcome to the Editor's Playbook. Today we discuss something that is hot topic from the White House to the Vatican. Well, it has to be artificial intelligence, but we dive into the India stack and the fuel powering the world's AI engines. Now, foreign portfolio investors have pulled out over $24 billion from the Indian equity markets since the start of 2026. A major driver behind this exodus has been the global reallocation of capital towards artificial intelligence and tech-linked assets. But this, again, is something where the debate is split wide open. But consider this, Taiwan's equity market, where Taiwan Semiconductor Manufacturing Company accounts for more than 40% of the benchmark index, has now become the world's fifth largest stock market, powered largely by the global AI boom. Taiwan's weight within the MSCI Emerging Markets Index has also surged sharply over the past several years. Meanwhile, AI-driven demand has turbocharged memory chip makers like Micron Technology, as memory increasingly becomes one of the most critical components of the AI revolution. In fact, NVIDIA, SK Hynix and Samsung Electronics, three companies at the heart of the AI boom, have each added between $690 billion to $750 billion in market cap just this year alone, as investors aggressively chase AI-linked growth. So which brings us to the key questions. How many trillion-dollar companies do we have in India? To be sure, the Indian government has placed significant bets on semiconductors and data centers, but have we truly unleashed the genie yet? And perhaps more importantly, can an AI deficit eventually become an economic problem? Joining us on the show today, Prashant, Rima, Sriram and Hormuz. Rima and gentlemen, thanks very much for joining us on the Editor's Playbook. Prashant, let's get straight to it. Do the Indian stock markets have an AI problem or not? Where is India placed on the global AI table?
I think we do for now, Shireen. Great to be back on the playbook. And yes, I mean, I think it's very clear that we do have a problem, whether we like it or not. Let me just start with a data point, which I think helps focus the mind. As someone was saying, I guess exaggerating a bit to make a point, there are only three stocks in Asia which are attracting all the capital. There is Samsung, there is TSMC, there is SK Hynix. These three, the foreign holding in these three companies, Shireen, is 750. It's about $1 trillion. The three foreign ownership, foreign value of foreign holding in these three companies is $1 trillion. The total value of foreign ownership in India is $750 billion. So, that just tells you the size, scope, scale, etc. Now, to your specific question, does India have, listed AI plays, especially from a market standpoint? And what I've done really is looked at, the different layers of where, what AI is. Because when we talk about AI, largely, the conversation revolves around LLMs, etc., the large language models. But let's take it from the top, right? So first, of course, is the global AI capex. Who's doing 90% of the capex? It is three companies: Microsoft, Amazon, Google, and when the others like Oracle, etc. But these are the three which account for about 90% of all the capex. One layer down, of course, we don't have a play here, obviously. Second is the AI accelerator sort of layer, which is essentially the chips, the GPUs. The big ones, NVIDIA is the big daddy. There is Broadcom and a bunch of others. Again, we don't have a foot here. Memory comes one layer below. As you were just saying, there is Samsung, there is Hynix, and there is Micron, etc. You come to then you come to the advanced packaging, which is, what we call OSAT here. And, we are trying to build businesses here. Keynes, for example, is listed, and maybe you got one or two other, SEG Power, for example. But, the big ones are Semco, LG, Doosan, etc. These are the big ones, right? Then you come to one layer below, which is the network fabric. And here, again, LG, OE Solutions, etc., the big ones. Here in India, there are companies like Sterlite Tech, maybe an HFCL, which are trying to pivot away from telecom to data, providing network fiber for data centers. But again, very, very few. Then you come to the data center build-out itself, right? Which is, I missed one layer, which is, of course, the package chips have to be put together in an AI server. We have maybe a NetWeb, for example, but the big ones are Semco and some of the others. Data center build out, yeah, we have companies. We've got about 1 gigawatt of capacity. We have ambitions to go big, but again, it's a few here, few there. Then you come to the grid electrification and the power story, and maybe you have a few companies, again, not particularly, they're not Indian companies, at least those who have the technology. We talk about this HVDC technology, but that is Hitachi and GE Vernova, right? Nuclear is one level lower in the US, for example. People are talking about data centers having their own captive capacity. Maybe in India, because of the law has changed, we will get some action happening there. But the point is, if you look across the value chain and the hundreds of billions of dollars flows from right at the top, US, right? And those three companies which I spoke about, and it flows through across the system. And who's sending all the equipment needed? I mean, who is essentially getting all this money? Or the capex. It's not US companies. It is companies largely based in Asia, based in Korea, based in Taiwan, and I mean, whether we like it or not, perhaps based somewhat in China as well. Those are the guys who are sort of, recipients of these, whatever. I think the number for 2026 in terms of capex is some $750, $800 billion, just about 5 or 6 companies in the US.
No, just give us that FII number again, Prashant. The FII holding
the total
as far
stock,
as these AI companies are concerned?
Yeah, just 3 companies, Shireen, right? That is the three Asian companies, TSMC, SK Hynix, and Samsung. The total FII holding in these 3 companies is $1 trillion, 1 trillion. The total stock of FI money in India is about $750 billion.
Well, that tells you the story, but let me bring Hormuz into the conversation since we are talking about $1 trillion. $1 trillion companies being minted overnight, 2 of them being minted overnight, Hormuz, and that gives you a sense of the size and scale that we're also talking about.
Absolutely, it does. And, the market is working on a very simple principle, right? You give us the numbers, we'll reward you. And you give them a theme. Whenever you speak about something like this, the easiest example to give is the new age companies that listed in India all the way back somewhere around 21, 22. At that time, they were loss-making companies. Eternal is a case in point. That one point, the IPO price was around 75, 76 rupees, went up to 130, 140. Then when the numbers were not showing up, the street smashed it down to 40. When the numbers started to show up, it went all the way up to 360. Yeah. And that's the case with these companies as well. So it's not as if the street is blindly chasing a theme just because it's the hot topic right now. You take a look at the numbers for these companies over the last 3 quarters. Nvidia's revenue growth 2 quarters back was 122%. On that base, it delivered a 94% revenue growth in the quarter prior. And in the most latest quarter, it still delivered a 53% revenue growth on that base as well. So it's not as if you would have a company who would grow 20% one year and the next year they would say, oh, we have a high base, so we'll grow only 6 to 8%. They are delivering the numbers quarter after quarter. Same is the case with Micron. Same is the case with AMD. Numbers are coming in, and that is exactly the reason why the stocks are doing what they are. Micron's market cap at the start of the month was $750 billion. Yesterday, it went up to $1 trillion. And that's because UBS came out with a note and they said that the stock can triple from current levels. And they said that their target earlier was 535. They raised it to 1625, which is more than 100% even from where it closed yesterday. So that's the kind of, and at the end of the day, you put your money where the mouth is. So if those are the kind of stocks that are delivering you the returns, it is only obvious that the money will go there. There are 2 stocks that are powering the Korean stock market, that's Samsung and SK Hynix, and 1 stock that's powering Taiwan, and the Magnificent 7 is powering the S&P 500 and Nasdaq to record highs almost every day. So numbers are coming in, and no matter what the doomsayers say, okay, AI is going to be, they are resembling the dot-com bubble and so on and so forth, but till the time the numbers keep coming, the market will keep rewarding them.
Shireen, just one thing.
You're absolutely right. And Prashant, I just wanted to make a point, which is why you see whether it is the Jensen Huangs of the world sitting there and saying, or Jeff Bezos, both who were on CNBC saying, look, we don't believe that this is a bubble. And to Hormuz's point, and that is because the earnings continue to show up there, at least at this point in time. And, you can argue whether this is going to hit a roadblock. Is it overdone? But at this point in time, the numbers are matching expectations. In fact, for many, ahead of expectations as well. Go ahead, Prashant.
No, Shireen, the point about what Hormuz said, right, that many making the comparison with the 99 tech boom. Back then, it was, it was valuations which were absurd and there were no numbers. We were talking about 100p, 200p, all kinds of numbers. Take a P multiple of the latest minted $1 trillion company, Micron. And this is not now. The average forward P multiple for Micron over the last 12 months is 10, right? That is because over the last 12 months, the earnings for Micron are up 10 times. So the P multiple has stayed at 10. And that is
also the company that pivoted to Bitcoin storing, right?
So that's MicroStrategy.
MicroStrategy, okay.
So that is the point, right? Which is it's valuations, and we've looked at these numbers. I'm actually just take a look at the P multiple for the Korean stock market. It is, I think, about 8 times, 7 times, 8 times or something, right? So it's backed by earnings. I mean, of course, we can ask the question, and it's always good to look over your shoulder and look for signs whether this is getting. Because if the earnings stop coming or the earnings start to decelerate a little bit, look, for example, memory, Shireen, at the end of the day, it was always a commodity. But because there is just physical shortage of it, and prices are being, prices have gone through the roof, these companies are making money hand over fist. So if the earnings start coming off for the top layer, which is the 3 companies or 5 companies in the US, then they start cutting back capex. I mean, the entire flow-through will start to look, it'll be lesser. The flow down will be lesser. And at that point, we'll start to wonder whether this is excessive or not.
But at least for now, these companies Micron...
I think the question mark there on the CapEx continues, but I'll get Rima to weigh in on that. And also, Rima, put this in context of what we are seeing as far as Indian markets are concerned.
Well, just to add to that point about Micron, and all these companies have orders booked for the next 3 to 5 years. Earlier, when Micron was considered to be a cyclical play commodity, you could replace one memory chip with another one in the CPU and work would be done just fine. So it was dependent on the vagaries of demand and supply and commodity prices. But now with GPUs, these memory chips are highly complex, personalized and customized, which means they also command a pricing power. But just to get back to that point about the AI haves and have-nots, and India currently is in the have-nots. We've got about 15 companies in the $1 trillion list. There is no Indian company in the top 100 companies in market capitalization. And since we are talking about the 2 newly minted $1 trillion companies, SK Hynix and the other one is Micron, at the start of the year in 2026, when we began 1st of January, the market cap of these companies was about $300 billion. Today, it's $1 trillion, which means they've added $700 billion. India's largest company by market cap is a Reliance Industries, and their market capitalization is less than $200 billion. It's followed by an HDFC Bank at 123 and a Bharti at $118 billion, which basically means that one company, say a Micron, has added $700 billion in this year alone. That is equivalent to 3 Reliances and 1 Bharti in terms of value, which has been created at a valuation level, Shireen.
Well, yes, we'll talk valuations and through the course of the show. But, Sriram, I know you believe that India has a play and India has a right to win in the AI era, despite what the markets may be telling us at this point in time.
Yes, Shireen, it's interesting how you can spin a narrative. I mean, and that's exactly what we are seeing that's happening, right? Prashant explained it in 6 or 7 layers, how you want to divide the AI industry. I would borrow from Jensen Huang, who divides it into 5 layers: energy, technology, infrastructure, LLMs, models, and applications. And if you look at it in that sense, India has a play in 3 out of these 5 sectors. If the argument is that India does not have an AI play, it's essentially centered around the fact that we don't have semiconductor chips, neither do we have foundational models, right? And that is true for every country except 4, right? US and China have models, Taiwan and Korea have chips. Any other country you take, you can make this argument against it. But that has not, for example, Brazil, Thailand, Indonesia, a bunch of these countries have actually seen net inflows into their economy. Despite, I mean, they're not talking about, is there AI or not? Do they have chips? Do they have models? So I think the narrative is that AI is a global phenomenon. And to address what Hormaz is trying to say, right, that NVIDIA has given you a growth on top of 100% growth, and it's 2 years of back-to-back phenomenal growth. That is what happens when you have a monopoly. You have pricing power because you're the only player, and I think that is the one thing that the Indian government is trying to avoid. I think we have a philosophically a different approach towards building AI. Time will tell whether it is good, bad, whether it works or not. But I think in principle, it makes sense to me.
through the start of the year, every time we see something from Claude or we see something from OpenAI, the meltdown that we see as far as the Indian IT services sector is concerned, I mean, that's real. It's been something that we've been talking about, and it's something that's very visible in the markets. Now, again, the question, though, is what does it mean in the near term? What does it mean in the medium to long term for the Indian IT services industry, for this ecosystem that has been a job creator, that has been a forex generator as well?
Well, I just want to point one data. It's HCL Tech. So that's the first company, a tier 1 company, in its conference call today, in its conference call earlier, spoke about 40% of the industry is AI disrupted. So that's the only company which has put out a number which can shrink 3 to 5% for the next 3 to 5% for the next few years. He said 55% is AI augmented, and that has to play out, and that can grow 10%. And only 5% of the IT industry today is AI native, and that can grow 30%. So at as things stand today, what HCL Tech is telling us is that 40% of the industry, IT industry, can shrink. Right? And this is an industry which has seen hyper growth. It's slowing down, and this would be the 4th consecutive year of a slowdown. And the problem comes back to jobs, right?
They are the ones to blame. I said this in few playbooks earlier also, right? If you have 500,000 engineers in your team, you should have built a ChatGPT, but you didn't.
Right? Even a Meta is laying off, right? You can always make that argument that global tech companies are laying off.
But having said that, in the same software industry, I believe in them, that, tomorrow when the dust settles down, they will be able to generate more value out of AI, hopefully. Maybe it won't be the same players. Maybe it will be someone else.
But there was a fortune.
And I just want to bolster the point that Sriram was making in the context of what we've seen coming in as commentary from Uber, saying, look, the cost of tokens is not giving you the kind of returns on investments or productivity, and perhaps that is going to be a question mark. And perhaps in that context, with the talent that we have, and with that being one of our strengths, this hybrid workforce that is being reimagined at this point in time, can that be a strength, Prashant, Rima, Hormuz?
On that token point, Shireen, and that is the. So there are two impacts, right? One is actually that news that Microsoft and Uber, etc. Companies are blowing up yearly budgets in 3 months, right? But there is another way to read it. So the other way, one is of course saying, well, it's too expensive. The other is, well, people, engineers, etc. are loving it so much that they're actually blowing through the annual budget in 3 months, right? That's the other way to look at it. That it's so efficient that. But the cost is very high. That's the point. And
Prashant, you'll have to see it as a life cycle also, right? Right now, the AI is in that age where it needs semiconductor, it needs LLM. And as it matures, these are the things that they are going to ask for applications, and that is when Indians come into the picture.
Absolutely.
So I think there is a point, right? Yeah. There is a cost and there is a value. So yes, the cost of tokens is going up and the cost of using AI is going up dramatically. But the question is also the value. By using AI, if your productivity is going up to such a great extent, your go-to-market comes down, you can do the work instead of 3 months, you can do it in 1 day. So then it adds value at the end of the day. So there is a difference.
We have evidence of that. I don't know if Hassan Karmali is in our production control room or not, but the amount of graphics that we can churn out now within minutes, what would have taken us an entire day or a couple of days, we're being able to do in minutes. So the productivity gains are there for everyone to see. But it comes back to the cost aspect. Yeah, Prashant, go ahead.
So if, say, for example, just to complete that point about tokens, right? The biggest risk is China, which is, of course, maybe a step behind US. They come out with, with significantly lower models, and the cost drops. It's going to be great for AI productivity and everybody who loves AI, but that may actually be the primary risk to this entire AI supercycle, because the industry right now, Micron is priced a certain way. They're expected to make all these, is because there is, it's an industry built for scarcity. Correct. And if scarcity goes away, suddenly this entire thing will look very, the AI will be real and the productivity gains will be real, but what happens to financial markets and, this entire big boom we're seeing in AI-related stocks, that is another thing. Just one more thing. I heard something very interesting from a consultant who's working in this space. He told me two things actually stood out. One was that there is especially amongst listed companies, and he was not necessarily talking about, India, he was talking about companies in the Middle East where he primarily works, and in the US as well. there is real FOMO. Listed companies want to come out and put out a press release saying, well, this is what we're doing with regards to AI. This is our AI unit. Everybody wants to be seen to be one step ahead, right? And not like have a lackadaisical attitude, or at least not seen to be having a slightly relaxed kind of approach here. So that was interesting. And second, he also said that a lot of layoffs, etc., which are happening in the US, and I think Rima has been talking about this for a while, they are showing up in India. Those jobs, for example, someone pointed out and I checked it, I was correct. LinkedIn just opened their largest campus in India, in I think Bangalore or Hyderabad, right?
Bangalore, Hyderabad, gift city.
The cost is so significantly. You have to pay $100,000 or whatever in the US, and here you can pay $30,000, $40,000. I mean, so it's a no-brainer in that sense. The old story. I mean, the wage arbitrage. But that is also getting accelerated because of everything which AI is doing right now.
DeepSeek moment, you remember in January 2025 when China came out with a much cheaper version of ChatGPT, there was actual consternation amongst the US markets, and the US exceptionalism in tech was questioned.
And to add to that cost bit, right? Because the cost bit right now, the market is appearing to overlook that factor, because all of these companies, all the big tech, the Magnificent Seven, all of them are funding this 180 billion, 200 billion capex through their own cash. And they're generating so much cash every quarter that they don't need to. The only company that perhaps went through the debt route was Oracle. They announced that some $35-40 billion debt financing, and the stock got smashed for a couple of days, and then everybody forgot about it. So
That's the problem, Harmas. Things people are forgetting in this euphoria.
No, but that's how it is. People forget. Until the times are good, people forget the concerns. So as of now, till the time the companies are funding it through cash, and as long as they are getting what they want, they are ready to pay that extra premium, and so do we. If we get that, if we have that convenience factor, we are ready to pay that extra buck as well.
This line that it's being funded by cash is thrown quite loosely. There is a significant amount of credit funding that has gone into this AI capex, or not all of it is cash funded.
Even Meta, etc.
And that is a significant risk, again, forgotten by the markets.
Well, when times are good, the market tends to forget. When times are not so good, the market will remember. But, to the point that you were making, Prashant and Rima, about this ostensibly being a scarcity play as well, which is showing up in the kind of valuations that these companies are enjoying. And many researchers, AI researchers, argue that, look, DeepSeek may not necessarily be an exception, that this model of heavy compute, etc., is probably also in the enlightened self-interest of these companies to play on, to be able to extract the kind of valuations that they are enjoying. So that is something that we're going to have to keep a close watch on as well. Can you actually deliver the same outcomes with less compute, with less costs? And I think that is up for discussion, debate, and evidence. But DeepSeek certainly is one of the companies. But this is not a debate that's over by a long shot. It is going to be a discussion that we will continue to have. But Prashant, the quick final point on India and the markets, in light of everything that we've seen before we close, and of course the Pope getting in on the AI debate as well. We'll end with that. But Prashant, the quick final word.
I just think, Shireen, it is you don't, as I said, you don't have to make money buying an AI stock, right? But yeah, I think it is. I mean, I'll give you an example, Shireen, right? We are dependent on oil. Oil hurts India because we import big amounts. I mean, 5 million barrels every day, right? 80% of our oil is imported. But so is Korea and Taiwan. But guess what? They're running current account surpluses. And this year, both countries, current account surplus as a percentage of their GDP was projected to be, last year was projected about 5-6%. It's going to be 20% plus. Current account surplus as a percentage of GDP with oil at where it is, right? So this is so there are all kinds of implications of this.
We're out of time. We are going to continue our conversations on the Editor's Playbook. If you enjoyed watching this show, then send us your feedback and your comments. Tell us what you'd like us to talk about on the next one. Till then, from all of us here on the team, goodbye. Thanks very much for watching, and see you soon.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, the big story that we're tracking, the Supreme Court has upheld the 1 lakh crore rupee GST show cause notice to online gaming companies. Now, the top court has said that the tax on actionable claims arising out of online gaming are constitutionally valid. It has directed the GST authorities to proceed with the notices in accordance with the law and said that the gaming companies are free to respond to these notices. Now, it is estimated that the total show cause notices are aggregate up to 1.12 lakh crore rupees. That's against 71 online gaming companies. This may potentially soar to as high as 2.3 lakh crore rupees or even higher, subject to, of course, interest and penalty components that may get added. That figure, of course, is not final. We're only at the show cause stage at this moment. Now, major companies that are facing these notices include the likes of Gamescraft. It has a demand of around 21,000 crore rupees, Dream Sports at approximately 28,000 crore rupees, and Delta Corp at nearly 30,000 crore rupees. Major numbers, those. And let's also not forget that this is at a show cause notice stage. The next process, the next step in this process will be a response being sought from these companies, a response being sought by the GST authorities. Now, to discuss this further, we have with us Mr. Prateek Bansal, senior tax expert. Also joining us a little later on the show will be Darshan Bora, partner at the Economic Laws Practice. Mr. Bansal, coming to you first. First, help us understand, is this the biggest tax dispute that we're looking at being decided by the Supreme Court?
Certainly, Ashmit, this is one of the landmark sort of dispute which we are seeing right now. This is, I mean, the quantum, given the quantum and the magnitude of the demand and the numbers, the industry is essentially saddled with, almost, it's a situation where it can erode the industry entirely. So, yeah, this is one of the biggest tax dispute which we have seen so far.
Mr. Bansal, also help us understand the big issue that was also there before the Supreme Court is that whether the show cause notices will be actionable retrospectively. The amendment that had come out which levied a 28% was again introduced in August of 2023. The question that many raise is that will this be applied retrospectively, because a lot of these show cause notices are from that pre-August 2023 period. So has that been cleared by the Supreme Court that even retro application can be done? GST authorities can proceed with that?
Yes, Ashmit. So Supreme Court has clarified that retrospective application can be done because, when the government brings in any law, and until unless it is specified that this will be applicable from the date on which it has been enacted, in that situation, it automatically sort of becomes retrospective. And in the present case, where this amendment was brought in to bring all the online gaming companies within the tax net, and also to tax the full face value demand. I mean, this is the most critical aspect of this judgment, where the government has brought in the tax demand on the full face value. As in, if I simplify this entire thing for the viewers, if a person is betting 1,000 rupees, the government needs to tax the entire 1,000 rupees, not only the convenience fees, the platform fee, which eventually is only retained by the platform. So I think the entire dispute, and that is why the numbers are so big. If you see as it is there on the screen, because they are taxing the full face value.
Sure. That's an important point. Let's go across to Mr. Darshan as well. Mr. Darshan, thank you for joining us. Again, the first question, the Supreme Court, it's granted its stamp of approval. Are we looking at GST levies on the entire amount that is brought in? That was, of course, something that was hotly contested by the gaming companies.
Yeah. Hi, Ashmit. Thanks for having me. Yes, kind of a, far-reaching judgment. And as you rightly put, the biggest tax dispute till now. And yes, we are looking at, the tax on the entire face value of whatever money is being staked. Okay, a GST levy on the entire, face value of that, bet, and not just the convenience fee portion. And that too retrospectively from the date of GST.
That was, in fact, the next point I was building towards. Retrospective application. Good to you. Historically, we've seen that the Supreme Court has been shy of allowing some form of retrospective application. The argument that, of course, taxpayers often make is that since it wasn't clear to me as to what the taxable position is, and therefore it's not fair for me to share that burden, but the Supreme Court granting that green flag, allowing for retrospective application as well?
Yeah, that is what one could gauge from what was pronounced in the court today. We'll have to wait for a copy of the judgment, and we have to read the fine print and come analyze the nuances. But what the court said today is that the amendment is clarificatory in nature. So that means that the levy will be retrospective.
Let me ask you, Mr. Bansal, let me come back to you on one.
Yes.
Let's wait for the fine print. Of course, these are early moments. We've only had about 60 minutes to process the ruling coming in from the apex court. Mr. Bansal, let me ask you this. Let's see it in context of the centre's legislation, which has completely banned online real money gaming. Realistically, academically, the court may have approved such a retrospective levy. Realistically, how much of it can be recovered? Most of these companies now will effectively exist only on paper now that their practices have been banned.
Basically, the recovery will obviously be a challenge because it will be in the form of arrears, essentially, wherein the demands will be recovered from the companies by, maybe immovable and movable properties. The companies which are still operating but have sort of divulged into different other business verticals. So maybe, the recoveries can be made from the common directors and from the common partners. So yeah, recoveries will be an interesting issue, and I would also like to highlight one important aspect which Supreme Court has observed, obviously subject to the fine print of the judgment, that they have said that it doesn't matter whether it is a game of skill or chance, till the time the money is being bet. And the person is kind of gambling on that aspect, then it doesn't matter whether it's a skill game or a chance game. So I think the thought process was very clear that as far as the amendment is concerned, they have to tax it. Yeah.
Mr. Darshan, let me come to you again. The show cause notices aggregate to about 1.12 lakh crore rupees. We're talking about 71 gaming companies bearing the brunt of this. Tell us, we're hearing from experts as to this could easily balloon to over 2.3 lakh crore rupees. Can you tell us what the penalty component, what the interest component may look like going forward from now?
Yeah, so the interest component in many situations may actually exceed the tax amount, given that, we are talking a very long period. And there, ideally in a matter like this, there shouldn't be any penalty. So we'll have to see how this evolves. Okay. See, right now, this is at the stage of show cause notice, which have been challenged at the Supreme Court level. Now, the matter will have to go back and there will have to be adjudication of the show cause notices. And perhaps we may see another round of litigation as to whether or not there could be, the invocation of extended period, okay, or whether or not there could be levy of penalty. So that may see a separate stream of litigation on that. But of course, interest is automatic, and interest is going to be substantial here.
So interest could be substantial. Could that figure could balloon northwards from here? Of course, the 71 show cause notices aggregating to 1.12 lakh crore rupees could go up significantly higher if the interest component is also put in. But Mr. Bansal, again, as far as gaming companies are concerned, as far as their legal options, one, of course, is a review whether or not they choose to exercise it. But going forward from here, this is only at a show cause notice stage. So as the proceedings move forward, the Supreme Court has been clear. It has to be only as per the process of law. The gaming companies will have their opportunity to respond to this show cause notice. And as and when the demand is being finalized, is that also another stage at which litigation can be seen? The gaming companies could challenge finalization of any figures?
Yeah, so the normal process is that once the adjudication will happen, order will be passed, the companies will have an option to file an appeal against that order. The only challenge is that appeal involves 10% pre-deposit of the tax. So if we are looking at a number of 1.12 lakh crores,
So you can imagine the 10%, which will be the pre-deposit amount required to be deposited at the time of filing of such appeals. So, and obviously, if we go to the tribunal, which is the second level of appeal, then another 10%.
Right. We just have Ashish Kumar also joining us, partner with Capstone Legal. One quick question for you, Mr. Ashish. What does the road ahead look like? What are the legal remedies available for the gaming companies after the setback from the Supreme Court?
Well, now the remedy will only be procedural. So substantively, they have settled the law because Supreme Court is a final court where one can be. They had challenged the notification, but only the quantification part is something which remains. So as was pointed out by the speakers before me, it would be a process which would involve pre-deposit, show cause notice, reply. But essentially, whatever they had to say in their reply, they have said in this judgment as well and while arguing this case. So the road looks very difficult and very tough for them.
And one quick word, what does recovery proceedings look like? These companies, again, their operations have been banned by the center itself. So does that, again, hurt the recovery proceedings, if at all, any by GST authorities?
Well, it is certainly a hurdle if the company is not operating, but certainly there are assets which the company might have and some money which may be already there in their bank accounts. Essentially, this demand will have to be covered as per the procedure under the GST Act.
Right.
So it prescribes for a very detailed procedure and that would follow.
Right. I'd like to thank all of our panelists for joining us again. Multiple moving parts to this. We're yet to, of course, get a copy of the Supreme Court judgment. But with that, it's time now for heading into a very short break. Coming up next, we address the recent controversy around this year's CBSE Class 12 board examinations, where many students complained that their marks were far lower than expected. We are joined by Nisarga, an ethical hacker who highlighted errors in the CBSE platform, along with Jyoti Gupta, former member of the CBSE governing body, as well as Anita Rampal, professor at the Delhi University. Stay tuned. Well, this year, CBSE 12th board examinations have been marred by a massive controversy. Just after the results were declared, many students complained that their marks were far lower than they expected. The CBSE adopted a new system called the on-screen marking system to evaluate the students this year. Under this, Answer sheets are scanned and uploaded to an online platform. The teachers can check the answers digitally and marks are automatically calculated. The students insisted that the new digital evaluation system had failed them. Re-evaluation revealed that many issues, some students alleged that the scanned answer sheets shared with them did not match their own handwriting. Many alleged that pages were blurred, answers were allegedly unchecked, and that the total marks were miscalculated. Tech glitches and payment issues were also reported. The situation became even more serious after a 19-year-old ethical hacker claimed that he breached the system in February of 2026 and found vulnerabilities. Now, the hacker, who identifies himself as Nisarga Adhikari, has alleged that the OTP verification system was weak. Anyone could change the password and anyone could potentially impersonate an examiner and even alter scores. However, the CBSE has denied the vulnerability, saying that the portal flagged by the hacker was a testing site which had sample data, not actual data. Now, amidst the row, Education Minister Dharmendra Pradhan has sought a detailed report from the board and asked authorities to explain the reasons behind technical failures. He also directed a team from IIT to assist the board with fixing this issue. Well, joining us now to help us discuss this further is with us Dr. Jyoti Gupta, former member of the CBSE governing body. She's joining us now. Also with us, Professor Anita Rampal, professor at the Delhi University, and ethical hacker who goes by the name of Nisarga Adhikari on X. He's joining us live as well. Nisarga, let me come to you. Just help us identify what were some of these challenges that you faced and what were the concerns that you had raised with CERT-In, and had the government body taken note of these security challenges that you had flagged?
So initially in 25 February, I discovered the vulnerabilities for the first time. I documented all of them, like prepared a whole meal and sent it over to CERT-In. So CERT-In reverted back to me saying that they need more information to actually reproduce the problems on their side. So I sent them a screen recording and other ways and step-by-step guide on how to reproduce the vulnerabilities on this side. So they acknowledged the vulnerabilities, which proves that they were able to reproduce and verify my claims. And they said that, thank you, we'll bring it up to the concerned authorities. Now, after that, the portal went down for 3 days. The master path of vulnerability was fixed, but the other 5 to 6 vulnerabilities which I had reported were still there. And there are sources I can use to back up this. There are non-profit websites to archive web pages, and they also archive the CBSE's page, which still has the vulnerabilities. Like there's an archive of 3rd March, which I have. I tried to follow up with CBSE several times. I made certain, but I didn't get any response, which was pretty disappointing.
So no response. But Nisarg, let me also get your thoughts on the CBSE clarification. They've clarified that the portal that you actually went into was only featuring test data, that was sample data, that wasn't actual data. You on X have said that that is not the case. What were your findings?
Okay, so when I had tagged into the portal for the first time, I hijacked an examiner's account. And this person was a real teacher at a real school. I have the screen recording of it. I have posted a censored version of it on X. But in the uncensored version, friend of mine has cross-checked and found a faculty directory of that school. And that person is a real evaluator who was tasked with checking physics papers in the CBSE board exams. If it was a test URL, as CBSE is claiming, why would they use a real person's details? And secondly, CBSE said the same thing twice yesterday. First, they made a statement and then they retracted it and they posted a new statement saying that it was a test URL. In the first statement they posted, they gave an URL which didn't even exist. Domain wasn't bought. A friend of mine bought it and redirected it to my blog, which is pretty hilarious in my opinion and pretty embarrassing for CBSE because they are just posting statements before verifying it twice or thrice. And there are other, I was able to access production data and I'm pretty sure about that. And it wasn't a test URL. You can see, yes, it wasn't test URL. I'm sure about this because it was using a real person's data. There was real person's data on it. And
so real person data is what Nisarg is claiming, an ethical hacker, pointing out what he claims are glaring technical issues. But Professor Rampal, let me come to you again. We're looking at deployment at a very large scale. Evaluation of almost 1 crore papers is what we're looking at. What many experts are asking is that why was this not done with a smaller sample size? Why was this not tested before deployment at a scale of 1 crore papers?
Yes, one, I want to say I'm very happy to be with Nisarg on this platform. And I think I really hope all our students can ethically use their knowledge and talent for the public good like you have done. I want to say that this question about smaller sample, this has been done earlier in some years earlier. Our own teachers have told us that there was in 2017 or 16, and then again 5 schools this year, just before the exams. But I don't think that is the question. I think one, of course, serious questions have been raised with the company that has been outsourced. I mean, the contract that has been given to some company, which in Telangana has been, has been marked for identified or blacklisted. But my concern is deeper. It's not just the sample and trying it out. My concern is the fairness of assessment and the professional task of an assessor. That's what we do, and that's what we train our students to do. And that a machine cannot do. Sure. So we have to use, use our trust. Yes, we use our professional skills, our judgment, and we cannot do it marking. We cannot do that assessment on a scrolling machine. We cannot do it on a screen and scroll the mark sheets there. So that is a more serious question for an educationist like me.
That's an interesting perspective. Ms. Gupta, do you agree with that, that you need human eyes and that you can't have scanned sheets being scanned, being evaluated online?
I would like to, I'll answer that question of yours, but let me first go back to the question that you asked, Professor Rampal. The CBSE had already done a pilot of this in 2014. The technology has really advanced since then. That was the time when the copies had to be cut and scanned. But this time, the entire copy was scanned without tampering the entire copy. So there are advancements. And then at that time, the pilot was done for 3 years, and there were up to about 30 lakh of copies that were scanned, and that the result was, made by those. Now, this time when the OSM came in, I was associated with the pilot also. Like Professor Rampal said, there were 5 schools where the pilot was done. There were observers. We were all there, and we were real time giving suggestions because that is the time when the program was being also, strengthened. And at that time only, we had flagged off the challenges. The scanning was done very well. And I have a little contrarian view here that, seeing the copy before you and correcting that copy manually with the pen on the paper and correcting the paper on the screen, there wasn't much difference because the screen was there in front of the teacher, of the evaluator, and instead of a pen, there was a mouse and a keyboard. So the only thing that differed was that instead of, placing a tick with a pen, it was a tick that was selected from the drop-down menu. And the marks were also selected. And again, the evaluators did not have to...
Not much difference there, Ms. Gupta. Not much difference there, as you're pointing out, between digital and analog. But let me ask you this. I'll just take a cue from what you had mentioned, that concerns had been flagged at the time of the pilot stage. Were those concerns heeded to by the CBSE before deployment of this? Because many are asking, were the evaluators ready? Were the SOPs in place for an evaluation of this scale? Again, 1 crore papers is what we're talking about.
Yes. So there was a training of the principals done because the principals are the chief nodal officers. So we are all the CNSS. So our training was done, and then the evaluators training was done. The videos were created and they were posted for every evaluator. And I had about 13, 14 subjects being corrected in my school. So we had the complete training of all the head examiners, of all the evaluators, and we were there. The entire technical team was there to handhold the people who were finding it difficult initially. And we never forced anybody to go beyond their capacity to check. So it was a complete process that was defined that was, put in place, all the SOPs, everything, only then the corrections were done. And let me also state here, no blurred copies were checked. Every copy with even a little bit of a doubt was rejected. It went back to CBSE, it was scanned again, and it came back again. And the copies that were not scanned, were not being able to get scanned, these were checked manually. So there are about 13,000 copies.
So
that
evaluation and SOPs, evaluation training was there, SOPs were there. So let me come to Professor Rampal for one quick final comment. If all the SOPs were in place, if all the concerns had been heeded to by the CBSE, what went wrong, Ms. Rampal?
From the people that I've spoken to, who are some of our best former students and teachers of the system, when you do evaluation, as I said, it's not a mechanical task. I think anyone who evaluates knows it's not just scrolling down a screen and reading it and giving a mark. You can't process a screen when you're scrolling it down. You look back, you flip back on something, you think about the answer, you then take a judgment as to what the answer is, how original it is. You're not just mechanically marking it. So what we do is not what machines do, and we should not be made into machines. So the problem is there. That's what happened. Teachers said that they couldn't, everything was problematic even when they were trying to do it very seriously. And also they said the fact that you were being watched and someone who took longer or did it very fast, actually the center got a call.
I'll just interject very briefly there. Dr. Gupta also wants to come in. She wants to dive in with a comment. Ms. Gupta.
So I just want to say, Professor Rampal, that the screen was not scrolling. The pages were coming one by one. So at one time, there was only one page. When the work was done on that page, the second page came in.
I understand that.
No, it was a very scientifically done, very well done scanning, and there can't be anything better. See, we have to move forward. There are boards like Cambridge, there are boards like IB, where the children are giving exams all across the world. How are they correcting the papers? So we can't just move back. It is a digital time. Today, even we are not in a studio.
That's the problem.
We are sitting at our offices and homes and participating in a debate like this. So we have to digitally, we have to embrace the digital.
Just have to, right. Dr. Gupta, we are running out of time. I just have to give the final word to Professor Rampal. Professor Rampal, running out of time. Analog, digital, which of the two would you pick? What would your recommendation be?
I think that's completely the problem. When we close our minds and we think that digital is the answer, we undervalue and devalue what a human assessor is doing and what our teachers, who are professional, senior teachers, what they do when they try to do a fair assessment. They're not.
It was the teachers here, ma'am. It was the teachers here. Their machines have not checked the paper. It is the teacher who has checked paper. If I can come in and I can tell you what the problem could have been this time.
We know all that. I'm talking about teachers. I'm not talking in the air. So please don't respond like that.
We're completely out of time. Clearly, a subject that's inspiring strong, polarizing comments from either side. I'd like to thank all of our panelists, Dr. Gupta, Professor Rampal, as well as Nisarga, for joining us on this special broadcast. But that's all the time that we have. Do stay tuned to CNBC TV 18 for more news and updates.
Welcome to Indianomics. What's puzzling about the rupee fall in the past 15 months is that it is happening at a time of modest current account deficit. Current account deficit, or CAD, is the extent to which current outflows like imports, interest payments on loans are higher than inflows like exports and remittances. Historically, over the past 30 years, India has run a CAD of just 2 to 2.5% of GDP, and we have had enough capital flows to fund it. In 2013, CAD went up to 5% of GDP and we had a rupee problem. But in FY25, India's CAD was only 0.6% of GDP and we still had a problem. Likewise, in FY26, CAD, or current account deficit, is only about 1.3% of GDP. We still have a falling rupee because capital flows are not enough. The problem is, historically, we always had enough capital flows, that is FDI and FPI inflows, to bridge the current account deficit. But in the past 2 years, we are not able to get capital flows even to fill smaller current account deficits. But then we can't do much about capital flows if investors are chasing AI stocks or commodity markets. What we can control is our exports and imports. Hence, the Indian government has signed a host of FTAs to boost India's trade. India signed 9 free trade agreements in the past 5 years, and 11 more are in the pipeline. The question we are asking today is, will more FTAs help us to bridge the current account deficit? Will they increase capital inflows in the form of FDI? Will they give us more services exports? Joining me are 4 experts: Arpita Mukherjee of ICRIER, Amita Batra of JNU, Rupa Chand, formerly of IIM Bangalore, and Professor Pralok Gupta of the IIFT, Indian Institute of Foreign Trade. Gentlemen and ladies and Mr. Gupta, thank you very much indeed for your time. Well, let me start with Arpita Mukherjee. Ms. Mukherjee, you know, I was looking at the data from UAE and Australia. Those are the 2 countries with which we first signed FTAs. They become effective in 2022, I believe. But if I looked at it, 22, 23, 24, 25, 26, it is not as if exports have grown a great deal. I mean, they've grown in some years, but, you know, to Australia, for instance, exports have grown by just 3% in FY26, 3.96%. It's not as if the FTAs have done wonders. Are the FTAs taking time to generate exports? How should we look at what to expect from the free trade agreements?
See, basically, the exports happen from the free trade agreement based on tariff phasing period. So you have to wait for 3 to 5 years to see a change. Having said that, the 2 countries that you selected are actually a very low tariff country. So they, any which way, had very low tariff. And the FTA that you selected with Australia is actually a mini deal. It's not a very comprehensive FTA covering wide range of products on both sides. Secondly, after the trade agreement is concluded and signed, it takes time for the implementation, and based on the phasing out, you see the benefits. So if you are entering a zero duty immediately on signing of the agreement, that will show something, or else you are going for like 5-7 years phasing out, then you will see the growth in exports slowly.
Fair enough.
These are 2 things you have to take into account, and don't take all trade agreements from the account of, you know, that they will really boost export. It also depends upon the market. There are markets where, you know, the custom duties are much lower than India. In most countries, they are lower than India. So, you know, when you're doing a free trade agreement, India may have to reduce the duty more than those markets. But there are many other gains of the trade agreement, like you bring in regulatory parity and all of that, that we can discuss later.
Fair enough, fair enough. Professor Batra, would you want to add to this? What's your take? Is my whole premise to look at FTAs as a solution to current account deficit all wrong?
Not at all. Yes, exports are expected to be pushed up because of an FTA. But as has been said already, there has to be a distinctive higher preferential margin that we must be able to access the other market with. In case of Australia as well as EFTA, you see the tariffs on the other side are low, preferential margin is low, the incentive for our exporters is low. Plus, there is also another aspect, you see, which is that when we look at competition in these markets, particularly when we're talking about Australia, there have been some gains, as you mentioned, in the textiles and clothing sector. But these are far smaller than the rate at which you see a competing nation like Vietnam gaining in Australia. So these are, Vietnam is a country that's already present in these markets. It dominates these markets. And so there is existing first mover advantage for certain other countries that you have as competition. So export competitiveness, building that up for us as a prior to export and FTA benefits is very important. The second aspect that you mentioned in terms of the capital account bit of the overall balance of payments, I'd like to touch upon that too, because an FTA is not just supposed to be, I say supposed to be, just export push through the preferential access, but also the linkages that it provides any country in terms of integrating with global value chains. EFTA has an investment promise from the other side, but the commitment is another aspect.
Okay.
And so are the UK and the coming in EU, European Union FTAs,
Okay.
With all these, what we need is an additional component which ensures investment is part of the trade deal or as a separately negotiated parallel agreement. And that will come in when we have our own template, that is the bilateral investment treaty model of 2015, worked upon, that was promised in the budget of 2025, but we've yet to see the outcome of that. So it's the trade investment linkage that must be promoted and that must be protected and be a part of the FTA trade deal to give us the real benefits in terms of enhancing our exports and attracting FDI.
Okay, fair enough. Let me get Professor Gupta in. Professor Gupta, as has already been said, I am prematurely looking at the goods data alone. We have to look at investments and services. So if you can enlighten me on either of them, have our FTAs already signed or to be signed concentrating enough on promise of FDI? I think with the Europeans, there is some $100 billion commitment. Can you enlighten us? If we are not able to narrow our current account deficit, will the FTAs at least bring in enough capital flows to bridge that deficit?
Yeah, thank you, Lata. Just 2 points. One, before coming to your question with respect to, because you started your show with linking FTA journey with the current account deficit.
That's right.
So it is very important to note that our renewed journey for FTA, it started in 2020. So at that time, we were not facing any pressure on the rupee. So it's more a part of that. Exports are part of our more growth strategy when we are talking about the 5 trillion economy. But essentially, what I'm trying to say is that it's not that because CAD is high, so we are focusing on FTA. We have started FTA journey much ahead. And coming specifically to your question on the services and investment, yes. On the services sector, there are significant commitments from our FTA partner countries. So from like European Union, we have around 144 subsectors that have been committed by European Union out of the around 160 subsectors in the services side. The same is true for UK also. So more than 135 subsectors they have committed. And one thing which is very important to note in the services, that there is a commitment, there is a liberalization or commitment on a foreign direct investment in the services sector, which is in the trade parlance called Mode 3 or commercial presence. So India has made commitments on Mode 3. That means India has committed to allow foreign direct investment from these countries. So there is an expectation that significant FDI in the services sector will flow.
Yeah.
Second, on the 100 billion in the EFTA agreement that you talk about, the Switzerland, Iceland, Norway, and Liechtenstein, there is a provision that these countries will make 100 billion investment in coming 5 years. And if there is a shortfall, then the balance that have been achieved in the FTA, that could be recalibrated.
Okay.
So it's more like incentive or facilitative element that these countries, the private sector are more promoted to make investment in the country. So I would say that these FTAs are geared towards having a multi-pronged effect on the economy in terms of investment, in terms of increasing exports, in terms of increasing imports to ensure the raw materials for India. For example, in the Australia deal, we have good provisions for the raw materials like cotton, chemicals, and different kind of raw materials so that supply chains are completed. Also, there is a mutual recognition agreement like with the Australia. You mentioned some data on the Australia. So last year only we signed a mutual recognition agreement on the organic foods.
Okay.
And so India's testing is India's standard that would be accepted in India.
Fair enough.
Now, see, where is the market for organic food?
Yes.
The market is in the developed countries.
Yes.
Now, if these kind of things are happening in the FTA, they will give benefit in different to the country.
I take your point, sir. If it has only happened last year, then I'm counting my chickens too quickly. We will have to give it time. Professor Rupa Chadha, thank you for your patience. Can you tell us if the FTAs are geared towards having more GCCs and other kinds of services? Is there evidence already?
Okay, so thank you very much, first of all, for having me on this show. First of all, the whole perspective of looking at an FTA in terms of its benefits is not about reducing deficits. And as previous speakers have said, it is much wider than that. It is about promoting exports, but it's also about increasing inputs and having, supply chain diversification, getting access to critical inputs, reducing manufacturing costs. So there's a range of things that you actually want from the FTAs. They're geopolitical, of course, as well. And second thing is that having a deficit bilaterally is per se also not bad. It could be because you're actually getting access to better quality inputs and that feeds into better quality exports. You could be increasing your bilateral deficit, but actually increasing your exports to third market. Now here coming to the services question that you specifically asked. Yes, of course, we've seen that our surplus is there in services. We are seen to be competitive in services. However, not a sufficiently broad range of services. So we tend to focus on IT enabled and professional services. I would look at services much more broadly than again just professional services and IT services, and I would look at imports of services as well through Mode 3, which can enhance our overall economy-wide competitiveness. So what do I mean? I mean, for instance, logistics. That's a very important sector. Many of these sectors are actually open to FDI. Telecommunications. So what I'm getting at is that look at the service sector both as an enabler for exports in other areas as well as our exports, which we already have, which we are doing very well at in areas like GCCs and IT services, professional services.
I have to run into a commercial break. Sorry for interrupting you. We're going to come back and take a more detailed look at all these verticals that you all have spoken about. Mutual investments, getting into global value chains, more services, more investments, all those questions after the break. Welcome back to this very special Indianomics. I have 4 trade experts, Professor Arpita Mukherjee, Professor Amita Batra, Professor Pralok Gupta and Professor Rupa Chanda, who have invested a lot of their research efforts on FTAs, designed them for India. Some of them, they've been part of the negotiations. They're asking whether at what point in time the FTAs will ensure that we are able to either get enough capital flows to bridge our current account deficit or to narrow the current account deficit itself. Ladies and Professor Gupta, thank you for your patience. Arpita Mukherjee, to start again at what is our current problem. I agree with all of you that we did not design the FTAs at a time or with the intention of narrowing current account deficit, because at that time, that was not the problem. But right now, we have that problem. So by when do FTAs mature enough for us to be able to milk them to give us either exports or higher investments? Does it take 5 years, 10 years to really marinate?
Lata, that depends upon when did you sign the agreement, when the agreement got implemented. So if you sign the agreement, see, there is a gap between the signing and the implementation. If you look at UK, it is almost a year. EU, it will be almost a year. So there is a gap between the signing and the implementation. And then after the implementation, there are trade partners have 5 to 7 years. In some cases, earlier FTA, we had 10 years to actually see the entire benefit. So there is a time period that is there. During this time period, let us understand, if you go back to your question of export versus import, during this time period, you also have to see that these countries are doing trade agreements with many other countries. Yeah. Some of them who have signed agreements before us, like Amita pointed out, and their implementation has already happened, whereas we are in a phase of implementation. So if you're looking by country, you need to also, the other thing is that if I am catering to Australia, I need to actually think what Australians will consume and like. They have a limitation to how much they can consume Indian products. Like, if I am going to sell basmati rice to everybody, there will be a limit to which they will consume basmati rice. So am I able to move up the value chain from a raw material intermediate producer to a final product that is needed by those markets? So this is also very important, and that's what I think Rupa was trying to push, was that whether my domestic economy is gearing towards the need of the partner country and customizing the product that is needed there. Okay. The moment we customize the product that is needed there, you will see a growth in our export. It takes a time for the industry to rethink, understand a new market, look at it from a liberalization perspective, that I am going to now get a easier access to this market and then move forward.
Fair enough. Ma'am, I'm sorry. I am out of time. This is a small show with too many good experts. We'll have to debate on a later day. But Amita Batra, when we did the ASEAN FTA, we got into trouble with a lot of Chinese goods coming, because the rules of origin were not very clear. Are we now ironing that out? Can we say that the new gen FTAs are better designed to ensure that our goods go to the destination countries more safely and we are not flooded with third-party products?
Thank you, Lata, for that very important question. I'll answer it in 2 ways, and be a little more specific. One, to also your earlier question, I really consider the UK and EU FTA, both of which to be yet implemented, to be more substantive, and I think to be more benefit yielding, because both these have in them elements that can bring us value chain integration and possibility of immediate benefits in terms of 100%, for example, in case of textiles and clothing being brought to, of our tariff lines in that sector being brought to zero on immediate effect. Okay. But as I said earlier, there is competition, and so we need preparation. This preparation is very important. We have time as far as the EU FTA is concerned, and we need to bring our exports up to that level which will be accepted in those markets. There is a lot of potential in these markets. There's a lot of consumption, but we have to remember that there is also a lot of emphasis on sustainability. related regulatory standards in both the UK as well as in European Union. So prior preparation is important, When you talk about rules of origin, I think it's very important, A, that we not be flooded, B, that we are able to send our exports to the right destination in the right manner. As far as flooding is concerned, I have to say what the UK, for example, has adopted recently in terms of reduction of its quotas. India has somehow taken that as an issue to delay the implementation of the India-UK FTA. Now, I wish we had not done that because the issue of there, as far as dealing with the reduction of quotas for steel imports is concerned, should have been taken separately at the WTO, which we are. But we should have gone ahead with the FTA implementation, which was to otherwise come in May, because it has benefits of value chain integration, particularly also in a sector that we are very good at, such as automobile components. Although that would have been phased out over 10 years, but it would have given us a very, very good...
Dr. Batra, I will have to give you more time because this is a large topic, especially our relation with Europe. Unfortunately, the clock is ticking. Just 1 minute each to the other two guests. I'm sorry. Pralok Gupta, what's your sense in terms of when we will start getting the full benefits of these 9 plus 11, 20 FTAs? Do you think India's trade gallops by the time we get to 2030?
See, I think earlier speaker also pointed out that we are talking about this number 9 and 11 FTA, but only 3 FTAs, UAE, Australia and EFTA. They are right now in the implementation stage. The others are either just signed, not yet implemented, or still negotiated.
Yes.
To say that when they will come into implementation. But I say that their effect come into play in the short period, in the 3 to 5 year, but there are also long-term benefit in terms of increased whenever professionals move to their countries, in terms of increased remittances flow, and also the innovative approaches that we now have in our FTA. For example, in the Australia FTA, we have post-study work visa.
Yes.
Our students going there, they will work and send the remittance here.
Yes, yes. Fair point. Got it, sir. Got it. I'm sorry, I'm out of time. Rupa Chanda, you can add one more sentence to this. Out of time.
Okay, so I will just say that for at least the UAE and the Australia FTAs, we are seeing some increase. Now, to what extent you can say that's due to the FTAs, that's always difficult. You have to look at utilization rates. But really, the benefits will come if you, in parallel, also have domestic reforms, scaling strategies, SME integration strategies. It would take at least around 3 to 5 years, as Pralok said, to see some benefits, but the longer term benefits of leveraging investment, technology transfer, digitalization, integrating services with manufacturing, these are really the things that will pay off in the long term. And there are many intangibles that will come in terms of quality, standards, skilling, capacity building, etc., which you cannot quantify with any bilateral trade
superb.
deficit.
That's an excellent last sentence to wrap up this discussion. We should not be counting them prematurely. It's just that there is this big problem of rupee and current account deficit sitting on our head, and we get these high, headlines of FTA. We try to link the two. We should know that this is a longer term effort. Thank you very much, ladies and Professor Gupta, for joining me. We will invite you for a more detailed discussion later on. That's it on Indianomics. Thanks for watching.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end flat after a range-bound session. Midcaps outperform. The rupee remains above the 95 mark against the dollar. Iran condemns the latest US attacks as a definitive violation of the ceasefire, but Tehran does not pull out of the talks under joint mediation of Pakistan and Qatar. President Trump calls for a rare cabinet meeting at Camp David. Crude oil prices pull back from recent highs. US Trade Representative Jameson Greer expects to meet Commerce Minister Piyush Goyal to finalize the framework for a trade deal. Greer says a team of negotiators from the US will visit India next week. Air India cuts nearly 20% of domestic flights and 27% international flights, citing high fuel costs. Indigo also cuts frequency on domestic routes due to a drop in demand and disruptions on account of the war in West Asia. SpiceJet and Akasa also trim capacity. The Supreme Court upholds a 28% GST on online gaming, says the tax levy is constitutionally valid. The tax demand from companies could soar to over 2.3 lakh crore rupees. Relief for Amazon. The Supreme Court quashes a 200 crore rupee penalty imposed by the Competition Commission. The penalty was imposed for allegedly suppressing material information while seeking the approval for investing into Future Group in 2019. Baiju Ravindran sentenced to 6 months prison by a Singapore court in a contempt case linked to alleged non-compliance over asset disclosures. The court orders him to surrender and pay 90,000 Singapore dollars in legal costs. Ravindran claims no wrongdoing, adds he has not been actively contesting court proceedings as settlement talks with lenders are underway. Prime Minister Modi urges citizens to take precautions as the sweltering heat wave continues to singe large parts of India. The cabinet seeks a report from all ministries on actions taken to deal with the heat wave. The cabinet approves more than 25,500 crore rupees for the Sarthak public distribution scheme over the next 5 years. The scheme will cover assistance to states for the movement of food grains and modernization of the public distribution system. The Supreme Court upholds a controversial special intensive revision of electoral rolls by the Election Commission, says the exercise is intended to secure free and fair elections. Sam Altman and Dario Amodei back the pedal on previous statements warning of a jobs apocalypse due to AI. Altman says he was pretty wrong about the economic impact. Amodei hopes AI will be a multiplier of output and not a destroyer of jobs. Both OpenAI and Anthropic are planning to go public this year. While a range-bound day of trade saw the markets ending the day mixed, the Nifty and the Sensex closing marginally lower today, with the Nifty holding above the 23,900 mark. Banking stocks underperformed today. The Sensex down 140, the Nifty Bank down by about 240 points. The Midcap index closing in the green. So once again, we've seen the Midcap story picking up pace. But the big story that we continue to track, negotiations between US and Iran continue, and this despite US military strikes on Iranian targets. Here are the latest developments. Iran has said a renewed war with the US is unlikely because, and I quote, of the enemy's weakness, end of quote. But the country's Revolutionary Guard said Tehran stands ready to repel any attack. Iranian defense forces have released footage showing the interception of US's Reaper drone. Tehran also said it tracked an F-35 fighter jet which withdrew after missiles were fired. Iran also announced the end of a record 88-day internet shutdown overnight. The continuation of talks despite the US's attacks have helped oil prices soften. Meanwhile, Iran has claimed that 25 ships have transited through the Strait of Hormuz in the past 24 hours. In fact, a tanker carrying LNG from Abu Dhabi National Oil Company has exited the Strait of Hormuz. This comes a day after an LNG ship crossed the strait to reach India for the first time since the waterway's effective closure. President Trump said he and his cabinet convene at the White House. The meeting was supposed to take place at Camp David. In a post on social media, Trump said the trip was scrapped because of the possibility of bad weather conditions. A White House official told the New York Post the president and his top officials were poised to discuss both foreign and domestic issues. In Lebanon, Israeli airstrikes have killed 31 people, injured 40 others in the southern part of the country. UN officials say Israel is responsible for 91 airspace violations yesterday, the highest number since both countries agreed to post the ceasefire. Israel's Prime Minister Netanyahu has said that he has ordered Israeli defense forces to deepen the operation in Lebanon.
Under my direction and that of the Minister of Defense, together with the Chief of Staff, we are deepening our operation in Lebanon. The IDF is operating with large forces on the ground and is seizing controlled areas. We are fortifying the security zone to protect the northern communities.
It is imperative to avoid any escalation of a conflict that has already exacted a devastating toll on civilians and that risks making the search for peace even more distant, prolonging the suffering of people. The Secretary General added that this takes place as Israel has announced an escalation of its operations in Lebanon. We witness constant violations of the ceasefire in Gaza, and the result of negotiations between the United States and Iran to enter the conflict in the Gulf remains unpredictable.
Well, that's the latest there in the US-Iran conflict. We told you first it is now official. Shares of Coal India down 6% today, recovered midday. This after the government said it will sell 1% stake in the company via an offer for sale. This accounts for roughly 62 million shares. The centre will also provide an option to sell an additional 1% stake via the Green True option. The floor price is at a 10% discount from Coal India's closing price on Tuesday, so the stock closing lower today. Global aluminium prices continue to soar. They've now touched their highest levels in nearly 4 years. This as fears about production cuts in China added to supply concerns on the back of the ongoing tensions in West Asia. Remember, West Asia is an aluminum powerhouse and accounts for about 10% of global output. Bloomberg reports that China may tighten controls on energy-intensive industries to curb excess production. China has been running smelters at near full capacity to ease global supply shortages. Shares of Hindalco, Vedanta, a national aluminum company, rose in trade today. Now, airlines are cutting their domestic and international flights amidst a drop in demand and rising jet fuel prices. Sources say that Air India plans to cut around 22% of its domestic flights, but Air India is not the only one. Madiha joins us now to take us through what's going on with Indian aviation. Madiha, airlines across the board cutting capacity, both international as well as domestic. Take us through what consumers should expect.
Right, so India anyway has just 5 major airlines, so passengers already don't have many choices, and now they are quietly pulling seats off their schedules, and this is across the country. Fewer flights are being operated. The West Asia crisis, remember, is the main reason behind this reduction. So starting with Air India, where the cuts are big. So domestic network cut by 15 to 20%, and on international routes, the reduction has been even sharper, 27% in their overall international network. In its official statement, Air India attributed these cuts to rising jet fuel prices that have made operations unviable for Air India. Coming to Indigo now, India's largest carrier by market share. It is reducing flight frequency on domestic routes, and sources inside Indigo cite 2 pressures simultaneously: a dip in demand during the current lean travel season and the overhang of the West Asia tension. So it is more of a demand side squeeze, not a cost story like Air India. Among smaller players, Akasa Air has also pulled back on its West Asia operations by 15%. This is what Vinay Dubey, the CEO of Akasa Air, has publicly mentioned. While they've kept their domestic network largely untouched, we are still to hear from them what their current domestic changes are. Regional tensions are the stated reason for Akasa Air's West Asia reduction as well. Now, coming to SpiceJet, which has been navigating financial turbulence for some time now, it is also reducing domestic flights by 8 to 10% is what we understand. They are hit by a combination of high operating costs and softening demand for SpiceJet. This is not a new challenge, but it adds to the pressure on a carrier still working to stabilize. On Air India Express, the low-cost arm of Air India Group, we are still awaiting their official details, but what we understand is their capacity cut on domestic routes is of 10%. The airline has shared its position with us, and we will update their stance shortly. Taken together, this is a sector-wide signal. Fuel costs are biting demand. Fuel costs are biting and demand is cooling, and airlines are responding by doing what airlines do. They are cutting capacity to protect their margins. And what does this mean for the traveling public, as you asked? It means fewer options, potentially higher fares on the routes, and that remain and the period of uncertainty ahead for Indian aviation.
Well, it is going to get tougher, not just for airlines, but for consumers as airlines cut back on capacity, as Madiha was pointing out. And we will have to wait to see how much of this is going to pass through in terms of prices. Now, U.S. Trade Representative Jameson Greer has said that a team from Washington is set to visit New Delhi next week. Speaking at a conference, Greer said that he hopes both India and the U.S. finalize their trade agreement soon. This comes after Commerce Secretary Rajesh Agarwal said that talks with U.S., Canada and the EU are moving ahead, and that the government hopes the agreement with the U.S. is reached soon.
We've had many meaningful discussions. We have a framework agreement done with the Indians. I have a team going there next week. I expect to meet with my counterpart soon as well. I would really like to be in a position to finalize our agreement with them as well on the basis of the joint framework we agreed to. It would be historic for the U.S. and India. I mean, just think, with the U.S. and the EU, we tried to have a trade agreement with them, didn't work out. EU and India, we've tried several times, didn't work out. So we're trying to do things that have never been done. They're not going to be comprehensive trade agreements because, as we have found, that takes years and can never find full traction.
Well, that is the U.S. Trade Representative Jameson Greer saying that a U.S. trade team will visit India next week, and he hopes to meet with his counterpart, that's Commerce Minister Piyush Goyal, to finalize the India-U.S. trade agreement. Now, the Supreme Court has set aside a 200 crore rupee penalty imposed on Amazon in the Future Coupons deal case. The competition watchdog, the CCI, had imposed the penalty for allegedly suppressing information while seeking approval to invest in the Future Group. The court maintained that any amount deposited or recovered from Amazon should be refunded within 8 weeks. In another legal setback, this time for Bajaj Ravindran coming in from a Singapore court, it has sentenced him to 6 months in jail for contempt of court over alleged non-compliance with disclosure orders. Ritu joins us now to take us through the ruling. Ritu, a 6-month sentence there for Bajaj Ravindran. What does the Singapore court have to say?
Bajaj Ravindran has been sentenced to 6 months in prison by a Singapore court in a contempt case where the court found that he had failed to comply with multiple orders linked to the disclosure of his assets. Now, as part of the ruling, he has been asked to surrender before the authorities, pay legal costs of 90,000 Singapore dollars, and also submit ownership documents linked to BR Investco, which is a corporate entity that held shares in a related company. The case is being pursued by Qatar Investment Authority, or QIA, in the Singapore court, and it is linked to a $150 million loan that Baiju's Singapore arm had taken from them. Now, the ruling adds to the mounting pressure on Bajaj Ravindran, who is already facing legal battles across multiple jurisdictions. In the United States, for instance, lenders are trying to recover losses tied to a $1.2 billion loan. Now, Bajaj Ravindran has also hit back strongly. In a statement today, he said lenders and stakeholders are already in settlement discussions with the founders, and that a settlement has been agreed to in principle with just a few minor issues that are still unresolved. He called the case an unnecessary pressure tactic by QIA and claimed there was no wrongdoing by the founders, accusing the proceedings of creating a misleading impression at a sensitive stage of negotiations. He also added that neither him nor any of the founders have personally received any portion of the disputed funds, and that the funds were only used for legitimate business purposes.
Ritu, many thanks. The Cabinet has approved the Sarthak Public Distribution Scheme to strengthen the public distribution system. The scheme will have an outlay of 25,500 crore rupees over 5 years. The program is intended to assist state agencies in interstate transportation of food, grains, and introduce technology-driven reforms. So that's a decision being cleared by the Cabinet this afternoon. Prime Minister Modi urging citizens to take precautions as the sweltering heat wave continues to singe large parts of India. In a post on social media, the Prime Minister urged people to stay hydrated and help others cope with the extreme weather conditions, advising citizens to carry water while stepping outdoors and extend help to others whenever possible. The Cabinet has sought a report from all ministries on actions taken to deal with the current heat wave. And staying with weather updates, the Met Department has delayed the expected onset of the southwest monsoon over Kerala from the 26th of May to now between the 28th of May and the 3rd of June. The Weather Department has also predicted that the monsoon is expected to reach Mumbai between the 5th and the 10th of June, while Delhi is likely to receive rainfall around the 27th of June. We'll head into a break, but up next, the Supreme Court upholds a 28% GST on online gaming, says the tax levy is constitutionally valid. That and more when we return. The Supreme Court has upheld the 1 lakh crore rupee GST show cause notices to online gaming companies. That is the top story. The top court has also ruled that tax on actionable claims arising out of online gaming are constitutionally valid. Ashmit joins us now with the details. Ashmit, this brings to closure a long pending matter, massive amounts involved here, big win for the Revenue Department. Take us through what the Supreme Court has said.
Significant decision, a decision that could impact possibly, potentially one of the largest tax disputes ever in the country. We understand that the apex court, the Supreme Court, has upheld the GST show cause notices that was issued against as many as 71 gaming companies. Now, just the numbers, those show cause notices add up to about 1.12 lakh crore rupees. Legal experts say that accounting for the penalty and the interest component, that figure could soar to even higher than 2.3 lakh crore rupees. So again, potentially one of the largest ever tax cases here in the country. The Supreme Court saying that the show cause notices are valid. The authorities can proceed under those show cause notices. The companies are free to respond to those show cause notices, to respond with their concerns, but that the GST authorities shall proceed as under law with processing these GST notices. Now, bear in mind, the whole issue came to light with the August 2023 amendment that was brought to the GST framework. This amendment, essentially what it did is that it provided for a 28% levy. The question then arose is that will this 28% levy apply prospectively, or can it also apply for the period before the amendment, pre-August 2023? And that is the question that seems to have been decided by the apex court. For now, the court saying the show cause notices that were issued even for the pre-amendment period, they are valid, they can go ahead, the authorities can press forward with that. But just the caveat here for the benefit of our viewers, this is a show cause notice. This should not be read as a final decision on the total demand that is to be paid by gaming companies. This is a show cause. GST authorities asking companies to show cause why that tax should not be levied. So now, of course, that stage will begin. The Supreme Court allowing for these companies to now go ahead and to respond to these GST notices that they're looking at.
Well, many thanks, Ashmit. Of course, recovery is a whole different matter. Many of these companies are shut. Many have pivoted. Their cumulative revenues will also not amount to the kind of demands the tax department has raised. But that is another matter altogether. HDFC Bank has refuted allegations that it flouted banking regulations by camouflaging higher interest rates offered to Maharashtra State Road Development Corporation on deposits as marketing expenses. But CNBC TV 18 learns that HDFC Bank is not the only bank to follow such a practice. Remember, HDFC Bank's shares had come under pressure through Wednesday following an Indian Express report that highlighted differential interest rates offered to the state-run entity. Furkan joins us now with more. Furkan, what is the bank's stance and where could this lead us? Is the RBI looking into the matter?
So in a nutshell, the bank has rejected allegations that there was any wrongdoing on its part or that there are any irregularities in its internal audit and governance processes. But CNBC TV 18 learns that this practice of offering certain entities an interest rate that is higher than one offered to the general public is an industry-wide practice. Industry sources also tell us that in many instances, this differential rate of interest is couched under other accounting heads so that it does not set a precedent and the bank is not pressured to offer other customers a higher rate. But let me quickly take you through what has happened. The allegations are that HDFC Bank offered the Maharashtra State Road Development Corporation, or the MSRDC, an interest on deposits at an effective rate of over 6%, when the prevailing rate it offered to others on the similar deposits was 3.5%, so a difference of over 250 basis points. The report also suggested that the differential interest amount was not paid as an interest but couched as a marketing expense. Now, we learned that in practice, this money, which is classified as marketing expense, also includes the distributor's commission. But this does not mean that RBI may not scrutinize the bank's practice because the 250 basis points difference is quite large and works out to a substantial amount given MSRDC's deposit. It's also being said that the bank's internal governance and audit committees had already taken note of this practice. Sources say that audit committee of the board under the chairmanship of former Infosys CFO MD Ranganath had ordered a formal internal vigilance investigation into this practice, and a probe had begun on 2nd of April this year. The probe was completed by the Vigilance Department under Prasoon Singh on 17th of April. The investigation report has been sent to the nomination and the remuneration committee of the bank. And my sources tell me that the investigation has flagged instances of hyper-competitiveness by the bank. This could lead to some penal action. However, the bank has responded to our queries on the matter, saying that, and I quote, the bank has a robust internal oversight, audit and control processes and systems. All issues are dealt with in accordance to bank's established norms, and full process is always followed before final determination post any internal review. We strongly reject the assumptions of wrongdoing or culpability based on selective material, unquote. We are still awaiting responses from the Reserve Bank of India on this development. Back to you.
Furkan, many thanks for joining us. Ethical hacker Nisarg Adhikari has disputed the CBSE's clarification that no production data had been compromised in its on-screen marking system. He asserts that he accessed non-test user data and had visual proof, including screen recordings, to back his allegations. Archana joins us now to help us understand what the on-screen marking portal is all about and why it has caused such a fracas. Archana.
Well, Shireen, India's education system is in the headlines yet again for all the wrong reasons. After NEET, CBSE is facing one of its biggest result controversies in recent years. Remember, this is the largest education system or board of high school board in India. So what exactly is happening? Well, it all started after this year's Class 12 board results were declared. Now, across subjects, many students said that their marks were shockingly lower than what they had expected, even compared to their own school assessments and pre-board results. Then some students began questioning the CBSE's brand new digital evaluation system called on-screen marking, or OSM. Now, what is OSM? Let's go back in February this year. So on February 9th, CBSE notified that it was moving the evaluation of Class 12 board exam answer scripts to the digital system called OSM. Now, under this system, physical answer sheets are scanned at designated centers and uploaded to a portal where examiners log in and mark them on screen. But after that, what happened? Two students, Vedant and Sanjana, and then many others like them, claimed that the scanned answer sheets shown to them during the revaluation process did not even match their handwriting. In simple words, they alleged that they may have received someone else's answer sheets. It did not end there. According to a Hindustan Times report, CBSE may have ignored suggestions from its own governing body members to first conduct wider pilot projects before rolling this out across the country. The report says several teachers involved in this testing process had advised CBSE not to proceed so quickly, now citing the need for better training and more preparation. Meanwhile, this is another important development. According to the Internet Freedom Foundation Executive Director Apar Gupta, a teenage cybersecurity researcher that you also mentioned, Nisarg Adhikari, he claimed to have found serious vulnerabilities in this portal months ago. He flagged them, but no action was taken. Now the IFF has written to the Ministry of Education demanding a time-bound probe and review the contract with the vendor. However, CBSE has rejected that any breach like this has not happened. Now, the controversy has also taken political colors. Now, Leader of Opposition Rahul Gandhi has questioned why the company which is handling this OSM system, which is COEMPT, was awarded the contract when it had similar experience or similar, obstacles in Telangana. It was previously named Globe Arena, and it was linked to similar controversies in Telangana in 2019. Now, he has also demanded a judicial inquiry into this. Back to them.
All right, Archana, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV. And stay tuned, we're back in a minute with more.
Hello and welcome to Startup Street. I'm Arundhati Ramanan, and these are the headlines that we're tracking for you from the startup world. The Supreme Court upholds 28% GST on online gaming, says the tax levy is constitutionally valid. The tax demand from companies could soar to over 2.3 lakh crore rupees. Bajaj Ravindran sentenced to 6 months prison by a Singapore court in a contempt case linked to alleged non-compliance over asset disclosures, orders him to surrender and pay 90,000 Singaporean dollars in legal costs. Bajaj Ravindran claims no wrongdoing, adds he has not been actively contesting court proceedings as settlement talks with lenders are underway. Push files its draft red herring prospectus for its IPO. The proposed IPO will comprise solely an offer for sale of 7.44 million shares with no fresh issue component. Under the OFS component, existing investors, A91 Partners and 6 Sense Ventures will offload stake. Pfizer's Capital announces the final close of its 400 crore rupee fund will invest between $1 and $3 million per startup, aims to build a portfolio of 15 to 20 companies. Sam Altman and Dario Amodei backpedal on previous statements warning of a job apocalypse due to AI. Altman says he was pretty wrong about the economic impact. Amodei hopes AI will be a multiplier of output and not a destroyer of jobs. Both OpenAI and Anthropic are planning to go public this year. Those were the headlines that we're tracking for you this evening. But on what's brewing today, in another legal setback for Bajaj Ravindran, a Singapore court has sentenced him to 6 months in jail for contempt of court over alleged non-compliance with disclosure orders. Ritu Singh joins us now to take us through the details. Ritu, take us through what the ruling is saying.
Bajaj Ravindran has been sentenced to 6 months in prison by a Singapore court in a contempt case where the court found that he had failed to comply with multiple orders linked to the disclosure of his assets. Now, as part of the ruling, he has been asked to surrender before the authorities, pay legal costs of 90,000 Singapore dollars, and also submit ownership documents linked to BR Investco, which is a corporate entity that held shares in a related company. The case is being pursued by Qatar Investment Authority, or QIA, in the Singapore court, and it is linked to a $150 million loan that Baiju's Singapore arm had taken from them. Now, the ruling adds to the mounting pressure on Bajaj Ravindran, who is already facing legal battles across multiple jurisdictions. In the United States, for instance, lenders are trying to recover losses tied to a $1.2 billion loan. Now, Bajaj Ravindran has also hit back strongly. In a statement today, he said lenders and stakeholders are already in settlement discussions with the founders and that a settlement has been agreed to in principle with just a few minor issues that are still unresolved. He called the case an unnecessary pressure tactic by QIA and claimed there was no wrongdoing by the founders, accusing the proceedings of creating a misleading impression at a sensitive stage of negotiations. He also added that neither him nor any of the founders have personally received any portion of the disputed funds and that the funds were only used for legitimate business purposes.
All right, Ritu, many thanks for taking us through those details. Now, the Supreme Court has upheld the 1 lakh crore rupee GST show cause notice to online gaming companies. The top court has also ruled that tax on actionable claims arising out of online gaming are constitutionally valid. Ashmit Kumar brings us more details. Ashmit, take us through what the Apex Court has said on this front.
Significant decision, a decision that could impact potentially one of the largest tax disputes ever in the country. We understand that the Apex Court, the Supreme Court, has upheld the GST show cause notices that was issued against as many as 71 gaming companies. Now, just the numbers, those show cause notices add up to about 1.12 lakh crore rupees. Legal experts say that accounting for the penalty and the interest component, that figure could soar to even higher than 2.3 lakh crore rupees. So again, potentially, one of the largest ever tax cases here in the country. The Supreme Court saying that the show cause notices are valid. The authorities can proceed under those show cause notices. The companies are free to respond to those show cause notices, to respond with their concerns, but that the GST authorities shall proceed as under law with processing these GST notices. Now, bear in mind, the whole issue came to light with the August 2023 amendment that was brought to the GST framework. This amendment, essentially what it did is that it provided for a 28% 28% levy. The question then arose is that will this 28% levy apply prospectively, or can it also apply for the period before the amendment, pre-August 2023? And that is the question that seems to have been decided by the Apex Court. For now, the court saying the show cause notices that were issued even for the pre-amendment period, they are valid, they can go ahead, the authorities can press forward with that. But just a caveat here for the benefit of our viewers, this is a show cause notice. This should not be read as a final decision on the total demand that is to be paid by gaming companies. This is a show cause. GST authorities asking companies to show cause why that tax should not be levied. So now, of course, that stage will begin. The Supreme Court allowing for these companies to now go ahead and to respond to these GST notices that they're looking at.
So another blow there for online gaming companies. Thank you so much for those details, Ashmit. Now moving on, India's semiconductor ambitions are getting a fresh boost from the AI revolution. Bengaluru-based Hardwire has raised $13 million in a Series A round led by Idea Spring Capital to build AI-native chips designed for the age of physical AI, where intelligence moves from the cloud to real-world devices. The startup is betting big on energy-efficient edge computing for sectors ranging from consumer tech to EVs and data centers, as India looks to build a stronger foothold in the global chip race. Joining us now to talk about the fundraise and the roadmap ahead and India's AI chip opportunity is Ramamurthy Shivakumar, the founder and CEO of Hardwire. Shiva, thank you so much for taking time out and being here with us on Startup Street. You know, the first question, right? India has long spoken about building this domestic semiconductor ecosystem, but execution has always lagged. What makes this the right moment for an Indian AI chip startup like Hardwire to sort of go global from India? Take us through what you're doing, what you have on offer.
Yeah, sure. I mean, there's so many questions in that one statement you made. So I'll try to dissect through, and you can then logically bring me back to whatever you like. So fundamentally, there is a overall sense that strategic autonomy, strategic control of semiconductors is very important for any economy, and certainly for a large economy like India, right? Large and complex economy like India. And commensurate with that, we've seen the massive push from the government over the last couple of years. And I think the government is probably focusing on the right areas in terms of manufacturing and so on. But the depth of talent that exists in India is on design. And as the industry is going through, you can call it second generation, third generation, doesn't really matter. We're going through a transition in the AI industry where fundamentally the sort of the training phase of AI with big GPUs and software running in the data centers is now transitioning to compute happening on the edge, and edge intelligence, edge ability to provide efficiency and very low latency for the types of applications that it's needed. And this fundamental shift to what we call physical AI, right? The first phase of AI largely had to do with what we think of as cyber AI, that your consumption of the output from AI is on your screen, whether it's on your laptop or on your phones. Now what is happening is that intelligence is now moving to a plethora of sensors getting data out.
Sure.
And a large number of agents working on the edge together to provide you real life, real world results. And that is the transition to physical AI.
Absolutely.
And that's where we see a massive opportunity for India.
Absolutely. And, you know, we're pressed for time, so that's why I had to cut you off there. But you've raised $13 million in fresh capital, right? How will this funding sort of be allocated across chip design, hiring talent, R&D? What's on top of the agenda for you?
You pretty much touched upon the most important things. It's all about talent, right? There is a profusion of talent in India, but there is a massive amount of competition. You know, we cannot underestimate that. And if anything, in the last year, that fight for talent has gotten even tighter. So it's about building IP. It's about finding your moat. You know, you might think of data centers and all the power challenges around the world as a limitation, but we think efficiency is your real moat. And efficiency really comes out of software and our ability to really build all of those agents that have to work very intelligently and very collaboratively at the edge to create the types of solutions that we want to. So it really comes down to IP ownership, and our ability to attract the right talent. We are a fabulous company, so obviously we manufacture with other companies, but our focus is on building our own IP and owning it.
Building your own IP and owning it, and talent is what you're looking at mostly spending these funds on. Semiconductor businesses are notoriously capital intensive, right? They also sort of have long gestation periods. Now, at this stage, what does the revenue pipeline look like for Hardwire, and when do you sort of expect meaningful commercial revenues to sort of scale up?
I think we should start seeing some things trickle in by the end of the year. We already announced a product with our lead customer last September. We've been working the execution here, keeping our heads down and executing over the last 12 months. And those things should start hitting the market by the end of the year. And then obviously it takes a couple of years to really run. So that's the sort of trajectory we are.
Sure. And, talking about AI models and data centers, right? But you're betting on sort of physical AI at the edge. Can you you've explained what that means in sort of practical terms, but which are the industries that could become your biggest revenue drivers first?
I think you'll see massive application of those in anything that is robotic in nature, things that actually have actuators and sensors that move things. That could be in industrial use cases, that could be in warehouses, that could be across a bunch of other healthcare applications. So I don't think the end market will limit us at all, right? Ultimately, what will limit us is our ability to deliver extremely efficient inference on the edge. And we have this phrase called true edge autonomy. That is sort of our framework. And as we are building things towards that true edge autonomy, efficiency is right on top. So it's basically efficiency and very, very low latency, because when you have to do physical things, things cannot wait, right? When a robot has to pick up a glass from a table, you cannot actually send data to the cloud and try to process it. And the other thing is that these plethora of sensors generate a lot of data. So you have to be able to process all of that on the edge.
Sure. And quickly, before I let you go, with global giants like NVIDIA, Qualcomm, and AMD dominating AI hardware, where does Hardwire sort of believe it can carve out a defensible niche, especially from India?
I think our moat is really the intelligence and the software that we build, right? And the big irons from all the names that you mentioned, they have populated the data center and done a phenomenal job of accelerating this business. What that has done is pretty much created an infinite market for us to address. Now our smart comes in, which are the ones that we pick, where do we put out the most efficient products, and India is a phenomenal place to not just build these things, but also have the initial customers, deploy them, and then take it to the global markets.
Absolutely. So India is a phenomenal place to build and then take it to the global markets is what you're saying. All right, Shiva, many thanks for taking time out and being here with us on Startup Street.
I really appreciate your time. Thank you, Arundhati.
On that note, it is time for us to head into a short break. But coming up next, Goa is looking to turn its tourism appeal into an economic opportunity. The state is now betting on the workation trend with a push to position itself as a work-from-anywhere hub. A special discussion on the other side. Stay tuned. Welcome back. You're still with us on Startup Street. A Vijayawada-based startup has successfully launched the country's first indigenous super pressure balloon into the stratosphere. Our correspondent Rachna Dhanrajani joins us now with more and was in conversation with Sirish Palikonda, the co-founder and COO of Red Balloon Aerospace.
India has just joined a very small club, a club that only has United States, France, Japan and China. But now India is in it because a 17% startup from Vijayawada called Red Balloon Aerospace has successfully launched the country's first indigenous super pressure balloon into the stratosphere. Founded just last year, the company went from a blank facility to a successful commercial flight carrying 7 national and international payloads in just 8 months. And 8 months is one of the fastest development timelines in the global near space sector. Now, the platform operates in a layer of atmosphere that has largely been ignored because it's too high for aircrafts and too low for satellites. And the balloon can stay there for weeks, even months, delivering connectivity, imaging and disaster monitoring at a fraction of satellite costs. Joining me now is Sirish Palikonda, who's the co-founder and COO of Red Balloon Aerospace. Firstly, congratulations, Sirish, on that successful launch. Do tell us about it. A balloon has just crossed into the stratosphere from Andhra Pradesh. Tell us what happened today and what this means for the company.
Today, we had India's first super pressure balloon launched from Vijayawada, Andhra Pradesh. So typically we have zero pressure balloons, okay, which are commonly launched to the stratosphere. And a super pressure balloon is something which can sustain in the near space from days to weeks and weeks to months. And today we have developed in record time. So our company was established last year. So within a year, like we have developed the full super pressure balloon and launched it today. And it has met all the success parameters like what we anticipated.
Now, you've described this as building towers in the sky. For someone watching from a village or a coastline with no connectivity, what does that actually change for them?
So a lot. Okay, so typically what happens like in the coastal lines or in the villages, because of less density of population, the towers would not be so many, and that limits their connectivity. And wherever there is less connectivity, usually like to put a fiber line into a very remote place, it takes like 25 lakhs per kilometer. And for areas such as that, we would be able to launch this balloon or airship, and which can provide the internet services. So it is eventually going to become like a non-terrestrial networks for all these people. And if we are operating from stratosphere, it can replace close to 400 mobile network towers. And a single airship can serve that whole geography.
So from what we understand, 7 payload partners flew on a single platform today, national and international. What does that tell you about the appetite for near space access, and what does it mean for the rideshare model for the economics?
Okay, so typically we have both rideshare as well as dedicated launch, the solutions what we offer. So when it comes to the near space, typically any space company that wants to spend a satellite or any spacecraft to the space, before sending that, they need to get it qualified on the Earth, and after near space, and then eventually they send it to the space. And to qualify it in near space, it is very expensive, first of all, because there are very limited number of players who can support in near space validations. And apart from that, they have to take care of their own power requirements as well as the communication requirements and everything. And the rideshare program, what we are planning is the customers doesn't need to worry about any other things such as the power comms or the regulatory approvals and everything.
And what would be your vision for the next 5 years?
We want to position ourselves as a cell tower in the sky. Okay, so this cell tower would be replacing 400 cell towers on the ground. So on a scale, if you look at, okay, each cell tower would be costing around 1.5 to 2 crores. And if we could replace 300 to 400 cell towers, it's close to 800 crores. And our intention is to develop a technology which can solve this problem at, 1/10 or, 1/4 of the cost of this particular, the whole mobile network operators.
From crowded commutes to beachside conference calls, the way India works is changing rapidly. Goa is now betting big on the booming workation economy by turning beach shacks into temporary offices for startups, freelancers and creators. Could work from Goa become the new normal? Zinia Baria spoke to Goa's Minister for Tourism and IT, Rohan Kaunte, on why the state wants to position itself as India's ultimate work from anywhere destination. Take a look.
For years, Goa is a place where Indians came to switch off. But now, for a new generation of workers, creators and founders, it has become a place of work away from the traditional four walls and a rooftop. We live in an era of work from home. And when you say work from home, people are really starting to ask some important questions. Why stay stuck in traffic? Why live in cramped apartments? And why commute to crowded office spaces? Why not make Goa your new workplace? The Goan government agrees. That's why it's come up with the Goa Shackathon, a first-of-its-kind initiative that turns beach shacks into workspaces. Startups, freelancers, creators, coders, students and founders are all working side by side here.
Now the Prime Minister's whole shout-out has helped us dually. One is domestic tourism has started moving up, scaling up. Weddings, conferences have started showing more interest in Goa, where they would have been going to Bahrain or some Middle East countries. And secondly, very importantly, is the work from home. When we start talking about work from home, there are states in the country where the overcongestion is there, traffic issues are there, pollution is there. So the youth today are not only looking at opportunities, they want a better job satisfaction. It is not only the salary, it is not only the perks. The best perk can be ensuring you come with your dream and make it live. And informal creative capital of the country.
Yeah.
So let's make it happen dually. So we want them to come here, enjoy Goa, stay here, work across. And for that, whatever this Shackathon is, we're getting a lot of more inputs how better we can do it. So it's the whole country we are looking for in a very balanced manner, not overdoing it. Having the right people come and utilize the spaces. We want mid-sized companies to come, create opportunities for our goals. We have the talent. We need a little skilling, upskilling, reskilling. And I think that vision, that thought which I had in my mind, I'm very happy that it's taking some walk the talk is happening.
Right.
And inputs from this type of Shackathon is going to allow us to know what we need to do in terms of infrastructure. How do we take care of the high-speed connectivity? How do we take care of the issues or the concerns raised out of this particular part where people want to come, yet they want to create this space for themselves. So it's some community-led things which we want to make it happen. Very interestingly, you'll be surprised a small state like Goa, very focused, is today having about roughly close to 800 DP-IIT startups working out of Goa.
It feels like a corporate retreat, an idea of how young Indians today actually want to work. Work from home or work from Goa?
Obviously, work from Goa.
Obviously, work from Goa.
I would say work from Goa.
As a concept itself, it sounded exciting. But when I saw it, I felt that this is something that has a very bright future.
People are fed up of working from office, and if you get a place like this, who won't like it, right?
Here in Goa, we have a thought and we'll make it happen.
The future of work in India is not going to be settled by government notifications or corporate policy memos. It's going to be settled in places like these, along the coastline or in co-working cafes or in cities that compete for talent rather than wait for it. Goa has made its move. In Goa,
Xenia Baria. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
We have with us a very special guest, the chairman of the Vedanta Group, Mr. Anil Agarwal himself. Mr. Agarwal, a busy day. Glad you could take out time to join us on CNBC TV 18. Let me first talk about the one issue that's been on all of our minds, demerger. This was a big issue on the agenda. You seem to have finally crossed that threshold. Tell us one question that we're all asking. What's next?
Thank you very much for inviting me. CNBC is my favorite channel.
Glad to hear that, sir.
Board. Very nice. We have grown in our natural resources. Since I left Bihar till now, I only looked at below the ground. So we have developed very beautiful business, and it was very important to each business is so good, so that can be by itself, Vedanta by itself. So we have demerger has already happened. I'm thankful to all the regulator or whoever was there and the court and everybody. So we have 4 big company. One is the Aluminium Vedanta Aluminium.
Sure.
Which is a phenomenal company. This will be world largest company in the private sector. We started with the 1 lakh ton of aluminium production from Bharat Aluminium. Now we are producing 30 lakh ton and going to produce in 3 years' time 60 lakhs ton. The lowest cost of producer. That story doesn't end there. We will create 1,000 industry downstream. We are creating an industrial park because aluminium users are tremendous. So all the downstream 1,000 industry will be developed, so people will come and set up the industry, and we'll support them in every respect. Then we have oil and gas. Oil and gas, my heart and soul is there. India has tremendous reserve and of oil and gas, hydrocarbon, and we were the only people in India producing oil in private sector. It was not an easy job. We are looking for producing 500,000 barrel to spend $5 billion in three years' time, 3 to 5 years' time, to produce 500,000 barrel at the lowest cost. We will have producing sweet crude. We have a complete pipeline. We have every kind of opportunity. We have a tight oil. I have a shale gas. I have a shallow water. I have a deep water. I have a big block in the Assam northeast where the first oil was produced. We are in the process, we are looking for government to give us a lease, long lease. So we are comfortable because then we can make a big investment.
Okay.
So aluminium, oil and gas, power is very, very important. At the moment, our power company produces about 4,000 megawatt, going to produce 20,000 megawatt. For that, all brownfield. All brownfield. We are looking forward. One of the best company. We have all coal linkage. Coal is not going anywhere. And we should be very proud of our coal. Coal, we have coal, what India has is sulfur-free. And I have always been advocating that coal is not going anywhere. We are a poor country. We are going to make sure environmentally we 100% take care of that. But we will make a power company about 20,000 megawatt power plant. That's what we are looking at. We have a iron and steel company, which is a phenomenal company. It is around Tata Steel, Bokaro Steel. It has infrastructure. We have a gas pipeline to produce 15 million ton of steel. At the moment, we are producing 3 million ton. We have another million ton in Goa, so 4 million ton we are producing. And we are going to produce 15 million ton, all green steel, electrical steel, or special steel. So we are the largest producer of iron ore. We will 100% backup of coke and the iron ore. So looking forward, this steel company still has a great demand in India. And then we have Vedanta Limited, which will have Africa largest zinc company. Very, very, very proud of having a zinc company. We have a 65% of Hindustan zinc. We have a FACOR, which make, we also, critical materials. So this is a Vedanta Limited, again, very flagship company. So these are the company demerger. All the share will be in the process of issuing. By next month, all these 4 companies will trade by themselves. It will have a very strong management. And this will be company which is what we require in natural resources in India. And we will proceed in that direction.
I don't want to come in there in the middle, but that's an important clarification that you're giving. Can we take it as a confirmation that perhaps by next month we'll see these individual demerged entities also being listed?
Absolutely. By next month, all the individual entities will be listed.
That's fantastic. You've given us a very comprehensive roadmap about how each of these companies in their individual spaces can grow up to be bellwethers. You talked about subject to support from the government, you're looking to make big investments. So tell us, can you give us some glide path, some indication as to what is the kind of capex that you're looking at, say, over the next 3 to 5 years?
They're looking to spend about $20 billion. And we have a very good internal profit generation in the company. Internal accruals are very, very good. Some equity, some debt we might have to take, but $20 billion investment will be there, and probably we will increase our production by 2.5 times of everything.
But you're saying mostly through internal accruals? Any numbers that your team has run by you?
No, we will be having about $10 billion EBITDA.
Okay.
$10 billion EBITDA. So I don't know that financial detail, but I was not ready. But $20 billion we spend. Fund will never come on the way. Government is with us, and this all will be India. And by this, I'm looking forward at least 5,000 downstream industry to come in with our product. For me, most important, which give me joy, to develop the downstream industry.
You've talked about previously, we've heard you speaking when you say that Make in India push has been very good. It's yielded results when it comes to smartphones, electronics, even the defense sector has done very well in terms of indigenization. But that you classify as above ground Make in India. The question that you asked previously is, what about below ground Make in India? Again, tell us, is there a need for perhaps a Make in India push even for below ground resources that you manage?
What we're talking at is self-certification, what government... I'm very thankful to Prime Minister Modi, Amit Shah ji. They always think how the business can be developed, the employment can be developed. And what we are looking at, simple policy, trust-based policy, trust-based and court also has to... What Indian courts are there is worldwide, people are very proud of. It's very important. The time is the essence, because India can't wait now. Time is the essence. All economic, whether it's the court, whether it's the regulator, more and more trust-based it be given. Entrepreneurs should be given a recognition. Manufacturing people must be given a recognition. You know, because they are pay the highest tax. You will not believe, every year I'm paying 60,000 crore tax. When I set up all this industry, I raised $35 billion abroad and brought the money here and invested all the money in all these companies. So these are the... And it's not me. Every individual is like me. Because we have the DNA of entrepreneurship.
Right.
We have a DNA of the women working very differently. So these things were being encouraged nowadays. Tremendous opportunity. We will, as far as Vedanta is concerned, we are very clear how we demerged identity will work. Very strong management. For me, it's a very inclusive.
Sure.
Because for me, last person working in my company, I cannot ignore him. He's also very, very important for me. And I'm very proud of my people and my team. We are ordinary people. Vedanta means what? Ordinary. But we deliver extraordinary result.
Well, you are anything but ordinary, Mr. Agarwal. But let me follow that up with another question that's close to your heart, what's on import substitution. I came across some very interesting numbers. We have an import bill of roughly around $800 billion. Half of that are below ground resources which we end up importing. So whether that's oil, gold, bauxite, for example. So we're talking about nearly $400 billion every year. What is the missing from our picture? Take oil, for example. We've not been able to build up capacity here within the country. What is the rationale? What's required from the private sector, from the government?
We have to be very, very careful of the world. World does not want us to produce. They want India to be a market. Middle East, all world they develop 2 hours away to supply into India. The Gold Council, they just want to supply to the gold, whether it's a copper. We have a tremendous bauxite. I just read in the newspaper, you know, the largest company has gone to Guinea to produce alumina. Why? India has the largest deposit and the best bauxite, because we have to simplify our policy. Land is required, everything to be digital. Seller is ready, buyers are ready. We have to address three. I'm just thinking big way, is our system.
Okay.
System. Our bureaucrat officers are very qualified. They are most intelligent people, but they have to let go. They have to rethink inclusive. How do we recognize is very, very important. Your government companies, what is it called? All the government companies? Public sector. Public sector, very important. Government has to take a decision. Everything has to be privatized.
Okay.
Everything has to be privatized. No one person will be retrenched. I can see 5 times more production can come up. It is very important that we take decision. In fact, I'm for gold company. nothing producing, copper company. I'm ready to take challenge on anything. Let the parliament decide and trust. And I will do everything for my country. So, and the court. Courts are, judiciaries are very important. Time is the essence. We have no other in the world. The judiciary, what we have, nobody has. But for the, to take country forward, to create job, to develop the economy, is very important. The decision, we don't waste time, we move forward. Where else we'll find Prime Minister like Modi, Amit Shah, these people, what they have done in West Bengal. West Bengal was the hub for the industry. Hub for the industry, what they don't have. It is all, everything, Bihar, this, you talk about Assam, these things, what they are addressing now, will develop.
You spoke of reforms. I want to get in your reaction on one particular aspect. You've previously spoken of how this 50-year lease that we currently have is not quite working. We need a lifeline. As long as the life of the mine is, that should be the duration of the lease itself. Are you calling for a complete overhaul of the current mechanism that we have for auctioning, for allocation of mines, of resources, of natural resources?
Beautiful question. You know, government has all the powers. Give a long rope. What is this short leave, 50 years taking back? People will run away. Nowhere like this is in the world. You are unnecessarily hanging the short. Tata Steel, we will, huge plants are there. And then you make a policy that you will take back the mine and you re-auction. Does it work? We have to come out with a long lease, whether it's oil, and there should be one policy below the ground. For the oil, you have a different policy, and for mineral, you have a different policy. Below the ground, simple policy. For us, only one objective. How do we stop import and start producing? And this can only produce by the private sector. It's very important. And public sector must be privatized.
Okay.
And the court must be very conscious that time is the essence, whatever it comes to, whether any NCLT or this, they're doing a fantastic job, but time is the essence.
Okay. Okay. You've mentioned privatization twice, so I'll just labor on that point. You talk about completely privatizing as far as all the PSUs are concerned. Will you be...
There can be exception. I'm saying generally. Because no democratic country government doesn't run the business.
So if the government were to take up on your suggestion, which is greater divestment, greater public sector assets put on the market, would you be in the market in line for perhaps some of these government assets?
My shop is open. I'm not going to go to hunt. Okay. But something comes to my shop. Any customer comes, any opportunity comes. For my shareholder, I will look at.
Fair enough. Just a couple more questions, Mr. Agarwal. One question is that you've talked a great deal about privatization. You've talked a great deal about regulatory reforms. One low-hanging fruit, to your mind, that you will recommend to the government can be put into action as early as tomorrow. What would that recommendation be?
Anything which we are importing.
Okay.
Anything which we are importing, and there is a black and white, there is nothing left. What entrepreneur can do, you know, we have proven from, one example is Bharat Aluminium. One example is Hindustan Zinc. They are the only two companies I have taken. Anything, and if you see the privatization of the airport has happened, privatization of anything, then you have trust. I really salute all my industry. They were from where to where, whether it was a telecom, whether it's airport, airline, any steel production, anything you entrusted to the or corporation, whoever trusted, they have delivered.
Sure. That brings me to my one final question. I'll end you by asking, we're living in tumultuous times. There's geopolitical sensitivities. There are factors, some beyond our control, some in our control. With all of these multiple moving parts, one commodity that you're bullish on for perhaps the next decade or so?
I'm very bullish on aluminium, copper, oil and gas. All three critical metal, very, very important. And fourth is, we can be the largest producer of arm and ammunition. The kind of factory we have, massive, if they can be modernized and privatized, we will be the largest producer of today's digital technology given. But we have to be, Parliament has to be together. Everybody has to be together, one way, one goal, to make sure that we will produce arm and ammunition here. And we run our, whatever strength we have, we leverage that 100%.
Fair enough, Mr. Agarwal. We'd like to thank you for joining us, for sharing time with CNBC TV 18. You've given a lot of insight as to the recommendations for the government, but clearly close to your heart, import substitution, and of course, perhaps some form of regulatory changes as well. Mr. Agarwal, we'd like to thank you for joining us and sharing time with our viewers right here on CNBC TV 18.
Thank you very much.
We have with us a very special guest, the chairman of the Vedanta Group, Mr. Anil Agarwal himself. Mr. Agarwal, a busy day. Glad you could take out time to join us on CNBC TV 18. Let me first talk about the one issue that's been on all of our minds, demerger. This was a big issue on the agenda. You seem to have finally crossed that threshold. Tell us one question that we're all asking. What's next?
Thank you very much for inviting me. CNBC is my favorite channel.
Glad to hear that, sir.
Board. Very, very nice. We have grown in our natural resources. Since I left Bihar till now, I only looked at below the ground. So we have developed very beautiful business, and it was very important to each business is so good, so that can be by itself, Vedanta by itself. So we have demerger has already happened. I'm thankful to all the regulator, whoever was there, and the court and everybody. So we have 4 big company. One is the Aluminium Vedanta Aluminium.
Sure.
Which is a phenomenal company. This will be world largest company in the private sector. We started with the 1 lakh ton of aluminium production from Bharat Aluminium. Now we are producing 30 lakh ton and going to produce in 3 years' time 60 lakhs ton. With lowest cost of producer. That story doesn't end there. We will create 1,000 industry downstream. We are creating an industrial park because aluminium users are tremendous. So all the downstream 1,000 industry will be developed, so people will come and set up the industry, and we'll support them in every respect. Then we have oil and gas. Oil and gas, my heart and soul is there. India has tremendous reserve and of oil and gas, hydrocarbon, and we were the only people in India producing oil in private sector. It was not an easy job. We are looking for producing 500,000 barrels to spend $5 billion in